Bajaj Finance, Cummins and Jubilant FoodWorks.
Absolutely, and we'll get you more as we go along, more opinion that is. Now let's listen to Treasury Secretary Scott Bessent, that speech which was widely followed, widely tracked, some important points here. Listen in.
There is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy. And if they want to rebalance, let's do it together. This is an incredible opportunity. I wish to be clear, America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
Okay, and I urge you go and listen to that full speech made by Scott Bessent. And Scott Bessent, of course, is very much a market, has been a market operator all his life and knows what's at stake. Drew Pettit is with us, Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi. Drew, good to have you back on the program. Thank you very much. Just a quick word, Drew, on just the overall thrust and which way it is going. It just would seem like to an outside observer that the US and the Trump and the trade team, because there are so many people who talk out of the US and on these issues, put people in power, that they are kind of becoming a little more conciliatory. They're open to a deal, etc. We've not heard China is silent. I mean, I guess biding its time. What is your sense? That's the right way to look at this?
Yeah, the tone has definitely changed in the past few weeks. Look, it started with the 90-day pause, and we saw the market reaction there. But then on the other side of this, too, you got to think about what's happened to the treasury markets and even the dollar here. So you were starting to see weakness in the dollar. You were starting to see weakness in treasuries, just higher yields. Those things do matter to the administration as well. So the conciliatory tone is kind of helping all of those assets, and it's helping U.S. equities. So yeah, look, the tone has changed, but we do have to remember, because of how aggressive the Liberation Day tariff announcements were, we're probably not going back to, where we were before. We're still expecting a higher base case of tariffs. And the other agenda for tariffs for the United States is some revenue generation as well. So look, this all kind of feeds into, it's less bad than feared on Liberation Day, but it's still probably going to settle out higher than where, at least where we expected it at the beginning of the year.
Drew, and that's the point, right? If you start at 145, there are so many levels lower down that you can declare victory. So if they declare victory, say, at 60%, which is the level that has been spoken about before the election, during campaigning, etc., right? The 60% tariffs on China. So if you go from 145 to 60, that is equal. It doesn't matter if it's 100 or 145. There's no trade there. But 60 is equally, not equally maybe, but it's still bad, isn't it?
Yeah, it's still dense. It's still dense U.S. earnings and companies that source out of China. Look, when we thought about this impact across sectors, the more aggressive China tariffs have a greater impact on something like technology and consumer discretionary. And those are the two sectors that really, from an EPS perspective, are at the most risk of seeing downgrades, at least in the U.S. So, yeah, that's back to your point, 60 is still a high level. We are expecting something higher than a 10% baseline sticking around for China, but 145 is really not baked into our updated views post-Liberation Day.
Drew, hi. Great to be speaking with you today. And I guess that explains why you folks at Citi have cut the rating on, I think, U.S. equities to neutral, right? because the EPS tailwinds and the GDP strength, all that, as the note says, will perhaps be fading now. But how severe could it be? I mean, what exactly are you expecting in the US market? And in the part, the reason I'm really asking is that I know that India is an overweight for you within the EM basket, but in the past, when there's a big slowdown in the US or the US market really falters, most emerging markets tend to suffer. Could there be a decoupling of sorts this time?
To some extent, yes. But what's really interesting in the regional calls out of our global team is you're thinking about buying cyclicality outside of the United States. So select emerging markets, like you talked about, Europe, Japan, different areas, again, for cyclical and value stocks. Why we're still neutral on the United States and not moving all the way to an underweight here is there are still very innovative companies that are very well run that are still going to have good earnings growth. So the risk at this point is being underweight or not exposed to high margin, high quality US companies that can bear the brunt of tariffs. And again, seeing those stocks move like we've seen in the last few days on some conciliatory tone on trade. So yeah, yes, we've downgraded the United States as a team, but we do see the risk of not being exposed to really good secular growth stories still. So it's selective in the United States. That's why it's in neutral.
All right. Hi, Drew. Good morning and good to see you. When, a lot of our audience would like to know what about within the emerging markets, how are you betting between India as well as China? Because China is going to be hit harder as per what we have on the table right now from the US tariffs, while India, well, we're relatively better placed. So between the two, India gets pole position. Would that be the way we look at it?
Yeah, it sure is. Like, look, India, from a trade perspective, less exposed. So number one, very important when we're thinking about tactical position in EM. Now, number two, India also has a really good at-home macro growth story. So you still have that tailwind in place. So both of those points really push India as an overweight within our EM allocation. China, on the other hand, that's an area where we're neutral. Again, not all the way underweight. There are some kind of structural stories there, and maybe less trade exposure for some of the big names within that market. But India does have far less trade exposure from a macro perspective than China does, hence the overweight rating relative to a neutral on China.
Okay, and within the emerging markets, I'm just looking at a note that you put out. It appears some of the LATAM countries as well as finds preference. I think Chile, is one market that you like. Tell us more about that.
Yeah, so I'll give you LATAM. So Chile is our overweight there. And again, this is a really good earnings growth story. So coming off of a low base, working much higher, the cyclicality there probably priced in better than other places, or potential dense to cyclicality. So really good earnings growth story for Chile. Where we're thinking about other overweights in EM, a place like Taiwan, for example, similar story to how we talk about US growth. There's AI and secular tailwinds for some of the big weights in the Taiwanese indices. And then the one cyclical area where we kind of are comfortable in emerging markets is South Africa. And this is a valuation call on something like South Africa, which has probably priced in, the effect of tariffs very aggressively. So again, outside of India as an overweight, we have Chile for an earnings growth story, Taiwan for the AI tailwinds, and South Africa because it's already priced in a lot of bad news.
Okay, got that. So, well, a lot of equity calls changing, and that's given the uncertainty that we're living in the midst of. Thank you very much, Drew, for joining in. Appreciate you giving us that perspective today. So there you have it. That's the city view coming in on lots of calls changing, actually. But the good news for us is that within the Asian region, Japan is an overweight for them, India remains an overweight, and China is a neutral.
What was the number, guys? The FI number yesterday?
3,333 crores. Quadruple three.
Stomping back into the market, but still a fraction of what they sold, right? I mean, I think that's an important point. So this is a sort of slightly looks like a global kind of repositioning of India within whatever EM funds, or we'll get that perspective from EPFR, etc. as well.
6 straight sessions, I think. So good.
So last week was 3 days. It was 50,000 crores. And this week would be
so far 3
plus
days.
What? I mean, so we'll have to see.
I mean, today's the 4th day. We'll see.
It should be what, 25, at least 25,000 crores?
22,000 crores, I think.
Over the last 6 trading sessions or so. Well, let me quickly run you through what's lined up here in terms of the interactions over the next 2 hours or so. 8:35, Aditya Khemka of Infrared Asset Management talks to us about pharma. And we'll talk specific stocks with him. Lots to discuss. 9 o'clock, Sandeep Agarwal, IT analyst, ex-IT analyst, Sovelo Investment Managers, but IT is the focus on the back of earnings. 9:20, Dheeraj Agarwal of Ambit Investment Managers will be with us. Market Master, 9:40, we'll have a discussion on autos. So, we'll have 2 gentlemen to run us through the Ather IPO, which opens early next week. And of course, what's happening with Ola and the entire EV ecosystem. Our sort of excerpts of the conversation my colleague Shireen had with the management of Tata Power at about 9:50. And towards the end of the program, it's the economy Lata in conversation with Stephen Major, fixed income expert at HSBC on expected trends in dollar and US, and of course yields here as well.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you. On the other side, in our special Top 10 segment, we're looking at Tata Consumer, LTI Mindtree, Canfin Homes, Persistent Systems, Dalmia Bharat. All of them will be reacting to positive news flow. We had Biocon as well as Sami Hotels. But on the flip side, you have Bajaj Housing Finance as well as Syngene and Spandana Spurti that will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail.
Welcome back. So like we've been telling you, cues across most Asian markets, barring Hong Kong, are actually pretty okay. There are some gains in Asia. Let's get the markets up. Yeah, the Hong Kong markets, not feeling too great this morning. Let's pull up the implied open. I mean, considering our run, this solid run of 7 straight sessions of gains, the implied open is suggesting that today there could be a bit of a halt on that, 47 points lower at this point. Well, apart from all the global cues, of course, lots and lots of earnings and stock-specific action to go over. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, good morning to all of you. First, let's recap the big earnings, then we'll come to the others. Mangalam, Tata Consumer, how did it look?
Well, it's largely in line with expectations, a few bright spots in Tata Consumer. So if you look at the revenue at 4,600 crores, the street was working with a number of 4,575 crores. The EBITDA, despite a 420 basis points drop in gross margins, it actually improved versus expectations. So 621 crores versus expectations of 600 crores, which meant margins came in at 13.5% versus 13.1% as well. And the net profit was a beat led by, better than expected EBITDA. But more importantly, there was a 45 crore exceptional gain that came in as well. India beverages, organic revenue grew by about 9%. The street was working with a number of 10 to 12%. But look at foods. There, the organic business was close to 17% in terms of growth. The street was working with low double digits. So that was an outperformance out there. Narishco as well. We were working with 8 to 10%. 10% is what the company reported. That's a positive. And Capital Foods in Organic India, the acquisitions that they made did about 320 crores in revenue. Again, better than as expected in the performance. International business, 5% revenue growth led by US and UK. We had non-branded businesses that did extremely well, 25% higher, led by higher realizations in coffee prices. The stock has done well this year, 24% higher this year with, trading at around 55 times FY27 price to earnings. So it's priced to perfection. So see mild green despite, numbers which are slightly better than expectations.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Rima. She's here to tell us about a couple of tech names. LTI Mindtree. Rima?
Well, LTIMindtree was largely in line with expectations. The company's top line declined by 0.6% quarter-on-quarter. EBIT margins unchanged at 13.8%. The company said the quarter was impacted as ramp-ups of deals which closed in Q3 got delayed, and even some new fresh deal closures got pushed out. That said, in the conference call, they did say that they're hopeful that Q1 is now a growth quarter. Clients were cautious in Q4, but some conversations have started in Q1, and the company is hopeful the deal closures will happen in FY26. So Q4 muted on expected lines. Commentary about the upcoming quarter and the year seems to be a little more optimistic.
All right, Rima, thanks very much for that. So keep an eye out on this one as we open up. Bajaj Housing Finance and Canfin Homes are the next two in focus. Abhishek is here with details. Abhishek.
Well, Prashant, to begin with, Bajaj Housing Finance, the numbers are below analyst estimate. P&L versus Kotak Securities estimate does show that NI and PAT is below Kotak Securities estimate. Disbursements are strong at 25% growth YOY and about 13.5% sequentially. However, disbursements to AUM ratio has declined, and for last 4 quarters in a row, it's been on a declining trend, which suggests that the tenure of the book is also declining. AUM growth is healthy at 25.5% YOY and nearly 6% quarter-on-quarter, but they have lost out on spreads over the last few quarters. So spreads has declined to 1.8% versus 2% in the same quarter last year and about 1.9% in the previous quarter. Well, Canfin Homes, the P&L is ahead of analyst estimate, which I've taken into consideration, that is DAM Capital. NI is at 348.5 versus 345.7 crores estimate. PAT is at 234 crores versus 221 crore estimate. Net interest margin has surprised positively. It's at 4-quarter high of 3.82%. Disbursements have started to pick up. Sequential growth is at 30.65%. Remember that in Q3, there was a blockage with respect to registration in the key cities of Bangalore as well as Hyderabad. So AUM growth has picked up 9.2% YOY and 2.9% sequentially. The return ratios are robust with ROA at 2.6% and ROE of 18.5%. And if you check, the asset quality has also seen seasonal improvement over here. Gross NPA ratio has declined to 0.87 versus 0.92% in the previous quarter. Back to you.
Okay. All right, Abhishek. Got that. Thanks very much. Let's get back to Rima. Rima, Persistent Systems. How did it fare?
Well, very good growth in Q4. So the company reported a top-line growth of 4.5%, slightly ahead of consensus expectations. And also bear in mind that most of the companies in Q4 have reported a top-line decline. And this is a company which has grown 4.5% in Q4. And for the full year, top-line growth stands at 18.8%. EBIT margins have expanded to 15.6% on expected lines. Deal wins are a bit subdued sequentially. If you look at the total contract value, the new wins, across the board, deal wins are down quarter-on-quarter. But the company, in their commentary, says that as we look ahead, we're optimistic about sustaining progress to reach $2 billion in annual revenue by FY27. So despite the uncertainty, they're reaffirming their guidance of $2 billion by FY27, and growth continues to be superior than peers.
Okay, all right, Rima. Thanks a lot for that. Well, I'm focusing on Dalmia Bharat, and the numbers are pretty okay, and the outlook should be better. That's why I'm going with green. No big shakes in the numbers, but I'm going with green because the outlook should be better from here on. These numbers are more or less in line. On the top line, a small miss. Why was that? Because realizations were expected to go up on a sequential basis. Didn't play out for them. Also on volumes, it came down by closer to 3%. That's on expected lines because in the base year, there was tolling volume coming in from JPA, which wasn't there. Adjusted for that, actually, there was a mild growth in terms of volumes. Moving to the operational performance, actually, it was in line. You'll be wondering how. Because there's no operating leverage that played out. They didn't get the benefit of higher pricing as well, but they benefited on the cost side. So the cost of power and fuel as well has come down, which helped them on the operational performance. And just one factor that we'll be waiting by for clarity on is the other expenditure came down sharply. So that's what led to the EBITDA per ton moving up from around that 750 odd mark. It went up all the way to around 926 rupees per ton, which is a positive. The net profit number though looked much better. Effective tax rate was lower and depreciation was sharply lower as well, which explains why the profit number looks much better in comparison to our poll. They've also laid out a capex plan of close to around 3,500 crores as they're looking to add capacity. And now the debt number has come down to only around 700 crores. So balance sheet in pretty good shape. Going with green because the outlook should be better from here on. But there's a big deal that's announced earlier today, and Nimesh had given us a heads up about Sami Hotels. Mangalam joins us to help us out with those details. Mangalam?
That's correct. You know, Nimesh had told us in D Street Chatter, and it's come true. It's announced a strategic deal with GIC where GIC will acquire 35% stake in 3 of the company's subsidiaries for about 752 crore rupees. This values that business at an enterprise value of close to 2200 crore itself. And these are just the 3 subsidiaries of the company. They will use 603 crores of this to reduce debt. Remember, in FY25, their net debt is close to around 1500 crores. So their debt comes down by that. And the remainder, 149 crores, will be used to fund capex in a couple of their marquee properties as well. The company said that on closure of this deal, their debt will reduce by about 580 crores. And their profit will increase by 15 to 20%. So this is obviously a good exercise when it comes to value unlocking and improving their balance sheet as well. How much of that is priced in will be the big question, because in the last fortnight itself, the stock is up around 23%. But it is strong tailwinds for the hospitality industry. Expect the stock to see some more green on the back of this deal announcement.
All right, Mangalam, thanks very much for that. So Sami is a stock you must have on your radar as we open up this morning. Syngene and Biocon. Vinny is here with details on these numbers. Vinny, over to you.
Good morning. So Syngene, a weak set of numbers that came in from the company in Q4 FY25, and overall for FY25 also it was a very subdued year that came in for Syngene. Now in terms of revenue, especially for Q4, 11% growth in terms of revenues. Margins have seen a contraction this time. 33.7% is what the margins came in at versus last year 34.5%. Mainly pressure on the margins was higher employee cost. Overall change in mix is also something that is impacting Syngene's margins. So a bit of a subduedness that we saw in terms of margins. Profits of the company have seen almost a 2% decline as well this time. Now revenue growth this time was mainly only supported because of the CDMO side of the business that was doing well. Commercial projects were there, and there was a conversion in terms of inquiries that came in for the CDMO business into clients. So that was a bit of a positive on the CDMO business side, but other than that, muted performance. Now what's taking a bigger hit and why are we expecting red here is the guidance for FY26, a very muted guidance that is coming for FY26. Despite this being a year where we are seeing muted performance as a subdued year for the company, so FY26 revenue growth, they're expecting just a mid-single-digit revenue growth there. Base business also is seeing a growth of early teens is what they're expecting in FY26. EBITDA margins expected to moderate, profits expected to fall from these current levels as well. So FY26 not expected to be a great year. Biocon, on the other hand, we're expecting green coming in here. They've announced a raising of around 4,500 crores. This is going to be through issue of securities. QIP's right issue could be a possibility over there. So keeping an eye out on Biocon, expecting green here.
Okay, so Biocon green, Syngene maybe a little more red. Got it, Vinny. Thank you very much for that. Back to Abhishek. Abhishek, Spandana Spurti, the MD and CEO has resigned?
Well, yesterday in trade, you saw the stock decline massively despite the fact that Nifty was up 0.7%. So now we know the reason. Spandana Spurti has seen their current MD, that is Shalabh Saxena, place his resignation. He'll assist the company during his notice period. The president and CFO, that is Mr. Ashish Damani, has been nominated as the interim CEO to take over the reins during this notice period. The con call that they had for analyst community yesterday evening, he did say that they'll raise money of about 500 to 750 crore post the Q4 FY25 results, and this will be confidence capital as the CRAR, that is capital adequacy ratio, is already at 35%. Now the MD also did mention that he had been contemplating this move since last 6-7 months about the resignation, and now he's placed resignation at the company. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's do a quick recap of all the top stocks that we covered for you. The ones with positive news flow first. Tata Consumer, LTI Mindtree, Canfin Homes, Persistent Systems, Dalmia Bharat, Biocon and Sami Hotels. While the ones with negative news flow include Bajaj Housing, we have Syngene and Spandana Spurti. That's about equities. Let's turn our attention to the commodities market. Manisha Gupta joins us to tell us more what's going on there. Well, Manisha, when I woke up this morning, gold was down, but that was short-lived. Popped back up. Tell us more.
Oh, well, absolutely. Every dip is getting bought into. You're absolutely right. We saw an all-time highs of $3,500 an ounce. And from there, gold saw profit-taking, went to 3,260 on the lower side. It's trading at 3,340 right now. So, well, absolutely. $60 to $100 of a move coming in every day in case of gold prices there. Well, the dollar index is off its 3-year lows. There's a bit of a rally in equities. And the U.S. has expressed potential lower trade tariffs with China That is what is keeping the gold prices in check right now. But various banks and brokerages who had earlier talked about 3,500 with that target done are talking about some profit taking in the near term. But they do expect that the year 2025, calendar year that is, will end with all-time highs in gold yet back again. What we are also seeing volatility into is the crude oil prices. Fell 2% overnight. Crude is, by the way, down 10% on months now. There are various statements from OPEC and allies suggesting that there could be an increase in output, not just for the month of May, but even higher for the month of June. And then the U.S. crude inventories also have seen a bit of a decline. Markets also are looking at potential trade negotiations with China. So all that premium that was building up in case of crude prices also seems to be going away. The only thing that actually has made a mark in the overnight trade has been the silver prices, 3.5% of gains overnight, and continues to surge in Asia even now.
Right. Manisha, thank you very much for that. You know, that snap, gold lower and then gold lower last night, gold higher this morning. I think the difference is China. China woke up, Chinese markets opened. And actually, that's been true for the last couple of days now. So demand out of Chinese markets quite very, very strong. And that kind of explains the pop higher that we saw early on. We'll take a quick commercial break here. We're going to come back. Aditya Khemka of InCred Asset Management talks about stocks and stocks on the pharmaceuticals space and what he likes there. You know, this sword has been hanging on the pharma space for a while, these tariffs, sectoral tariffs, right? But lots of individual stock-specific developments as well, which we want to address. Deepan Mehta of Elixir Equities will be joining us as well. So stay tuned. Okay, welcome back. You know, Pharma in Focus, right? Aditya Khemka is now with us, a fund manager at InCred Asset Management. Aditya, good morning. Good to have you back. Prashant here. You know, I want to start with what is the hottest topic of discussion? I mean, if you are in, sort of, you're talking to your GP or doctors, etc. I mean, I've been GLP-1 and all of the excitement around this new oral drug of Eli Lilly. Right? And decently high efficacy in terms of course, the test was for type 2 diabetes. The obesity longer run tests will now happen. But still, even in this, 8% weight loss, etc. So very effective in that sense. What are the implications for Indian listed stocks here? There's a Citi note this morning, Aditya, talking about how, you know, Divi's perhaps is the big beneficiary out of this. So talk about that, Divi specifically. And second, talk also about two other companies. One is OneSource, there's one more company, right, which Shelley Engineering. So one does fill finish, the other does sort of plastic components. So these three names to begin with. Aditya.
Yeah. Thanks for having me, Prashant. So firstly, you know, just to be very clear, I think the GLP-1 market is going to be extremely competitive. And, you know, there might be players who will be, you know, the first movers for the first 6 months or 1 year, but then, you know, there'll be a whole bunch of companies jumping into the market, especially where the injectable product goes. So your fill finish players, your API manufacturers like Divi's, they will all have, you know, significant competition. over a period of time. But yeah, initial 6 months to 1 year, they might have some sort of a exclusivity window where they'll make some money, but then the revenue stream dies off. So as an investor, when we look at cash flows, we don't look at 6 months, 1 year cash flows. We look at 3-5 year cash flows. And there, our estimates don't really change because you have these one-off kind of opportunities hitting the P&L and, helping you in any form or fashion. As far as Eli Lilly goes, yes, the innovator might make some money out of this because it's an oral drug, and the oral drug, therefore, have a much higher ability to penetrate the market than the injectable does. And yes, so Indian branded generic pharma companies, they might in-license the drug from a Lilly and they might sell it, with their own brands on the label, and they can make some money on that side. But as far as the manufacturing side goes, be it Divi's, OneSource, Shaily, and many others, who are claiming to be a participant in the GLP-1 markets, I would not have very high hopes for them.
But why is that, Aditya? I mean, it's a big market. It's not just weight loss, right? There are studies which are, I'm just want to clarify, it's such a controversial topic, right? I mean, and doctors get all riled up when you ask them. Some are strongly against it, saying, well, what about the long term? These are new drug side effects. I don't know. We're not medical doctors. So there's no opinion on whether one should take it or not. But purely from a business standpoint, there is the obesity part, but also there are studies which show, it's effective in treating so many other ailments. Neurological, for example, etc. My question is, and these companies are, so I have a specific 2 or 3 questions. One, will oral dent in the injectable GLPs? That is one, in your opinion. Second, if it's going to be the biggest drug ever, globally, I mean, this category of drugs, why won't it be a lasting revenue stream if Indian companies are able to get into various parts of it, either the components or the fill finish?
Exactly. Yeah. So first of all, will the oral be better than the injectable? Given that everything else is the same in terms of side effects and efficacy, yes, oral will be more successful than the injectable. But that's subject to the side effect profile and the efficacy profile, which I don't think we have a head-to-head comparison yet. So it's too early to call that. But if it is the same, then oral will definitely be more successful commercially than the injectable product, just because of the ease of dosing, right? Now, why we don't expect the manufacturers or the Indian pharma companies to be beneficiary in the longer term? Because in manufacturing of pharmaceutical products, it is never the demand, the size of the demand. It is the size of the supply that dictates how much money you make. So the demand can be 100 units, 1,000 units, 1 lakh units. If the supply is 150, 2,000 and 5 lakhs, then nobody makes money. And I think that is exactly what GLP-1 is going to be, because no matter which pharma company I speak to, GLP-1 is the first growth driver they talk about. And that's what tells me that nobody's going to make money. Let's take a journey back to 2011. Atorvastatin, Lipitor, was the largest selling $14 billion drug in the market back in those days. And nobody made money. Only Divi's and I think only Dr. Reddy and Ranbaxy and Teva made money for 6 months. And then nobody made money out of Atorvastatin. So I think it's pretty much going to be the same thing here.
You think, so again, to take off on that point, do you have specific numbers on the capacity? You said supply more important than demand. Do you have size of supply right now? For example, let's take this, the components, for example, or let's take the API, which Divi's will get into.
Yeah.
All these companies, this is all anecdotal, right? They all are excited, but are they really being able to do anything about it? Because Eli is not going to work with everybody, right? So it's hard to kind of get on board with in licensing or whatever as well.
Yeah. So look, none of these pharma companies will call out their capacity for a given drug. Many of their capacities are generally multi-purpose. So they can be used for a given drug or other drugs at any point in time. And hence they cannot sort of call out a dedicated capacity for a given product or a given therapeutic segment. And hence, we do not know how much capacity is chasing the demand here. But what we do know is that the number of companies chasing it is very high. So even if each individual company on an average has a certain capacity, then it will outstrip the demand. And this is not new. This has happened at least 5 times in the past 20 years that I've been looking at pharma. It happened with aripiprazole, it happened with pantoprazole, it happened with atorvastatin, it happened with rosuvastatin. So we have seen all these large multi-billion-dollar drugs translate to nothing for generic players over a period of time. Initially, they do contribute some number, but then they translate to nothing. It's happening to Revlimid as we speak. Look at what happened to Natco in the last quarter. It's just the nature of the beast. You cannot make money in these large drugs because of the large number of players who are interested in these drugs. And then, when you come to the marketplace, it's cutthroat competition. Nobody ends up making money in the long
Okay,
run.
got that. Let's talk about two other names. One is Lupin. There is this big drug going off patent, a big opportunity. So any thoughts there? And then just run us through, if you have any thoughts on Syngene, pretty poor numbers.
Absolutely. So let's take up Lupin first. I think the drug that is going off patent, Lupin has a play in it. But that is already part of our estimates for Lupin. So, it's not over and above what we were expecting. So let's see, how the business sustains. But again, Lupin has a limited competition window there, and after that there will be competition. The drug will not be a sustainable revenue stream for Lupin as well. So that 180-day exclusivity that they have, that is basically the period where they will make some extraordinary money, and then it will fizzle out. And such revenue streams and profit streams cannot be given a multiple simply because it's a half-year revenue stream. It does not deserve a multiple. Now coming to the second company, which is Syngene. So in Syngene, I think what has happened is that the order flow that they were expecting has not been up to the mark. They have maybe lost a couple of customers or some orders from a few customers because these customers have opened captive centers here in India, and hence switching some of the demand from Syngene to their own captive centers. And that is something which is sort of creating a challenge for revenue and margins in the near term. Having said that, from a longer term standpoint, I'm not so worried about Syngene. Again, it goes back to sustainability, where we feel that, the China Plus One is clearly something which is playing out. Syngene is a front runner in the Indian CRO CDMO space and should eventually benefit. What we feel is that the current environment and maybe even the next 2 or 4 quarters, you may be looking at Syngene as more of an aberration than the rule. And I think once they get their act together, definitely there has been some mixed execution at the company's level. But once they get their act together, I think the demand in the market is too big for them to sort of grow in single digits. They will definitely come back to double-digit growth, subject to them getting their demand, their act together.
All right, Aditya, a quick conversation. Thank you very much for joining us, and we'll have more of these as we go along and we track developments, especially on the GLP-1 side. We take a break. Deepan Mehta on the other side.
Welcome back. Hope you're having a good morning. For starters, the GIFT Nifty was suggesting a bit of a flattish or mildly negative start of close around 40-50 points. So they're about 60 points now is what we're bracing ourselves for. But plenty of stocks, a lot of action. Deepan Mehta, Director at Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Good to see you. When few good earnings came out overnight, case in point being a Tata Consumer, though the stock has jumped up. And also we had positive numbers coming in from LTI Mindtree, and Persistent System looked very, very good. Among the three, do you like any of them?
No, Nigel, none of them. If you call 2-3% type of a growth as good, I don't know, what is good then. So whether all the tech companies, the results so far have been disappointing, except maybe for Persistent System. There also, eventually growth will slow down because of base effect and the uncertainty. So I think it's time to get extremely cautious on the software services company. And what is even more disappointing is that the management say that a 2-3% type of a quarter-on-quarter growth is a strong quarter. Means what has happened to the ambitions of the software services companies which were driven by entrepreneurial spirit? Now they are more than happy with a mid to high single-digit growth in sales. So I'm just very disappointed with the sector as a whole. And there are a lot of secular headwinds. This GCC is going to play a big role in reducing their growth rates. And of course, there is this entire sword of slowdown in US, which may affect tech profits. So we are getting more and more underweight on the software services side. There could be a few exceptions, companies which have a differentiated business model. But by and large, don't get enthused by a 2-3% outperformance versus what the analysts are expecting. And just because stocks are cheap. So I would still avoid the sector completely. Tata Consumer is good, but look at the valuation. I mean, the PEG of 6-7 times or so. You can't get solid money or get great returns or build wealth through Tata Consumers by buying at these levels. That's my conclusion.
Deepan, that's on Tata Consumer. Of course, today lots of other consumer companies are also reporting. Nestle is reporting, Lever is reporting. We all know, I mean, there's no growth there either. But, maybe they're not as expensive as they used to be. Would you look at any consumer stocks at all on the FMCG side?
Yeah. Good morning, Surbi. The biggest mistake I have made in life is to buy stocks which are cheap. And because they have corrected and valuations have come up, because the valuations have come up because there's something fundamentally wrong. And in the FMCG sector, a lot of categories have become mature. The growth rate, underlying volume growth rates of many of the FMCG products is now linked to the population growth and not the GDP growth rate. And that's a very important distinction because you're in a country where you have a nominal GDP growth rate of 10% plus. Then why aren't these companies growing at 12-13% or so, or growing at 4-5%? That's a question you have to ask. And the reason for that is that the penetration levels have reached deep. All the benefits from getting into the rural areas is now over and done with for a lot of these companies. And end of the day, I think consumer spending on FMCG products as a percentage of their income has remained static or gone down. And now there are many more avenues for the consumer to spend, be it in retail, travel, hospitality, healthcare, education. There are many more needs. And the Indian consumer has fast changed than what he was about 20 years ago.
I call it the mid-single-digit jinx, Deepan, because that's what this whole sector and many of these companies have been in the severe grip of, this mid-single-digit growth. Will it be any different for Lever this time around? Since we're on the subject, let's bring in Manglam and get the expectations going. Manglam?
You call it the mid-single-digit jinx, and will Lever be any different? Yes, it will be, because it'll be low single-digit and not mid-single-digit this time around. Demand conditions are very similar to what they were in the third quarter. 0 to 1% domestic volume growth is expected, not too much. 2% underlying price growth, and that's largely because of palm oil prices increasing, and at the same time, tea prices increasing as well. So there would be that portfolio-led price increase, and the company will navigate through their margins by reducing their ad spends from closer to 11% of sales to about 9.5 to 10% of sales itself. Put all of that together, what do you expect for Unilever? A 2% revenue growth, 15,161 crores. EBITDA grows at 2% as well, with margins staying stable at that 23.1% mark itself. Net profit higher by about 3% at 2,475 crores. Personal care segment likely to grow between 0 to 2%. Beauty and wellness, which is a category which has been growing fast. We've seen that in the case of Nykaa as well. Likely to grow much better than the overall portfolio at around 4 to 5%. So that's mid-single-digit growth for you. Home care and food expected to grow around 2 to 3% or 0 to 2%, depending on the way you look at. More important than the numbers this time around would be the management commentary on scaling up of operations and what their expectations from FY26 is when it comes to urban demand in particular.
2% volume growth, Manglam, right? That's what you said.
0% volume growth and 2% revenue growth. 0 to 1% volume growth.
0 to 1% volume growth. When a giant like Lever, with its muscle and might, its distribution power, its marketing power, tells you there's 0 to 1% growth, and this is all across the country. It's pan-India growth that we're talking about.
Yeah.
Through channels, I mean, e-commerce, direct, kirana, everything put together, 0 to 1%. That's telling you something, that the market definitely is listening.
Well, indeed. Deepan, I wanted your view on a sector that could grow, though, going ahead. Dalmia Bharat. The numbers are pretty okay. I think after a few years, the last time we chatted, you were sounding at least a little bit more interested in the cement names. It's domestic facing. Cement prices have moved up. Input costs have come down. Q1 should be better than Q4. Anything you like from the cement pack? And if you had a closer look at Dalmia Bharat's numbers?
Yeah, Nigel, we are getting constructive on the cement sector. I think it's in a nice cyclical upswing after 2-3 years of downswing. And Dalmia Bharat being the fourth largest cement company certainly should do pretty well. Bit disappointed with the volume numbers because the growth in profits has come through lower costs. Typically, we want the volumes to go up in the cement industry to get more and more confidence in the sector. But yes, I think given the kind of construction activity and so many real estate projects have been announced, they should start getting into construction phase as well. And with the elections and all over and done with, execution also will pick up. So we are very positive on cement. The favorites over here with the usual disclosure that we and our clients are invested are the Adani Group company, that is ACC and Ambuja, where they can squeeze out more efficiency, especially in ACC. And they're very aggressive when it comes to M&A activity. The group itself is a captive consumer, and they have great plans for these companies, and valuations are reasonable below the other larger companies, be it UltraTech or even Dalmia Bharat or Shree Cement for that matter. So there's at least a slight opportunity of a P getting re-rated higher. So generally positive on cement, I think, and I think that these two companies will outperform the rest of the market.
Valid thought, Deepan, and good to hear after a while you're getting constructive on the cement space with good reason, as you explained that to us. Stay with us. For the time being, we slip into a short break. Come back. Our technical experts will be joining in as well.
Welcome back. Just about 15 minutes to go before we hit the pre-open session. Good time to bring in our technical experts. Actually, not the pre-open session. I meant the open session. We're already close to 9 o'clock. We have Sudarshan and Mitesh joining in, as always, with the technical setup. Gentlemen, good morning to both of you. So the market is in cruise control mode nearly. Yesterday, banks took a bit of a pause, but then other sectors made up for it. Sudarshan, so what would your sort of trading direction be, and specific index calls first?
Yeah, good morning. See, my trading direction would be completely away from the market. Yesterday, I suggested that we are getting a gap up. Use that gap up to close all your long positions. And I think that view continues today. This doesn't mean the market is going to turn down or we want to go short, far from it. What it means is that markets will become choppy and sideways. You know, a trader will always find it difficult to trade choppy markets. So it's much better to step aside. Wait for a couple of days, 3 days, whenever the markets start giving signs of life again. I would expect a lot of choppiness for the next few days. So stay away, cash in your profits on the long side and just watch it.
Okay, all right. Cash in your profits on the long side and wait by. Got it, Sudarshan. That's your take. Mitesh, what about you? Would you participate on the upside?
Nigel, I've been maintaining a long bias, and I think that still remains. The setup on the short-term and the medium-term charts is positive, except for the fact that we are slightly on the overbought side, which means that now, instead of buying at every moment, every chance, every opportunity, I think you got to be slightly smarter and you want to wait for some kind of intraday dips to take fresh positions. If you're holding long positions, then you can just keep trading your stop losses and be happy about it. But for somebody who wants to enter a fresh, I think any kind of decline, intraday or maybe a 1-2 day kind of a pullback to the 10-day average or to a gap support pivot area, I think would be a fresh entry point, and that's the way we'll approach it. But on stocks, yes, you would still be trading with a long bias, clearly, because my belief is that the market is poised to go higher.
By the way, congratulations, Mitesh. Yesterday, we started 200 higher, lost 100, and then I think came back once again. So it was good. I mean, I think it was saying that by the intraday dip in that sense. Gentlemen, morning. Sudarshan, what would you do in terms of specifics?
Well, Asian Paints is a buying opportunity with a stop under 2410. GMR Airports is a buy with a stop under 85. I have only one intraday short because I'm not bearish on the markets, just choppy. Voltas is an intraday short with a stop above 1335. And finally, ICICI General Insurance is a buy with a stop under 1845. This is a good time to focus on stocks rather than on the index.
Okay. Mitesh, what about you?
I would, have all buy calls today. A buy on Aurobindo Pharma with a stop at 1220 for targets of 1300. A buy on Cummins India with a stop at about 2920 or 2923 and a target from 3060 can be looked at. Alchem Labs is a buy with a stop at 5195 for targets of 5320 and also a buy on ICICI Pru. It's a conditional buy. So it's been, making those intraday highs around 610, 611 for the last 2-3 days. Once we start getting past 612, buy with a stop below 600 for a target of 635.
Okay. Let's just look at the dollar rupee as the market is opening up. Mitesh and Sudarshan, thank you very much for that. The pre-open is also kicked off. By the way, the dollar rupee, the rupee basically weakened about 0.3% in the offshore non-deliverable market last night on the back of these the Pahalgam attacks and of course what may follow. So markets very much focused on that as well. So this morning 85.60 or so on the dollar rupee, which is coming through. 50 points lower on the Nifty, but this is, initial first 3 minutes of the pre-open session and focus. Let's talk about IT, guys, because the index was up 3% yesterday.
Yeah, big pullback on the IT side of the market. And I think we have a guest.
Well, that's right. Let's get straight to it. We have a lot of numbers that come in there. And the good news is the last couple of trading sessions, we've got some positive surprises. HCL Tech delivered a fairly good set of numbers. The index was on fire yesterday. And you have LTI, Mindtree, as well as Persistent System that did quite well. Sandeep Agarwal, fund manager at Subilo Investment, joins us on the show. Hi, Sandeep. The stocks pulled back a goodish bit. Yesterday, the index itself was strong. But these numbers coming from Persistent in particular looked quite good. What's your view?
Yeah, hi, good morning, and thanks for having me on the show. So, to start with, Persistent have been delivering quite well for the last several quarters. And, I think they have got the very good grip on the ER&D piece of the business and they have been delivering on top of that. So I think that is an exception. If you see across the board, they have been delivering quite robust number for several quarters. And I think, they have good client stickiness and consistent flow of deals. So that is a very good number, to be honest, in this environment.
So, Sandeep, hi, good morning, Surabhi here. So, what's the overall way to play this? Companies like Persistent, even Coforge, they've anyway been coming out with industry-leading growth, right? They've done so much better. Coforge, 30-35%. Persistent last year grew at 18%, still sounding confident. So do you stick to these names or would you perhaps be looking at even IT services because of, I don't know, maybe valuation comfort, cash levels or something like that? Because growth clearly is still missing.
So, what has happened is with that, you see IT has underperformed massively in last few months and now they have come to a level where some of the large caps are now at 4.5 to 6% dividend yield. And, across the globe, there are many funds, dividend funds, which have very limited options to buy for dividend stocks. And for them, these stocks now have become quite attractive. And because of that, you would have seen the kind of movement you saw yesterday. In fact, in last 7-8 days, most of the stocks, whether TCS, Infosys, they have moved up almost 10 to 12%. And this is primarily because of the FCF yield. But as you rightly mentioned, growth I think will be very challenging. And remember, in IT, 80% is top priority, which cannot be changed, delayed, postponed, nothing. Balance 20% is last priority. It is discretionary. So it only comes when environment is extremely good. So I really believe that, for the IT services firm, growth this year will be challenging. For large cap, 3 to 5% is also a very tough ask. And for good quality mid cap, even low double digit will be challenging. So given that scenario, the PEG ratios are between 3 to 6, 7 times. So I don't know whether that kind of PEG ratio should be assigned to a sector which is growing at such a low rate. So that is my concern. So valuations are still not very reasonable, to be honest.
But within this universe, I mean, would it be mid-cap IT over large-cap IT? And names like what Surabhi said, Coforge, etc. Coforge, for example, reports over the weekend. So if, these companies say, well, deal pipeline is looking pretty strong and, they indicate, you think there is still a price dislocation, which is there between, because stocks sold off from 10,000 to about 6,000. It's come up now, of course, 20-25%. What's your sense?
So, as you mentioned, Persistent in the ER&D has been delivering very solid numbers. And similarly, Coforge in the services side has been delivering quite good number. But my concern is that, in ER&D, there is a different reason why the stocks were doing well. And I think they will do much better than IT services in long term. But given these challenges, which we are seeing, early signs of challenges in the auto space in Europe, I think, even ER&D can have a lag effect. So remember, these are very long-term deals and it takes time to slow down and it takes time to pick up. So I would not read too much on just quarterly number. In my view, the pickup will also show first in the large caps, which I don't think will happen in first half of FY26. So I think there is some slowdown, which you will see in this good quality mid caps, which are still giving good numbers. And these are on back of the past orders, which they're executing now. So I think some slowdown in good quality mid caps is yet due. And the large cap, I think they will be the first one to start reporting good numbers, but they are also at least 2-3 quarters away. That is what my sense is. So I think, we have to be very careful. Where there is 5.5-6% FCF yield in large cap, probably they would have been closer to bottom. But otherwise, I don't expect too much on growth this year.
So that means that since you're saying the auto sector is unlikely to offer any respite to these ER&D companies, I'm looking at Tata Elxsi. Let's get long-term charts in, maybe one-year charts. Tata Elxsi and even KPIT. The stock, Sandeep, interestingly, in the last 3-4 weeks, started showing some signs of life, even as this whole tariff storm was surging around. Now let's pull up a 1 year. Look at the value destruction. And then this little excitement building up, pretty much in the last 2 weeks. You're saying this is a bit misplaced for stocks like Tata Elxsi and specifically KPIT Tech?
So I will not call out any name because we run a PMS, but let me put it this way that, I believe that auto will give some pain to ER&D companies. And when that pain comes in, as I said that, right now they are executing what they have won in the past. So going forward, I think there will be some slowdown in all these companies which are in the ER&D space, and even the IT services, the growth which you have seen in some of the mid caps, which was very high. I think that will pull off a little bit. See, large cap, you see the impact immediately because in large cap, what happens that, they have to get that 20%, and that 20% discretionary is a very big number. But for mid and small cap, it takes time to show the, to bring down the growth, and it takes time to pick up the growth. So I think, first sign of any recovery in growth will show up probably in second half of FY26 by large caps. And after that, 1 or 2 quarter lag, maybe, good quality mid caps will start showing you growth. So I think at current juncture, if anyone has to, seriously look at it, then the only parameter to look at will be the free cash flow yields, which wherever you have 4.5 to 6% range, maybe investors will start nibbling there. But I don't see any other growth reasons to buy the stocks right now.
Okay. All right, Sandeep, we'll leave it on that note. Thanks very much. Good to have that perspective. Stock prices do these things, those, pretty big moves, flash in the pan kind of moves that we've seen earlier this week, yesterday as well. But some longer-term perspective always helps. Thank you very much for joining in. Time for a 9-10 calls. Let's quickly look at what the index is doing. 51 lower, very much in sync with what the implied low, open was telling us. Bank Nifty is also down about 0.5% at this point. So Darshan, what would your 9-10 call be?
That will be ICICI General Insurance by ICICI GI with a stop under 1845.
Okay, ICICI General Insurance, got it. Amitesh, your stock.
I'll go with a buy on Alchem Labs for targets of 5,300 to about 5,320.
Okay. All right, gentlemen. Thank you very much for joining in with those calls. Let's also put the spotlight, obviously, on the biggest national story of the hour and an extremely important one. The union government has convened an all-party meeting later this evening. It's probably going to happen this evening, and this is in the aftermath of the attack that left 26 people dead and several injured in Pulwama. There was a cabinet committee on security meeting last evening, and some very, very strong diplomatic actions were announced at the end of that meeting. Parikshit is joining in. Parikshit, I mean, it's pretty historic, right? The Indus Water Treaty in abeyance, Pakistani nationals being told to leave the country in 48 hours. What are the next steps? What does today look like?
Well, the Pakistan chargé d'affaires, the top diplomat of the Pakistani embassy here in New Delhi, was summoned last evening. He was handed over papers asking him to make sure that the defense attachés of Pakistan and India, the military attaché, the air attaché, the naval attaché, all of them leave the country in the next 7 days. So literally, they have been expelled from the country along with their 5 support staff. SARC visas for Pakistani nationals, they have been suspended as well, even those which were issued earlier. So all of that have been cancelled, and all those nationals who are in the country, they have to leave in 48 hours. The Atari checkpost, which is used to cross over into Pakistan and for Pakistani nationals to cross over into India, that has been shut down, and all nationals from both sides have to return as well. So we are looking at diplomatic measures. We're also going to see perhaps more action in the next 2 to 3 days. India is deliberating on various options on how to isolate Pakistan diplomatically. We've got an outpouring of support from various countries, including the US, including the European Union. And India is going to use that support to somehow expose Pakistan and export the linkages, the direct linkages with the Pakistani state as far as this terror attack in Pahalgam is concerned. The Indian government is saying it is very clear that normalcy, economic prosperity was returning to Jammu and Kashmir. Successful conduct of elections is something that has not gone down well with Pakistani state actors. And perhaps this is the reason why Pakistan has sponsored this terror attack. And it is clear from the manner, the modus operandi used by the terrorists, they were not locals. The fact that they were asking for identities of the individuals means that they were not from here, and they could have possibly been members of the Pakistani armed forces or Pakistani commandos as well. So a multi-pronged strategy. Pakistan itself is going to hold a meeting of its National Security Council. They are going to retaliate with similar measures, diplomatic measures that India has taken. So let's see how the ball rolls from here on. But it is going to be a tense period in India-Pakistan relations once again.
All right. Parikshit, thank you very much for that. And we'll of course, keep coming back to you for updates on the story throughout the day. Lots of focus on this from a financial market perspective as well. Tata Consumer is the stock we want to shine the spotlight on. Mangalam is here with why. Mangalam, morning.
Good morning. So Tata Consumer reported its numbers yesterday. While the overall results were largely in line, there were a few bright spots that the company reported this time around as well. If you look at the revenues, they were above street expectations by about 25 to 30 crores. The EBITDA, despite a 420 basis points decline or contraction in gross margins, actually were better than what the street were expecting, and the net profit was further aided by a 45 crore exceptional gain that came by as well. If you look at the categories as well, in the India beverages business, the organic revenue growth was close to around 9%. The street was working with a number of 10 to 11%. Foods was where the bright spot was. Organic growth out there was 17% as against expectations of 11 to 12%, partly led by growth businesses, partly led by the price hikes that the company had taken in their salt portfolio, and partly led by a strong performance of their other verticals as well. The international segment grew by about 5%. The street was again working with that number itself, largely led by US, but there was a decline which was expected in the UK, and that's exactly what has happened. The brightest spot for me was the growth that the company reported in their non-branded business, which was 25%, led by 60% growth in their plantation revenue. And secondly was the Nourishco business, which came back to growth after 2 quarters of underperformance. A 10% growth is what their Nourishco portfolio reported this time around, with an 835 crore revenue for the entire year. See the stock mild green after a strong outperformance this month.
All right, Mangalam, thank you very much for that. We're starting 50 points lower on the Nifty, so 24,288 is where we're at. The Nifty Bank is down about 0.3%, 55,184. Sensex is down about 0.17, 79,978. And I think you got some green on the small cap index, 16,980. Mid cap index is absolutely flat, but there's some green on both in the broader space, broader markets. Otherwise, I mean, it's slightly sideways, slightly subdued. it's 12% in 9 days on the Nifty, and running into, of course, some adverse news flow here as well. So 24,280 is where the index is at. The Nifty heat map maybe will quickly come up, and we'll just look at which way things are. So it's all mostly down. I mean, I think about 30, 35 stocks are lower, and about 15 odd names are higher at this point in time.
And Bajaj Finance is in leadership position. I'll tell you why. Because the board is meeting today. They'll be considering not just a dividend, but also a stock split. And typically retail investors like that. Just makes ownership a little easier. Stock at an all-time high this morning of about 9,450, almost 9,500 on Bajaj Finance. So that's the big mover. Tata Motors is the other one that's tracking some green. There's IndusInd Bank on the upside. Nestle ahead of numbers is up about 1%. Let's look at Tata Consumer and see what it's doing. Tata Consumer is actually down about 4%. So the stock's selling off on what seems to be an inline performance in the fourth quarter. Tata Consumer actually is the weakest stock on the Nifty, with that cut coming through. Eternal, which has had a good week so far, it's cooling off as well, 2% lower on Eternal. And there's news on Eternal as well. Let's not forget, there is a management change. Mr. Dipinder Goyal himself is going to take over the food delivery operations now. The current CEO is moving out to another business, still in the company, but to another business. It seems like it's a regular reshuffle, but the stock is lower. Bharti Airtel, Sun Pharma, HDFC Bank, these are the other losers. Banks in general are a little soft again this morning. ICICI Bank also lower by about 0.5%. Kotak is also slightly lower. L&T Cipla also slightly down. So very muted and quiet for the time being. IndusInd, by the way, is seeing some interesting buying, about 1.5% up on IndusInd.
Well, that's right, Surbhi. And a couple of more stocks actually that are calling for our attention. Thyrocare, solid set of numbers. There is valuation comfort out there. So that's the big bazooka move this morning. Thyrocare is up close to around, I think, 8-9% the last time I checked. Let's get the intraday chart up for you on the screen. Syngene, disappointing numbers with disappointing guidance as well. Bharti Energies, that's the one that's given up a little bit post yesterday's big run. So that's coming for some profit taking. Vascon, well, that stock is up close to around 5% or thereabouts because it won a 200 crore order. Syngene now, it's down close to 10%. That's actually a lower circuit on that particular name. So just keep an eye out on that one. Vascon is up close to around 6%. That's won a 200 crore order. So I think we should get that as well up for you on the screen. It's at the 100 DMA. So keep an eye out on Vascon. Spandana Spurti, the stock started off in the red, but it's recovered from the low point of the day. A few factors at play. Mr. Ashish Damani that now takes charge, he's been longer there than Mr. Shalab, so that's why that could be one factor. The management commentary as well was positive, that they see settling down of this MFI stress in a quarter or so, which is another positive, and valuations at around 0.85 times give some kind of support. So because of this, after starting off gap down, and yesterday the stock was down 5% as well, that's recovered from the low point of the day. And Dalmia Bharat, as we said, the numbers are more or less flattish. The way ahead could be better. That stock is up 3.5%.
Absolutely. So lots of movers, right? I mean, we're still on the Nifty down about 45, 50 points to start the day. And the biggest volume-led loser, I mean, price-wise, it's just a 3% cut is Vari. But look at the volumes. It's huge volumes coming through on Bharti Energy. At 29.35, yesterday, of course, it was up some 16-17%, but almost quickly clocking up to about 1 million odd shares on the NSE. LTI Mindtree, of course, Rima was highlighting that. Syngene, we've highlighted. Tata Consumer, Mangalam just spoke about that. It's down 3%. Eternal is down 1.25%. Max Health is down 2%. K Fintech, big winner in the last 1 week, 2 weeks. 3% down, about 12.50 on K Fintech. And so on and so forth. Rallis is down about 5.5%. It's got decent-sized volumes as well, but not high, but some volumes in it. And of course, I mean, Samhi is up 5%, so 182. Stocks up 25% coming into this deal. It's up another 5 this morning on Sami. So, yeah, I mean, there's a fair bit which is going 60 points lower on the Nifty.
On Tata Consumer, I started going through a lot of the brokerage notes, but just to sort of gauge market reaction and pulse. Jefferies is the one that's actually downgraded the stock. And what is their rationale of doing this? They're saying, first of all, this tea inflation is really hurting margins. They're not too happy with that, though growth is okay. And more importantly, they're pointing out the obvious. The stock is trading at 70 times FY26 earnings. So they just think it's too expensive. So therefore, it's a hold now for them. That's a Jeffrey's view on Tata Consumer.
Absolutely. So 2.5 lower on Tata Consumer. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. Dheeraj, good morning. Good to have you back on the show. Thank you for your time. What's the view now, Dheeraj? Have 12% in 9 days on the Nifty. And, you're again, gains come so quickly, you just snap back that you're left wondering, what now? I mean, and stocks uniformly are up 20-25%. I'm talking about, say, BSE 200 or a well-tracked group of stocks. What's your view from here?
Yeah, so if you actually zoom out a little bit and ignore the fast down and fast up moves, market continues to be in a large struggle zone, right? So it falls very fast, it comes back very fast without actually going anywhere. So the last time I think we discussed on your show, I basically said, look for 1 or 2 years of just single-digit kind of returns. And I think I maintain that view. But it will be through bouts of optimism and pessimism where we will see sharp moves on both sides. So it's not one of those kind of markets where you'll see a vertical down kind of a correction. For that, you need some big shock to happen. I mean, the tariff issues could have provided that shock, but India looks like a bit of an island of safety or oasis of safety within the whole tariff war, which is currently going on. So I broadly maintain it's a large range market. We will keep on doing top of the range and bottom of the range many times before the mean reversion actually happens.
So continue to be a little cautious in the market. Dheeraj, good to have you with us on the show this morning. Now, so what is the issue? And for a second, I'm just leaving aside this entire trade uncertainty and whatever's happening with tariffs. Hopefully, we'll get a better deal. At least that's what the market believes, right? That India will probably get a much better deal than a lot of other countries. That aside, why else are you far more cautious? Is it that you're not convinced about this whole earnings recovery story? Is it something else?
So two things, Surabhi. One is you can't fully ignore this whole tariff issue, right? Because to my mind, one thing is very clear: the current disruption or change in the global financial order, the global trade order, which is happening, has two clear implications. One clear implication is there will be a slowdown in global economy. Now, we will have to wait and see whether the slowdown is shallow or deep, whether it becomes a full-blown recession. But I think it's pretty much a given there'll be a slowdown in the global economy, and India can't remain fully protected or shielded from the fact that the global economy itself will slow down. So that is point one. Point two, domestic economy itself has been slowing down for the last few quarters. I mean, we can see that in the top line of Nifty or BSE 500 earnings. Bottom line has been telling a different story because of the margin uptake which happened for a few quarters. But the top line growth has been anemic in the region of 7 or 8%. Domestic economy has been slowing down. So if you add on top of a slowing domestic economy, a layer that the global economy will also slow down in the next few quarters, I think earnings will see more cuts. So as you rightly mentioned when you were discussing one of the stocks that brokers are downgrading because of valuations despite okayish earnings. So that's the challenge. When where the earnings are okayish, valuations are too high. Other places we are seeing a little bit of earnings downward pressure. So both these two things will keep the market in a bit of a struggle zone, I think, for some more time to come, according to another year or so.
So, Dheeraj, where are you on earnings, if I could just ask? Because the street consensus, when we kind of began, FY26 was supposed to be somewhere around 12 to 14%, depending on whom you're listening to. What is your base case expectation?
So this is just a very, very top-down guesstimate. I don't have estimates. So very, very top-down guesstimate looking at the way cuts are still happening in many, many spaces despite good results. I would say we would end FY26 in high single-digit range. So 7, 8, 9, that kind of a range.
And that's not in the price, is it, Dheeraj? 7 to 9% earnings growth this year. That's not in current stock prices, is it? Or is it?
I don't think it is. I don't think it is in the because that level of earnings disappointment is bound to slow things down, right? So I mean, there are two things which are playing in the market. So one is the narrative of what is happening on the global scene. Second is the actuals, which is the earnings. And in the near term, India actually benefits from the narrative that India is an oasis of safety in the tariff war. India has a very good relationship with the US, and we are trying, and that's a fantastic job achieved on diplomacy by the current government to do a trade deal with the US fast. And as a supply chain alternative, this is the third time in the last 17 years that we are staring at a wonderful opportunity of making India a supply chain destination. Whether this time we are able to do it or not is a question we will see going forward. But these three narratives are playing on the positive sentiment on the market. But if you look at the earnings itself, they're weakish. Nothing to write home about. And there's no upward revision in any of the earnings which are coming out. Either it's flat or we are seeing downward revisions.
Okay. All right. That's a sobering thought and one we must take on board. And perhaps eventually they say earnings is the fuel of every market. And if we're looking at more cuts ahead, it could be maybe a little problematic. All right. Got it. Thank you very much, Dheeraj. Good perspective this morning. Appreciate you joining us on the show. For the timing, we're moving on and putting the spotlight on a big deal that just got announced, Sami Hotels. And this is exactly in step with what Nimesh was telling us earlier. Now, we have the management of the company with us to talk about their strategic deal with the GIC. GIC is all set to acquire 35% stake for a total of about 752 crores in 3 subsidiaries of Sami Hotels. Ashish Jakanwala, Chairman and Managing Director and CEO at Sami Hotels is with us. Ashish, great to have you. Thank you very much for joining it. Good morning and congratulations on a big deal. GIC is a marquee name. Now let's go through the whys. I know you want to use a lot of this money to pare down debt, but what exactly is the transaction? What are these 3 subsidiaries and how soon does the money come in?
Thank you for having us. Absolutely, we're very excited about this transaction, largely on account of the quality of partner that we are getting. So I don't think I like to belittle the whole transaction by just only focusing on leverage. Clearly, that's a great end result. But what this gives us is a strong partner for future growth, especially in the upscale and higher category of hotels. As you've mentioned, we have picked up 3 of our existing hotels where GIC has picked up 35% stake against a total investment of 752 crores. This does multiple things. It reduces our debt significantly, on closing. That frees up a lot of our free cash for future growth. And in addition, GIC and Sami are committed to growing this whole partnership to about $300 million. So we do expect both partners to put more capital for future growth in this business. In terms of timing, the deal is subject to customary approvals such as shareholders' consent. We believe this should be in place by end of May. And majority of the investment comes upfront. We should get done, I would think, by June end. And the balance comes in Bangalore asset over the next 2 years. But majority is coming
what you said, actually, sorry to come in, but what you said was very interesting. And I was just going to ask you that. Is this the first of more or the first of many? And you said the partners are committed to putting in more capital. So are you open to selling more stake? Could you be looking at deals in other properties as well?
No, so I think the larger part of the deal is that we've incubated the deal with these 3 assets, but both the partners will look at new acquisition opportunities in the space, wherein both of us will bring future capital to deploy. So it's not just about Sami continuing to bring more assets in the platform. That clearly is an option, but I think the bigger focus is to also look at opportunities outside. We've had tremendous success over the last decade in our acquisition strategy. And we believe getting a partner of GIC stature and obviously kind of fixing a balance sheet, both of them put together gives us tremendous appetite and potential to grow through acquisitions.
Ashish, hi, good morning. Prashant here. Congratulations on the deal. So just to understand, is this something similar to, so GIC was an anchor investor with DLF, for example, right? Early anchor investor. Or, for example, if you take a look at the case of Max Estates, again, another real estate company, but also sort of operates commercial properties, etc. They have New York Life as a kind of anchor investor, and they go asset by asset. Is that kind of the roadmap to think about this?
Prashant, hi, yes, absolutely. Besides the three seed assets, both the partners will look at new opportunities on an asset by asset basis. And if both the partners like the opportunity, we are committed to bring in capital in the ratio of 65-35, 65 from SAMI and 35 from GIC.
So but that is in the agreement. I mean, anything you do in the future, it'll be in this 65-35 ratio.
In the upscale space, Prashant. As you know, our business is spread across upscale, upper mid-scale, and mid-scale. The joint venture that we've set up, or the partnership that we've set up, is targeting the upscale segment. So hotels that we look at in the upscale space, we will have to take it to the joint venture or the partnership first before we do it on our own balance sheet.
Okay. All right. Hi, Ashish. Good morning. Good to see you in. Nigel on this side. Could you tell us what's the contribution of these three subsidiaries in terms of revenue as well as profitability to the entire, the listed entity?
So Nigel, about 30%. These entities put together contribute circa 30%. I'm talking December 2024 numbers. If I take trailing 12 months as of December, about 30% is the contribution to revenue and EBITDA of these three hotels to our overall portfolio.
Got it. Okay, all right. Now, the net debt has steadily been coming down. If I look at it, when you joined us a couple of years ago, it was 2,800 crores, then it came down to around 2,000 crores, and you had told us in the time to come, it will reduce. Now, post this fundraising that you have done, what should the debt number be, say, by the end of FY26, FY27? What's the rough number we can work with?
So immediately on closing, the net debt will come down to about 1,460 crores. Interestingly, that absolute number, Nigel, helps us achieve a target of near-term going below 3.5, within a year going below 3 times, and fairly quickly getting to our stable target of 2.5 times net debt to EBITDA. Therefore, we can look at deploying a lot of our free cash towards growth, but we believe our net debt will remain in the zip code of 1,000 crores to 1,400 crores over the next 2 years. It all depends on what's the deployment of our free cash. And it's an important perspective because we will see almost a 55 crore reduction in our interest expense on an annual basis. So our free cash growth will be pretty substantial. And if we can find acquisition opportunities, good. Otherwise, a lot of that will eventually end up reducing our leverage beyond 1,470 crores.
Okay, all right. Ashish, you've given us very good numbers. So, thanks for that. But if you could tell us, it's too early to talk about, they're just entering, but what's the exit plan for GIC? Is that already a structured deal or something that you'll have already worked on? Or you said that they could be interested in other assets as well. Will they deploy some more capital?
Yeah. So I think the intent is for the partnership to grow substantially and both partners to put more capital. And Nigel, with that, I think it's too early to talk exit. We both are very excited about both India as a market, hotel as a sector, the acquisition and turnaround strategy that SAMI has deployed over the last decade. So I believe there's a lot of growth that we can leverage in the cycle and in the sector. There are obviously provisions for monetization of investors' stake. But Nigel, we have a credibility and experience of working with institutional capital for the last 14 years. So if any point in time in future, there is a requirement of monetization, we feel that should be an easy path.
Ashish, that 65-35 ratio that you mentioned, right, for future projects, upscale hotels, as you said, could you give us a sense of what the number of keys at SAMI right now is? And you already have a pipeline, right, of identified upscale properties. What is that number? And in how many of those cases will this 65-35, will GIC come in? As things stand right now, yeah.
As of today, as I said, they are in these 3 subsidiaries. These 3 subsidiaries will eventually own 5 hotels. The Courtyard Fairfield in Bangalore Outer Ring Road, which is an operating asset. The Hyatt Regency in Pune, which is an operating asset. And, we had acquired the Trinity Hotel in Bangalore Whitefield in October, which eventually will be rebranded as Tribute under the Marriott portfolio and a new Western block. So, they are currently picking up 35% position in these 5 hotels across 3 subsidiaries. As I mentioned earlier, we are keen to evaluate more opportunities to add to this portfolio, but I really don't have a definitive agreement on any future pipeline that I can discuss today. But the plan is to definitely grow this partnership using both the opportunity, the capital, and the skill sets we both bring.
So, Ashish, just on that point, because you've given us an idea of the debt levels, you're saying that after the paring down, debt will not exceed 1,000 to 1,400 crores. At the same time, obviously talking about, investing more in the business. So, at least from Sammy's point of view, what is the additional capital requirement that you see to deploy into these three entities and even overall otherwise? I mean, give us some sense of the leverage levels that you'll keep at a debt equity ratio, and how much more capital will you bring in? What's the plan on the equity capital side?
On the debt levels, we've had a fairly committed position to the investors. We had said 3.5 times near term, and 2.5 times is what we believe will be a good, healthy, steady state, given the fact all of our debt is pretty long-term, 12 to 14 years, right? So we will get below 3.5 times on closing. We will get below 3 times in the next 12 months. And that obviously accelerates the path to get to that stable 2.5 times net debt to EBITDA. So that stated strategy and promise to the markets remains steadfast. The only thing which is changing is we are accelerating the timelines to get there. Now, with that, what happens is a lot of our free cash over the next 3 to 4 years gets freed up for growth. And if we take some rough estimates, we believe we'll get some 1,000 odd crores of free cash over the next 3 years from our business. And that's now available for growth because our net debt is already at a level where we'll reach 2.5 times, if not lower than that, over the next 2 years. So we have a reasonable firepower. And to add to that, whenever we do an asset in upscale, GIC has an ability, subject to obviously them liking the deal, contributing incremental 35%. So I think what we are doing is we're really augmenting the firepower to grow the portfolio. And our focus is really growth because, as I said, and I'm sorry if I repeat it a few times, leverage is clearly sorted in this one single transaction.
With the partnership, GIC has got investments globally as well in other hotel companies, I think with Westin and a couple of others as well. You work with Marriott, of course, is the big one for you, but you have, I think, 3 international hotel flags in terms of, the multi-brand exposure that you have. Will we see more, and does that change in any way towards one or maybe addition of more?
We've always maintained a brand agnostic approach to investing. So in future, we will look at each hotel and each opportunity on its own merits. We are tracking many other hotel companies and brands that we like. And I'm quite sure that the bouquet of brands and the partners that we work with would expand in future.
Just very quickly, Ashish, before we let you go, this GIC deal that you've done, is it exclusive or you can tie up with others as well?
So on the upscale hotels, Nigel, it's exclusive. If we do any hotel in the upscale space, we need to take it to the joint venture first. But in the mid-scale, lower mid-scale space, there is no such exclusivity. But having said that, I'm personally not a big believer of exclusivity, but I'm a big believer of partnership. So as we've done partnership with GIC, we'd like to explore opportunities to grow this partnership, whether it is in contract or outside of the contract, because each partnership takes a lot of time to build trust and ability to do some things together. And obviously, once we've done that hard work, I would like to believe both Sammy and GIC would like to leverage that hard work that we've done, the trust that we've built to do more and more.
Sure. So more partnerships like GIC?
Sorry?
Should we be expecting more partnerships like the one with GIC? Maybe in some of the mid-range hotels as well?
Not in an immediate way. Not in the immediate.
Not in the immediate future. Got it, Ashish. Thank you very much. Very helpful conversation. Thank you for making us understand the structure of this deal, and good luck with those plans. We need to head into a very quick break now. Up next on the other side, the big auto discussion. The primary market will soon be buzzing with an EV IPO. It's a big one. What lies ahead? You're seeing some flashes right now on the Delhi EV policy on the screen as well. A full-blown discussion coming up with Hormaz Sorabji of Autocar India and Kumar Rakesh of BNP Paribas. Welcome back. So the market for the time being hasn't done too much, just about 50 points lower. The next sector on which we're putting the spotlight now is the automotive space. We all know that Eicher is the next IPO in town. It'll be the first big IPO actually of the current financial year. It's all set to open for the general public next week. And for the anchor investors, it opens out on Friday. So what does this really spell for the EV sector in India, particularly, of course, EV two-wheelers? That's what we're looking to discuss with our next set of experts. Joining in are Hormaz Sorabji, editor at Autocar India, and Kumar Rakesh, India analyst, auto and IT at BNP Paribas. Gentlemen, thank you so much. Great to have you on. Thank you for joining in. Hormaz, I'm going to open with you because I go back to a conversation that we had on Ola. And this is well before the Ola stock price decline had started. And we were flagging off some concerns in terms of, after sales, the product itself and all. Short point is that Ola has been a pretty bitter experience from an investor standpoint. And on a separate note, there's all this going on with Blue Smart. So in general, in this environment, we have now Eicher coming in, very different company. But what can investors expect? Will it be a little sweeter this time around?
I think for sure, I don't think you can paint both companies with the same brush. I mean, I've been very open about it. Ola, absolutely very, very poor credibility. I think just the way they've gone about it, I think they've taken investors for a ride is my view, just the way they've gone it. And, you've seen the reports, compliance issues, regulatory problems, very, very typical. My basic issue with Ola is that, from a technology standpoint, I've really not seen any breakthrough in what they've been doing. It's still the S1 Pro, which again is, a product which has come from Europe and adapted over here. I don't see any huge R&D capability in the company. I mean, the cells they are planning to make also as a 4680 cell. Is that suitable for a small scooter? I have my doubts on that. Whereas Eicher, to me is actually far more refreshing, much more credible. They're sorted on their engineering. And, I actually have a lot of faith in that company. And so I said, you can't paint both with the same brush. So I think that's what investors also need to know, that, you have to. And obviously what's happened to Blue Smart, again, there are promoters and there are promoters. So they're not all cut from the same cloth there.
Absolutely. Hormaz, but just one follow-up question. The only issue, again, purely from a market and investor standpoint, is that there is so much and such rapid, frequent policy change within EV, and that's always going to be a risk, right? Look at the lobbying that's happening in Delhi, and that was, I think, a source-based story that our colleagues in Delhi had just put out. The hybrid guys are now lobbying. They want hybrids to be given the same kind of treatment and perhaps incentives as EVs. So from a two-wheeler standpoint, since we're talking Eicher right now, is there any policy uncertainty, regulatory issues, any such risks that investors should be very well aware of in the immediate future?
Well, I think, the policy uncertainty, the fact that, policies are not defined well in advance. Again, this whole thing on CAFE, it's just been stretching. So I think that really is a big fundamental issue that, affects the entire industry, not just EVs, especially the ICE guys, because, emissions is a bigger issue for them and a bigger challenge for them, where it's not so much for the EVs. But you're right, I think these constant flip-flops between, especially at the state level, as you said, you've got road tax, once it's waived off, then it's come back on. So that does cause a lot of uncertainty. But I think, what's very clear is that EVs are the future. They will always have a huge fiscal benefit over ICE vehicles. And I think, especially with scooters, I think that's really been the segment that's led EV growth because scooters lend themselves best to electrification. So I think that is the safest bet right now in the EV space. Of course, it's getting very competitive. You've got the legacy players also fighting back. Bajaj Auto, I mean, it's really kind of up the ante. TVS there as well. It's all come at the cost of Ola, which we've seen their market share has completely fallen. So it's not going to be easy for Eicher either. You've got really strong legacy players in this game as well. But I think at least what I see is that, they've approached it right. Their fundamentals are right. Their products are good. And, they're not in this mad rush for massive volumes and growth and, a lot of smoke and mirrors the way Ola has kind of, projected itself.
I mean, strong words, and always strong words.
That's why we like Hormuz.
Stuff.
He cuts through the web.
Absolutely. By the way, Eicher, guys, is like the poster child for incubation out of educational institutions. It's come out of the IIT Madras Research Park. So if you go down there, it's like a point of pride. Eicher and what the founders, etc., have done with that company. Kumar, come into the conversation. I mean, as an analyst, what is your assessment of Eicher? We've got the price band now. The RHP, of course, has been out there. We've been reporting on many of the details, and they'll come up on the screen. But what is your sense? Eicher.
Hi, good morning, Prashant. I'll not be able to speak specifically about the company, but I think what Hormuz was earlier saying, that in the two-wheeler space, especially in scooters, electrification seems to be a structural trend. It is the cost advantage customers have very well started appreciating. And that is something which we have seen over the last 2 years when the incentives have been coming down on the electric two-wheelers. The penetration falls for a month or two and then revives back up again. So, and then continues to grow. So that structural shift towards electrification in the two-wheeler space, we think is already pretty much underway, at least for the scooter segment. We'll have to see how much of success EVs can make in motorcycles. It would be relatively more complicated to electrify motorcycles at attractive price points. But at least we have enough and more headroom right now to electrify the entire scooter space. And that is where many of these new age startups are working. And some have started creating pretty good niche using their differentiated vertical integration and technology know-how. While the incumbents have definitely established the leadership, a couple of more Japanese players also will enter the electrification journey through this year, and we'll have to see how that redistributes the market share. But for the startups, the space would be really to create a niche for themselves, and technology is a good differentiator to create that niche.
All right. Hi, Kumar, Rakesh, and Hormuz. Thanks a lot for joining in. Well, Kumar, I wanted to ask you, there has been this talk that India is going to go a little bit easy on the duties, and then we'll have, the Harley Davidsons and other US automobiles here in India. Do you think it is reducing duties, but actually we're not really giving away anything? Markets are very different. The left-hand, right-hand drive is very different, and maybe they don't make much of a dent. What's your take?
I think, yeah, I agree. Now, the incumbents in India who are selling are well established. The brand perception about the brands which are available in the markets are very well established. And now I wouldn't expect that to create a material impact on the existing structure of the market, partly also because of the price point at which these products will come potentially would be much above where the average price point in the market is. On the car side, the average price point is close to about 11-12 lakh rupees in India, which is significantly below the average price point what it is in Europe or US for that matter. And hence that may not create a lot of impact, and even more so in the two-wheeler space. The market in India is very different compared to US. And we have seen this in China as well. China earlier used to have a lot of restrictions in terms of global OEMs entering into the Chinese market. They necessarily need to have JVs and such restrictions. But when the electrification journey started, they reduced many of these restrictions. But what we have seen actually is Chinese OEMs are doing far, far better in the EV space now that they have established themselves. The customer and the market is well established. They are able to compete actually quite fiercely with these global OEMs in the Chinese market. And hence now we think we are way beyond the point where these domestic companies or the established companies could see a material impact from any new entrants.
Kumar, what are your top stock bets, auto OEMs?
So we prefer passenger vehicle names over two-wheeler industry. As we are discussing on this show, there's a lot of flux which will happen within the two-wheeler industry, the market share shift in the two-wheeler EV space. Some more entrants would be entering in the EV space, and that will continue to create impact on the ICE volume as well as margin of the overall business. And hence we see the passenger vehicle industry relatively more stable, where the bulk of the competition is within the existing incumbents and we don't have any disruption happening from outside. And also we would expect the long-term growth drivers to be very well in place for passenger vehicle industry. And that's why we prefer Maruti, Suzuki and Mahindra. Mahindra is delivering a pretty solid volume growth, and even their farm equipment business has been doing pretty solid.
Yeah.
So we would expect them to continue to deliver double-digit volume growth. Maruti, from a longer-term perspective, the points which you were earlier highlighting there, hybrid at some stage may start getting favorable policy support. Even without that, globally, we have seen hybrids to do much better than EVs in most of the markets, barring, say, China or UK. In UK, more for regulatory reasons, EVs have done better. But hybrid is the powertrain which has really picked up in the recent years. And India is behind in that curve. So we would expect at some stage hybrid in India also to start picking up. And the key beneficiary of that would be Maruti.
Got it. So Maruti, you like. M&M obviously has been the poster boy of the Indian automotive space from a financial market standpoint, which brings me to my final question to Hormaz as well. Hormaz, going back to passenger vehicles for a bit, you just heard the comments that Kumar made. The stocks, the companies, barring M&M, they've all been struggling just because of lack of growth, right? And against this backdrop, we have every day Mr. Elon Musk tweeting, saying that duties need to be lowered. We don't know what finally that trade negotiation is going to be like. And I don't know if he can bring duties down to zero on an imported car. That would be almost unheard of in India before. But what should we be prepared for next 6 to 8 months on the PV side within this whole, Tesla knocking at India doors perspective?
Yeah. Well, I think firstly, you could have some serious reductions in duty, but they would be coming with conditions. It could be for a limited number of units. It could be above a certain price point. So I don't think, as Kumar says, it's going to really impact the kind of the core of the market. And over here, our cost structure is so strong, it's very difficult, for even, imports to compete with a lower duty if you try to go low down over there. But I think, the EV space, again, I think 2025 is going to be a very, very crucial year. Clearly, we've seen, let's say Mahindra, which has launched two vehicles, a bit of a measured start. I think they haven't really gone full tilt on it. I think they're making sure things like the software and all are sorted before it reaches the hands of the customer. And I think you've got Maruti now coming in. We'll have to see what they do. It'll be very interesting. I think what Maruti will do will leverage its network, which is quite essential from an charging infra point of view. And that could be Maruti's play, not so much the product, but the EV ecosystem, which will, kind of be their play. Hyundai have launched the Creta EV. Again, a tepid response, really not as much as we thought, doing under 1,000 units a month. So, I think it's going to be very interesting in terms of how the EV segment plays out. But what's for sure, I think from a 2.5 penetration, it's going to be substantially higher. Best case situation would be perhaps, let's say 3.5 to 4%. But it's again very, there's still a lot of barriers in the EV space. And I think infrastructure is primarily the largest one.
Okay. All right. Gentlemen, thank you very much. Very insightful discussion, very helpful one. And let's see what the next couple of weeks bring for the Indian automotive space, starting with, of course, this Eicher IPO. Thank you for joining in this morning. Well, with that, let's head back to the market. Markets are absolutely fine. The Bank Nifty, actually, if anything, has recovered now from that opening cut of 0.5%. It's flattened out. We've got Mitesh joining in with some more details.
Well, that's right. I just want to highlight a couple of stocks. Whirlpool is now at the high point of the day. It's up 3.5%. Overnight, you had Whirlpool Corporation that came out with its set of numbers. They've given the Asia breakup. And the read-through from most analysts, and I have a sell-side note, they are stating that India is likely to have done well. Remember, the challenge is what the promoter is going to do with the India business, which is going to be important. But at least operationally, whenever Whirlpool India does report, it could be a pretty okay set of numbers. Could explain one of the reasons why the stock is up close to around 3.5%. But let's get back to Mitesh. Mitesh, what's your take of the initial 45 minutes of trade, and also give us a couple of picks?
Morning again. I think it's a market, which is just trying to consolidate. I think extremely overbought readings on the hourly to hourly chart suggest that there will be profit at higher levels. And I've been maintaining that on the index, if somebody wants to enter now, use declines to enter. So I think, wait it out. I think 24,100 and then 24,050 are good support pivots. I think that's where one can explore buying. Till then, keep your powder a bit dry on the index. But on stock side, a lot of stocks are still showing a tendency of moving up and are showing some kind of a breakout pattern. So I have a buy on Adani Energy Solutions. Keep a stop at about 935, which is today's low. Look for a target of around 980, about 990 on the upside. And the other one is Sun Pharma. Pharma as a pack is doing well, and Sun Pharma yesterday had a breakout, today is sideways, but the setup is positive, so I'll want to take a trading bet here. Keep a stop below levels of 1770 and look for a target around 1845 to about 1850.
Okay, well, interesting ideas and trades. Mitesh, thank you very much for that. Well, let's bring in an exclusive conversation now. Tata Power is assessing opportunities for setting up large or modular nuclear plants, says Praveer Sinha, MD and CEO of the company, in an exclusive chat with my colleague Shriram Finance. He also spoke about opportunities in the solar module space, capacity expansion there, and more. Listen in.
We've just seen the US impose tariffs to the tune of 3,500% on Southeast Asian countries when we talk about solar equipment. Now, does that open up an opportunity for a company like yours?
Well, it does open up opportunities for us, especially in terms of supplying these modules to not only US but also to many countries globally. And that's an area that we are very seriously looking at, that how do we not only meet the requirements of solar modules in our country, but also export it and cater to the requirement of some of the other countries.
How much capacity would you have available at this point in time, which could be used for exports if that were to be the case?
Well, we today have a manufacturing facility of nearly 4.9 gigawatt. Most of it is actually tied up, but possibly up to 1 gigawatt we may be in a position to sell outside the country.
Would this also then perhaps accelerate capacity expansion plans?
Absolutely. We are examining that now that we have commissioned our 4.3 gigawatt plant, the solar cell and module plant in Tamil Nadu. We strongly believe that we have a capability to execute projects very fast and ramp them to full production. So we are definitely examining such opportunities. And based on how the market conditions are there and how some of the things that will evolve globally, we'll take a call on adding capacity.
And do you believe that this call is likely to be taken sooner? Are we talking a few weeks, a few months?
Maybe in few months.
In a few months. Well, again, speaking about the opportunities that you are considering at this point in time, and you brought up the issue of nuclear power, and that's a move that India has now decided to further. In fact, the budget, the finance minister made the announcement of amending the liability clause, and there seems now to be a concerted attempt by the government to move down that path. What does it mean for Tata Power, and what does it also mean for India?
I think in the energy transition, one of the gaps that we had was we need to have a very efficient base load generation, and nuclear fulfills that requirement. Government has very timely taken a decision that they will open up for private sector, and the government plan is that we will have at least 100 units of SMRs by 2047, which I think is a right move and a correct move given the huge growth of power that is there in the country. The important thing is that this will also bring the best technology which is available globally, as also Indian technology. We have the Bharat small modular reactor, and that is something that we can start with and then get some of the newer technologies from other parts of the world. And for Tata Power, this is an opportunity that we are looking at. We are identifying places, locations in the country where it is safe to put such large or modular nuclear reactors. And I think we'll play a very important role in the whole opening up of the nuclear reactors in the country. And I think you will find that going forward, we'll set a few plans.
Well, you've made it very clear that you do intend to get into this space and set up a few plants. Of course, the legislative action will take its own course, but how ready and prepared are you at this point in time to move forward on these plans? You said that the process of identification has begun. So realistically, what are we talking about in terms of timelines? As and when the legislation, of course, gets through.
So typically, it takes about 2 years to get the land and get the necessary approvals, permits from various government bodies, statutory authorities. So we are looking that maybe 2 years hence, we would be in a position to start work on construction. Typically, these type of projects take 4 to 5 years for construction. And we do expect that we will be in a position to be ready with the plant sometime in early part of 2030s.
Sometime in the early part of 2030s. But, again, for the benefit of all of our viewers who are watching, what does it take to set up an SMR? You were talking about technology, you were talking about indigenous technology as well. What are going to be some of the challenges that one will have to contend with, to be able to make this a reality?
So the most important part of it is how do we make them safe and secure for operation. The nuclear island, which is the main heart of the plant, is something that has to be constructed. We do have a large number of companies in India who make these type of equipments, and we need to put that together and give them the confidence that large number of nuclear plants will come up. So to that extent, we need to get them organized to cater to the requirement of the private sector. The second is the power island, which is like the normal turbine, and those are very well known, and the balance of the plant. So I don't think there would be really a great challenge if we have a good technology partner. In India, we have the Nuclear Power Corporation, which has the right technology and also the competence to support in setting up these type of plants. But globally also there are large number of companies.
Westinghouse?
Yeah, absolutely. And then there are the French companies. And
are you in talks with anyone at this point in time?
Well, yeah, we keep on discussing with them because technology is something which is evolving very fast. And it's very important to keep ourselves abreast with what's happening globally. So we are very excited about the opportunity. This is a new way in which we can produce clean power. And I think we will have large number of them, not only setting up these type of plants in remote locations, but also in locations where we have the load, and we will be in a position to set up and operate in a very, very safe manner.
What would the capex be for an SMR typically?
Well, the capex is very large. A normal coal-based plant costs about 8 to 9 crores. This will be double of that. But the cost of uranium or the fuel that you use in nuclear plants is much lower. Of course, the whole tie-up of getting the fuel, the processing of that fuel, the spent fuel that has to be taken away, all that has to be done by a government agency. We need more clarity on that in terms of how the government will set up a separate entity which will support the power companies, which will set up these SMRs. So I think there's a whole lot of work that needs to be done, but I personally feel that the cost of power from nuclear will be as competitive as the cost of any other firm power that comes, whether it is from brown coal or it is from any other way that we produce 24/7 power.
All right, that is Tata Power. Let's quickly move on and focus on some of the other stocks that are on the move. We have Vinny standing by, who's tracking Syngene and Divi's. Vinny.
Hi, morning. So yes, keeping an eye on both these stocks today. Divi's, firstly, it's on the back of a brokerage note. Citi has given a buy rating. Target price is what they've increased. 7,050 rupees from previous target price of 6,850 rupees. Now, why? Because they believe Divi's has a high potential to become the primary supplier to Eli Lilly's oral drug, which we had recently heard that, phase 3 trials, the trials that were going on were quite efficient. So on the back of that, they believe that Divi's has a high chance versus competition to actually become the primary supplier. Why do they believe so? Because the Divi's has a lot of capacity that is there as well. They're focusing a lot in terms of capacity addition as well. Current capacity 300 metric tons is there. Planned capacity is also there for the company. And because of this, Citi believes that Divi's has an opportunity actually and forecasted around $800 million plus GLP-1 opportunities coming in terms of revenues for Divi's by 2030 is the estimate, and Divi's continues to be the top pick. Now, on the other hand, Syngene, why we are keeping an eye out on this one? Because they've reported their numbers. weak set of numbers came in from the company in Q4 FY25. Overall, other than that, what is also there is that FY26 guidance. That's not exciting, and that's not something that is exciting the street as well, because FY25, they believe the revenue will be much lower in terms of single-digit revenue growth is what they're saying, and other inflows in terms of EBITDA and margin also, they expect that to also come down.
Okay, all right. Vinny, thank you very much for that. We'll come back to you for a sort of more detailed link, but lever numbers, HUL numbers are out. Usually lever reports later in the day, but the numbers are out in the morning, the first half. When the first hour of market open, they're looking like they are in line, largely in line to slightly lower. Actually, I think on the EBITDA and PAT level, they seem to be slightly lower. Margins 22.8 compared to 23.1. We don't have the volume growth, which we should be able to get soon. And Mangalam is miking up as we speak, and we should be able to go across to him. The top line numbers should also come up. I think that table with the top line and the bottom line numbers, etc., will give you a quick snapshot view or the actuals are compared to the poll. So, is there a big surprise? Maybe at the margin, if you want to be, maybe you want to nitpick, maybe at the margin, at the bottom line level, slightly on the downside. But stocks holding up about 1% for now. Numbers just about coming in. Mangalam, what do you make of the numbers?
These are absolutely in line with what the street was expecting. No quibbling about the margins or the EBITDA as well. The company has reported a revenue of 15,200 crores. What was the street working with? 15,161 crores. So when you're working with a base of over 15,000 crore, a 40 crore miss is nothing really to write home about. The EBITDA 3466 crores, growing slightly lower than street expectations of 2% by growing 1%, but that also was expected because of the firm inflation that we've seen in tea prices as well as palm oil prices. I'm just trying to figure out what the underlying volume growth is this time around, but my sense is it's not going to be much beyond what the street was expecting, which was either flat to 1%. Why do I say that? Because the revenue growth has been around 2%, which is largely in line with the price growth that the company has made as well. Net profit growing at 3.6%, again in line with street expectations of close to around 3% growth itself. What is it that the company's done in their segments? Home care segment has been around 5,800 crores. The street was working with a number of around 0 to 3% in terms of growth coming in out there. Foods is where there has been a revenue decline as against a revenue growth expectation. So that's something that we'll most definitely keep an eye out on. Perhaps it's on account of, the decline in tea volumes despite the rises in tea prices. And that's largely because, at higher inflation levels for tea, people move to unbranded tea. So there is a lot of, down trading that takes place out there. Still awaiting volume growth. Nothing yet. But these numbers, largely in line with muted expectations. And on Prashant's comment of them having reported their numbers in the first half itself, I did speak to the management about this. They said from here on, Hindustan Unilever will report their numbers at this hour itself. This is to be in line with the Unilever parent reporting their numbers. Typically, the Unilever, international report numbers come in at around 7:30 to 8 a.m. UK time. So comparing with that, the Unilever India numbers will also come at that time itself. This is perhaps to prevent the arbitrage that takes place between Unilever reporting numbers, their India commentary, and thereafter the Indian numbers coming in at around 3:30 for itself. So from here on, we have to brace ourselves for Unilever reporting their numbers.
Mangalam?
The interaction is at 11:15, so I'll be rushing to Andheri right from here. Meanwhile, we do have Prakash Diwan joining in as well. Prakash, 2% revenue growth, 1% in terms of EBITDA growth, volumes largely flattish. Do you think this is the bottom of the barrel right now, and from here on things can only improve, or maybe just stay put because growth is not coming by any time in the hurry?
No, looks like we are probably at the bottom, Mangalam. The reason being the numbers could have been much more softer than what they are. If you look at this particular quarter, in spite of whatever, higher food, we have a receding food inflation environment, and that is something which you could look forward to in the subsequent quarters. With the quarter gone by, I don't think there was any way margins could have been better or revenue could have been. But there's not much of pricing power left after all the grammage changes that most of these larger players have done. My sense is this is close to the bottom, if not the bottom. But the street will like if the commentary is sounding positive on some of these segments that could start picking up. I don't see any reason why it would not form a good bottom and give you an opportunity to participate in the upside.
All right, we're still awaiting management commentary from Unilever. Typically, it comes shortly after the earnings release itself. So we'll await, any sort of comments on the demand environment and more importantly, what the underlying volume growth has been this time around. But the stock's not giving up because, of course, it's been an underperformer, still trading very close to its 5-year average valuations itself. Amnish, the same question to you. The stock is trading at closer to 5-year, average valuations. It's not done much in terms of a performance when it comes to growth and the stock price move. But from here on, do you think things should improve, or maybe you'll, let that be right now for Unilever in terms of a call?
Okay, these expectations are not very high. And with the inflation having peaked out and the volume recovery overall in the sector likely to be better in the coming quarters. And I think the HUL from the current perspective can give you a reasonably good trade. Say from 21,200 rupees, where it was earlier trading at. Now it is close to 24, but if you look at the last 12 months, it is still significantly below its peak, which was around 3,000 rupees. So I believe that from the current level, there is a probability for the stock to give you a reasonable 10 to 15% return if the volume growth picks up as expected in the industry. But in terms of margins and all, one should keep the expectations moderate because the focus, I think, is going to be on the volume growth going forward.
No, I remember speaking to one of the analysts earlier on the program. They were saying that you can't fault these companies at least for the dividend yield, right? Yeah. The final dividend is 24 bucks. Put all the other interim dividends put together. In the year, HUL has given you 54 rupees in your hand on the stock price. At least that you can't fault them for.
It's about 2% on the stock price itself right now. Be that as it may, 2% revenue growth. It's actually not about the margins. It's definitely not about, the earnings, etc. It's just about growth, which has been fairly anemic. And it's not that 0 to 1% volume growth has been on a very high base or something. If you look at the trend over the last four or five quarters, it's never exceeded 3% at best. So even if you look at a CAGR over the last 2 or 3 years itself, the volume growth has been just about 2 to 3% at best. So on the back of that, there really is weakness in the external environment, as the managements have been pointing out. But lately, the question is, what is it that HUL is doing internally to pump prime the growth in the near term as well as the long term? To that, they have laid out a strategy at the Capital Markets Day as well, saying that they're looking at 6 verticals of growth, beauty and personal care being one, face, high-end sunscreen, etc. being the other, and then you have nutrition and well-being as well. From a management change standpoint as well, very recently they hired Rajneet Kohli from Britannia to head their foods business. One of the rarest lateral hirings done by HUL. Typically, you have HUL managers going and leading other companies, but here you have Rajneet coming in from Britannia and leading their food business. So what their expectations are. The thing is that with all these changes that the company has been making, Rohit Java has been there for about a year or so. Is this the time where the stock is at an inflection point? Very recently, we had a note that came in from UBS as well, which did say that HUL and GCPL look like stocks at inflection points. That's the question, because when the results are so muted and the stock is still up around 1.5%, that tells you something.
If you talk to, I've not spoken to many, but I've spoken to 1 or 2 HUL sort of insiders, past and present, and they all make the point that all these newer brands, D2C, etc., they've been chipping away in some of these fast-growing categories. Skincare, I think, sunscreen as a brand.
Which is why HUL took the fight right to the heart of the matter, right? I mean, I don't remember HUL being in so much press for legal issues as with the sunscreen ad.
Just one. So this person, the one comment stayed with me. He said, "Well, the R&D of HUL is a very large organization. Large organizations typically take a little bit more time to respond, react, etc. But the R&D within HUL, the product lineups, etc., is so vast, and when that gets going." I mean, they can really sort of charge ahead in some of these categories. To that point of inflection, we'll see.
Totally. I can just tell you one thing about this. In all the other categories, you have the disruptors going ahead and acquiring the incumbents, be it financials, be it, technology and all of that and stuff. It is only in the consumer space where it is the incumbents which go ahead and acquire D2C companies. Why is that? Because that's where the power lies. D2C companies, 0 to 100 crore, very easy to scale. 100 to 500 crores, a little difficult. 500 to 1,000 crores, a little tough after that. Beyond 1,000 crores, you have to be with these big boys. So over the last 6 decades that HUL has been here, every decade there has been a disruptor or two which has nibbled away at their market share. But at the end of the decade, the disruptor wasn't there. So if it's the long-term game, then it is HUL. Near-term, of course, it's 1-2% growth that it does anemically. But it's built up a 15,000 crore revenue base per quarter sort of target.
It's an absolute giant. Mangalam, thank you very much for that. 1.5% higher on Lever. The numbers, of course, coming through, and of course, the numbers will now quarterly numbers every quarter in the mornings instead of later post-market close as it was to the last one. Well, we'll take a quick commercial break here. A special segment, it's the economy. Lata in conversation with Stephen Major, the fixed income expert at HSBC, on expected trends in what else but global macros, dollar, Indian yields in focus. Stay tuned.
Hello and welcome to It's the Economy. The latest statements from the United States administration appear to signal a thaw. President Trump has said he has no intention to fire Fed Chair Jerome Powell, and Trump and Treasury Secretary Scott Bessent appear to be signaling some de-escalation in the trade war with China as well. However, we haven't seen a very big bounce in US Treasury yields, though equity and gold markets are reacting very strongly. All other risk markets are reacting very strongly. To understand what's worrying, what's moving the debt and currency markets, I have with me an absolute veteran of the fixed income markets, Stephen Major, Global Head of Fixed Income Research at HSBC. Stephen, thank you very much indeed for your time today. While I express my sympathies for all fixed income traders, given the hot, cold, blow hot, blow cold statements you all have to deal with, what is the underlying worry of the US yields? Why is it just refusing to go below that 4% mark, which we did see on April 2nd?
Well, in fact, there's a story here of a different narrative really behind the front end compared to the 10-year. The front end looks like it's quite rational in that it's pricing in rate cuts and doing exactly what you'd expect from weaker growth and trying to look through the tariffs and the inflation that might come near term. The 10-year is a bit more vulnerable to global factors and uncertainty combined with volatility. And I'll just emphasize that point because uncertainty in its purest form would be good for government bonds because it results in deferred consumption and investment, lower GDP and lower policy rates. But when you add volatility, investors require compensation. And that comes in the form of additional yield and a steeper curve. And that's the reason that 10-year bonds are lagging the performance of 2 years. But let's not forget, 10-year yields are down since the peaks around the 13th of January before the inauguration.
Oh, no, that's a fair point. They had touched, I think, 4.78 earlier this year, as you say, January. And it's clearly fallen, but we were expecting sub-4 recession fears. Let me ask you about this conspiracy theory. There are people who say that Japanese investors have been selling. Some people are even proving it with numbers. Conspiracy theory of Chinese and Japanese selling. What's your take?
Yeah, so look, on the first point about what the view was, the consensus view at the end of last year was that 10-year yields were going to go to 5. And so the surprise was that we were heading to 4. The surprise on top of the surprise is that we're at 4.4, 4.5. Now, the overseas selling argument comes and goes. The latest data has suggested that Japanese sellers were there of a magnitude of $20 billion in the recent week. And I guess it's a rational outcome from the news flow that some private investors may choose to de-risk or to take money away from the US. But $20 billion, let's put this in perspective. The Treasury market turns over between $1 and $1.5 trillion per day. It has a $29 trillion free float of marketable securities. $20 billion is a drop in the bucket. It isn't even a quarter of a typical auction size. So I push back on this idea that overseas sellers are driving the yield upwards because, first of all, the yield hasn't gone up. It just simply hasn't fallen as much as some people have recently started to expect.
Okay. Fair point. Okay, rather than ask you to defend somebody else's actions, what's your own expectation? What are you expecting by way of Jerome Powell's actions, Fed actions? And what are you therefore expecting on the 10-year through the course of the year?
Yeah, so we have a forecast of 3.5% for the 10-year Treasury. We have an official forecast of 3 rate cuts through the rest of this year and then 2 more next year. The forecasts have not changed. Our 3.5% forecast for the end of 2025, we've had it since the middle of last year. The point is the forecast is the forecast. It's based on scenario analysis, not a simple point estimate process. So to me, when our economist tells me that he thinks the Fed could cut 3 more times this year, I think, well, yes, that's consistent with the Fed's own projections, but also from a more stochastic or probability-based framework, it's a bit like saying there's a 50% chance that they cut by 6 times and 50% chance they don't cut at all. To me, there's an asymmetric bias to what happens here to the bond yields. The bond yields are unlikely to go up very much. I don't think the 10-year will break above 4.5. When the 10-year hit 5% last year sometime, the policy rate was 100 basis points higher. So with policy rates where they are now and expectations of easing, it's very hard, I think, for the 10-year to go above 4.5. And once the easing starts in the second half of the year, I think we'll be on the path towards a 3 handle and maybe as low as 3.5 as per our forecast.
Okay. Well, let me try and counter this argument just to, try out these contrary arguments. There are people who worry that if the US is working towards reducing its trade deficit with every country, probably even go to a surplus, I don't know, but at least definitely reduce trade deficit, all of us, like India, China, Japan, will all have fewer dollars. There will be fewer reasons to buy US treasuries. So will not that push up yields?
Yeah, so you're touching on the accounting identity that speaks through the trade deficit, current account deficit, and capital account. Yeah. So someone probably needs to explain that to the powers that be in the US, because it doesn't make a lot of sense to many economists. The thing is that the bonds are increasingly being bought by domestic investors. Some 70 to 75%, depending on how you calculate, of the bonds are inside the US, either in the private sector hands or inside the Fed. And that trend will probably continue so that there's even more. And if you look back through long periods of history, whenever there's a recession, domestic ownership actually picks up.
Yeah.
So I'm not that worried about the bond market. I think that the dollar was overvalued. It was very hot coming into the start of the early part of this year. And so some of the dollar move is actually mean reversion. If you look at the dollar versus most indices and individual currencies, it was overvalued. So some of this is a mean reversion. Some of it is cyclical. And there will be people that tell you there's a secular story about de-dollarization. We would push back against that one as well.
Okay. Yeah, even I find it difficult to believe the de-dollarization story. At least there is no alternative. But Stephen Major, since we have started the conversation into dollar, can you give us your expected range? Are we going to see the dollar index, the DXY, below 100 for a better part of the year?
Well, we've already fallen a significant amount, a double-figure amount. And it wouldn't be unreasonable if we fell a bit more from here, and you know the possibility of 5 to 10% is quite possible. I've got a few simple rules of thumb in my head. If you took, say, one of the major parities like euro dollar, since the euro was created, the euro versus the dollar has been in a range of 0.8 to 1.6. So the midpoint is 1.2, and 1.2 isn't that far from purchasing power parity, apparently. So the fact that the euro's going up and the dollar's going down, again, seems to me fairly consistent. And globally, it looks to me a logical outcome that the dollar should be a bit weaker. Now, the FX markets go through regime shifts, and for much of the last few years, it's been very cyclical. So whilst the US economy was running hot and US real rates and policy rates were higher than everyone else, the dollar was winning with this rate differential argument. But this is too simplistic, because what happens is the FX market can switch very quickly into a different regime, and it could be more structural or, at the moment, more political, because the tariffs really are embroiled in politics, and therefore some of the dollar move will be explained from a more of a political framework for the currency market than a cyclical one.
Fair point. Okay, let me come back to my favorite topic, the bonds. We are seeing contrary moves. The US yields have been high, or at least are not falling, but other yields have been falling, especially in Asia. Can this disconnect continue?
The short answer is yes, and a softer dollar helps the Asian central banks that want to be on an easing path and can justify being on an easing path because of their local domestic data and backdrops. So a softer dollar is consistent with that. What we don't want to see for the Asian markets and actually more globally into some of the emerging markets, we don't want to see a fast move because that would normally be associated with dysfunction or a hard landing. Now, a hard landing may be what we eventually get. A lot depends on the news flow around the tariffs, which of course could change whilst we're speaking. But the reality is, this backdrop does open the door for easing by Asian central banks, and perhaps more than is expected in the forwards and in the consensus expectations.
What's your best Asian market? And per se, your comment on India itself. We've seen a dramatic fall in yields. Is there more to come? Would you be attracted to this market?
Well, our forecast is 6%. We think there's 2 more rate cuts this year. I think that the nature of the momentum that's building up is that we could be underestimating how far yields are going to fall. So if I think there's a risk to our forecast, it's that we're not bullish enough. Oh. If I have a look-back bias through our recommendations this last year, we've been consistently bullish on India. It's been one of our favorite markets. But I always feel we haven't been bullish enough. The arguments for buying India have been based on diversification, and then what is on a relative and absolute basis a strong and stable government with a negative fiscal impulse, a genuinely good, happy outlook. What I fear is that this view is becoming quite consensus. And as a fixed income analyst, I prefer sometimes to be a bit more lonely with my views.
Stephen Major, it's been a pleasure speaking with you. Thank you very much indeed for joining us. And of course, the key takeaway from Stephen Major is going to be that he sees Indian 10-year at 6% and one of the more attractive fixed income instruments in Asia. Thank you very much for watching this edition of It's the Economy. Time for a break. Chartbusters coming up.
HUL and Tata Consumer report largely in line set of fourth quarter numbers. HUL gains with volume of about 2% in terms of growth. Tata Consumer slips as gross margins contract 420 basis points from a year ago, and the stock had already seen a bit of a run-up. In fact, we have the management of Tata Consumer joining us very shortly to discuss their numbers in detail.
Syngene shares fall as much as 10% after reporting a revenue miss in the fourth quarter. A mid-single-digit growth guidance for FY26 also leaves the street disappointed.
Persistent Systems climbs 2% on the back of a strong quarter. Constant currency revenue growth beats estimates. Margins improve. The company has also maintained its guidance for FY27.
Singapore's GIC will pick up 35% stake in Sami Hotel subsidiaries for around 750 crores. The management tells CNBC-TV18 the deal significantly reduces its debt and frees cash for growth. The stock is up by 7%.
Rallis slips nearly 5% following a weak quarter. The revenue declines 1.5% from a year ago. Pressure on export volumes and margins were major drags on the company's fourth quarter performance. You're watching us here on Chartbusters. I'm Mangalam Malu. With me, as always, Nigel D'Souza. It's earnings season, so let's get in our first management coming in on the show. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's Tata Consumer, which reported a largely in line set of numbers in the fourth quarter. The EBITDA beat estimates despite gross margins compressing by 420 basis points. We have with us Sunil D'Souza, who's the MD and CEO of the company. Thanks a lot, Mr. D'Souza, for joining in right now. The most important thing that the street wants to know this time around for the next 1 year is what is your target on the margins? You've said that if tea prices were to normalize, you could see margins normalize as well. The question is, what is that normalized level? And secondly, what's your expected target for Narishco, Capital Foods and Organic India in FY26? These three numbers, if you could provide us.
So Mangalam, we had a good quarter in line with our expectations, actually slightly ahead of expectations. As to your question on forecast for FY26, double-digit revenue growth is a given. We've already come to volume growth across all our businesses this quarter. We have every single business growing on revenue as well, 17% top line, 12% organic. EBITDA margins were a bit soft, and if you look at it overall, EBITDA, I was a negative 1.1. But here's the thing, the primary compression has been because of tea prices, which have run up 25 to 30%. We've absorbed about 50% and passed on about 50% of the prices. So two things are going to happen. A is we're going to continue to take calibrated price increases as we go forward. But also as the new crop comes in, if it is normal, we expect tea prices to start coming down. That will aid margins. Just as a perspective, while we say margins are going to improve, if I took off both the cost and price increases that we took on tea this quarter, I have improved my full year by 80 bips. Our guidance is for improvement of 50 to 100 bips every year on EBITDA margins, and that doesn't change. As regard the question of starting with Narishco, about a year back, we had pressure from competitors who went in with significantly higher retail margins. No changes on consumer price, which was 10 rupees in Tata Gluco Plus. And we had to recalibrate our retail margins. We did that. And we rejigged our distribution system, etc., to the new reality. And it's coming back very strongly. Actually, we exited March at a 38% volume, 26% revenue. And for the quarter, it was 17% volume, 10% revenue. So it's back on growth. We do expect it to come to 30%. And there's no reason why. The Himalayan business, which is premium, grew by 29%. And Tata Copper, our water business, grew by 23%. So largely on track. As regards Capital Foods and Organic India, the good part is we finished the integration. We've taken synergies out. We understood the business. And I would underline that because it took us about 4 to 5 months to understand the nuances of the two businesses. Different product, different buying cycles, procurement, supply chains, marketing. And now I think we are in full control. This quarter, I think we delivered some decent numbers, 213 crores of Capital Foods, 109 on Organic India. Actually, if you take growth rates, it's 80 and 40 plus in the two businesses, but that's because we had soft quarters last year in Q4. But we feel pretty confident of delivering 30% growth going forward with a focus on distribution expansion and innovation and portfolio expansion as well.
Okay. Hi, Mr. D'Souza. Good morning and good to see you. Ben, I wanted a couple of other points. On the international business, what kind of a growth are you guiding for? On a blended basis, last year's growth was better than what the street was working with, so that's good. For this year, what will international business look like? And what is the targeted ROE? You know, it's still in the mid-single digits. So where do you see that headed?
So the international business, the good part was for the full year, I think we delivered a 5% top line and a 21% EBIT growth. And broadly, the business is back on track. We've always maintained a mid-single digit top line and EBIT margins being accretive to India, accretive to our total business. We did deliver a 5% growth and EBIT margins were 300 bips higher than where we delivered the rest of the business to be. So it's fulfilling what it's supposed to be. The UK business is a standout. We're number 2 tea business now and on a very strong margin profile and overall structural balance. Canada, of course, has come back. It's always the jewel in the crown, very steady. This thing. The US business was a bit of topsy-turvy with the coffee prices, etc. I think that's come back on track. We had 2% volume, 4% revenue growth, and we've announced a price increase starting June with the coffee prices, and therefore even the margins will come back. So international business, again, mid-single digit top line and EBIT margins accretive to the total business is what we would guide for. On the ROE basis, it's a choice to make. I could stand still on acquisitions, and therefore, as I grow my top line and EBITDA ahead of margins, I will improve EBITDA, my ROE, ROC margins. In fact, before we did the acquisitions, if I'm not mistaken, in 4 years, we had gone up about 400 to 500 bips on ROC. So we could do that. But we are geared for the longer term. We will grow organically and inorganically while making sure we are focused on both top line and profitability.
All right, we take that point. And final question before we let you go, Mr. D'Souza. One is the target share of revenue that you expect from new products. You launched 41 in the last financial year, 41 in the previous financial year as well. So what proportion of your revenue is currently coming from products launched in the last 2 years? What's the target here? And secondly, there is a slowdown in Tata Starbucks. Do you still maintain targets of 1,000 stores? And have you scaled back on the pace at which you are investing in Tata Starbucks? Comment on Tata Starbucks as well as innovation in products.
So on innovation in products, Mangalam, innovation is key to any FMCG business. And we do aim to be in the top tier of innovation in the food and beverage and FMCG space. Last year, FY24, we delivered 5% plus. FY25, we delivered 5.2. We aim to continue that same trajectory going forward. So you could expect one launch every week as we go forward. That doesn't change. In fact, we will try and accelerate that, if anything. On the Starbucks business, we remain focused on the long-term guidance of 1,000 outlets by FY28 doesn't change. We remain committed to that. It's just that, I think I said this earlier also, we will calibrate depending on market conditions. The simple thing that I use is a quote from one of my bosses earlier. Emerging markets is a snake in a pipe. Directionally, it's going up, but it will yo-yo up and down while moving up in that direction. And that's where we are. The good part is, I think we've started to see business coming back a bit. Same-store sales growth was, I would say, low double-digit negative when we started off FY25. By the time we exited the quarter, we are into almost zero, touching distance of zero on same-store sales growth. We had tempered outlets a bit, but we remain confident of hitting the 1,000 outlets by FY28.
Okay, all right, Mr. D'Souza. Appreciate you joining in. Thanks a lot for giving us those details. We look forward to having a chat with you as the year progresses. For the time being, we'll take that guidance on board. The stock is down close to around 1.5%, but actually it's recovered considerably from the low point of the day. Well, let's slip into a short break. When we come back, we'll focus on the technicals of the market. Sachidanand Uttekar will be joining in. Welcome back. We'll keep an eye out on a few stocks on the screen. VIP, yesterday the stock had seen a good recovery from the low point of the day. That one has continued with that, so volume spike on that one. And the other stock that's surging away, which we pointed out earlier as well, is Whirlpool. Now it's up close to around 5.5%. The international parent, that's Whirlpool Corporation, came out with its set of numbers. And the read-through is that India business could have done quite well. So that's the reason why that one is up close to around 5.5%. And Dalmia Bharat continues to hold strong with a gain of close to around 3.5%. Sachidanand Utekar joins us on the show. Hi, Sachi. Good morning. Good to see you. When markets in a bit of a consolidated mode just for yesterday as well as today, moving in that band of around 24,000 to around 24,350 or thereabouts. How would you read this? Would you look to buy into this mild dip?
Good morning, Nigel. Good morning, Mangalam. I think clearly the trend has been on the bullish side. What we are observing today is a mild consolidation. And as you rightly said, I think 24,200, 240 looks like a stable base. But on the higher side, there is resistance at 24,440 at least for the day. But overall, we are expecting that this particular rally should continue towards 24,500, 560 in the coming weeks. So I think it's better to be on the long side. The decline is very healthy so far. That 24,240 mark has been respected well. So keeping a stop loss somewhere close to around 24,160 on a closing basis, some long positions can be maintained. When we look at Nifty Bank as well, 55,000 support has been very strong and very significant. Even here, until unless we don't see a closing below the 5-day or the 5-day exponential moving average support, which is placed somewhere close to around 54,960 thereabouts. I think the trend momentum would still continue to be on the positive side. So even Nifty Bank, I think, has come to a stage wherein some long positions can be deployed. We are expecting that in the coming series, Nifty Bank may scale towards 57,000, 57,300. When we look at stocks, there are ample of stocks which are hitting our radar now. If you look at Tata Power, this is something wherein the stock has started trending above its 200-day exponential moving average after almost 4 months. If you look at its 50-week exponential moving average support, which was placed at around 388, has been negotiated well. And if you look at the weekly RSI, it has started giving a breakout above that 50 mark. Even on the price scale, it looks like a inverse head and shoulder formation, exhibiting a pattern target at around 436, and that's why we are recommending building long positions for the coming series. Trading target is placed somewhere close to around 412. Second target would be 436. The stop loss can be placed at around 388 on a closing basis, and long positions can be deployed in Tata Power. The second stock which has hit our radar is Cipla. Now, the entire pharma pack has been doing really well. We have already seen very sharp pullback moves here. But if you look at Cipla's performance for the last couple of trading sessions, we have seen consistent built up on the long side. If you look at the weekly pattern, it looks like a classic V pattern breakout. Even here, the daily ADX has just turned on the positive side. It's giving a breakout at around 25 level, which is a good sign of momentum. So we are expecting that this particular move may extend towards 1600, followed by 1670. And that's why we are recommending building long positions in Cipla in the May futures. One should keep a stop loss at around 1540 on a closing basis.
Okay. All right. Thanks a lot for that, Sachidanand. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock that he's tracking closely. Sachin?
Maharashtra-based country liquor manufacturer GM Breweries posted a solid operational performance in the final quarter of FY25. In Q4 of FY25, the company reported a top line of almost 169 crores, which represents a growth of 6% year-on-year. Margins also expanded by 60 basis points at the operating level to 24.5% in the quarter gone by, thanks to benign operating costs. However, the operating costs, especially on the raw material front, is expected to be challenging going into FY26 due to decline in sugar production at the all India level. The sugarcane production in India is anticipated to decline almost 20% year-on-year due to unfavorable weather conditions. So that should have a bearing on the margins for the company going into FY26. That being said, the company has a very strong balance sheet to navigate the current set of headwinds and is currently sitting on cash equivalents almost 600 crores. And also the company trades at reasonable valuation of around 10 times FY26 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, well, let's slip into a short break. You come back, we'll continue to focus on markets and stocks that are moving around. Well, let's address another story that's coming in. Sources tell CNBC-TV18 that the Indian Commerce Ministry officials will be visiting the US, UK and other major trade partners to discuss the terms of the FTA. Abhimanyu joins us, all those latest details. Abhimanyu?
Global trade will continue to remain in focus as several Indian officials are going to visit various countries in the next few days, ranging from the United States to the European Union, the United Kingdom, and even an EFTA country. Now, an Indian negotiating team led by Chief Negotiator Rajesh Agrawal, who's an additional secretary with the Department of Commerce, is already in the United States, and they are going to hold talks with the American side before formally launching negotiations for a bilateral trade agreement between both the countries. Now, already the terms of reference have been finalized with 19 chapters, which include issues like goods, rules of origin and regulations. It remains to be seen how talks are going to pan out. Also, Piyush Goyal, India's Commerce and Industry Minister, is going to leave for a 5-day visit on the 27th of April. He's slated to go to London, Oslo and Brussels, while India is already engaged in FTA negotiations with EU and the UK. It's awaiting implementation of the FTA which India had signed with EFTA countries, since it has to be ratified by respective parliaments of different member countries before it completely gets implemented. Also, the 11th round of India-EU FTA talks are slated to be held in New Delhi from the 12th to the 16th of May, and an Indian team is expected to also go to Brussels next week for pre-negotiation talks with the European Union. Now, both the sides may explore the possibility of an early harvest agreement similar to what India had signed with Australia.
Thanks a lot for that, Abhimanyu. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went chappal, and just a student, you go there and So kala, like, come tomorrow, like, and so on. And then after conviction, after some convincing, fill the form, 2 days, 3 days, like, and open my account. By the time you're like gone, like, your interest is like lost.
Yeah.
So the point was like you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in like low single digits. And now it is at like high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do like e-commerce, unregulated products. We will not do anything which is not good for the customer.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and with me is Vinny Motiwala. And after 7 good days on the trot where the markets were running higher and higher, today is a session of consolidation. Markets have paused. The Nifty is down 50 points, just shy of the 24,300 mark. The Sensex has slipped 180 points. Mid-caps, though, continue with their relative outperformance. So no gain on the mid-cap index. The mid-cap index is flat. But this week, the mid-cap index has clocked in a gain of 4.5%, significantly outperforming the Nifty, which is a gain of close to about 1.5%. On to the top, gainers. Reliance Industries is a tad bit subdued ahead of its, numbers tomorrow. So keep your eye on that. Hi.
Hi, Rima. Good morning. So like you were mentioning as well, a bit of a subduedness is what we're seeing in terms of the market after 7 consecutive trading sessions that decline. Volatility is obviously something that is there today because there's expiry as well. But, a sector that is doing well in this grim is pharma. Look at the Nifty Pharma. We've seen a bit of a spike coming in the last half an hour specifically as well. A lot of announcements today that have come in specially for these pharma names. So that is something that we'll be keeping an eye out on. We'll deep dive into all those names separately as well, whether DVs, Thyrocare, GSK Pharma, Syngene, Lupin, all these names are something that have been buzzing in trade today. And specific reasons for that we'll get all through in the later on part of the show. But FMCG, let's just focus on that because today we had HUL that had reported its numbers sometime back. Now, post that we're seeing HUL is in focus, Nifty FMCGs, that's seen a bit of a furthermore decline coming in as well. FMCG is reacting to Tata Consumer numbers. We'll have Nestle that is reporting its numbers today as well. Now, specifically on HUL, today as of now, the stock is down 3%. Overall, numbers seem like largely inline set of numbers in Q4 FY25. Volume growth is coming in at 2%. But to break down and analyze these numbers, Mangalam is here to give us more details on that front.
Well, Hindustan Unilever recorded an in-line performance in the fourth quarter, where the revenue grew by about 2.4%, the EBITDA grew by about 1%, largely in line with very muted expectations of the street. But what was positive were a couple of things. One, the company scaled back on some ad spends to ensure that the margins are, improving. Between 22 to 23% is the guidance that the company is given going forward as well. This, despite the volatility that we've seen in raw material prices. And secondly, the underlying volume growth this time around has come in at 2%. Most on the street were working with a number anywhere between 0 to 1%. So to that extent, there has been a positive performance that has come in. Add to that, the stock is at near 5-year average valuations itself after having underperformed. So the street believes that maybe going forward, there could be sort of an inflection point and improvement in the demand environment for the company itself. And that's exactly what the management has said as well. If you look at beauty and well-being, that grew by about 3%. Personal care grew by 3% as well. And home care delivered a 3% underlying volume growth. The company said that going forward, they expect demand conditions to gradually improve over the next fiscal year, for which they are committed to unlock growth for the company itself. So largely in line with muted expectations, a few bright spots and attractive valuations versus its 5-year average has the stock excited in today's trading session.
Okay, Mangalam, thank you so much for that. And we'll also go across to the management of HUL addressing the media after the Q4 earnings. Okay, let's move on and shift focus and talk about one of these pharma names that have been in focus today. Lupin, that's seeing a spike up in today's trading session. Why? Because yesterday we had spoken about this, right? The company was expecting to get an approval coming in from the US FDA. This was for the generic version of the drug of tolvaptan. That's the drug that we're talking about. Now, obviously, the patent expiry has happened of this drug for the innovator. So that is why they've gotten this approval. Now, for Lupin, they will be the first to file of this product. They've signed in the press release, they've mentioned in the press release as well that there will be a 180-day exclusivity that they'll have on this generic drug as well. Other than that, they will be launching this product soon. They've not mentioned an exact launch date, but soon is what they've highlighted. Manufacturing this product in the Nagpur facility. Analysts, what they are highlighting, they expect this generic drug to have an opportunity for Lupin almost in the $150 million to $200 million range for FY26. And possibly this could contribute to 25% plus for Lupin in terms of FY26 earnings. Axis Capital also has said that they have revised the FY26 EBITDA and profit outlook for the company, factoring an 8 to 10% increase furthermore from what their previous estimates were. So that is something interesting. A big drug coming in for Lupin with 180-day exclusivity is something that's keeping a stock abuzz as well, Rima, today.
Okay, but Syngene, that's the big casualty of the day, and there is some guidance cut. As in what the company is guiding for is lower than what the analysts hope to hear.
Absolutely, Syngene, the numbers were in line when you look at it. Nothing bad that came in terms of numbers. But for FY26, the guidance in terms of revenue, it's lower than what the street was expecting. Base business, yes, mid-teens is the guidance given, but for overall business, single-digit revenue growth is what they're talking about. Other than that, do not forget, FY25 was already a subdued quarter for the company. So if, apart from that, you're seeing more of a subduedness even in FY26, then that's something that's fearing the street. But other than that, they're expecting the EBITDA and the margin front also to be a bit subdued. Profits also to see a decline on a year-on-year basis in FY26. So that is some bit of a worry that's coming in for Syngene in terms of their numbers going forward, that is something that we'll be keeping an eye out on as well. But commentary seems to be a bit weak in terms of the guidance for FY26, and that is why today we're seeing Syngene that's down and out in today's trading session. But on the flip side, we have DVs, that's buzzing in trade as well today. The company has actually, gotten, this is a note that's coming from Citi. Now, they are maintaining a buy rating. Target price is up to 7,050 rupees from 6,850 rupees. And this is mainly, they believe that, DVs could be one of those players who will benefit from Eli Lilly's oral drug that is going to be launched or that's going to be coming up. They would be one of the primary suppliers. So because of that, they believe that this is a very big positive that could come in for DVs.
Welcome back. Let's turn our attention now to the commodity markets. Manisha, as promised, is now with us on the show. Manisha, what is the commodity that you're looking at today?
Well, I'm looking at the gold prices because the volatile moves in this space just about continue. After hitting an all-time high in this week itself at around $3,500 an ounce, we've seen some profit taking come into the markets. Well, yesterday it fell all the way down to below 3,300, but it's holding above those levels at this point in time. And there is a volatility of anywhere between $60 to $100 an ounce that we are seeing in gold prices on an everyday basis. Not just international gold prices, but the Indian prices, after hitting almost a 99,400 level of a mark, have seen some decline coming in, holding around that 96,000 rupees at this point in time. But even with these corrections, if you look at the gold prices, they're up by 10% on month and up by 27% in this year until now. Well, the markets are looking at a few things which have led to some decline or some cap in the gains coming in. One is the dollar index, which did fall below 99 toward 3-year lows. That has seen some gains come in. And then there's a bit of a uptick in the global equity markets as well. So you have seen some gold money go in there as well. Markets also are looking at US indicating potential lower trade tariffs with China. There has been some retracting of statements as well about the US Fed independence. And that also has eased a bit of a safe haven buying that we saw in gold. But a couple of important developments, and that would continue to support gold prices. One is China buying gold. The central bank and the institutions have been, even the insurance companies are buying quite a bit of a gold. And March has been a 5th straight month of gold buying there. If you look at the numbers therein, well, China bought 50 tons in Feb and another 5 tons in the month of March as well. China has been buying for the last 3 years now, and that pattern just about continues even now. More interestingly, even as China is talking about internationalization of yuan, China also is looking to invest via Shanghai Gold Exchange in sense of gold. There are conversations and reports that gold trading in China could also be internationalized, and not just trading, but deliveries and warehouses also will be opened up to the world. That really comes in on a big one, and that has been supportive for gold. Well, that's about China. But when you look at the US imports of physical gold, they also have been on the higher side. They're actually categorized as industrial supplies and materials. So when you look at the US trade data, that shows you that in the month of November or for the month of Jan, we have seen very strong gold being bought into US. In November 2024, the holdings or imports per month was at around $2.8 billion, which we have seen surge in the month of Jan. This was ahead of tariffs. In the month of Feb as well, it has been a double-digit $1 billion of an import in US that we have seen come in for gold. Another important thing to watch is the statement that has come in from the Atlanta Fed official, who says that they're looking to introduce new GDP estimation model adjusted for gold trade. So there are newer developments coming in from across world, especially from China and US when it comes to gold trade, and that clearly would be supportive going forward. Global ETF holdings for gold also are at September 2023 highs, and the gold ETFs for US are at all-time highs. So various newer records being created there as well. So even as we are working with a bit of a profit taking in case of gold, Goldman Sachs, JP Morgan do tell us that it would be higher highs, all-time highs before we close this year. And then they are estimating $4,000 an ounce for 2026 as well. So, well, buy on dips does look like a strategy.
Absolutely. Buy on dips does look like a strategy. Right now, some profit booking, but going forward, maybe year-end, we could see newer highs coming in as well. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Vishal Mulkan of mulkansview.com and also discuss their top trading bets. Welcome back. Let's revisit HUL. HUL is now the top Nifty loser, nearly 4% gone.
It's at the 100-day moving average of 2,334. Volumes look fine at a 2% growth. So what's weighing on the stock? Sudarshan is now joining in. Sudarshan.
So you've heard from Mangalam about the earnings. Earnings were largely in line with estimates when volume growth has come in at 2% against our expectation of flat to 1%. But what is dragging the stock is the outlook that company has given. While it believes that H1 FY26 is expected to be better than H2 FY25, but on EBITDA margin front, now the guided range going forward is in the range of 20 to 23%. And remember, earlier guided range was 23 to 24%. Also, company says that gross margin is expected to moderate from current levels and price growth is now seen in low single digit. And one major segment, that is the home care, which has seen the negative price growth even in Q1 FY26. So while earnings were largely in line, but the outlook has weighed on the stock, and that's the reason you are seeing a sharp fall. It's down almost 7% from day's high.
Sudarshan, thank you so much for that. But let's cut across to my colleague Mangalam and Shilpa, who are in conversation with Rohit Java, CEO and Managing Director of HUL.
During the year, we continued on our journey of sharply executing the Aspire strategy to unlock a billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Period business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year-on-year. This contraction in gross margin was driven by commodity inflation across palm oil, tea and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year-on-year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skin Care was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin Cleansing, led by non-hygiene segment, continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remain healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18% and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with right price-value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks and I will take questions.
Hi, thank you so much for speaking. If I could just quickly touch upon the urban demand scenario, can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years. And we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong, getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'll be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further dial up investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year will progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where we can expect price decreases and where can we expect the price increases?
Yeah, so home care is the category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter, we had a negative price, and this is where the momentum of pricing will be negative, unless, again, the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production. The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
Right. If you could also just touch upon the margins bit that I was talking about. How do we look at the margins?
So margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Right. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And it will keep helping us to keep driving more amount of investments across the board.
Just to confirm on that, last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23 and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today what we're speaking about that we are lowering that number to a range of 22 to 23 because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
So, first of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out, first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading. They quality of life, they want better products. And I'm not talking of, extremely privileged or luxury products, but people climb up to a better quality of product experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point. Right. So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the low pack sizes. That also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption. And market development is the main thesis for growth. Innovation, improving quality of our products, getting people to use something more, better, is the main thesis of growth in this market. And we stick to that in medium and the short term.
Any guidance with respect to growth where minimalist is concerned, because beauty and personal care has done very well this quarter. What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to minimalist business. We will also aid international expansion of the business. And last but not least, minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the four elements of synergies with which we will now start running the business. We'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand. very well positioned in the masstige skincare category. And we do believe now within the family of Hindustan Unilever, it will have a very bright future.
Welcome back to Trading Hour on CNBC TV18. Now, let's get a check on the market on the technicals. And we have Vishal Badkan of mulkansview.com joining in with us to give us that check. Vishal, morning. Thank you so much for joining in with us. Today, what we're seeing in terms of the market, after 7 days, we're seeing the red on the screen for Nifty below the 24,300 mark. What are we technically watching out for? Could we see a further fall coming in, or what are you expecting today?
Yeah, hi. I think the rally which we had in the last 7-8 days is a very sharp one, like a perpendicular one. So there needs to be some breather, which the signs are already there in the last couple of days. So it can be like a consolidation before we move forward, like between the range of 23,900 and 24,300 could be a good range. So there could be a small correction, or what we can say retracement, where it comes down to 23,900 or 24,000 and then take support and then move forward. So there would be some subdued market for the next few sessions.
What about stocks? Vishal, what are you recommending? And any thoughts on HUL and the fall to 100-day moving average that we've seen?
Just checking out on HUL has, of course, has corrected due to results, and there's a big candle, like big volume. So there is definitely some kind of resistance on those levels, and it can further go down to 2270, 75. That could be a good support where HUL can take support. So for the timing, I would avoid, especially because it is news driven or event driven. So I'll avoid and wait for a dip till 2270 on HUL. And as far as stock specific is concerned, I think one stock which is looking strong as of now on my charts is CDSL, which has given a good breakout about that 1350 level. So we can go with a buy on that with a stop of 1335 for targets of 1420 and 1475 in the next few trading sessions.
Okay, Vishal, thank you so much for that, talking us about the levels and taking us through the levels for the market as well as in terms of stocks. HUL as well as CDSL is something Vishal has mentioned and spoken about liking as well. But let's move on, and Devang Mehta from Spark Private Wealth Management is joining in with us to discuss market fundamentals and his top sectoral bets as well. Devang, good morning. Thank you so much for joining in with us. In this current global market scenario that we're seeing, domestic market, we have earnings that are coming in as well. Where do you see growth coming in? Where are you bullish on now going forward?
Good morning, Vinny. Thanks for having me on the show. I think very clearly the growth pockets are right now clearly visible in the market. What has happened over the last few days, to be precise, from April 7th, where I think market formed a bottom, and from there on, a 10% rally in the large caps and almost the same amount of rally on even the mid cap and small cap indices have been actually showing the market's resilience. Why I say that? Because it's extremely fashionable to be in and out of the market, and there are a lot of questions about probably raising cash or staying underinvested. But I think this is where clearly one differentiates that when you stay invested, you probably don't miss the best days of the market. If you miss the best days of the market, your return suffers drastically. Now, coming back to the question, very importantly is which are the sectors which are sort of participating. I think there was a lot of hue and cry around which sectors would probably lead the rally. And if I can say, this rally has probably started from the bottom or whatever the last few months of correction. A couple of sectors come to mind. I think very clearly one theme which we've been very bullish on, the entire capex, manufacturing, infrastructure, capital goods, manufacturing, sort of this type of theme where there can be data centers, where there can be power automation, there can be lamination, there can be engineering type of companies. And these companies had undergone a severe correction, not only on the price front, but also on the valuation side. But if you look at the order book of these companies, I think the last one quarter where numbers were not so great, but if you look at all this order book of these companies, they've been generally very robust. Secondly, the government activity which has slowed down in the October, November, December quarter also saw a good bit of bounce in the January, February, March quarter. We have seen inflation cooling down. We have seen rate cuts, which helps the industry, which even helps consumption. I think budget also announced a little bit of measures for consumption and financialization. I think a couple of sectors, as I said, one capex-related theme. The second, as I always talk, is more of discretionary consumption related to hotels, related to sort of lifestyle expansion. And the third is financials. And financials, definitely, I don't mean only banks. It is a lot of NBFCs, a lot of companies related to the broking or depositories, exchanges. I think there have been a dream run in some of this, but I don't think if somebody has a 2-3 horizon, why these companies would not do well.
You spoke about financialization trend, which is still very much intact, and exchanges, depositories, etc. What about wealth management? We just saw this big deal where partnership between 360 ONE WAM and UBS, sort of setting a valuation benchmark now for the wealth industry, wealth management industry, and the stocks. Your thoughts on this space? And is it attractive to buy in at these levels?
Extremely interesting space, Rima, to tell you the truth. Of course, as I said, we are in the similar space, and we know how in India the number of millionaires and number of billionaires are rising by the hour and by the day. The most important thing is this. The second important part is that as AUMs keep on rising, there are also alternates which have come to the picture. There is so much that people aspire for, and there is so much goal setting. There is so much of things which people want to sort of grow their wealth at a decent pace, right? So earlier, if you think about wealth management, there was just a couple of products. Now, because of the productization, because of the huge bouquet of products, right from equity to debt to alternates to structures to real estate to even overseas investing, I think it's a very interesting space. I think a bit of consolidation has started to happen, as you rightly talked about, couple of deals, and most of the numbers that the listed players have shown so far have generally been good. So you're seeing a 20-25% type of growth in certain companies as well on even the revenue and the profitability front, which I think augurs very well. I think the size of the market is enough and more for everyone to expand, and even the market shares will be taken over by certain companies. So my sense, this is one prime financialization candidate, this wealth management or private banking as an industry.
Okay, surely find interest in the wealth management side as well. But Devang, I just want to understand in terms of pharma also, what is your thought coming in on that? You have not mentioned it anywhere, though you mentioned IT metals, more on the export-oriented side. Your view on the pharma?
So ideally, what we have gone ahead and told is that there are two things. One, wherever there is global dependence, wherever there are global linkages, now be it IT, be it metals, we know that what happened to IT companies. I think most of these large cap IT companies are trading somewhere near the 52-week low on unknown reasons, right? So most of these companies are growing their top lines by say 2, 3, 4% type of line. So I think probably they might give you returns in the tune of 8, 10, 12%. Even metals the same. Pharma, I think we are clearly bullish on India-centric companies, on MNC companies like About India. I generally just don't recommend ideas, but this is just one portfolio stock that we hold. Now, this is an MNC company which is more of a health tech, but the company has superb ROIs. The company come up with good set of numbers over the last 3-4 quarters. I think these are the type of niche companies that would like to sort of get into innovators rather than being a normal generic company. And you know that probably today the narratives change by the day, change by the hour. And if US announces something, I think again we see a bit of correction. So my sense that we would be probably more domestic facing. Even in pharma, if there is something domestic centric, we would be interested. But otherwise, generally there are so many domestic consumption, domestic financialization, and domestic capex oriented themes that there is ample choice. You are spoiled for choice to buy great companies.
Okay, Devang, thank you very much for that. Nestle numbers are up for you on your screen, and it's bang in line with street expectations. 885 crore is what the company's reported in terms of a bottom line, a slight moderation of 4% year on year, and the top line too at about 5,500 crore has come in line with street expectations. The stock currently is up close to about 1.8%. So after HUL disappointed the street in terms of its EBITDA margin guidance by lowering it, saying they'll unblinkingly focus on growth when it comes to growth versus margin trade-off, Nestle seems to have delivered and met street expectations. We'll await more in terms of the commentary, but revenues at 5,503 crore, in line with expectations, a growth of about 4-5% on the top line. Bottom line has seen a slight bit of a decline, a decline of about 5-6% perhaps in the bottom line compared to it on a year-on-year basis. But the stock is holding up okay. We await the margin performance and even the volume growth.
Absolutely, margin performance and volume growth is something that we're keeping an eye out on. As of now, seems like largely in line with what we were expecting. Nestle is managing to hold on to some bit of a gain as well in today's trading session. 1% uptick as of now, just around that 1% mark. In terms of commentary also, what they've said that, they are seeing beverages, confectionery, which is seeing a good growth coming in for the company. So that is something that is working out well. Margins is something that we'll be keeping an eye out on. But yes, on that note, we're going to slip into a very short break. And okay, actually, we have Prakash Diwan who's joining in with us as well. Prakash, good morning. And Nestle, in terms of numbers, what's your first cut coming in for Nestle? HUL, while it's a bit of a disappointment coming in on that front, Nestle seems to be okay. That's also gone into the red as well. So your first cut on Nestle.
No, so, I don't think there was any high expectation from any of these larger FMCG plays because, demand revival is still some time away. Very clearly, even before the numbers were out, data was very clear indicating that there could be still some softness because there's no volume growth. Even if they were to improve margins marginally, it's not going to make a big difference till volume growth comes. For both of them for quite some time. Nestle is probably in a better position given the price points that it sells at and the kind of product mix that it has. HUL has certain other things which at times pull it down, especially the high value, high priced personal care stuff, which Nestle doesn't need to worry about. So I think both of them are very similar. They tell you a very common picture. There's nothing, there's no outlier kind of a performance in any of them. So we'll have to kind of just wait for even the commentary to give you that assuage that doubt whether demand is going to grow from here. There's nothing very, very stellar about the numbers at all.
Naveen Kulkarni, Chief Investment Officer, Axis Securities, is also with us on this show. Naveen, in the FMCG staples, Nestle has a bias more towards urban consumption. And we just heard the HUL management where they're saying the macro triggers are positive and therefore urban will now start picking up. Up until now, it was rural driving growth or rural growth outpacing urban, but now urban should start looking up. Would you read that as a positive for a company like Nestle? And two, tell us about the valuation because, generally high valuations, elevated valuations for Nestle has always kept some people on the sidelines when it comes to Nestle.
Yeah, so the pickup in urban consumption going ahead is a positive, no doubt about that. And it should help Nestle probably more than other companies because the brand strength for Nestle is much higher. Their ability to pass on input cost increases, all those things are much, much better than most of the other FMCG companies. So that is certainly a positive. However, the challenges for Nestle are not so much with regards to valuation, but the overall growth trajectory, right? So the valuations, of course, vis-a-vis the growth appear to be a challenge. If growth were to pick up, right, then of course Nestle and the likes of HUL and others tend to have very, very high return on equity, right? So from that perspective, they don't need any significant capital to grow. So all those factors will essentially play out and then of course the valuations will get justified. But the critical element will always remain what is the growth versus the outlook going ahead, right? So those are the critical factors on which I would say that we will have to look at Nestle and Unilever.
Got that. Growth is paramount for all companies, and growth has been, in line with expectations, but generally we're still looking at very low to mid-single digit kind of a top-line growth. The Nestle share price has dipped down close to about 0.5%. Numbers are in line. We'll await the volume details and the commentary going forward. Get into a break. On the other side, by the way, we thank Prakash and Naveen for joining in. On the other side, Mangesh Bhadang from Centrum Broking will join in on the other side to talk about the latest trends from the cement sector. And Nigel, as you can see, is also waiting by to give us a quick preview.
Welcome back to Trading Hour on CNBC-TV18, and like we promised in our special offering Quarter Se Quarter Tak, where we bring you key earning expectations from each sector, Nigel today is here to tell us what to expect from the cement sector in Q4 FY25. Nigel, over to you.
Well, in Q4 FY25, cement companies could emerge stronger. Let's quickly run you through what's happening in the industry. First up, cement demand is set to grow by close to around 8%. This after the 6 to around 7% growth that we saw in Q3, and after we had a flattish year in the first half. Demand is now bouncing back across regions. Rural demand is roaring back, and the government capex recovery is adding fuel to the fire. On pricing, there's a bounce as well. All regions except South have seen hikes of roughly around 2.5 to 3.5% odd, which has been led by North India, West and Central India. Even April has seen some price hikes, and that's what will give a solid boost to the EBITDA in the coming quarters as well. And after 3 quarters of decline, the EBITDA per ton is set to see some kind of improvement finally. That's thanks to the better pricing that we just spoke about, as well as the operating leverage will play out as well. Though on a year-on-year basis, still that EBITDA per ton will be a little bit lower. Let's focus on company-specific expectations then. UltraTech, well, they gain on volumes from the Shriram as well as the India Cements integration. Though on the margin, well, that will be capped because they'll be getting the profitability or lack of profitability from both these two acquired assets. JK Cement and Shree Cement, well, they'll benefit from the strong regional pricing, while Ambuja Cement could see a good bounce back after a tough Q3. Before we wrap up, well, let's get you a quick valuation snapshot of the companies. The majors come up for you on the screen, trading between 15 to around 18 times on an EV upon EBITDA basis. That's on the forward earnings, that's FY27. While we also have a few more names, Ramco, Dalmia, as well as JK Cement. So those are the expectations. The big question is, will cement emerge stronger from here on? To answer some of those questions, well, we have with us Mangesh, who joins us. Hi, Mangesh. Appreciate you joining us, this morning. Well, tell us first, what is the read-through you saw from Dalmia's numbers? The positive is that I think prices have moved up a little bit and their operating performance was more or less in line. What's your take? And if we look for any surprise in this quarter, which company could bring that up?
Hi, thanks Nigel for having me. So Dalmia numbers were good, slightly better than what the street expectation was. The EBITDA performance was quite good, and they delivered almost 925 rupees of EBITDA per ton. And this is despite lack of pricing as well as volume growth in the southern region, where they do have a relatively large exposure. So I read that as a quite decent numbers, and I think the rest of the players who have, say, lesser exposure to South, I think they would be able to deliver much better performance compared to what Dalmia did. So volume growth, if you exclude the GPA volumes that they had in the previous quarter, I think it is decent. It's not very high, but I think, the industry, they might have only two of the things. Either they will have volume growth or they'll have pricing. And I'm happy that, the industry is focusing on pricing after a long time. So volume growth probably is in line with what the industry had delivered or slightly lower. But I think over the period of, say, 3 to 4 quarters or period of a year, I think their volume growth would either be in line or slightly higher than what the industry has delivered. So good numbers from Dalmia. And I think, the north and east focused companies should be able to deliver much better performance than.
So the outperformance should basically come in from the likes of Shri Cement and JK Cement. Would that be the call you're making?
Yes. So Shri, I think it would be a large outlier this quarter. We are expecting a bumper quarter from Shri, and I think they will be able to surprise on the positive side. So volume growth for Shri was missing for some time. I think they will deliver on it this time around. And profitability, as always, probably this will be an industry-leading profitability. So we are expecting very close to 1,400 rupees of EBITDA per ton for Shri.
Okay, all right. Valuation's not cheap, but this quarter should deliver a strong showing. What about the South-based player like a Ramco Cement? The stock has gone through a period of consolidation. It's come off the recent peak that we have seen. And the past quarter may not be that great because pricing, as we have been discussing, has been weak. Valuations as well, not cheap, but that deleveraging is something that holds them in good stead. What's your call on Ramco?
So South-based companies and specifically Ramco, they had this double whammy that, overall the pricing as well as demand was weak in the regions that they operate in. And a month back, the state government of Tamil Nadu had imposed a royalty on the increased royalty on the limestone that they mine. So that's also going to increase the cost for some of these southern players, specifically located in Tamil Nadu. But I think April onwards, we have started seeing prices move up in the region. And we have seen 30 to 40 rupees on an average per bag kind of price for all these players. And that should actually improve the realizations for Ramco. But in case of Ramco, I think, overall the demand environment in South because of the state finances remains weak. And that's why that's something that should actually drive down prices if competition creeps up. They will be able to keep up pricing higher at the moment, but we'll have to wait and see how it pans out going ahead. But for Ramco, I think compared to the valuations, we feel that Dalmia is a much better alternative right now compared to Ramco.
Okay, all right. Mangesh, final question before we let you go. The big boy UltraTech could go through a period of some kind of consolidation on the profitability front as it integrates both the acquired assets, India Cement as well as Kesoram. But give and take everything, give us your top 2 picks from the large cap cement as well as from mid cap.
Yeah, so based on the valuations as well as the regional pricing outlook as well as demand outlook that we have, I think 2 large caps that if I have to pick irrespective of valuation, because I see earnings growth, and as well as strengthening profitability for the sector, are Shri and Ambuja, and within the mid caps we like JK Lakshmi.
Okay, all right, Mangesh, we appreciate you joining in. We look forward to being in touch with you as the result season takes shape for the cement players. But as you said, things are looking a little bit more optimistic for the industry on the whole. So let's see how that goes. Well, that's it from Mangesh and myself. Back to y'all.
Well, unfortunately, not looking so optimistic for the FMCG lot. Nestle is now down over 1% and it's moving lower. volume growth has come in at the lower end of what the analysts were hoping for. I think 2% is the analyst growth. The expectation was 2 to 3%, and Nestle continues to see profit booking. Britannia too, with that, has taken a tumble, and HUL still down 3.5%, 4%. It's a wrap on Trading Hour with that, but don't go anywhere. On the other side is Halftime Report. Stocks trade in a narrow range following conflicting signals from US, China on trade. Pharma, IT gain, while realty, FMCG drag. Mid-caps fare a tad bit better.
Hindustan Unilever posts a tepid quarter but expects the first half of FY26 to be better than the second half of FY25. Although gross margins will crimp on higher investments, Tata Consumer see double-digit growth as a given and better margins if tea prices ease.
Lupin gets a nod from the US FDA to launch tolvaptan, a drug with US sales of nearly $1.5 billion with 180 days of exclusivity. Analysts estimate a revenue potential of up to $200 million in FY26 from the sales of the drug.
Tata Power CEO Praveer Sinha sees an opportunity to supply solar modules to the US and other markets and is contemplating capacity expansion for this. He also expects to have a nuclear unit ready by 2030.
Hello and welcome to Halftime Report. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar and with me is Hormus Patakia. Hi Hormus, we've just got the management of Persistent waiting by to chat with us.
Indeed, and we will get to that. And as it was a strong quarter from Persistent Systems and the stock is doing well for itself as well. Now, to discuss this in detail on the fourth quarter results and the outlook going forward as well, Sandeep Kalra, the CEO of the company, is joining in. Mr. Kalra, good afternoon. Thank you for joining in. You know, you registered a strong quarter, but was there any impact on the business in terms of deals being paused paused, or did you see any ramp-ups or deal closures getting delayed? What's the sense on ground right now?
At a high level, if you look at the quarter, we delivered $375.2 million. This is 4.2% quarter-on-quarter growth, 20.7% on year-on-year basis. In full year terms, it is $1.409 billion, 18.8% year-on-year. Now, coming to your question, the macro did get tougher, and the last 6 to 8 weeks have been fairly, interesting from a macro perspective, with all the discussions about DOGE, USAID, tariffs, etc. There are pockets where obviously the impact is being felt, whether it is the decision making being delayed, certain amount of deal flow getting slower, and people getting a little bit more cautious about where they want to spend money. So yeah, we saw some amount of that, but from a revenue perspective, and I would say to a certain extent from an order book perspective, we delivered very well. It could have been better from an order book perspective, but look, the macro is the same for everyone, and we hope that this stabilizes and bodes well for the IT services industry. Any which ways, the last thing that I would want to point out on that is even if the macro becomes tougher, I think our industry has good prepositions and persistent at large. If you look at the last 5 years as well, we've done well both in good macro and in tough macro. So I'll leave it there.
Okay, let's talk about healthcare. That revenue growth was soft, just about up 0.4%, and that's about 28% of your overall revenues. You spoke about DOGE, USAID. Was there any impact on account of these particular factors? What is happening? What led to the slower growth? And when should we expect a recovery in the healthcare vertical?
Yeah, so if you look at our healthcare vertical, there is right from the pharma to scientific instruments, medical devices to payers and providers. Now, a part of these ecosystems are also dependent on things like the various US government funding for research, etc., and so on. And so when that gets paused because of USAID or the DOGE part coming in and kind of optimizing, there is a certain amount of softness there. We did see softness in one or two of our customers, and that led to a little bit of degrowth in those customers. But overall, if I look at our pipeline, if I look at our set of customers, if I look going forward, I think we'll sail through reasonably well. Healthcare has done very well for us in the last 6 quarters. This set of next 3-4 quarters, we believe banking, financial services, followed by tech, would be the growth drivers, and healthcare will be a little soft, but it will still continue to grow well for us.
Mr. Kalra, there are a lot of managements who've come to us and they've told us that FY26 will be better than FY25. What do you feel about that? Will FY26 be better for Persistent, especially given that the annual contract value last year was up 12%, top line also grew by 18 to 19%. Does that add to your conviction?
So, look, I don't want to give any forward-looking guidance, but if you were to sum the overall things, we announced 2 things. We announced an annual contract value. We announced a total contract value. The total contract value is contracts that span more than 12 months. The revenue realization from that is over multiple years. If I look at the Persistent revenue that we deliver on a quarterly basis, it's a sum of what converts from an annual contract value and these multi-year deals. So we are fairly, happy with the kind of backlog we are entering the year with. Obviously, the macro is tough. You've seen our peers announce their results. We have done relative outperformance for the last 5 years, quarter on quarter. This is the 20th quarter of sequential revenue increase. We'll let the macro pan out, but we are reasonably confident of continuing the growth journey.
Okay, reasonably confident of delivering another good year. So just trying to still get you back to talk a little bit more about FY26. When you say reasonably better, is it going to be as good as FY25? Will it be better?
So we don't give forward-looking guidance. The year has started off well. We'll let it pan out. There are 2 parts to it. If you look at the revenue side of it, we are growing at a fairly healthy clip as compared to our industry. We delivered more than 4% sequential growth, where if you look at our bigger peers, you can look at yourself the kind of growth people have delivered. Second part of it, we did not just deliver the revenue growth, we delivered 15.6% in EBIT compared to our full year of 14.7 and last year of 14.4. So we are entering the year with a reasonably good growth. We are entering the year with a fairly strong EBIT profile, which we are confident of maintaining. So net, we are confident of delivering another year of outperformance. Obviously, we live in the same macro as everyone else does. So if the macro deteriorates, the growth rates may taper here or there, but on a overall basis, we are fairly confident of delivering for the next several years good growth.
Right. Mr. Kalra, your margins improved 70 bips this quarter around. Can you attribute the factors what led to this?
If you look at the margin performance, we have been saying we have invested ahead of the curve in sales and marketing. So if you look at our sales and marketing headcount, even over the last 4 quarters, it's in a very narrow band. While we have delivered in excess of $225 million or thereabouts in incremental revenue over the year. So that gives us a SG&A leverage. If you look at our utilization, we started the year with 81-82% utilization. We ended the year with 88% utilization. So there's a significant amount of utilization. And that utilization, please keep in mind, there are not too many companies that are growing. A lot of companies are degrowing. They are in fact reducing headcount, whereas we are one of the few companies that are growing, adding headcount. Even in this quarter, if you look at it, we added more than 600 plus team members globally. So if you look at whether it is the revenue growth that gives you a leverage overall over many different costs, sales and marketing leverage, whether you look at the forex side of it, whether you look at utilization, every part of our business is kind of kicking in high gear.
Got that. So now talking about your margin guidance, you had said that you want to improve margins by 200 basis points from FY25 to FY27. Now in FY25, that's the first year, you improve margins only by 30 basis points, which means the heavy lifting of improving margins, if you want to achieve your guidance, has to be done in FY26, FY27. How do you feel about that and how will you go about it?
So devil is always in the details. Quarter 4 EBIT is 15.6%. Full year is 14.7%. If we maintain the trajectory at 15.6% over 14.7%, it is right there a 90 basis point improvement. Now, obviously, our endeavor would be to deliver better than that. We are not giving any guidance, but that's our aspiration. So if we do that, we would have delivered the first 100 basis points improvement over the year. And then obviously, as we go along and look, all of this is subject to the macro. We live in the same macro as everyone else does. The same tariff regime, the same, negotiations with different countries and so on, which we hope will settle down over the next 2, 3, 4 months. And hopefully, our play, even on cost optimization, should play out well. So from that perspective, keeping the utilization where it is, having a better leverage of SG&A, growing SG&A at a lower pace than overall revenue growth, and, overall maintaining the same discipline of growth. That should pan out very well for us.
Right. Mr. Kalra, you have been maintaining for a while now that you would be achieving this FY27 annual revenue of $2 billion and FY25 revenue goal, or FY31 revenue goal of $5 billion. Now, despite all of these tough macros, all of this tariff-related uncertainty, the worries of recession in the US, what's driving this confidence for you to maintain this guidance?
Let me answer in the reverse order. COVID year, everyone in our industry degrew. We grew by 12.9%. Our CAGR, compounded annual growth rate, is upwards of 24% for the last 4 years, compared to the industry at less than 8%, maybe in the range of 6%. So if you look at it, we have delivered 20 sequential quarters of healthy growth. That's point 1. Point 2, if you look at $375 million plus that we have delivered, $375.2 million, you multiply that by 4, it is $1.5 billion plus. That is the starting entry point for the year. And we have 2 years to go from $1.5 billion to $2 billion and then build up from there. Now, we have very clearly said we do have a good capital allocation strategy. By the way, we declared dividend of 15 rupee as the final dividend. So getting the overall dividend to 35 rupees for the year, which is roughly about a 40% dividend payout ratio. We have a good capital allocation for acquisitions, and we will look at maybe a scaled acquisition in Europe, tuck-in acquisitions in the US to build capability, and horizontal use cases in Gen AI, like we did in contact center with the Starfish acquisition that we did. So what we are saying is there's a good organic revenue build. We may layer it up with relevant acquisitions, and that's part of the entire building the business for the longer term towards the $5 billion. So relatively confident delivering $2 billion on the path to $5 billion. And as we go along, we'll keep giving you updates.
Sandeep, always a pleasure chatting with you. Thank you for joining in. That's Persistent continuing on its high growth path. Even in Q4, when most of the large cap IT companies reported a top line decline, a revenue fall quarter on quarter, you had Persistent growing at 4.5%. And they're saying that, of course, all subject to macros, but even next year should be a year of outperformance for the company. And they hold on to their guidance of $2 billion of annual revenue by FY27, $5 billion by FY31. and also improving margins by 200 basis points over FY25 to FY27. And they're confident about margins, holding on to margins at least at current levels for this year. So that's persistent for you. Get into a break. As we do that, here is a small programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing the boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for the SME Champion Awards Season 2.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went in chappal, and as a student you go there and so kala come to and so on. And then after conviction, after some convincing, fill the form, 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. Time for an exclusive conversation then. Tata Power's MD and CEO Praveer Sinha believes that the DISCOM privatization is the last key change that needs to happen in the power sector. Now, in an exclusive conversation with Shriram Finance, he also spoke about the solar rooftop opportunity, power demand and pricing trends. Listen in.
Let's talk about the solar rooftop scheme, Surya Ghar, and what has that meant for you as a company? But more importantly, what do you believe it means for an economy like ours?
So, I think the PM Surya Ghar program is a very, very good program and a very powerful program, which actually brings the access of power to everyone in their homes. So whether it is in urban areas or rural areas, everyone can generate power and use it for themselves, and in some cases they can also supply to the grid. So I think that's a very unique program that the Prime Minister has started, and we strongly believe that it can actually democratize the use of power. And this is a big thing, because the empowerment that you provide to people, where you don't have to actually depend on the grid or depend on an external source of supply, where you can generate your own power. For Tata Power, this is a very big initiative, because we have been into rooftop power for many years. We are the biggest right now. We have nearly 150,000 consumers who have set up nearly 3,000 megawatt, 3 gigawatt of rooftop power. And we strongly believe that the type of reach that we have in the country, and it's right across the country.
Geographically, yeah.
More than 500 cities we are there. We will be able to play a very, very important role. And for us, it's not just about giving them the equipment, but it's also about operating them and giving them the benefit of what Har Ghar Solar program is there.
Let me also ask you about where you find the DISCOM privatization story at this point in time. We, of course, have some examples in the country where DISCOM privatization has worked. There are state governments at this point in time that are looking at DISCOM privatization, and you, of course, expressed your interest in being able to play a part there. Any updates on where things stand, for instance, in UP, etc., which have, of course, expressed their intent?
So I think that DISCOM privatization is the last key change that has to happen in the power sector. There has been a delay in the way the privatization or public-private partnership should have happened. But I do see now traction, because most of the DISCOMs are going through huge financial crisis. The total losses of all DISCOMs put together is something like 6,50,000 crores, and it keeps on adding every year by 60 to 70,000 crores. So there is a huge financial stress in the distribution companies throughout the country, excepting for the state of Odisha, and then some of the smaller places like the Union Territory of Delhi, and then some of the cities in India like Calcutta and Mumbai. Most of the cities or places are still being controlled by the state DISCOMs. And I think that big change and transformation has to happen. I don't think states can continue to have the financial burden that they have. UP is, of course, first off the block. We do see that at least 2 of the DISCOMs in UP are looking to have a public-private partnership. Apart from that, I do know that some of the other states are also looking at this opportunity. And I think it's a matter of time that this will happen. Also, I think there is a great awareness amongst the government and the policy makers that you need to bring in more competition, and there can be more than one supplier of electricity. So to that extent, they will bring competition in having more than one supplier, and you can have the option.
Give the consumer the choice.
Yeah, absolutely. Of using one supplier or the other, depending upon the type of service that they provide and the quality of service that they provide and the tariff that they provide. So I think it will be a unique experience for consumers if this gets unbundled.
I mean, you know, as a consumer, I would love to have that experience, but do you think I'll have to wait 5 years, 10 years to be able to experience that future?
I think this will happen in next 1 to 2 years.
1 or 2 years?
Yeah.
Really? What gives you the optimism and the confidence?
Because, as I mentioned to you, the financial losses are humongous, and it is time that many of the discoms took the bold decision of going through the reform. We did it in Odisha, and it has really become a benefit to everyone. The government has benefited because the losses that they were incurring is no more there. The consumers have benefited because they are getting much better quality of service. And the DISCOM employees have benefited because they are now more empowered and they get to use state-of-the-art technology to provide better services. So I think there is a general benefit and a general sense of happiness right across the sector over there. And this should also get translated in other parts of the country.
So when do you expect UP to tip over?
UP is in advanced stage in terms of the bidding process is expected to start in this month. And I think by the end of the year, we should have some results. But many of the other states also are looking at it. And I do hope that they are able to take a decision sooner than later.
Well, that certainly is going to be something to watch very, very closely. But, speaking of trends, I want to understand from you where we find ourselves as far as power demand is concerned. I mean, we're in peak summer now and, electricity is being used up at this point in time. What do you envisage as far as power demand is concerned?
So India's power demand, both peak as well as energy, has grown by nearly 5 to 6%. In fact, in 2 years, it grew by 8 to 9% in 2022-23. And I do believe that this trend will continue because we have a very robust industrial growth that is happening. We have
a growing economy.
And a growing economy. And there are more number of people who have now the money to buy more electrical equipments, more gadgets. Everyone has more mobile phones, more televisions, more air conditioning and all that. Climate change is also impacting where people use more electricity, especially during summer months. So I do believe that the growth of electricity will continue to happen. Last year we had a peak of 250. This year they're talking of a peak demand of nearly 270 gigawatt. I feel that we are geared up. Of course, there are certain time blocks in the evening that we have a shortage, but those are very, very small shortages. During daytime, we don't have shortages. Fortunately, we have a lot of solar plants which have been commissioned in last few years, and last year also we had nearly 22, 23 gigawatt of capacity add.
With what has happened on solar, what do you believe we could be looking at over the next 5 to 10 years in terms of pricing?
So I think the past prices have stabilized a lot because the basket of supply that is there has now more of renewable capacity, and renewable power, as you mentioned, as the prices have come down drastically, whether it is solar or wind. And we do also see that this prices of battery storage is also coming down. I remember about 5-6 years back, we were at $1,000 per kilowatt hour. Now we are talking of $100, and so it has reduced drastically. And with more and more of clean energy solutions coming in, like pumped hydro and also with nuclear, I do expect that the power prices will virtually stabilize and remain more stagnant rather than the type of escalations one would see with whether it was with coal or gas or oil.
Tata Power in an exclusive conversation there with Shireen Bhan. By the way, just a few minutes earlier, there were flashes on your screen on Devyani International, where the company's board has approved the acquisition of an 80.7% stake in Skygate Hospitality, and that will be done for a consideration of 419 crore rupees. Now, Skygate is the owner of brands like Biryani by Kilo, Goila Butter Chicken, and the Bhojan. And this 419 crore rupees, they also plan on raising through a preferential issue of shares. They are going to issue close to around 2.5 crore shares to almost 80 shareholders on a preferential basis, and that will be used to raise 419 crore rupees, which will be in turn used to fund this acquisition. So an acquisition announced there by Devyani International, 419 crore rupees. The stock at the highest point of the day now, 1.5% higher. Take a short break. We come back with markets, and Aditya Agarwala of Invest for Edu joins in with some trading ideas as well. Welcome back. 70 points lower on the Nifty, almost 270 down on the Sensex, but there is plenty of stock-specific activity both on the upside and the downside when it comes to the broader markets. Newgen Software is the top gainer on the Nifty 500, now 14.5% higher. So it is IT and pharma that's doing well on the upside. It's mid-cap IT and mid-cap pharma that's doing well for itself. Newgen Software is up 14. Sonata Software is up 14. Natco Pharma from the pharma space is up 12.5. Wockhardt is up 7.5. So it is these mid-cap IT and pharma names that are ruling the roost on the upside in today's session. On the downside is a mid-cap pharma name as well, but that's an earnings reaction. That's Syngene, and that's the top loser on the Nifty 500 index. And of course, 12.5% lower now, extending losses from the earlier trade. Had opened in a 10% circuit and now is trading lower by 12.5%. Now closing in on that 52-week low for Syngene, 12.5% lower. But Aditya Agarwala of Invest for Edu is joining in now. Aditya, good afternoon. Thank you for joining in. We've taken a bit of a pause after a 7-day run. I would say that's par for the course, but what are some of the important levels now that you are watching out for on the Nifty? Would this 70-point dip be enough for a re-entry, or would you wait for longer? And couple that up with your stock recommendations as well.
Good afternoon, Normus. Thanks for having the show. Oh, definitely. I think a bit of a pause and a cool off is much required in the market after a 7-day up move on a trot. And it's been a massive up move if we look at it. And I don't think so 70-point correction warrants you just yet to go into the market and go in with long, specifically on the Nifty and the Bank Nifty. Both, I think, will enter into some kind of a consolidation, maybe some bit of extended correction as well. So if we talk about Nifty, on the downside, 24,000 is acting as a major support on currently. If that is broken, I think another 150 point correction can be seen in the Nifty. Similar for Bank Nifty also, I think it is trading at overbought levels, and we have seen markets facing resistances on the Bank Nifty front as well, closer to about 56,000. On the downside, I think 54,000 to about 53,000 is something that the Bank Nifty can also test. So I'm not too bearish on the market, Horvus, but I think markets will enter into some kind of a consolidation, time-wise cool off, you can say, both on the Nifty and the Bank Nifty, while sector rotation is what we are witnessing, and that is likely to continue. So what started off with FMCG at the start of this rally is now moving to IT and select pharma names as well. So I think the leadership is changing. and you will not see money getting pulled out of the market. In fact, there will be a sector rotation that is going to happen, and that is likely to continue in the markets as well.
So is that sector rotation part of your stock-specific ideas as well?
Definitely, almost. I've got a couple of buy recommendations, one from the cement space and one again for the pharma space. From the pharma space, I like Divi's Lab. Though the stock is already up 5% in today's trading session, but it's on the verge of a breakout into an all-time high territory. And I think from here on, you can see easily 9 to 10% upside in the stock. So for Divi's Lab, currently I'll be a buyer in the stock for a target of 7,000 on the upside. Place a stop loss somewhere around 5,900 on the downside. From the cement space, I do really like UltraTech Cement. I think so it is on the verge of a breakout into an all-time high territory again. After all, the UN cry, stock is again back at its levels, all-time high levels. So on the upside, I'm looking at a target of 12,900 on UltraTech Cement. So at current levels, one should look at getting long on UltraTech Cement. Place a stop loss somewhere around 11,900. I think that is a strong support. So UltraTech Cement and Divi's Lab are the top two bets for me within the buying space.
All right then, Aditya, thank you so much for joining in and sharing with us your views on the index and specific stocks as well. Divi's Laboratories, one of Aditya's recommendations, now at the highest point of the day, 6% higher after a positive brokerage note coming in from Citi, where it raised its price target on the stock and to well over 7,000 rupees. Take a short break. Up next, Rakesh Nair of Supreme Petrochem joins in to discuss the fourth quarter earnings performance. Stay tuned. Welcome back, and earnings reactions continue for us, and Supreme Petrochem is the next management joining in on the show. It was a weak quarterly performance from them. The margins and profits were under pressure as well, but the company managed to achieve its FY25 volume growth guidance. To discuss this and more, we are being joined by Rakesh Nair, who is the Executive Director at Supreme Petrochem. Mr. Nair, good afternoon. Thank you so much for joining in. For growing for a better part of this year, growing between the high teens to the high 20s. Fourth quarter was a bit disappointing, right? At a 2% negative growth. What do you attribute this to, and do you see that just as a one-off and expect growth to return in the first quarter and so on in FY26?
Good afternoon. The last quarter, the margins were down because the global deltas were weak, particularly when the uncertainty on the tariffs and other things arose. So the deltas have been low, and that as a consequence of that, the Indian deltas were also low. But for the year as a whole, we have done well. Our profit has grown by 12%. Our volumes grew by 9.5%. And now going forward for the year 25-26, at the moment, though we plan to achieve a growth of around 13-14% in the volumes, but then we really don't know going forward if the tariffs cause any confusions or in respect to any disruptions in the market that may impact the volumes.
So have you factored in this tariff picture for your full year forecast, Mr. Nair? What is the current situation that you're witnessing on ground? How is demand currently shaping up? You mentioned about weak deltas in the fourth quarter. Has that percolated into the ongoing quarter as well?
The weak deltas globally at the moment, yes, they are there. Domestically, it's normal deltas at the moment. But then exports remain an uncertainty going forward this year we don't know how the trade flows will be and how the supply chains will move.
So at least for the first quarter, would it be fair to say that a double-digit growth in your top line is unlikely considering the factors that you're highlighting?
I wouldn't talk about the absolute numbers in rupees, but then in volume growth, we expect that we should be in line with the last year.
How are the current raw material prices shaping up, Mr. Nair, specifically for the styrene monomer prices? What is the pricing trend that you've been witnessing? They've been on a downtrend since March. So what's the current pricing scenario that you're witnessing?
The prices are further falling now. They have dropped since March, almost over 10 to 15% they have dropped.
And do you expect that to continue?
No, I don't think, because all is linked to the crude prices as well at the end of the day, and if the crude is stabilized, these prices would also stabilize.
You know, you've historically also spoken about being a high double-digit growth business, be it on the top line front, be it in the EBITDA front, even for the margins. You know, margins also, now they've declined from 18% in that you had done in FY22 to around 9%. But by when do you expect normal levels to return? Do you see that 18% that you did in FY22 being a distant this thing right now?
See, FY21, 22, that is the 22 one. I had said in the past also that was an aberration because of the global freight rates were very high. The global plants some of them were shut down. So the deltas internationally were very, very high. And we also had an advantage of that. And that is how the operating margins were high in that particular year. That particular year was actually an aberration. And the operating margins have been in the lower double digits or very high single digits then. So around 10 to 11% operating margin is what we generally expect in this business.
Right. You know, you've achieved the upper end of your volume guidance for the year, Mr. Nair. It is around 355,000 tons. And you are expecting a 13 to 14% volume growth this time around. How do you plan on achieving that?
See, our new capacities will be added this year. So some volumes will come from that and some growth will be in our existing volumes.
Right. And, you know, there has been a large increase in inventories during the year. But do you see that as a cause of concern, or do you see that as a one-off and things to normalize? And how are you managing your inventory costs as well this time around?
See, those inventories are not our finished goods inventories. They are the raw material inventories, and they are the raw materials which are in transit at the moment. And that number, because of some bunching of supply, that number happened to be large, and that is reflecting as high inventories in our books. So there is no cause to worry on that account.
So you expect them to normalize going forward as well?
Yeah.
And one final question, Mr. Nair. What is the kind of revenue mix that you're expecting this time around, breaking it apart from domestic to exports, and considering the export uncertainties that you've highlighted? Would you pay more emphasis to the domestic market this year till the export scenario normalizes?
No, we will still concentrate on exports to grow, apart from growth in the domestic market. But then what I said was that the tariffs may cause some disruption there. We, rather in our internal budgets, we expect that we will be able to achieve maybe better exports if going forward the tariffs come in. We would be better placed vis-a-vis China or other Southeast Asian countries or East Asian countries.
So what is the kind of mix that you are expecting between exports and domestic?
We would have almost say 15% in exports and 85% will be our domestic.
All right, Mr. Nair, thank you so much for sparing time and joining us today on the show. Wish you good luck for the rest of the year as well. The management there of Supreme Petrochem expecting the styrene monomer prices have dropped by 10 to 15% since March, but they expect those prices to stabilize, and also a statutory warning that the tariff disruptions may cause some impact on the volume growth. But of course, all of that currently is in an uncertain territory. The plan also is to achieve 13 to 14% volume growth in FY26 after achieving the upper end of their guidance for the current financial year. Still 70 points down on the index, but we take a short break. More on the markets on the other side. Stay tuned. Welcome back. It's an earnings heavy day today, and we have already seen two FMCG heavyweights report numbers, be it HUL and Nestle. Both of them have given up gains after their results. HUL 2 down to the lowest point of the day, now 4% lower. Then the other big one reporting results today is Axis Bank, and Abhishek is here with the street expectations. Abhishek.
Well, Homas, to begin with, Q4 FY25, the NII growth could be one of the lowest that you are seeing in last 28 quarters as per our poll, which is a sum of all the analyst prediction over here. So the key thing to watch is that sequentially the business momentum could be very strong. Now, Citi expects deposit growth of around 9% YOY and 7% quarter on quarter, while they expect the loan growth to be at 10% YOY and about 5% quarter on quarter. So 7% deposit growth on a sequential basis and 5% sequential loan growth will be seen closely. Net interest margin may decline on a YOY and quarter-on-quarter basis. Kotak Securities estimates a 20 basis point decline YOY and 15 basis point decline sequentially in net interest margin. However, what we have seen with other private banks is that the CASA ratio has improved, and that's helped the net interest margin remain at healthy level. Will that come up with Axis Bank needs to be seen closely. Provisions are expected to decline quarter-on-quarter. Kotak Securities estimates more than 27% decline on a sequential basis in loan loss provision, that is credit cost. Now, slippage is also expected to decline sequentially. Again, Kotak Securities estimates a slippage of 5,000 crore in Q4 FY25 versus more than 5,400 crore in the previous quarter. Asset quality expected to improve. Citi estimates gross NPA ratio at 1.4% versus 1.5% in the previous quarter, and net NPA ratio to improve by 10 basis point as well to 0.3% versus 0.4%. Watch out for management commentary with respect to positive road ahead, especially on the business growth front. So our polls suggest NI growth of 5.5% YOY and about 1.4% sequentially. We are working with profit decline of more than 5% YOY, but it can increase 7% on a sequential basis. Back to you.
Of course, the expectations are also high after the results that HDFC Bank and ICICI Bank delivered. So all eyes on Axis Bank later this evening. Abhishek, thanks a lot for that. Just a flash on your screen a few minutes ago about a massive fire taking place at one of BHEL's unit. Keep an eye out on that as more details emerge. But earnings reactions, and we just spoke about Syngene a few minutes ago, and still the top loser on the Nifty 500. While on the flip side, Divi's Laboratories is doing very well for itself after that strong positive note from Citi. Vinny is here to break down both of these stocks for us. Vinny.
Hi. So yes, in terms of Syngene, weak, not weak, but a miss in terms of the numbers that came in from the revenue front of the company. Other than that, the margins as well as the profits were in line with what the street was expecting. So yes, revenue growth of around 11%, margins at 33.7% versus 34.5%. We saw contraction coming in terms of margins. But the important thing is the outlook for FY26, which the company has given, where they're saying that they expect the revenue growth to be in the mid-single digits. They expect the base business growth to be in early teens, but that is going to be offset by the inventory destocking that the company may see. Now, margins, they expect that also to moderate furthermore from these current levels of, that we're seeing of 33.7%. They're expecting that to moderate further. Why? Because they're expecting higher OPEX expenses of the new facilities and plants that they have been opening and they're focusing on. So that OPEX expense will be higher, and that is why the margins will be lower. We could see an impact coming in terms of profitability in FY26 as well, and that could be lower as well. But as of now, inline numbers, nothing exciting because the guidance was weak, and that is what led to the fall for the company. In terms of overall Lupin, why we're keeping an eye out on this one. Now, Lupin has said that they have launched and they've actually received a final approval for the drug that they were talking about, the generic drug that is called Tovlaptin. Now, this drug is actually with a 180-day exclusivity. They'll be the first to file on this front, and that is why there's a big positive for the company. The market size of this drug as of 31st December 2024, the annual sales were around $1,467 million for this. So analysts are expecting Lupin to get in a revenue opportunity estimated at around $150 to $200 million in FY26, and this could contribute to 25% to Lupin in FY26 going forward. So a major contributor that could come in from this drug, an important one for Lupin.
Important one for Lupin indeed. Pharma has been in focus through the day, be it mid-cap pharma and some news coming in for some of the large-cap pharma stocks as well. Take a short break. On the other side, Manisha Gupta joins in with David Kelly, who is the CEO at the Natural Diamonds Council. Stay tuned. We'll be right back.
investing.
Welcome back, and joining us on the show now is David Kelly. He's CEO at Natural Diamond Council. David, thank you so much for joining us here in our CNBC studios. With the gold prices at all-time highs, would you say that this is a time that people are buying more of diamonds then? Because gold is out of reach, but diamond clearly, while is appreciating, hasn't really done up.
Yes, obviously, to a certain extent, the gold here in India and China, the gold market affects more directly the prices and diamond sales. But in the biggest market in the world, there has much less of an influence of gold prices in jewellery on the sales of diamonds.
David, the last couple of years haven't been so great for natural diamonds because we've seen lower demand growth in China and US, both of these major markets. Are those numbers improving now?
Yes, I mean, the numbers in the US market, is the biggest market in the world. It's around half of all diamonds sold are sold in the US market. In that market, up until the end of last year, the big diamond retailers had a very successful season selling natural diamonds. They predominantly their customers buying from Wealth, and Wealth has done historically over the last few years very well in the US. And that really continued through until the first quarter. The first quarter of this year, the US market was up just over 4.5%. So the trend in diamond sales in the biggest market of the world is still doing well.
Okay.
Here in India, we're still forecasting a 5 to 10% growth in diamond jewellery sales, which will make it the fastest growing market in the world and strengthen its position as the second largest market. And then in China, China is still is seeing slow signs of recovery. So it's certainly not fully recovering yet. There's still a long, long way to go, but it seems to be showing the earliest shoots of recovery for there.
And how is Middle East now looking at? Because that is a market that continues to do well over the years.
Yeah, the Middle East always seems an unusual market. It always has its completely unique dynamic in that market, and it's where people like to spend money. They get excited by new brands, innovation, etc. So the Middle East market is still innovating. There's still a lot of activity there, and it's still a strong market.
You talked about India, and you told us that India clearly continues to be a strong one, and 5 to 10% of growth. When you talk about that, are you looking at that on an year-on-year basis or this year particular?
Year on year, so 2025 versus 2024.
And are you anticipating this demand growth continuing over the years?
Yeah, I mean, I don't think in today's world any of us like to make predictions from one day to the next. I think we all feel a little less secure making predictions, but assuming the disruption that's going on in the world at the moment starts to calm down a little bit and we have more predictability in the world, I think there's nothing in the long-term economic factors or cultural factors that would slow that down.
David, for some time we've also seen lab-growns cause a bit of a heartache to natural diamond people here. Is that phase also now passing on?
Yeah, and I think now that people understand that lab-growns are a very, very big, very different proposition from natural diamonds. They're a very different market. The pricing of lab-growns is now 90 to 95% cheaper than a natural diamond. So there isn't really any confusion. There's no real overlap in there. So I think it's much more settling into a long-term, clear understanding that lab-growns are a much, much cheaper product to the real thing, which is the natural diamond.
David, we are stepping into a time and period which is going to be Akshaya Tritiya, an auspicious period where people buy a lot of gold and jewelry, and then of course a big wedding season coming in from the month of May onwards. What are you as a Diamond Council looking at India as a market? Are there plans for branding, marketing, etc. going forward?
Yeah, so there's more investment than ever being made in the India market because of the growth that's here. So us and other parties as well are investing a lot of money in this market to continue to show the innovation in diamond jewellery, continue to show the values of natural diamonds, and just get people excited. Diamond jewellery is something to be really beautiful and passionate about. So that's what we collectively all invest in this market for.
What would you say is the penetration level when it comes to natural diamonds in India, and what kind of growth are you seeing on there? Penetration
Penetration of the total diamond market. I mean, lab-grown diamonds here are still very, very small relative to the total market. So I don't have any market data specifically, but it's the very low end of single-digit numbers. So it doesn't really play. There's much more talk about it than there is actual reality of people buying lab-grown diamonds. Don't really see that changing too dramatically. So it's why we really just focus on the natural segment of the market.
A word on diamond prices as well, if I may, David. And we've seen prices hit all-time highs in 2022, and then there was a profit-taking and the prices seem to be rising yet again. I was reading some reports which suggest that this year we've seen diamond prices gain up by 10% already. How are you looking at diamond availability, certification, prices?
Yeah, so really the prices reflect the growing demand, particularly in India and the US, as I was saying. So ever since kind of February, we've seen a real bounce back in the price of diamonds. And again, we can see that continuing because the markets remain strong. Consumer consumption of diamond jewellery remains strong. So we really see this as really the kickback following the reaction to the very big growth in diamond prices post-pandemic. This is really the kickback from, from then that decline that came after that.
And what caratages are doing better or well, especially in the Indian markets?
Which?
Caratages. What carat? Are people buying solitaires? Is it smaller diamonds that people are buying? What is?
Yeah, I mean, it's across the range of qualities and sizes. I always say diamonds are very individual. There's no two diamonds in the world that are the same. So diamonds are very much about you and what you love and what you fall in love with. And so I don't really narrow it down to trends in specific diamonds because I want everyone to go to a jeweller, see the diamonds they fall in love with, and that diamond will be for them.
All right. Thank you, David, for coming to our studios here. And of course, as always, weaving a story around those diamonds and emotions as well and giving us very strong numbers going forward into the market. Well, India is the second largest market when it comes to natural diamonds. And as David tells us, 5 to 10% of a growth in demand is what we're anticipating in the year to come as well, as far as natural diamond concerns. With that, let's go across to PM Modi as he's speaking at that summit there. Let's go across.
जिस बेरहमी से मारा है उससे पूरा देश व्यथित है, कोटि कोटि देशवासी दुखी हैं। सभी पीड़ित परिवारों के इस दुख में पूरा देश उनके साथ खड़ा है। जिन परिवारजनों का अभी इलाज चल रहा है वे जल्द स्वस्थ हो, इसके लिए भी सरकार हर प्रयास कर रही है। साथियों, इस आतंकी हमले में किसी ने अपना बेटा खोया, किसी ने अपना भाई खोया, किसी ने अपना जीवन साथी खोया है। उनमें से कोई बांग्ला बोलता था, कोई कन्नड़ा बोलता था, कोई मराठी था, कोई ओडिया था, कोई गुजराती था, कोई यहां बिहार का लाल था। आज उन सभी की मृत्यु पर करगिल से कन्याकुमारी तक हमारा दुख एक जैसा है, हमारा आक्रोश एक जैसा है। ये हमला सिर्फ निहत्थे पर्यटकों पर नहीं हुआ है, देश के दुश्मनों ने भारत की आत्मा पर हमला करने का दुस्साहस किया है। मैं बहुत स्पष्ट शब्दों में कहना चाहता हूं, जिन्होंने ये हमला किया है उन आतंकियों को और इस हमले की साजिश रचने वालों को उनकी कल्पना से भी बड़ी सजा मिलेगी। सजा मिलकर के रहेगी। अब आतंकियों की बची खुची जमीन को भी मिट्टी में मिलाने का समय आ गया है। एक सौ चालीस करोड़ भारतीयों की इच्छा शक्ति अब आतंकी आकाओं की कमर तोड़ कर रहेगी। फ्रेंड्स, टुडे from the soil of Bihar, I say to the whole world, India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times. साथियों, शांति और सुरक्षा ये तेज विकास की सबसे जरूरी शर्त है। विकसित भारत के लिए विकसित बिहार जरूरी है। बिहार में विकास हो और विकास का लाभ यहां हर वर्ग, हर क्षेत्र तक पहुंचे, ये हम सभी का प्रयास है। पंचायती राज दिवस पर इस कार्यक्रम से जुड़ने के लिए मैं एक बार फिर आप सभी का आभार व्यक्त करता हूं।
Stocks trade in a narrow range following conflicting signals from US and China on trade. Pharma and IT gain while realty and FMCG drag. Mid-caps fare better. Hindustan Unilever posts a tepid quarter but expects H1 FY26 to be better than H2 FY25, though gross margins will crimp on higher investments. On the other hand, Tata Consumer sees a double-digit growth as given and a better margin in tea prices as tea prices are easing. Nestle too flags improving volume growth. Lupin gets a nod from US FDA to launch tolvaptan, a drug with a US sales of near $1.5 billion with 180 days of exclusivity. Analysts estimate a revenue potential of up to $200 million in FY26 from sale of the drug. Tata Power CEO Praveer Sinha sees an opportunity to supply solar modules to United States and other markets and is contemplating capacity expansion for this. He also expects to have a nuclear unit up by 2030. In response to the deadly terror attacks in Pahalgam, the Cabinet Committee on Security has suspended the Indus Water Treaty with Pakistan. Pakistan's defense attaché are declared persona non grata, while SAARC visa exemptions for Pakistani citizens have been suspended. The Prime Minister also reaffirms the commitment to bring perpetrators to justice. Hello, good afternoon. You're tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. The markets have come off the day's highest point, and now a very narrow range that we've seen the markets move in today's trading session. As of now, it's at 24,265 levels, so yes, something to watch out for. It's, look at the range, 24,350, and then it came down to 24,240 around that mark, and that is where it's roaming in. As of now, when you're looking at in terms of the market, 0.2% of decline is what we are seeing coming in. Now, moving on to the mid and small cap, a bit of a better performance versus the benchmark indices. The Nifty mid cap, slight bit of a green right now coming in on the screen. Small cap also is seeing a better performance and trading at the day's highest point. 3/10 to 4/10% of uptick coming in for the small cap. Nifty Bank among the top sectoral losers today. It's down 0.04%, so keep an eye out on that. Not doing too great in today's trading session. On the flip side, we have pharma. That's buzzing in trade. Any of the pharma names that you see, apart from few names like Syngene reacting on the back of numbers, we've seen pharma buzzing in trade up almost 1%. Now, on the loser side also, we have real estate that is not doing well. So, Nifty Realty, that is down and out in today's trading session. And other than that, FMCG. We had HUL report its numbers. We had Nestle that reported its numbers. And yesterday was Tata Consumers. Muted day of trade coming in for all these FMCG names. And since we're focusing on FMCG, let's get the show started with talking about HUL, because that's under pressure. And this is despite an inline set of numbers that we saw coming in for fourth quarter. Volumes growth was around at 2%. But what is weighing on the stock? Why is it falling in trade? Sudarshan is joining in with us to give us an explanation on that front. Afternoon, Sudarshan.
Good afternoon, Vinay. So, as you have said, HUL has reported earnings for Q4, and those earnings were largely in line with the estimates. Revenue has come at more than rupees 15,200 crore against our expectation of around 15,160 crore. EBITDA 2 has come in around 3,466 crore, and our expectation here was around 3,505 crore, and margin has come in around 23%. It was at 22.8% against our expectation of 23.1%. What has worked for the company is the volume growth. For Q4, volume growth has come in at 2% versus expectation of flat to 1%. But what has spoke the market is company's commentary about the outlook. Now going forward in the near term, company's margin guidance is in the range of 20 to 23% versus earlier guidance of 23 to 24%. Also on the gross margin front, company is saying that going forward, gross margin is expected to moderate and price growth is seen in low single digit if commodity prices hold on to current levels. And one of the major segments, that is the home care, here company is seeing negative price growth. So our earnings were largely in line, but due to its commentary, especially related to margin, you are seeing a sharp fall in the stock, and currently it's down almost 7% from days high. At one point, it was up almost 3%. Now it's trading with a cut of almost 4%.
Absolutely. As of now, almost near the day's lowest points, Darshan, is what we're seeing HUL is trading at. But earlier, CNBC-TV18 Shilpa Ranipeta quizzed the management of HUL at their earnings press conference. Listen in to what they had to say.
There's a pretty strong case for us to further develop investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back-to-back for last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. So margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Right. And of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us.
Okay, now shifting gears from HUL to another FMCG major, that is Tata Consumer Products. They reported the numbers, inline set of numbers in Q4 FY25. EBITDA beat the estimates, and this was despite gross margin compression of 420 basis points. The company's net profit was also aided by an exceptional gain that we saw. And earlier on the day, we managed to speak to Sunil D'Souza, who's the MD and CEO of the company, and he shared the company's guidance for FY26. Listen in.
Double-digit revenue growth is a given. We've already come to volume growth across all our businesses this quarter. We have every single business growing on revenue as well, 17% top line, 12% organic. EBITDA margins were a bit soft. And if you look at it, overall EBITDA, I was a negative 1.1. But here's the thing. The primary compression has been because of tea prices, which have run up 25 to 30%. If I took off both the cost and price increases that we took on tea this quarter, I have improved my full year by 80 bips. Our guidance is for improvement of 50 to 100 bips every year on EBITDA margins, and that doesn't change. We do expect it to come to 30%, and there's no reason why. The Himalayan business, which is premium, grew by 29%, and Tata Copper, our water business, grew by 23%. So largely on track. As regards Capital Foods and Organic India, the good part is we finished the integration. We've taken synergies out. We understood the business. This quarter, I think we delivered some decent numbers, 213 crores of Capital Foods, 109 on Organic India. Actually, if you take growth rates, it's 80 and 40 plus in the two businesses, but that's because we had soft quarters last year in Q4. But we feel pretty confident of delivering 30% growth going forward. With a focus on distribution expansion and innovation and portfolio expansion as well.
Okay, let's move on. And in some news just coming in, a huge fire broke out at BHEL's premises in Bhopal. Now, firefighting operations are underway while the cause of the fire is yet to be ascertained. Okay, but on that note, we're going to slip into a very short break, viewers. Don't go anywhere. Up next, we get you the latest on the Pahalgam attack and India's diplomatic response. Welcome back and thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on, and in a recent turn of events, the White House is considering a significant slash in tariffs on Chinese imports, potentially cutting them by more than half in an effort to restrain tensions with Beijing. Now, White House officials familiar with the discussion told Wall Street Journal that tariffs could be lowered to between 50 to 65%, though no final decision has been made yet. We also understand that President Trump is considering exemptions for automakers from some of the tariffs that were announced previously by his administration, and this could include auto parts imports that are imported from China. Meanwhile, China's Commerce Ministry has said that there have been no trade negotiations so far and has urged US to show sincerity if it wants to walk the talk. Okay, now moving on that front as well, while White House continues to mull the cuts in China tariffs, President Donald Trump comments that United States has made tariff-related deals with 90 countries, and the deal with China will depend on Beijing's actions. Listen in.
How soon do you want to bring the tariffs on Chinese goods?
Well, that depends on them. We have a situation where we have a very, very great place. It's called the United States of America, and it's been ripped off for years and years. They all want to make deals, and we're going to make deals, but they're going to be fair deals. They're not going to be rip-off deals. And by the way, if we don't have a deal with a company or a country, we're going to set the tariff. We just set the tariff. It's something that we think that will happen, I'd say, over the next couple of weeks. Wouldn't you say? I think so. Over the next 2-3 weeks, we'll be setting the number. And we're going to pick, could be for China too, could be for China. We're dealing with almost all of them. Too many to fully deal with, but we're going to be fair to them. But we're dealing with a lot of countries right now, and could be with China, but maybe we'll make a special, a deal.
And moving on, Treasury Secretary Scott Bessent also said that there is an opportunity for a big deal on trade issues between the United States and China, and called for a deeper mutual respect among trade partners. Listen in.
There is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, and if they want to rebalance, let's do it together. This is an incredible opportunity. I wish to be clear, America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
Okay, on that note, we're going to slip into a very short break. We'll bring you more news and updates on the other side. Welcome back to Business Lunch on CNBC-TV18. Now getting you the latest updates on the terrorist attack in Belgaum. The Union government is set to convene an all-party meeting later today in the aftermath of the terror attack in Belgaum in Jammu and Kashmir, which left 26 people dead and several injured. Earlier, India also announced a series of severe measures against Pakistan, including suspending the Indus Water Treaty, declaring Pakistan's defense attaches persona non grata and more. The attack on the tourists has led to a strong response from the army, which has now deployed para and other forces in the forest area to track down militants. While in Delhi, massive protests have erupted against Pakistan amid heightened tensions between both the countries. Visuals from outside the Pakistan High Commission show a large crowd gathered outside the building with police forces trying to pacify it. Earlier in the day, India withheld access to the official X account of the government of Pakistan. The move follows New Delhi's announcements of a series of retaliatory measures against Pakistan. Parikshit is joining in with us to give us the latest on this front. Parikshit.
Well, yes, the Prime Minister has given a very strong message against Pakistan, saying that those terrorists who are involved in this ghastly attack, they will be punished no matter where they may be, and we will go to the ends of the earth to find them as well. On the issue of retaliation, he said that we will punish them in ways that no one even imagined. Having said that, an all-party meeting is going to take place at 6 p.m. and every political party is likely to extend support for the government. We spoke to P. Chidambaram a short while back, and he said that the Congress party fully supports any kind of action, and the action must be strong, it must be smart, it must be calibrated. Having said that, there is a meeting that C.R. Patil, the Union Minister for Jal Shakti, is holding at 4 p.m. this afternoon, and this would be on the Indus Water Treaty. Now, India has announced the suspension of the Indus Water Treaty, and India is now going to weigh its options, whether we are going to stop sharing of data, sharing of information, whether we are going to be flushing out the reservoirs. So multiple options are being discussed. There are meetings of intelligence chiefs taking place at the Ministry of Home Affairs. So India looking at multiple responses, economically, diplomatically, and militarily as well. All of those strategies are being chalked out, even as we work towards isolating Pakistan diplomatically. Even as we speak, there is an anti-terror operation underway in Baramulla, and we believe from sources that 2 terrorists have been killed there.
Okay, Parikshit, thank you so much for the latest update on that front. But like Parikshit was mentioning as well, we had comments that came in from PM Modi, and PM Modi has promised to take strict action against the perpetrators at his rally in Bihar. Listen into what more he had to say.
Today, from the soil of Bihar, I say to the whole world, India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times.
And meanwhile, tourists continue to leave Jammu and Kashmir after the tragedy. As per reports, over 11,000 people have left Srinagar on 60 flights to reach different parts of India. The Maharashtra government has arranged for a return of stranded tourists. A plane carrying 100 tourists will depart from Mumbai, with the airfare being borne by the state government. Okay, and let's quickly take a look at what's happening on the market front as well. Among the Nifty 50, as of now, we're seeing Nifty is almost near the day's lowest point. That's what we're seeing it trade at, around that mark. 24,250, around that mark is what Nifty is trading at. Top losers on the Nifty 50, we have HUL that is down and out. Bharti Airtel and Eicher are among the names that are down and out in today's trading session. So clearly, we're seeing FMCG, which is being under pressure. And just to mark the flashes at the bottom of your screen, we have Shriram Industries that has reported in its numbers. Seems like a weak set of numbers because we're seeing the profits is down 17%. Revenue is very muted performance, 0.6% uptick on a year-on-year basis. So not an exciting set of numbers that have come in from Shriram Industries as well. So all in all today, given that it's expiry as well, we're seeing a bit of a decline coming in from the day's highest point for the market. We'll watch out for what happens in the next couple of hours. That'll be important. But with that, we'll wind down this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Up next, your Midcap Radar.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went chappal, and as a student you go there and so kala come to and so on. And then after conviction, after some convincing, filled the form. 2 days, 3 days, and opened my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Final 2 hours of the trading session, the final 2 hours of the April series as well. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me today is Nigel. Nigel, good afternoon. The bulls are taking a bit of a breather today and hopefully going into the long weekend. We've gotten used to saying long weekend for the last two. But of course, taking the April series expiry on a lighter note, I guess.
Well, that's right. It's split down the middle. Two indices on the top out here, which are in the red, and the two that you have on top of you, they're into the green. And I'll tell you what, the Nifty bank has moved into the green, just mildly so. You'll want that to press home the advantage because that's been the leader so far. As you said, the series has been a pretty good one. 3.5% gain for the Nifty, but the Nifty bank has been the big driver. That's up a good 7%, and that'll have to do the heavy lifting from here on. But we'll talk more about that and more. Let's get straight to the top stories. The stocks trade in a narrow range following conflicting signals from the US as well as China trade. Metal and pharma gain, while realty and FMCG drag. Mid-caps fare a little bit better.
Divi's Labs has surged after Citi has reiterated its buy rating on the stock but raised its price target by 200 rupees, says that the company is their top pick in the pharma space and it is expecting $800 million in GLP-1 revenue by 2030.
Syngene shares fall closer on 12% after reporting a revenue miss in the fourth quarter. A mid-single-digit growth guidance for FY26 leaves the street disappointed.
Persistent Systems has done well today on the back of a strong quarter. The constant currency revenue growth was higher than expectations. The company has also maintained its $2 billion annual revenue aspiration for FY27. The management tells CNBC-TV18 that BFSI followed by tech will be driving growth over the next 3 to 4 quarters.
Bharti Airtel falls close to 4% after Jefferies and Kotak Institutional Equities downgrade the stock. Jefferies has an underperform rating on the stock, while Kotak has a sell recommendation. Well, the markets are trading with a cut-off close to around 70 points or thereabouts, but a few stocks actually are cutting their losses. Mahindra and Mahindra should come up for you on the screen. That stock was down close to 2% just an hour or so ago. That's trying to fight back. Here, Tata Motors, that's moved to the high point of the day, so we'll keep an eye out on that one. And the result that I'll be looking at very, very closely is Axis Bank today, because we'll get a bit of a sense in terms of what's going on the asset quality as well as how business is shaping up. Stock has been range-bound. We'll keep an eye out on that set of numbers. And just one more before we go across to Hormuz. Whirlpool Corporation came out with a set of numbers. From the word go itself, I've been mentioning this, that overnight Whirlpool Corporation came out with a set of numbers. The Asia part of the business looked quite good. The growth was good out there, close to around 16%. But the margin expansion is something that the street likes. And most of the Asia business is actually India, which explains why that stock is now up close to around 9%. But Hormuz has hopped across to the big wall. He's going to tell us all the top movers and shakers at this Hormuz.
Yeah, gainers and losers this time around, and equal distribution on both sides. It's been a week where we have had more gainers in comparison to the losers, but there are earnings reactions aplenty and on both sides of the spectrum as well. Syngene is now down to the lowest point of the day, 12.25% down. Now the top loser on the Nifty 500. Not a good reaction for Canfin Homes as well, and also for Dalmia Bharat doing well for itself. Persistent Systems did well at the start of trade, still holding on to gains of around 2%, but is off the highs of the day. Two pockets that have been the highlight of today's session is midcap IT and midcap pharma. We'll start off with midcap IT first. Look at this. Newgen Software is up 15.5% after that. Strong results from Persistent have rubbed off onto these names as well. Sonata Software too at the day's high is up 10.5%. Tata Elxsi also seeing healthy gains of around 4%. And switching over to midcap pharma as well. Pharma as a sector has done very well, but look at midcap pharma. Natco Pharma is up 9%, Wockhart's up 5%, Ajanta Pharma. But there has been some correction from the highs of the day. Alembic Pharma too has given up almost all of its gains. At one point was up around 5% as well. Stocks doing well on the back of strong volumes in today's session. Look at Whirlpool, as Nigel just highlighted, 9% higher on strong volumes. Divi's after that strong brokerage note. Thermax and MMTC is up 15% is among the top volume-led gainers in today's session as well. And lastly, some stocks that are on the losing side today. Vari, after some downgrades that have come in for the stock after the run-up that we have seen recently. Nava, TRIL, Macrotech too seeing losses of anywhere between 3 to 4%, Nigel.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's get in Nagraj Sethi, who joins us on the show. Hi, Nagraj. It's been a solid session and a solid series, actually, for the bulls. They're seeing some bit of follow-through after having many down series. We're suddenly having some green on the screen. What would you do? The Nifty is down close to 80 points. You'd buy into this dip or you wait buy?
Hi, good afternoon, Nigel. Nifty has been in a spectacular uptrend over the last 8 to 10 sessions, and we have seen 2,500 points of up move relentlessly without showing any reasonable downward correction. So, though Nifty placed at the higher levels, still there is no indication of any significant reversal pattern building at the higher levels, or Nifty, we can say that tiredness at the higher levels. I'm expecting this consolidation could take place 1 or 2 sessions, and this could be a minor consolidation or a minor healthy dip, you can say, and eventually Nifty could move up further and hit the nearest upside potential of around 24,550 to 24,800 levels in the next 1 or 2 weeks.
Right, Nagraj, in light of this, what are some of the stocks that you're recommending this afternoon?
Yeah, I have 2 stocks from a long side. First one is CDSL. Chartically, CDSL, after the formation of the 1050 bottom reversal, has been in a continuous uptrend. Recently, it has broken above the hurdle of 200 EM and currently trading higher. The overall chart pattern is looking positive. Currently trading around 137071 levels. One can look to buy at this point of time. 1460 is going to be the upside target, and 1320 one can place a stop loss. Second one is from a sugar side. Even though it has moved up a little bit in the last half an hour, it is currently trading at an attractive pattern on the daily chart. The Triveni Engineering, the sugar stock, is looking very positive on the chart. It has witnessed a decisive upside breakout of the range movement, currently trading around 447, 448 levels. One can look to buy at this point of time or slightly on dip. The upside target would be around 475. One can place a stop loss at 420.
All right, Nagraj, thank you so much for sparing time and joining us today with your views on the index and specific stocks as well. Triveni Engineering, in a few minutes, has now surged to the highest point of the day, 8% higher now as we speak. By the way, Supreme Industries too has recovered all of its losses and has nearly moved into the green now after delivering volumes that were at the higher end of their guidance, and they are also expecting better volumes in FY26. So good going for Supreme Industries as well. The management will be joining us in just a short while from now. But just before that, troubles continue to mount for Ola Electric as sources have told CNBC-TV18 that the company will face more government scrutiny over non-compliance with the motor vehicle rules. Parikshit is joining in with more details on this. Parikshit, what are you picking up?
Well, we've heard from sources that the Ministry of Road Transport and Highways has not been satisfied with the kind of replies that Ola Electric has been giving with regard to discrepancies in vehicle registrations and claimed sales numbers, and why stores were operating around the country without valid trade certificates. So they've actually sent them 3 letters already, and now a 4th letter is being issued to Ola Electric to understand and give details as to how many stores, Ola Electric stores, exist all across the country, state-wise, and how many such stores have valid trade certificates and how many don't. So Ola will now have to exactly tell them where all they are complying with the motor vehicle rules in terms of running these commercial establishments or showrooms across the country, because as per the Motor Vehicle Act, you cannot run showrooms without valid trade certificates. So they will have to give the exact number of trade certificates for showrooms and the number of showrooms which do not have certificates as well. On the sales numbers, the government is not yet satisfied with the explanation given as to difference between the registration numbers and the sales numbers that Ola Electric is claiming. So more questions are going to be asked there. They're also going to be asked as to how many vehicles have been delivered or are stationed at each of the Ola showrooms across the country. Simultaneously, the Ministry of Heavy Industries has also asked 4 vehicle testing agencies to look at complaints against Ola Electric, ranging from service centers, also sales discrepancies, and they will be looking at Ola stores and service centers all across the country.
All right, Parikshit, thank you so much for joining in with those details there on Ola Electric. The stock, though, is still around about 0.5% higher, levels of around 53, well below its IPO price and even further below its post-listing high. Take a short break, and as we promised, the management of Supreme Industries joins us on the other side to discuss their 4th quarter performance and the road ahead. Stay tuned.
Welcome back. Supreme Industries, that's the stock on our radar. The company's past quarter's numbers weren't very great. It was a weakish set, though the stock actually has seen a good recovery from the low point of the day. Maybe the street is a little bit optimistic on the prospects for the coming fiscal. So let's understand more. We have Mr. Taparia, the Managing Director at Supreme Industries, who joins us on the show. Hi, Mr. Taparia. Always good speaking to you. Thanks a lot for joining in here on CNBC-TV18. I had a couple of questions for you. Last year, you started off the year being quite optimistic on the volume front. I think you were guiding for in excess of 20%. That came down to mid-teens. You've ended the year at mid-single digits. That's the past. What's the way ahead? What kind of volume growth can you guide for? And if you could give us your sense that, are you being conservative? Are you being optimistic? And what's giving you confidence? Please go ahead.
No, last year we have given the reason of the volume degrowth. Where a huge destocking took place in our plastic piping system economy. As there was huge destocking, now the polymer PVC prices have gone down by 22% in last 8 months. And the price has become very affordable. We believe that destocking has to come back to proper stocking. So this year, last year the country had a minus 6% degrowth. This year, country is going to have a plus growth. So we anticipate we will grow 3 to 4% more than the country's growth this year.
Okay, and what would the country's growth be, sir? I think if I got that correct, you're going to outgrow the industry by 3 to 4%. So a couple of questions here. The PVC resin prices, have they already bottomed out? Point number one. Point number two is, since you're expecting stocking to take place, what is the industry estimate you're working with in terms of volumes?
No, the PVC prices the local producers are very much trying to get anti-dumping duty imposed on PVC. Already anti-dumping duty has been imposed on PVC press grade, and PVC suspension grade likely to be introduced. But even if there is no ADD also, the PVC prices have come close to bottom. It has fallen too much now in the last 8 months. We believe that in a normal given situation, the PVC prices have no scope to go further down, and business condition and demand at this current level is quite strong in the whole economy.
Mr. Taparia, so you're saying, sir, PVC prices have bottomed out, right? The pricing you believe has bottomed out.
We believe that.
We believe that. Good. So that's out of the way. And industry, sir, I missed that number. Your estimate of growth?
Industry side, I think last year had a 6% degrowth. Normally, it should grow slightly higher than the GDP of the country. The basic forecast in the country growth is going to be 6.4%. The PVC growth will be higher than the GDP growth, and we will grow 3 to 4% more than the country's growth.
So fair to say, Mr. Taparia, that your growth for the year would be around 9 to 10% if you are expecting a 6.5% GDP growth and 3 to 4% higher is what you are saying. So 9 to 10% would be a fair estimate?
Your thinking is very correct.
Right. Mr. Taparia, you mentioned about the fact that the volumes were lower this time around, and that has also had an impact on the top line as well, because you missed your guidance for that of 11,000 crores. So what are you penciling in for FY26 now, both on the top line front and the margin front as well, if you could share those numbers with us?
We anticipate this year our top line should be around 12,000 crores. And margin should be between 14.5% to 15.5%.
So if I heard that correctly, you said 12 to 13,000 crores on the top line and 14.5 to 15.5 on the margin front, right?
No, sir. I said our top line should be around 12,000 crores.
Around 12,000, okay.
And margin will be between 14.5 to 15.5%.
Right. Okay. Sure. So, and since you've also announced new acquisitions as well recently, how's the Wavin acquisition shaping up for you as a company, Mr. Taparia?
It's going quite well. We anticipate that Wavin business will be in our fold effective July this year.
Okay, got it. All right. Sir, give us a sense about the channel inventory. How's it looking? How are demand trends on ground?
Currently, demand is quite robust because the product prices have gone down by around 12%. compared to what it was in the month of April last year.
Okay, demand is quite robust. Good to hear. So there have been some reports that suggest that there have been some delays in payments from various states. How does this impact the Jal Jeevan Mission and also other demand?
We do not deal much big way in government business directly. We go through contractor, and contractor business has gone down. So there was a big degrowth in the consumption of polythene material last year. And we also had a degrowth in consumption of polythene material, but we are not a big player in infrastructure business.
Correct. No, but there's no big indirect impact as well that you're seeing, right? As you said, you're not direct.
No big impact, except that some of our low growth was due to loss of infrastructure business.
One final question from my end, Mr. Taparia. You have around about 950 crores of cash on your books. You have also mentioned that you are still on the lookout for inorganic acquisitions. Is there something in the pipeline right now? Are you in talks with any potential acquisition candidates?
No, we had a plan to invest around 1,100 crores this year, out of which around 300 crores we required to buy the Wavin asset. And apart from that, we have got majority organic growth plan only in this year. If any suitable proposal comes, we are always available to acquire that.
Got it.
Right. All right, Mr. Taparia, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Supreme Industries expecting around 9 to 10% volume growth, margins to be higher than FY25 as well. And it shows that the stock recovering from the lows as well.
Well, that's right, Mr. Taparia, giving good news for Supreme Industries shareholders. And we have got some good news of our own for all our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates. All of this at your fingertips. Download the app from the Apple Store or from the Google Play Store, or you can just scan the QR code that's up for you on the screen.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account. And the person did not even kind of entertain me. So I went chappal, and as a student you go there and so kala come to and so on. And then after conviction, after some convincing, filled the form, 2 days, 3 days, and opened my account. By the time you're gone, your interest is lost. So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit. Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. A slight bit of a loss is coming in now for the Nifty. Now 80 points lower is where the index stands. Still, although about 24,250 mark. So no reason to worry. Although it's still at the lowest point of the day as we count down to the final 90 minutes of the April series expiry. But it's an earnings heavy day today, as we have been highlighting through the day. And SBI Life is one of the other numbers that will be reported anytime now. Yash is joining in with what the street is expecting this time around. Yash.
Well, the numbers from SBI Life are expected to be on the weaker side in the fourth quarter. I'll speak about the specific numbers for the quarter that the street is anticipating. As far as the premium growth is concerned, the total new business premium, that is expected to see a contraction of as much as 24%. The number that we're anticipating here is 9,221 crore rupees. The total annualized premium equivalent, or APE, that is also expected to see a contraction of about 6%. The number that we're looking at here is 5,022 crore rupees. The retail APE, that is expected to come on the higher side, a growth of 8% expected at about 4,800 crore rupees. Value of new business, or VNB, is expected to contract by 8%. The number here that we're anticipating is 1,384 crore rupees. And finally, margins, they are expected to contract by about 74 basis points at 27.56% as compared to 28.3% on a year-on-year basis. In terms of qualitative expectations from the quarter, as I said, sluggish premium growth as well as VNB growth is expected from SBI Life, and that is on account of three things. One, there's a strong base effect which the company would be facing this time around. Second thing, the transition away from ULIP because of market volatility could have impact on the premium collection. Third one, transition away from the bank assurance channel and the movement towards agency channel, that could also hurt premium collection. Margins could improve sequentially, but they're expected to decline on a year-on-year basis. Still, SBI Life is expected to have the highest margins in the industry as far as fourth quarter is concerned.
All right, Yash, thank you so much for joining in with what's expected out of SBI Life. Of course, we also await results from Axis Bank, and we'll keep an eye out on these names and a whole host of other broader market results too that are awaited later in the day. But with that, we call time on this edition of Midcap Radar. From Nigel, me and the team that put this show together, thank you so much for watching. MF Corner for the next 30 minutes.
Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala and thank you so much for tuning in. As always, this is a show where we focus on breaking down different kinds of mutual fund, what's trending in mutual funds, and passive investing. That has been gaining traction in India, revolutionizing how individuals actually approach mutual fund investments. Passive funds, as we know, are investment vehicles designed to replicate the performance of a market index rather than outperform it. To shed more light on this, what is passive investing? What options do you have as passive funds for you? What style of investing should you follow? What are the risks that are there as well? Talk to us about all of that today. We're joined by Prateek Oswal, Chief of Passive Business at Motilal Oswal AMC, to talk to us about all of that. Prateek, thank you so much for joining in with us this afternoon. Before we deep dive into passive funds, passive investing, let's just start with something on the basic front. Could you just explain us what are the types of passive funds that are available right now for Indian investors? I know ETFs, index funds, smart beta funds, fund of funds, there are so many options, right? So how do each of these differ in terms of strategy as well as risks and anything else that I've missed out on in terms of funds?
Yeah, thanks, Vinny, for having me on the show. When it comes to, I think passive investing or passive funds investing, just to start with the basics, there's actually two types of, broadly two types of investing that happens in the mutual fund industry. One is, active funds and one are passive funds. What happens in active funds is that there's a fund manager who takes a call about which stock to buy, which stock to sell. It's a fund manager's responsibility is, for them to generate the returns that you get, at the end of the day or at the end of the year. When it comes to passive funds, there is no fund manager. You're essentially, creating a portfolio of stocks that mirror the index. So I'm sure a lot of the viewers have heard about Nifty and Sensex. The idea behind the Nifty index fund or a Nifty 50 index fund or a Nifty 50 ETF is for the returns to be similar to the index. So if tomorrow the Nifty 50 index is up, say 2%, if you're invested in a Nifty 50 index fund on ETF, your portfolio will also be roughly 2% up. So that's the idea behind passive investing. It's sort of like an autopilot mode of investing, and it's garnered a lot of traction over the last 4 to 5 years in India. If you look at developed economies like the US or Europe, over half the mutual fund industry there is passive funds, and India also it's gaining some good ground. So we talked about indexes like Nifty, and you have a very popular index called Sensex as well. But there's indexes across all categories today. Today you have indexes that span international products like NASDAQ, S&P 500 indexes. You have sectoral indexes like, bank index, IT index, metals index. You also have a category called smart beta funds or factor funds, that we can talk about later. And also you have commodity ETFs like gold and silver. So essentially, today in India, unlike 5 years back where you only had Sensex and Nifty, you can really buy indexes across categories, across asset classes. If you see today, there are over 600 ETFs and index funds that are currently listed in India, and that number is only going to grow from here on.
Okay,
yeah.
So you're expecting this number to go on from here on. But Prateek, you were mentioning, right, FOF. What does that also indicate? What does that typically mean? Index fund is what you explained, right? If there's a Nifty 50 index fund you invest, that's going to be, the similar kind of return that you would get on that front. But fund of funds, what does that mean? And what is smart beta fund as well? How are these different? What is the strategy here that is followed?
Yeah, in terms of the different categories of, passive funds, there are different. So the two biggest types of passive funds that are available in the market today are ETFs and index funds. These are essentially mutual funds, but, they're slightly different from each other. And ETF is like a mutual fund that's listed on the exchange. So if you want to buy a Nifty 50 ETF in the morning and sell it in the afternoon, you can do that through an ETF. Whereas a mutual fund, you're essentially getting an end of day NAV. So you can only buy it once a day, and you'll get the end of day, value for an index fund. So that is the key differences between ETF and index fund. And the performances of these two are fairly similar. When it comes to FOFs, FOFs are essentially the full form of FOF is a fund of funds. What that means is actually a fund that where the underlying constituents are other funds. So for example, today, we have a fund of funds that can buy multiple funds and a fund of fund that can buy a single fund. For example, today, at Motidal, for example, we have a Nasdaq ETF, but we also want it to be accessible to our mutual fund investors. So we launched a FOF that buys into the ETF. So that's accessible to our mutual fund investors who want to buy a mutual fund as opposed to an ETF. You also have, fund of funds that buy multiple ETFs or multiple mutual funds. So today, there's a lot of fund of funds who buy, say, a combination of ETFs, say 3 or 4 ETFs in a single fund, or you have a fund of funds that invest into multiple asset classes. Like we have a fund of fund that invests into an equity product, an international product, a debt product, as well as a gold or silver product, all in a single fund. So the idea behind a fund of fund is essentially offering a solution, for investors who are looking at that category, or the other objective is to give a mutual fund option to anyone who's looking at buying a particular ETF.
Pratik, you were mentioning that index funds and ETFs are almost similar, right? Not a major difference. But if as an investor, I have to pick up index fund or an ETF, what is the better option, whether it's liquidity, costs? What is it that is suitable? Or is it more goal-oriented suitability? How does this work then? How do I differentiate?
Yeah, so that's that's an excellent question. So essentially passive funds come in two formats, as I said, ETFs and index funds. ETFs are, the full form is exchange traded fund. So it's actually a fund which trades on the exchange. So essentially the positives of an ETF is that you can buy an ETF off your demat account. The second positive about an ETF is that if you want to lock into a certain price at a certain time of the day, you can do it through an ETF. For example, if the ETF is trading at say 10 rupees right at this point in time, you can actually lock in that amount by buying an ETF, as opposed to and ETFs. So a lot of traders and a lot of sort of institutional investors tend to prefer ETFs. But what we've seen in India, unlike the US where ETFs are very popular, index funds are actually a preferred mode of investment by majority of the investors. We've done a survey also that says that index funds tend to be a lot more popular because they are a lot simpler. You don't have to have a demat account in index funds. You can set up SIPs with a lot of ease in index funds, and also you don't. The problem with ETFs currently in India is that ETFs do not have as much liquidity on the exchange. So when you're buying an ETF off the market, say NSE or a BSE, then you have to buy it from someone else. And what normally happens is that in India, the liquidity for ETFs is very low. Okay. Essentially what that means is that when you're paying, so the ETF price is 20 rupees, you're essentially paying a slight premium, say 20.1 or 20.2 to buy the ETF because of the lack of market around it. So the problem in India is that liquidity for most ETFs, barring the top 3 or 4, is actually quite low, because of which, a lot of investors tend to overpay for ETFs on the exchange, and also they get lesser amounts when they're selling on the exchange. So for investors who like ETFs, we would advise them to look at something called an INAV, or that is the full form of indicative NAV, which is basically the live price of the ETF. Make sure that when you're buying an ETF, the price you're buying to is very similar to the INAV, which you can get on the website.
Okay. Pratik, thank you so much for explaining us so well and simply put, what one could look at. But what if I, goal-based normally investing is what you talk about. Everyone said that you should have a goal and then decide how your portfolio actually shapes up. But for, if I'm adding passive funds in my portfolio as well for specific goals, how should that be going around, right? What is the blend that I should be having in terms of maybe large cap index funds, short-term debt ETFs that are there? So what is that combination and how does it differ between goals?
Yeah, so, basically the way, at least, we see passive funds are simpler version of, actively managed funds or simpler versions of mutual funds. So today, if say a investor wants to, buy into a mid-cap fund, there are about 30, 40, 50 mid-cap funds out there, but you could easily buy the mid-cap 150 index fund, and, that's done for you. So essentially the thing about goal-based investing is that, goal-based investing is essentially building a portfolio I think in accordance to sort of goal you have in the future. So I think the asset allocation really matters when it comes to goal-based investing. If your goal is, say, retirement, then you could have a lot higher equity proportion of your goal. So suppose you're saving for, say, 30 years, suppose you're saving for retirement as a goal, then you could ideally have a 70-80% of your investments into equities, versus if you're, say, buying a house in 5 years' time, that you can't really have an equity of 80%. You'll have to come down to, say, 20, 30, 40%, because obviously equity tends to be a lot more volatile. So we believe that your asset allocations should be defined by your goals. That's number one. And number two is that when you're looking at passive funds, the best part about passive funds is that you're really able to find simpler solutions for all your investments across asset classes. So today, suppose you wanted to buy a commodity fund, you can buy it through a passive fund. Suppose you wanted to really buy a fixed income fund, you can buy a passive fund. Suppose you want to buy a mid cap fund, you can buy a passive fund, also international. So when it comes to your overall asset allocation needs, the beauty about passive funds is that you can really keep things very simple. The other benefit about having passive funds is that you don't have to really worry about performance. So I think you'll never see underperformance in your portfolio. And what we've also seen is that passive funds, unlike the past, today have become very efficient, and also they tend to be very good in terms of so also giving returns. So investors don't really need to check their portfolio every 6 months or every 1 year. They can just forget for life. So that's some more benefits about it is the long-term goals.
Absolutely. Long-term goals. I was going to come to the return part as well, because that's what attracts any investor, right? You want the best return whenever you make an investment. Long-term, I just want to understand passive funds versus active funds. What is the return in comparison? Are there times when we've seen passive funds actually outperform in terms of active fund returns? And given, that market volatility comes into play, right? So if it's an exchange-traded fund or an index fund, then when you're seeing such a time, that could see that impact coming in as well, right?
Yeah, so the performance differences between ETFs, which are exchange-traded funds, and index funds are pretty much the same. In fact, there used to be I would say bias towards ETFs, because people used to say that ETFs are more efficient. But actually now the industry has come to a conclusion that it's actually not, as if they both are exactly the same. So essentially investors should choose passive funds on the basis of convenience as opposed to what is better or worse. The second is that, what you said right now about performance between active and passive funds. I'll be honest. We used to have this huge debate about 4 years back when I initially started launching funds about active versus passive. Do you have alpha? We don't have alpha. So there was a lot of debate. Especially on these shows on what should you buy versus passive. And I think the really beautiful thing about what has happened the last 4 years time is that people have come to a conclusion now that you need to have active and passive in your portfolio. Fair and simple. So I think a lot of our investors, a lot of our distributors, a lot of our partners, almost everyone we speak to on a daily basis has come to a conclusion that 20-25% of the portfolio could be in passive funds. I think what the industry has also realized is that the large cap portion of the portfolio is where underperformance tends to be the highest for actively managed funds. So that portion can go into say a broad-based index or maybe a smart beta index. The third thing is also the rise of smart beta funds or factor funds. I think we are talking about underperformance and outperformance. There's a category called smart beta funds, which 3 years back was under 1,000 crore in assets. Today they're approximately 45,000 crores. So it's a very silent, growing category. It's the second biggest category in the world. Almost $4 trillion are invested in smart beta funds globally. Actually, no, not globally, just in the US. So I think it's a very big category, and a lot of people are sort of, taking account of this new category where you're able to get the transparency of and pricing of passive funds, but the outperformance of actively managed funds. All the smart beta funds in India have demonstrated outperformance over the long term. So people are also looking at these strategies going forward.
Absolutely. Interesting strategies there, right? So for long term, so far we have said that, you could look at those Nifty 50 or Sensex, Nifty 500, great choices coming in on those kinds of fund index funds as well. And other options are also there, like you mentioned, the Smart Beta Fund and international passive FOFs are something that is interesting. But on that note, viewers, we're going to slip into a very short break. We still have Prateek with us after the break to discuss more on passive investing, passive funds. So don't go anywhere. Welcome back to MF Corner on CNBC-TV18. Today we're discussing passive investing, passive funds with different goals, how you should be looking at passive funds and passive investment. For that discussion, we still have with us Prateek Oswal also, who's here. Prateek, while we spoke so much about long-term investing, goal-based, but what if I'm a short-term investor? I still want to invest in passive funds, or medium-term is what my goal of investing is. Is there an option still for an investor to look at the passive funds? Is it a good bet, or you would then say, because you're a short-term investor, better to move to active?
Yeah, so I think, depends on what short-term to medium-term means. I would say, anyone looking at under 3 years, should ideally not look at equities as an asset class, either active or passive. I think, equities is a very long-term asset class. In fact, even 3 years might be too less, maybe if you look at it from a 5-year perspective. But essentially, you could play two ways. One is by asset allocation. If you have a, say, 3-year timeline, which I think is a medium-term sort of a goal, then you should look at maybe allocating a small proportion of your money in equities, and the balance can go into, say, fixed income or gold or something like that. So that's one way of playing a sort of short to medium term sort of a goal. If your goal is under, say, maybe 1 to 3 years, then I would say, like an arbitrage or a liquid or maybe medium-term sort of debt instrument can be a good way of sort of playing through passive funds. You have today liquid funds that are available on an ETF format, which are completely passive. You also have arbitrage as a category, which is not passive, but that is really rising as a category because of its tax advantages over, say, something like a I think liquid fund. So we would recommend to look at more fixed income instruments for short-term goals, whereas medium to long-term, I think long-term can be majority equities, medium-term majority fixed income. That's a good way of playing it safe, because what happens is that markets are very volatile. And when you complete, say you have a goal in 3 to 5 years time, but what happens if there's a market correction in 3 to 5 years time? Because you can't predict these things, and that you can sort of do it with an asset allocation decision.
Okay. Prateek, what I want to also understand is in terms of how passive funds can be used effectively for two. One is wealth preservation as well as versus wealth creation. Which type of funds actually align these objectives, that if you have two of these?
Yeah, so, basically, I think, there are, I think the good way of, so let's talk about wealth creation. Yeah. I think wealth creation happens in equity funds. I think within equity funds, I would say there is higher wealth creation happening in something like a mid-cap index fund or a small-cap index fund. We also have a micro-cap index fund now, which is quite popular with investors. So I think wealth creation can happen through equity funds, and that could be large, mid, small. You can have international index funds like investing into a Nasdaq or an S&P 500. So those are excellent ways in which you could create wealth, given that you have a investing horizon of say 5+ years. We even I think for investors who are slightly more I think advanced, who are looking at smart beta strategies, they can advance or maybe if they have the risk profile which matches a slightly more aggressive behavior, then you can also look at smart beta funds. There is a strategy called momentum which is extremely popular today. There's a lot of investors who are buying momentum based strategies today, so that's a strategy which has worked really well in the past, and I think those are good for slightly more aggressive investors. If you're looking at wealth preservation, I think fixed income passive funds, and also I think commodity funds, or maybe a combination of different asset classes, could be a great way to build portfolios. If you look at investing, a lot of people want to sort of diversify their equity funds by buying multiple equity funds, and that is not the best way to diversify, because what we've seen is that when markets correct, all 5 of our equity funds will go down. Whereas the best way to diversify is to actually diversify across asset classes. For example, if you had a good allocation towards say equities, fixed gold, and international sort of funds. These are 4 asset classes, and what we've seen in history is that all 4 asset classes are actually moving. They have good returns over the long term, but the rise and falls happen in different moments in time. So, for example, in the last 1 year, gold has done extremely well. I think it's delivered something like 30-35%, whereas equities has not delivered as much. Even fixed income has not delivered as much. International funds have done very well because the Nasdaq has done very well. So essentially, if you're able to build a portfolio that's diversified across asset classes, you're essentially trying to negate the downside of asset class by the upside of some other asset class. Just to give an example, and this concept is called correlation. And we believe that if you have a portfolio that's very uncorrelated, that is an excellent portfolio, because you're essentially long-term returns tend to be the same, but the returns are uncorrelated. What means that when markets fall for one asset class, the other asset classes sort of help defend the fall, or they might move in different directions. So I think as the passive funds today are available across asset classes, and I think investors today can really build these portfolios across asset classes, which will help them with their wealth preservation needs.
Okay, Prateek, what is the best time to start investing in passive funds? Is it that, when you start seeing volatility, people realize, oh, I should maybe start doing more passive investing, or maybe look at something like that? But what is the best time for investors, maybe who are more cautious, or anything in terms of timing?
Yeah, so it's very interesting. So we did a study. In fact, we did a study last week where we looked at. So we're seeing some stoppages of SIPs. Small number, not very big, but small numbers of SIPs. Coming in from some of our investors in our AMC, and the idea was to do a study about when is the right time to start an SIP. And what we saw was that it was. I mean, it was sort of in line with what we thought. That if you have an SIP of, if you have the best days in the month, and if you start an SIP then, or if you invest in the best day every month, what would the returns be versus the worst days in a month? What would your returns be if you invested in a high PE scenario? Say the PE is about 30-35 versus the price to earnings is say 15 to 20 when the markets are very very cheap. And what we saw is that over a 10 to 15 year horizon, which is essentially, a long-term horizon, or even a horizon which is 7 years plus, the returns are pretty much the same. So even if today you start an SIP at the peak of the market,
right,
as opposed to trying to start an SIP at the bottom of the market, your long-term returns are pretty much the same. So we believe that when it comes to SIPs in general, I think it doesn't really, matter when you start an SIP, as long as you start. And also, if you are, what we've also seen is that, stopping SIPs and restarting SIPs is also not value accretive. When it comes to lump sums, we do feel that, over say, I would say over say a 7-year plus journey, regardless of when you enter, you will make some money or your returns will be positive by a certain percentage. So I think, if you are investing in a market today or invested in last the markets were expensive, you really have to give your investments time. And once you give time, you'll always make money. So I think that's the, similar sort of philosophy, when it comes to investing I think also categories matter.
Sure.
So see, small and mid caps will behave differently.
Right.
But if you're able to just, have a long-term horizon,
Absolutely.
fine.
Absolutely. Long-term horizon is the best thing to go around when you're investing, and the time in the market is more important than timing the market, right? So Prateek, thank you so much for joining with us on the show and giving us your time this afternoon, explaining our viewers as well about passive investing, passive funds, and what options they could look at in terms of goal-based investing as well. Thank you so much, Prateek, for joining with us. And viewers, thank you so much for tuning in to MF Corner on CNBC-TV18. We'll wind down this edition. Thank you so much from the team who put the show together as well. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
ASX 200 and the Nikkei, the Japanese index, that's managing to hold on to decent gains of more than 0.5% in today's trading session.
The levels, of course, upside level, 24,546 is where we are at.
They want to rebalance. Let's do it together.
50 points lower on the Nifty, so 24,288 is where we are at. The Nifty Bank is down about 0.3%, 55,184.
We will have to wait and see whether the slowdown is shallow or deep, whether it becomes a full-blown recession.
Identifying places, locations in the country where it is safe to put such large or modular nuclear reactors.
After 7 good days on the trot where the markets were running higher and higher, today is a session of consolidation.
If you could also just touch upon the margins bit that I was talking about, how do we look at the margins?
Track and punish every terrorist.
Multiple options are being discussed. There are meetings of intelligence chiefs taking place.
Well, the markets are trading with a cut of close to around 70 points or thereabouts.
Well, it is a bit of a down day as we've been seeing for the last many hours. Actually, a little sideways to be expected as we've been highlighting as well. This is closing bell and that was the day so far. So neither here nor there actually. I mean, all told, we've had a very, very good run. We are coming to you from the CNBC-TV18 News studios. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, hi, afternoon.
Hi, good afternoon, folks. But I guess, I was looking at the banks because yesterday the banks were sitting out of the action. This morning, the Bank Nifty started lower.
Yeah.
They've recovered and, maybe this is just a pause for the market.
Well, that's right. And the breadth of the market is still having a number of stocks advancing more than the number of stocks declining. So that's pretty good going.
No, absolutely. And we're not, it's not as if the market's broken any supports. Actually, we're not even close to any supports in that sense. And that's natural because the gaps have been so large and the moves have been so large. So the closest, even the hourly averages, and that's the nearest support for both the Nifty and the Nifty Bank, is further down. So for the Nifty, we are at 24,247. And here the support is the first 40 hourly exponential, which we put out in the morning, is 23,865. So that is some distance away. And similarly for the Nifty Bank, the first kind of hourly support is 54,390. And let's just quickly take a look at where we are. 55,380 is where we are at here as well. So again, on both indices, we are about 1.5% away from, just getting to their hourly averages even. So a bit of a sideways kind of consolidation kind of a day. But as Nigel said, broader market is having no such problems really coming through. That's the market breadth. Actually, market breadth also is not all that bad. It's kind of even Stevens. This morning we started with a bulk of it in the red, but I think things have improved a little bit, at least if you look at what's happening right now. Surabhi.
I'm looking at global markets, and for the time being, what's quite visible is that US futures are sulking. In fact, they've actually turned decidedly lower. If I'm looking at the right screen, the S&P futures are now down 1%, NASDAQ futures are down about 1%. So that a whole cheer that we had because of the expected climb down from Mr. Donald Trump, that I think is fizzling out, at least going by markets right now. And even across Asia and Europe, we're seeing more muted cues come through. So that seems to be weighing on sentiment here as well. Anyway, to talk about some more individual movers and shakers, today IndusInd Bank is quite the outlier. Those are some of the European markets, like I was saying, they're all muted. US futures are down, global markets are down. But over here, some stocks which are outliers. IndusInd Bank is definitely one. Cement stocks are seeing some interesting buying. UltraTech is notching up gains of about 1.5%, trying to buck the trend. And like I was saying, banks are trying to come back. And it seems that with banks, it's a buy on dips kind of a thesis that the market has gotten into. So Axis also, of course, reporting numbers today. Kotak Mahindra Bank, these are stocks that are clocking some green at this point in time. Just a quick word on consumer. Let's talk about the consumer stock reactions. Then we'll, of course, do the analysis. Lever down 3 to 4%. Really no sign of growth, cautious about the sort of upcoming trajectory, concern on margins. That's playing out on the stock. Tata Consumer has recovered from the morning blows. Tata Consumer managed a little bit of green for itself. And Nestle reported 2% volume growth. The expectation was 2 to 3%. They reported 2%. Lackluster performance there on the stock. So lots of consumer names. We'll get you more details and more analysis with Maglam in just a bit. Nigel?
Well, that's right. And we have ACC's numbers that are up for you on the screen. Remember, for ACC, it's a little bit confusing because they have a master supply agreement with Ambuja Cement. So they, there's a lot of interchangeability between them. But first, look at that. These numbers actually look good. On the top line itself, there's a beat. The margins have shown a big beat as well. So to tell you why the margin number actually is looking better than what the street is working with is because of a couple of factors. One is the top line growth is better. So in all probability, they've got some benefit of operating leverage as well. That's played out over there. And the other factor is the power and fuel costs. When you have a top line growth of close to around 12%, but your power and fuel costs have come down by close to around 11%, that's telling you that that's the clincher actually. And that's why, in fact, you are seeing that the EBITDA number as well is a little bit better than what we're working with. So we'll get you further details on that front. But I think the commentary that came in from Dalmia Bharat as well earlier today with regard to pricing, they were sounding a little bit optimistic and those numbers weren't too bad. So I guess that's played out as well. But let's get in, let's get in Mitesh Thakkar to help us out with what's the trade. Hi, Mitesh. Good afternoon. And tell us, how do you read today's trading action and a couple of stock picks as well?
So, Nigel, I think, the process of consolidation appears to have begun. We've been kind of sideways the entire day, and we've not been able to get past the yesterday's high, neither we have broken yesterday's low. So, looks like, I think, the markets will settle down for a few days, maybe, 1, 2, 3 sessions, maximum 4. That's difficult to say, but for the time being, the idea is that the directional bias is on the upside. So, within this consolidation, you're likely to get some intraday declines and pullbacks. I think those would be very welcome buying opportunities. So for the Nifty, anything closer to about 24,050, 60 is the area to start buying. So roughly about 180 to about 200 points lower from here. And as long as that gap which happened on the Monday, which is at about 23,872, I think that doesn't get filled. I think stay positive and buy a bit at about 24,050, add more if you get slightly lower levels. So that's the way to approach the markets in the near term. On the stock side, I have a buy on Tata Motors, keep a stop below levels of 659, look for targets of 695 to begin with. And also a buy on Nykaa, which is something which I've liked for many days now. Nykaa is a buy with a stop at 192 for targets of 202.
Okay. All right. Got that point. Mitesh, thanks very much for the stock calls. We'll come back to you a little later with more questions. Let's get down to specific movers and shakers in this afternoon's trade. And Divi's is one such stock. Last I checked, Divi's was up almost 4 to 5%. And this is on the back of excitement building in the market on the GLP-1 opportunity, the fat loss drug, so to speak. So Divi's could perhaps be an important vendor in the supply chain. That at least is going as per a Citi note. But let's bring in Vinny to understand this better. Vinny, what exactly is Citi saying?
Absolutely. So, the main crux behind Citi's note is that Divi's would be the possible primary supplier. So on the back of this one, firstly, they've given a buy rating to Divi's. They've increased the target price to 7,050 rupees per share. Previous target price was 6,850 rupees. Now, recently, we had seen that LLD study on this oral GLP-1 drug. That was a positive sign that came in there, positive commentary that came in on that front. And that is why Citi said that now seems like Divi's is well placed actually to capture the opportunity that could come in for this oral drug, the GLP-1 drug, which we're talking about. Now, why? Divi's has a lot of capacity that is there in GLP-1. Currently, when you look at it, they have around 300 million tons of capacity. They've planned more intermediary capacity already, proposed capacity addition of 18 million tons, capacity addition also for peptide GLP-1 specifically as well. So they have a lot of capacity which is just lying right now, mainly to capture on this GLP-1 opportunity. So at the minute we'll see, LILD actually getting the positive signs for this oral drug. They believe that Divi's would be the primary supplier, would get an orders on that front as well. And on the back of this, they're estimating around an $800 million plus GLP-1 opportunity for Divi's by 2030 is the estimation coming in from Divi's. So that's why a positive note, and that's why we're seeing Divi's buzzing in trade on the back of this.
Okay. All right. Got it, Vinny. Thank you very much for that. So lots of pharma companies in the news. Yesterday it was Lupin. Today it's Divi's on this possible opportunity. 5% up on the stock. Deven is joining in. Deven Choksi, MD at DR Choksi FinServe. Deven, always a pleasure having you on the show. Thanks for being with us. So that's exactly what I was saying, right? Some specific pharma companies, because of individual drug opportunities, seem to be in focus. Let's talk about Divi's and then also Lupin, in case you had a chance to look at the excitement around their kidney drug, the one for which they are about to get exclusivity.
Yes, Ravi, good afternoon. Well, I think for Divi's, definitely, I think it's all falling in line as far as I think their earlier preparation, including the capacity expansion and the approvals, I think, which are all now falling in place. And as a result of which, I think one after another positive news have been taking in. Though I fully agree that this particular part of the launch of the club could possibly be, I think, over the next 2 to 5 years' time and not immediately. But yes, the market would definitely factor in all the possibilities, I think, from starting itself. So certainly, I think the stock remains interestingly positioned. In between, during the corrections in the price, I think the stock was available at a valuation which was also quite attractive. Maybe currently, I think slightly improved valuation, I would say, as a result of which I think maybe one will want to buy in a falling market. But looks good from the long-term investment perspective, in my understanding.
Devin, anything on Natco as well, which you're picking up? Big move today.
Not sure, Prashant, I think on that front, I think we need to look into.
Okay, I mean, Natco, I think is a, by the way, it's a number one volume-led gainer right now across the board, which is phenomenal. You know, the other one, of course, is Sami Hotels, right? I mean, I think we have the sound bites with us, and maybe we can just play that out for our viewers. We spoke with the management in the morning, so they've got an anchor investor in the form of GIC, which has picked up a stake in. They've invested in 3 subsidiaries, so it's going to be investing in through these 3 subsidiaries, a total of 5 hotels for now. But the agreement calls for the GIC to sort of jointly come in at the upper scale sort of hotels, future hotels, etc., which Sami will sort of acquire, build, etc. as well. So it's a long-term partnership, apart from, of course, what this current infusion of cash will do in terms of reducing the debt, etc. Listen into the management, and we'll go across to Devin.
So I don't think I like to belittle the whole transaction by just only focusing on leverage. Clearly, that's a great end result. But what this gives us is a strong partner for future growth, especially in the upscale and higher category of hotels. As you've mentioned, we have picked up 3 of our existing hotels where GIC has picked up 35% stake against a total investment of 752 crores. This does multiple things. It reduces our debt significantly, on closing. That frees up a lot of our free cash for future growth. And in addition, GIC and Sami are committed to growing this whole partnership to about $300 million. So we do expect both partners to put more capital for future growth in this business. In terms of timing, the deal is subject to customary approvals such as shareholders' consent. We believe this should be in place by end of May, and majority of the investment comes upfront, which should get done, I would think, by June end, and the balance comes in Bangalore asset over the next 2 years. So besides the 3 seed assets, both the partners will look at new opportunities on an asset-by-asset basis. And if both the partners like the opportunity, we are committed to bring in capital in the ratio of 65-35, 65 from Sami and 35 from GIC. Closing, the net debt will come down to about 1,460 crores. Interestingly, that absolute number helps us achieve a target of near-term going below 3.5, within a year going below 3 times, and fairly quickly getting to our stable target of 2.5 times net debt to EBITDA. Therefore, we can look at deploying a lot of our free cash towards growth, but we believe our net debt will remain in the zip code of 1,000 crores to 1,400 crores over the next 2 years.
Okay, well, those are some sound bites from Sami Hotels. Devin, I don't know if you have a view on the stock transaction, GIC coming in.
Yeah, Prashant, I think about 4,800 keys that this particular company has, and also meaningful tab with likes of Marriott and Indian Hotel Groups, among others. So that way, I think the total asset management or the portfolios of the real estate that they are managing, along with the partners, I think that's something which is interesting. Not completely sure about the financial numbers this point of time, but I think the entire sector as a whole looks, I think, quite promising. When you look at ITC hotels, when you look at Indian hotels, on even some of the names like Pravik, in the entire hospitality space, I think these companies are showing some robust growth. And no wonder, because of, I think, higher amount of spending by the customers across, either in the spiritual locations or the tourism, or even in the leisure tourism space. I think everywhere, probably, I think you're seeing higher amount of growth apart from business tourism.
Deven, two bank stocks for you. One, IndusInd. I don't know, I mean, whether today IndusInd is just seeing some buying on a valuation basis, right? For those who are happy to take on a little more risk. We all know that it is one of the cheapest large cap banking stocks out there. So your thoughts on IndusInd. And the other is Axis. Great numbers from HDFC and ICICI. What about Axis now, and what's your view on the stock?
So we are distinctly positive, Surabhi, about the entire space and have been vocal about it, that the larger the size of the AUM, the higher the amount of deposit base. I think you are having the biggest advantage today in this situation because the growth rate is sticking into the economy. And the numbers are only validation. The HDFC Bank and the ICICI Bank numbers are only validation. Even, I think, the other ones which are there in the larger NBFC space, they have been reporting on a monthly basis larger growth on the AUM as well, including Bajaj Finance. So we remain, I think, distinctly confident about the growth prospects for most of the banking companies. Fortunately, they are not too expensive even after the current rally in the stock prices. They promises to be relatively performing relatively better compared to others among the banking space and NBFC space as well. Coming to IndusInd Bank, probably in my understanding, I think most of the fund investors are supporting the stock by their buying and accumulating the stock in the portfolio, also to ensure that the NAV do not fall. But more importantly, I think the negative news are getting priced into. And as a result of which, I think the valuation probably discounts most of the adverse news which probably one is seeing. Not too sure again, I think, whether to buy into the portfolio immediately, vis-a-vis some of the better names which are promising to do relatively better in the business at this point of time.
Correct. All right. Deven, I wanted to ask you, what about ACC and Dalmia? Now, both those two have reported pretty okay set of numbers. And as we know that now we're optimistic that FY26 will be far better than FY25. No big general elections. I think the first state election is only in the second half of the year. Prices finally, after many quarters, are showing some bit of an uptake. What do you like out here?
And Nigel, I think the important point for Dalmia in particular, that they are in the process of passing over the cost, I think, which is basically incurred by them on the limestone tax by Tamil Nadu government. And then exposure to those limestones, I think, close to, 25% in that state itself. So they are saying that they will be passing it over that particular cost to the customer, which means that the demand side scenario remains upbeat and bullish, which is a fact validated across the country, the construction activities which are taking place on infrastructure side as well as on the industry side that we are seeing apart from real estate. So all in all, put together, the demand scenario remain upbeat. On the other side, the input cost, the energy cost is coming under control because of the lower crude oil prices. And that's where I think one is arguing that on a higher capacity utilization, you are having lower cost of production, which will probably a win-win combination as far as I think the growth in the business and the profits along with. So certainly I think some of the cement companies expected to do well. And typically this quarter, April to June quarter, is supposedly the best quarter that one would be experiencing for most of these companies. We like the pan-India plays of UltraTech and ACC and Bharat combined, though I think some of the mid-tier cement companies are showing up signs of higher amount of growth because of the recent additions in capacity. Sector remains a little more favorable now.
All right. Deven, just throwing this to you. Not sure if you have a view, but VIP Industries has been a big disappointment in comparison to what Safari is doing. But some channel checks indicate that for the industry, not for the company specifically, but for the industry itself, demand is better at the start of this quarter in comparison to quarter 4. Given the valuations, what's your view on VIP?
I haven't looked at the valuation per se at this point of time. But in general, I think the entire segment looks, relatively better, largely because of the fact that I think they're getting the tailwind of the entire tourism activity, traveling activity which is taking place in the country. But beyond that, I think on the valuation front, I'm not fully comfortable to talk at this point of time since I have not looked into it.
Okay. All right, Deven, we'll leave it on that note. Thank you very much for joining in. Good to have you on this afternoon, as always. We need to take a very quick break on that note. Come back on the other side. We'll keep tracking the markets and get you more perspective. Pramod Gobi from Marcellus Investment Managers will join in. Welcome back. Quiet afternoon of trade, and the Nifty is still tracking a cut of around 90 points now. So it's a very slow drift down at this point in time. Let's talk about the consumer earnings that came through. Lever as well as Nestle. Lever is still down about 4%. Nestle is kind of flat last time I checked. Yeah, HUL is down 4%. We've got Mangalam joining in with the fine print. Mangalam, we weren't ever going in with very tall expectations to begin with, but let's start with Lever. Why is the street so disappointed?
Well, so for Lever, if you look at the numbers, they're largely in line with muted expectations with a few bright spots, but a couple of near-term concerns, and that explains why the stock is lower today. The bright spots was that the volume growth came in at 2% versus expectations of 0 to 1%. At the same time, the revenue came in largely in line with expectations, as did the EBITDA and the net profit. But the near-term concern is give and take everything. The volume growth is still 2%. The revenue growth is still about 2%. And at the same time, the management has lowered their margin guidance from 23 to 24% to 22 to 23% for the next few quarters. And this is not because of, any sort of commodity pressures, but they are looking to deliver the right price value proposition. So which basically implies to pump prime volume growth, they will be compromising on the margins by about 100 basis points itself on the EBITDA front. However, the bright spot is that the company believes that growth will gradually improve going forward. In fact, the first half of this financial year itself, they will do a lot better than what they did in the second half of the last financial year, which basically implies that the second half of this financial year will be a lot better than the first half itself, because that's the nature of FMCG. So from going forward, one can expect mid-single digit volume growth and low single digit price growth. That implies nearly high single digit revenue growth, even if that comes at the cost of slightly lower margins. So that is something which is important. Additionally, the management press meet, there were a couple of notes that I took away from. One, there is strong growth on their foods business. As far as their plan is concerned, Boost is one of the brands that they are looking to grow. Sunscreen is another category which is growing at 30 to 40%. Penetration is just about 3%. And they are scaling their acquisitions. Zoziva, for instance, when they acquired, was a 100 crore business. Now it's a 400 crore business. Similar is the kind of growth that they expect from Minimalist as well. So near-term margin-related concerns, growth-related concerns are keeping the stock under pressure. But we will monitor how growth pans out in the next few quarters. As far as Nestle is concerned, out here the muted top line and operational resilience is something that really stands out. If you look at the revenue, 5,500 crores, the street was working with 5,530 crores, but despite that, the EBITDA came in at around 1,390 crores as against expectations of 1,350 crores. Net profit closer to 885 crores itself. Here too, the domestic volumes grew by 2%. Gross margins compressed a lot less than feared, and other expenses were managed to ensure that the margins were better than street expectations. They did see good growth coming by in their beverages and confectionery business. Even their pet care business, which they acquired from the Nestle parent, has grown in high double digits rather, which is the highest that they've seen. What's not good is that domestic sales have grown at just around 4%. The street was working with 5 to 6% growth, and commodity inflation is still sticky when it comes to coffee, cocoa, and milk. So those are some things that we'll keep an eye out on going forward for Nestle.
All right. Mangalam, thank you very much for that. So that's a roundup of the FMCG numbers that we've gotten today. Pramod Gubbi is now with us, co-founder of Marcellus Investment Managers. Pramod, good to have you back on the show. I think even from the last time that we spoke, and private financials is an area that you've been kind of positive on, and you found value whereas other sectors, not so much, and the space has done well finally, waking up. But again, stocks have, of course, come up nicely from lows. What's your sense, Pramod? Is the environment conducive enough? Because there's enough liquidity. The problem seems to be demand for credit. That's got to pick up, right? And maybe easier liquidity over a sustained period of time will kickstart that. But what's your view and what do you like here?
Yeah, we still remain positive on private sector financials, but after the recent underperformance, you cannot say that valuations are compelling anymore. At best, they're reasonable and fair. Certainly compared to other segments of the market, they still seem relatively valued. That's as far as the valuations are concerned. But of course, on the other aspects, there's still headwinds. Clearly, you talked about credit growth. The demand environment in the country is sort of muted. We've seen the public capex slow down. Perhaps there could be further slowdown given the tax collections haven't been in line with expectation, and the government has reiterated its intention to be tight on the fiscal front. Private sector capex has also remained
We have a bit of a problem with that line. We'll try and get him back up in just a bit. But yeah, I mean, as a house, Marcellus has taken a favorable view on financials, especially private financials. And they're also selectively constructive on pharma, particularly healthcare, from what I recall from the last conversation. So we'll go back to Pramod in just a bit and try and get... I think we, in fact, have Pramod back. So Pramod, yeah, please continue. We lost you there. You were making a overall point on the market construct now.
Yeah, so as far as
Oops, not lucky with the internet line, I think. So we're going to try and do that again. By the way, the market's now turning into a slightly deeper shade of red. I mean, not too bad. It's still 100 points on the Nifty. After a big rally, it doesn't quite matter, but there is some additional pressure. Let's see which are the stocks that are seeing that incremental pressure. SBI Life, which is reporting numbers today, is about 0.5% lower. IndusInd Bank, this sharp 4% run. Now it has been trimmed to a 3% run, slightly off the highs on IndusInd Bank as well. And there's some incremental profit taking on Bajaj Auto, Eicher Motors. These are some of the stocks which are under pressure. By the way, Bharti Airtel, after lever, Bharti is the second biggest loser this afternoon on the Nifty, down about 2%. Like I've been saying, US futures, just going back and checking that, US futures are down about 1% or so at this point in time. So I guess last couple of days were a lot of excitement, thinking that there's de-escalation, and at least now Jerome Powell is not getting fired. So you run in relief on that. But then again, like we were discussing this morning with the city guest Drew, right?
Yeah.
Those deals are happening. First, they're going to take time. Let's see when they happen, and whatever shape and form they take, in all probability, with big markets like China, the tariff is going to be northwards of 10%. Which still 10. Means it's
north of, I think, north of that.
It's 10%, there's 145%.
So. Could be 30, 40, but still much higher than any time in the past. Lotus Laboratories numbers are at the bottom of the screen, and these numbers, I don't know if there are estimates. Oh, that is an estimate actually. 185 is the estimate, 230 is the actual PAT number. That's a very good number. And the top line also seems to be coming in. 1720 crores is the top line, and I think there is a bit of a beat there as well. So this is a decent set coming through from Lotus Labs at this point in time. We'll sort of look at, we'll have the margin number, etc. as well put out. A lot of interest around this one as a turnaround story, or whatever you want to call it. I mean, the stock's done well actually over the last many months. EBITDA at about 420 crores coming through. So more numbers as we speak at this point. So Vinny should be able to help us out with more if there's a guidance, etc. as well. 24.5% is the margin compared to a poll of 24%, which is largely in line with expectations.
So the margins have come in at this 24% mark for the first time, I think, in the last 2 years or so. So that was the expectation. It appears it's met those expectations. We got used to hearing, Loris, that the next quarter will be at those levels of 20-24%. But this time around, it's 24%. The last time, if I'm checking this correctly, yes, the last time they came out with these sort of margins was all the way back in December 2022. So there is a visible improvement out there. From those mid-teens, the margins moved to around 20% and now holding at around 24.5%. Wait by for the commentary though. I
remember we pressed Dr. Chava quite a bit on margins and top line as well. Top line, I don't think they gave out a guidance per se. From what I remember, back in, I think it was a 20% odd number, which was put out for top line as well, but we'll have to kind of sort of check. But these are a decent set of numbers coming through from Lotus. So from the lows over the last few quarters, people have made a lot of money on this one as well. Let's wait for Winnie to come back with more details. But we have the persistent systems numbers as well, which came in. Strong said we spoke with the management earlier on, and this is what they told us. Listen in.
So if you look at the margin performance, we have been saying we have invested ahead of the curve in sales and marketing. So if you look at our sales and marketing headcount, even over the last 4 quarters, it's in a very narrow band. While we have delivered in excess of $225 million or thereabouts in incremental revenue over the year. So that gives us a SG&A leverage. If you look at our utilization, we started the year with 81-82% utilization. We ended the year with 88% utilization. So there's a significant amount of utilization. And that utilization, please keep in mind, there are not too many companies that are growing. A lot of companies are degrowing. They are in fact reducing headcount. Whereas we are one of the few companies that are growing, adding headcount. Even in this quarter, if you look at it, we added more than 600 plus team members globally. So if you look at whether it is the revenue growth that gives you a leverage overall over many different costs, sales and marketing leverage, whether you look at the forex side of it, whether you look at utilization, every part of our business is kind of kicking in high gear. COVID year, everyone in our industry degrew. We grew by 12.9%. Our CAGR, compounded annual growth rate, is upwards of 24% for the last 4 years, compared to the industry at less than 8%, maybe in the range of 6%. So if you look at it, we have delivered 20 sequential quarters of healthy growth. That's point one. Point two, if you look at $375 million plus that we have delivered, $375.2 million, you multiply that by 4, it is $1.5 billion plus. That is the starting entry point for the year. And we have 2 years to go from $1.5 billion to $2 billion and then build up from there. Now have a good capital allocation for acquisitions. And we will look at maybe a scaled acquisition in Europe, tuck-in acquisitions in the US to build capability, and horizontal use cases in Gen AI like we did in contact center with the Starfish acquisition that we did.
Okay, that's persistent, and the company's done well in the quarter gone by in terms of growth. So has the stock. Let's go back to Pramod. We have him on a phone line now because of those internet issues. Pramod, very quickly, so I want to sort of throw two sectors at you, both that you like. You were just completing that point on financials, so please do finish that. And consumer. What part of consumer are you still convinced on? Because growth seems to be missing from most parts of it, unless you look at discretionary, like, let's say, some, jewelry companies, etc. So what in consumer and what in financials?
Yeah, sorry about the connection earlier. On financials, I think the biggest advantage is still the valuations relative to the rest of the market, although it's not as compelling as it was, say, 3 months ago, given the recent outperformance. It's still reasonable. There are headwinds in terms of credit growth, potentially in some pockets, asset quality deteriorating as a result of overall economic weakness. But even factoring that, I reckon it still remains one of the reasonable pockets of value in the market. As far as consumer is concerned, we've been talking about the crunch in the middle class consumption, particularly in urban consumption. That's clearly showing up in sectors, as you saw with the FMCG results earlier today as well. So to the extent that it'll take a while for middle class balance sheets to get repaired and they start spending again, I reckon the recovery in at least discretionary consumption is a while away. Possibly, rural is looking better given we've had welfare spends, we've had decent monsoons, food prices have come off, and food prices coming off is a big deal for the bottom of the pyramid consumer. To that extent, we might see some consumption picking there. But overall, from a valuation perspective, given still subpar growth compared to history, valuations don't merit an aggressive stance in consumer either. But that's the case with most of the market. I think valuations have structurally re-rated in the country, possibly due to the increase in financialization of savings, which is reflected in the sort of flows that we're seeing in these markets into mutual funds. Now, when that will abate is anybody's question. My sense is, given the opportunity... Yeah, sorry, go ahead.
Yeah, sorry. I mean, just to comment on there, I heard what you said about consumer. Does this mean that you have trimmed exposure to some of the companies that were earlier in the portfolio? Have you kind of downgraded the sector? Because what you're saying is what makes perfect sense, that growth is still a while away and valuations in that context perhaps are still expensive.
Yeah, so I mean, we've never done top-down allocation in our portfolio. It's always been bottom-up stocks. And in these sort of markets, it's actually good for bottom-up because the markets tend to be less discerning in a sell-off mode. To that extent, better businesses also get sold off and are available at reasonable valuations, at least relative to the market. Our portfolio construction is more from a bottom-up perspective. To that extent, we still do hold consumer names, but you're right, in terms of allocations, they have reduced compared to, say, 3 to 6 months ago.
Pramod, we'll leave it there. Thank you very much for joining us. And hopefully next time on a better line. Today, we do not have that. Thank you once again. What we'll do is we'll take a quick commercial break here. What's happening in dealing rooms with D Street Chatter, Nimesh gets us that intel in a bit. And of course, our technical experts with their trades as well. Stay tuned.
investing.
Welcome back. Well, the markets have slipped a little bit, namely the Nifty Bank. Not the Nifty so much. The Nifty Bank is now down close to around 200 points or thereabouts. That's been the outperforming index for this series. But expiry final hour sometimes swings it all over the place. So that's precisely what's happening. For the time being, let's hop across to Nimesh. He's here to tell us what he's picking up on D-Street Chatter. Nimesh?
Hi, Nigel. Given the expiry day, it's relatively a quieter day. It's been very range-bound day of trade. Not much in terms of big, wild moves, so to speak. I think it's the FMCG which is dragging the Nifty down because of the HUL results and the commentary. But largely from a flow perspective, for the second day running, I understand there is a basket buying, MOC basket buying at a leading Friday. So maybe last 30 minutes is because of that you might see some action in individual names. Again, from a sector perspective, from a flow perspective, it's largely the private banks which continue to be well bid. So most private banks is something where there is a bit of buying interest. And that index has relatively outperformed this month, and so to speak, this in today's market as well. Clearly, from a new series point of view, I guess the earnings is going to be a big dominating factor, and of course the MSCI review in mid-May will be important for some individual names. But from a flow perspective, there is buying, and there is buying into private bank stocks.
Nimesh, with individual names, I mean, lots of success recently.
Well,
Sami was the latest one.
Prashant, that just adds to more pressure, right? So it's always challenging. But anyway, in terms of individual names, the first stock on my list today is Whirlpool of India. A big move in that name. Need to see as to what comes out. But again, we all know it's an open secret that the parent wants to sell or bring down the stake from 51 to 20%. I understand the bankers have been appointed for the same. The excitement on the stock could be because the buzz is that maybe there are 3 or 4 large buyers, or maybe even an individual buyer, a single strategic buyer who can look at this particular stake. So maybe that's the reason why you've seen a big move in that stock. If indeed there is a single buyer or a clutch of buyers, the supply overhang will be out of the way. So maybe that's the reason why Street got excited on Whirlpool today. So that's the first stock. Second stock is Apollo Tyres. That's been consolidating in a narrow range of late, but it's up to 1%. The volumes have picked up as well, and the Street is anticipating a corporate development in Apollo Tyres very soon. What I hear is potentially a restructuring or something on those lines of their European businesses. So that's the trigger for Apollo Tyres. The third stock is Suven Life. Again, quietly that stock has moved up from the recent lows of 100 to back to 140 odd levels. It's buzzing in trade today as well. I understand the company is likely to raise funds, mostly by a preferential issue very soon. So that's a trigger there in Suven Life. And the last stock is ITC. The delivery-based buying has started in ITC in the last couple of days. And I understand a leading domestic mutual fund has been aggressively buying into ITC in the last couple of days.
Nimesh, with Whirlpool, just to kind of revisit, typically when there is a large stake sale, stock goes down. Here, stock's up 6-7%. And that could be, as you said, because there could be it may not come to the market. It could be a strategic player who could be interested. But this is very early stages, right? I mean, they're still scouting in that sense, just to be clear.
It's early stages, Prashant. I know for sure that the banker has been appointed and they've started the process. The feedback is, at least the market is anticipating, maybe there are a couple of big players, PE players who may just look to buy this entire 30% stake. If indeed they are selling the entire 30% from 51 to 20. And the other buzz is that maybe one single strategic investor could buy out that entire stake.
And just on the valuation parameter, the stock had come down to around 25-26 times. Traditionally, Whirlpool used to trade at around 45 times on an average for the last 10 years or so. And just one more observation, in their presentation, this time around, they were talking about going ahead with that stake sale, but they've removed, earlier I think they were written $550 to $600 million. So that wasn't there as well. On our, on our segment Midcap Microscope, I explained this, the company at around, less than 1,000 rupees or thereabouts, because the question was how much of the bad news is in the price. So today's con call, which is at 5:30 p.m. India time, will hopefully give some more details.
Absolutely, and we'll track that. Nimesh, thanks very much for that. So keep an eye. ITC, there was Apollo Tyres, and there's Whirlpool as well. 3 names. Well, let's quickly run you through what to buy or sell today for a reverse trade as we come back tomorrow. Mitesh is with us. Mitesh, what do you have?
Prashant, I think, despite the fact that the markets have been slightly negative, I will go with positive recommendations. SBI Card is after 3-4 days of consolidation is near the day's high. So keep a very tight stop at 918. Look for a 940, 945 kind of a target for tomorrow. And the other stock which I like is something which I recommended earlier, but as a VTST trade, Sun Pharma can still be a good trade. Sun Pharma is a VTST with the stop at 1794 for targets of 1820.
Okay. All right. Got it, Mitesh. Thank you very much for joining in, giving us all the stock advice through the course of the day today. Thanks very much. We'll see you tomorrow. Let's put the spotlight on earnings. Lots of big companies are slated to report after market hours. Let's go across to Abhishek first to talk about the expectations from Axis Bank. Abhishek.
Well, the NII growth rate on a YY basis can be one of the lowest that you are seeing in the last 28 quarters or, 7 years. That is what analysts on street estimate. So the key things to watch is that the sequential, that is quarter-on-quarter business growth can be pretty strong. Deposit growth as per Citi estimate is about 7% sequentially, and loan growth as per Citi estimate is about 5% sequentially. So net interest margin may decline YOY and quarter-on-quarter. Kotak Securities estimates 20 basis point decline YOY in net interest margin and 15 basis point decline on a sequential basis. So watch out for the slippages factor and the loan growth factor, which can actually impact the net interest margin. Now, provisions expected to decline sequentially, that is quarter-on-quarter. Kotak Securities estimates more than 27% decline in credit cost or loan loss provisions. So slippages also expected to decline sequentially. Kotak Securities estimates a slippage of 5,000 crore versus more than 5,400 crore in the previous quarter. Asset quality expected to improve. Now, Citi estimates gross NPA and net NPA ratio to decline by almost 10 basis points. So they estimate gross NPA ratio to come at 1.4% and net NPA ratio at 0.3%. Watch out for the near-term loan growth target and the business momentum guidance from the management. So our poll suggests NII growth of 5.4% on a YY basis and about 1.5% on a sequential basis. We are working with a profit decline of more than 5% YY, but profit can grow by 7% on a sequential, that is quarter-on-quarter basis. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. That's going to be a number that we'll be tracking. Well, Amrish Palika joins us to help us out with a couple of ideas. Amrish, before we ask you about a couple of companies, you normally give us that one stock that you're quite positive on. Which one is it this time around?
Nigel, it's JSW Infra, which is the second largest private commercial port operator in India, with a capacity of about 174 million tons per annum. It operates about 10 ports, both East and West Coast, have a liquid storage terminal in UAE, and they've been growing organically, but also doing strategic expansions and acquisitions. In fact, last year they bought out Navka Corporation as a listed company, and now its subsidiary JSW Port Logistics is undertaking about a 9,000 crore capex, which should be done by about 2030. Expansions are happening across various ports, and now we have seen 5 new ports and terminals being signed up. So this should also turn into revenue over the next couple of years. So JSW's target capacity by 2030 is about 400 million tons, which is about 2.5 times current capacity. So I think we should see a huge growth in the third-party volumes. My target price is about 400, based on FY27 EPS of about rupees 10.
Okay, Amrish, hi, good to have you on. That's one of the picks. Do want to talk to you about some of the IT earnings that have come in, Persistent in particular, because Persistent has persistently been delivering fairly steady performance, even in a challenging environment. But then the stock has also it's done much better than a lot of the others. What's your view now?
No, like you said, it's been quite consistent. Like a level like this possibly could be bought because, again, we are seeing, as far as software and IT is concerned, overall, at least the sentiment is improving to a certain extent compared to what we have seen in the last 2 to 3 weeks when it was down the dumps. So I think at the current levels, it could be bought. I think we should again see those levels which we had seen in the recent past of about 6,200 to 6,500. I think those levels should be reached in about 6 to 8 months.
Okay, that's Persistent. By the way, since we're on the subject, let's quickly run through some of the expectations from Tech Mahindra. There's also L&T Tech that's reporting numbers today. For Tech Mahindra, like a lot of its other larger peers, the expectation is the top line is going to fall. Dollar revenue is expected to decline 0.9%. That's the overall broader expectations that's come through. The margin should hopefully be steady. That's the sense. Rima's poll is saying the margin is going to be at about 10.3%. virtually unchanged quarter on quarter. Last time it was 10.2, this time 10.3. So let's see if they can deliver along these lines. Amrish, large cap IT, buying anything?
Yeah, in fact, I stopped buying in between, but then in the last 4-5 days, we again started buying into IT. So been buying Infosys, bought HCL Tech, in fact, post earnings, TCS. I think these are the couple of them which we bought in the large cap ones, because most of the bad news seems to be priced in. I mean, it's possible that they may not go anywhere for the next couple of months, but then from a valuation perspective, looking at longer term, 12 to 15 months plus, I think it's a great time to buy.
Okay, all right. Amrish, stay with us and you may want to listen to the next one. This is a CNBC Awaaz exclusive. Sources are telling CNBC Awaaz that Airtel is seeking to convert spectrum dues to equity. And Asim is now joining in with what the story is about and what he's picking up. Asim, over to you.
As you know, that recently government has come up with their policy where the government has allowed telecom companies to convert their dues into the equity. Vodafone Idea has already availed this policy and converted its due into the equity. 36,000 crore worth of spectrum dues have been converted into the equity. Now, what we are learning from our sources that Bharti Airtel is also seeking a parity on the same ground. Bharti Airtel has also written to the Department of Telecom for seeking a conversion of dues into the equity. When we tried to reach the Airtel declined to comment on this issue. However, when we tried to reach the Department of Telecom, they have said this policy is open to all. Anybody can apply on this ground, and this policy is open to all, but we will decide on the case-to-case basis. So far, government has not taken any decision on the same, but however, Airtel has demanded for it, and government may soon take a decision or a final call on the same.
The entire dues, Asim? Or the entire spectrum dues to be converted? So government will hold equity then to that extent, and Bharti. That's what you're picking up, right?
The government, it depends upon the Airtel how much dues they want to convert. As far as I know, that they have around 52,000 crore rupees worth dues for their long-term spectrum liability. So they wanted to convert that into the equity portion. So they have asked for Department of Telecom. So Department of Telecom now has to take a final call in that whether they will be agreed to the Airtel demands or not. So the final ball is on the government court. I have spoken to some senior official and they said it's on our discretion that whether we will allow this or whether we won't allow this. But they have demanded from the state.
Around 50,000 crores, Asim, right? You're saying that Airtel may want to convert 50,000 crores into equity.
The long-term liability worth through the spectrum is around 52,000 crores and they wanted to convert it.
Okay, all right, got it. Thank you very much. Interesting development there. Let's see where this really goes. Bharti Airtel anyway has been down about 2% in today's trading action. We'll take a break, come back and we'll get you more on the markets in just a bit.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account. And the person did not even kind of entertain me. So I went chappal and as a student you go there and so kala come to and so on, and then after conviction, after some convincing, filled the form, 2 days, 3 days, and opened my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. 6 minutes to close the day. We've got Amrish with us. Amrish, just wanted to get your thoughts on the story that our colleague from Awaaz just reported on. This is sort of a departure from earlier thought. Now, like Vodafone, even Airtel is saying we also want to convert some of our dues into equity. Your thoughts on what this would mean?
But then I don't think we can compare Vodafone with Bharti Airtel. I mean, they have prepaid 5,000 crores earlier as far as spectrum dues are concerned. So it's not that Bharti does not have cash to pay. It's just that the cash they have or they're generating could be put to better use. So this will work out about, I think, 52,000 crores, which will work out about 5% of the equity. I think from a government's perspective, I think it'll be a good hedge against the Vodafone Idea investment. I mean, if that goes down or under, you have Bharti doing well at that point of time.
Interesting. Amrish, want to ask you about a few more stocks. We have Asian Paints. That stock, over the last few days has been some kind of delivery-based buying. From the paint stocks, what do you like?
In fact, Asian Paints has been one of my top picks. I mean, even before it fell. So when it fell, we averaged out decently well. Knowing fully well that it'll take a while for this stock to bounce back. But then we still have a price target of about 3,400 to 3,600. So at the current levels, if one does not have, I think it's still a great time to buy. Because I think most of the bad news is already priced in as far as the competition is concerned. And even now, if you see, they've again aggressively started marketing themselves. So I think, over the next 6 to 8 months, we should see a decent bounce back in the stock.
Amrish, Eicher has not really corrected that much. High was about 59. Recent high was 5,900. It's come off a little bit now, but I mean, hardly anything. You think it on these Harley fears, etc., it corrects a little bit more, becomes a good buying opportunity? It's not given a buying opportunity in a while. It's one of the foremost plays on discretionary consumption in that sense.
Absolutely. And again, whatever said and done, it's in a niche category. Although you may say that Harley is there, which could be a decent competition, but they're still in a niche category. So in case we see some correction in this stock because of the market, maybe at levels of closer to about 4,800, 4,900, I think it becomes a decent buy at those levels.
One thing I've seen with Eicher Motors, the launches come and go, but the thump has a different feeling when you ride it, and for a shareholder as well, I guess it feels quite good because you see a lot of launches, you see the stock pull back, but ultimately, you get 350, 500, 650 cc at affordable rates, and the parts as well, you get it fairly well,
Actually,
available.
It fell to $5,000.
I think when Bajaj and Hero had launched it, I remember it fell more than 15%.
The war of the big bikes, remember? We did so many conversations around that, yeah.
So low on the 7th of April was $5,000. I mean, it was $5,000. And of course, it's come up about 10% or so. It's otherwise it's kind of been steadily doing very, very well over a period of time. Blue Star is another one, right? I mean, we had that one day, those BI standards it was, right? I mean, the day before yesterday, the stocks saw a bit of a pop, but yesterday stocks were down sharply. Today again, and I think Blue Star and Voltas both. Any thoughts here, Amrish?
In fact, instead of Blue Star, I would still prefer Voltas, which has more of B2C, share. So I think it's again followed decently well from the recent moves which we saw in the last 4 or 5 days. It's already fallen about, I think, 70, 80 rupees. Maximum, I don't see this like Voltas going below 1230, 1240 levels. So at the current levels, it should be bought. Looking at the scorching heat, clearly, I think it's time to have air conditioning and anything related to air cooling in the portfolio, and Voltas would be the first one.
Okay, all right, got that. Thanks very much, Amrish, for all the perspective. Just stay on, we'll take 2 minutes and recap the day, and then we'll come back to you. So the tally reads as follows. We've got about an 81 points sort of a dip on the Nifty. The mid-cap index is also subdued. And the Bank Nifty has again now turned. When we started the show, the Bank Nifty was flat, but now it's again down about 0.5%. So it does classify as a slightly weak day for the large caps. Let's talk about the key pain points then. Bottom of the barrel was HUL after its numbers, 4% lower. Bharti Airtel, 2% down. Interesting story that you just heard. The company could look at converting some or all of its spectrum dues into equity. At least that's what it wants. Eicher Motors down 1.5%. Then the banks, they couldn't really hold up today. So ICICI Bank is ending with a cut of 1.5%. HDFC Bank is down about 0.5%. Let's see Axis Bank, which reports numbers after the bell. Axis is at the flat line, not too much happening out there. Other weak names included ONGC, Eternal, auto stocks like Bajaj Auto and M&M also cooled off to quite an extent. On the upside, IndusInd Bank has been an outlier, about 3% up on that stock. UltraTech, Grasim moving higher, and Pharma has had a good session today. Cipla, Dr. Reddy's, Sun Pharma, all these stocks on the upside. Even Apollo Hospitals from the healthcare space, about 0.5% up, 85 lower on the Nifty, Nigel.
Well, that's right. A lot of stocks in the broader markets, though, were moving around. You had Morpin Laboratories up 14%. MMTC was up 10%. You had Inox Wind, that was up another 4.5%. And RBL Bank, 200 rupees now on that particular name. What came in for some mild profit taking? Syngene, I think you mentioned that. IRDA was down close to around 2% or thereabouts in today's trading session. So quite a few big movers from the broader markets in trade. In fact, we had a few more names that should come up for you on the screen. You had Repro India, stock was up 20%. You had a couple of other notable movers. Vimta Laboratories was up close to around 10%. And yet Subin Life as well, that was up close to 9% in trade today.
Okay, and the bell has gone. With that, it's curtains on this edition of Closing Bell. Many thanks for watching, but don't go anywhere because Prashant and I continue this discussion. Up next is Markets Forward.
The market snaps 7-day winning streak as it ends in the red. The Sensex slips to 79,800 level. Nifty settles near 24,200. The pharma index climbs while real estate and FMCG stocks decline in trade.
Hindustan Unilever posts a tepid quarter but expects first half of FY26 to be better than H2 of FY25. Although gross margins could crimp on higher investments, Tata Consumer sees double-digit growth as a given and a better margin profile if tea prices ease. Nestle also flags improving volume growth.
Divi's Laboratories surges on the back of positive commentary from Citi. Analysts believe the addition of oral GLP-1 drug is set to pose a big opportunity for the drug maker. Hello and welcome to Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. I'm Prashant, with me, my colleague Surabhi. Surabhi, hi.
Hi, Prashant. A quiet day, a day of pause perhaps, but not too bad considering perhaps the market has rallied so much.
You know, these pause days give you time to think, reflect, right?
Much
Otherwise,
needed.
you're just chasing headlines, chasing prices, and things have moved very, very fast. And that's the reality. 13% on the Nifty in the last 7 odd trading sessions now. So it's coming really heavy and fast. So today was, as we said, a bit of a pause. Nothing much, about 1/3% lower on the Nifty. The Nifty banged down a little bit more, but the Bank Nifty ended lower yesterday as well. And things were getting a little stretched. Actually, they are a little overbought. We've been highlighting that for since yesterday. And yesterday, the market did not pay any attention. It moved right back on. Today, this morning, of course, as we came in, there was some at the margin chatter, worry, whatever you want to call it, about, of course, the potential escalation or in terms of the terror attacks that happened in Kashmir and how that would go forward. And of course, on the global front as well, maybe, it's kind of swinging from extreme to saying that, well, everything is finished, to going to the other extreme to say that, well, we are absolutely back to again getting into a bit of a mood of despondency, that this is going to take time, nothing is going to get resolved very soon. So you were kind of swinging between those phases. That one-time reset, correction, pullback has happened, and now I think you're basically just waiting for something to move as far as these trade deals, etc., are concerned. Lots happened as far as single stocks are concerned. We'll talk about that. Surabhi.
Absolutely. And indeed, I mean, today, global markets as well, while we were trading, many of them chose the red color. Europe was down about 0.5%. US futures had turned negative by the time we closed out. They were down 0.5% to almost 1%. So a sense of caution perhaps prevailing in international markets as well. And for our market here today, if you talk about a lot of the sectors, there was no leadership at all. Yesterday, at least, IT was picking up the mantle. Today, IT was down, banks were down, almost everything except pharma and healthcare was actually on the lower side. And we'll talk about that as we go forward. And even mid-caps, very quiet session. Mid-cap index ending absolutely flat. And the advanced decline was totally even Steven. So a bit of a nothing sort of a day. Let's now talk about the lineup. Here's what we have for you on the show today. We'll start off with the key movers and shakers. We'll have Hormaz joining in with all the action on the stock-specific front. Some individual stocks on our radar include Tata Consumer, Divi's and Ola Electric, and we'll tell you why in just a bit. And then, of course, finally, we dive into a lot of the key events to watch, which will also include some pretty big earnings. So lots coming up. Let's get started then. Straight away go across to Hormaz with the key stock-specific account of the day.
It's almost been 2 weeks and it now finally feels like earnings season is finally picking up pace. It's evident from the earnings reactions that we had today. Syngene being the accident of the day, almost 13% lower. Canfin Homes too not having a good day today, 5% lower after its results. But the casualty bigger one on the Nifty was HUL. It was an initial pop that gave way to a steep sell-off from the highs after the management expressed some worries over margins. Dalmia Bharat and Tata Consumer too seeing some earnings reactions in today's session. Pharma as a sector did well. Mid-cap pharma in particular, look at Natco ending 7% higher. Divi's, of course, with that positive brokerage commentary, they're ending 5% higher. Here comes Ajanta Pharma, Wockhardt too, seeing healthy gains today. Among the newsmakers today, of course, was Whirlpool. The parent company reported results and that had a rub-off on the India unit, 9% higher here. Niva Bupa carrying on from where it left off yesterday after Motilal Oswal's initiation. Vari got a couple of downgrades today and ended 5.5% lower. Of course, some profit booking after a 2-day surge. Blue Star and Devyani International too seeing some news flow today. And stocks that are at a 52-week high in today's session. BSE, of course, continues to grow from strength to strength. GSK Pharma, JK Cement, SBI Cards too forming the list. And lastly, the stocks that did well on the volumes front. Mid-cap IT, a couple of names there. Newgen Software and Sonata Software. Look at these moves. 10.5%, 9% on strong volumes. Triveni Engineering and Thermax too among the volume movers today.
Okay. All right. Got that, Harmaz. Thanks very much. Well, let's move in and welcome our guests on the show. We have Amrish Baliga and Ruchit Jain of Motilal Oswal joining in for some perspective. Ruchit, let me first come to you because this is a bit of a pause day after this heady upward momentum and move. What do you make of the market right now? Key levels on the Nifty, Bank Nifty, and what's your advice?
Yeah, very good afternoon to everyone. The overall trend still seems to be positive because there are no signs of a change in the trend, but only because we have seen a significant run-up in a very short period of time. I think just 7 to 8 trading sessions and the markets have run up without any meaningful correction. Due to that, the momentum readings on the lower time frame charts are now in the overbought zone. So I think for next 3 or 4 trading sessions, either we should see some slight dip towards the 23,800 to 23,900 range, or some time-wise correction where the index would trade within a range like we saw in today's trading session. So I think before resuming the uptrend, we expect some 3 or 4 days of consolidation to play out. In this consolidation, I think there would be more of a sector or sectorial or stock-specific momentum could be seen. So on the index front, to relieve these overbought setups, we could see some consolidation. So traders should look for more of a buy on dip approach now rather than chasing the index at current levels. But yes, certain sectors, if you see, such as cement space is there, pharma is there, fresh momentum has been witnessed in these names which have not yet participated in last 10, 12 days of up move. So this is the take that we are recommending to take now more of a sector or a stock specific approach within which cement and pharma are looking good.
Okay, got that. Let's quickly focus on a bunch of specific stocks and areas in the market, and one such segment is, of course, FMCG. Now, a lot of the stocks were under pressure after reporting numbers. HUL, Nestle all came out with their Q4 performance, and the market was not too happy, largely speaking. Manglam is here with a snapshot on the earnings. Manglam.
Well, if you look at HUL, the results were largely in line with very muted expectations of 2% revenue growth, 2% EBITDA growth itself. There were a couple of bright spots and a couple of near-term concerns as well. For HUL itself, the bright spot was that volume growth came in at 2% versus expectations of 0 to 1%, even though revenue, EBITDA and net profit were all in line with expectations. The near-term concern and the reason why the stock was lower is because the company said that they will shave off gross margins to improve the value proposition to pump prime growth ahead, and as a result of which the EBITDA margin guidance for the next few quarters from 23 to 24% stands at around 22 to 23% itself. The big bright spot, however, is that they see growth returning in a lot of the categories. In fact, the first half of the next financial year, they expect growth to be better than the second half of FY25 itself. So those are a couple of factors that stood out for HUL. The stock lower, but one would have to look at growth in the next 1 year to see whether the brokerages will up their estimates despite them reducing their margin guidance as well or not. For Nestle, the top line was fairly muted, though operationally the company did report some sort of resilience. There was, that 2 to 3% top line growth that came in largely in line with expectations. Volume growth came in at 2% as well. But the gross margin compression at 62 basis points was a lot lower than what the street was factoring in, despite the sort of inflation that we saw in both cocoa as well as coffee. And the company did say they saw double-digit growth in their confectionery as well as beverages portfolio, along with the pet care portfolio as well. Finally, we had Tata Consumer, which saw a sharp recovery from the lows and ended marginally in the green on the back of largely in line set of numbers, but growth is returning in their portfolio when it comes to Narishco, Sampann as well as Soulful, which is the growth portfolio of the company, where the management did guide for double-digit revenue growth in FY26 on an overall basis with 80 to 100 basis points margin improvement and 30% growth for their growth portfolio, which is Narishco, Sampann and Soulful.
Double-digit revenue growth is a given. We've already come to volume growth across all our businesses this quarter. We have every single business growing on revenue as well, 17% top line, 12% organic. EBITDA margins were a bit soft. And if you look at it, overall EBITDA, I was a negative 1.1. But here's the thing. The primary compression has been because of tea prices, which have run up 25 to 30%. If I took off both the cost and price increases that we took on tea this quarter, I have improved my full year by 80 bips. Our guidance is for improvement of 50 to 100 bips every year on EBITDA margins, and that doesn't change.
There's a pretty strong case for us to further develop investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. So margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us.
Okay, so, that is what we got from the consumer companies today. Let's discuss one more stock and then we'll take it back to our guests. Shares of Sammy Hotels climbed over 11% today after Singapore's GIC picked up 35% stake in the company's subsidiaries for about 750 crore rupees. The management told us that the deal will significantly trim debt for the company and will also free up some cash for growth. Take a look.
So I don't think I like to belittle the whole transaction by just only focusing on leverage. Clearly, that's a great end result. But what this gives us is a strong partner for future growth, especially in the upscale and higher category of hotels. As you've mentioned, we have picked up 3 of our existing hotels where GIC has picked up 35% stake against a total investment of 752 crores. This does multiple things. It reduces our debt significantly, on closing. That frees up a lot of our free cash for future growth. And in addition, GIC and SAMI are committed to growing this whole partnership to about $300 million. So we do expect both partners to put more capital for future growth in this business. Closing, the net debt will come down to about 1,460 crores. Interestingly, that absolute number helps us achieve a target of near-term going below 3.5, within a year going below 3 times, and fairly quickly getting to our stable target of 2.5 times net debt to EBITDA. Therefore, we can look at deploying a lot of our free cash towards growth, but we believe our net debt will remain in the zip code of 1,000 crores to 1,400 crores over the next 2 years.
Okay, so that was Sammy Hotels also in focus today in the news. Amrish, let's take this step by step. I mean, all these companies that we discussed, there's FMCG on one side and there's SAMI on the other. They represent different sides of consumption, right? So let's talk FMCG first. What did you make of the numbers? Would you buy any of these FMCG stocks hoping for a turnaround anytime soon?
If you look at the numbers, they are more or less in line with what the market was expecting. I don't think the expectations were huge this time. Like it was quite tepid. And it was meeting expectations. But then, what broke some of the stocks was the management commentary. But it makes sense for the management to be quite cautious at this point of time, looking at the market environment, limit the expectations of the market, and then possibly have a chance to perform better. Clearly what the Dabur management did in the first week of April, see as to where the price was at that point of time and how it has improved as of now. So going ahead, FMCG overall or consumption overall, I would be quite positive on looking at more cash in hands for the consumers. Then normal to better than average monsoons, which I think should improve the rural demand going ahead. And I think the 8th pay commission by the end of this calendar year, early next year, I think that should be the next trigger for the consumption stocks. So in a market like this, where we are seeing some correction in FMCG because of the management commentary, I think should be utilized to buy.
And very quickly on SAMI, let's also pull a one-year chart of SAMI because this GIC deal, clearly the market was very excited about it. The stock has had a dream run in April. It's moved up substantially. Actually, if I just look at the levels, from 144 at the start of April to 192 today. That's the sharp surge I'm talking about. ahead of the GIC deal. So very quickly, Amrish, on this, I mean, hotels, we know the broad theme. We know the discretionary spends going up. The question is picking the right stock. So say versus a Lemon Tree or an Indian Hotels, would SAMHI look interesting?
No, see, SAMHI was interesting a while earlier. I mean, I would say at levels closer to about 135, 140, but not at the current level, especially after this sort of a move. So I would still prefer to possibly look at something like ITC Hotels, which is still consolidating at levels of closer to 200. And at the same time, like Lemon Tree, which has anyway moved up a bit, but not as much. I think there's still a decent upside, possibly at the 30, 40 rupees from where we are.
Okay. All right. Got it. Let's talk about some other stocks and stories in focus. Trouble continues to mount for Ola Electric. Sources are telling CNBC-TV18 that the company will face more government scrutiny over non-compliance with the motor vehicle rules. Parikshit is joining in with the latest. Parikshit, the troubles just don't seem to be ending for Ola.
Well, the Ola Electric company has been facing probes at the Ministry of Road Transport and Highways and the Ministry of Heavy Industries, apart from different state-level probes. Now, the Ministry of Road Transport and Highways is set to issue a fourth letter to Ola Electric because they are not satisfied with the 3 earlier questionnaires, notices, letters sent to them for discrepancies in their sales and vehicle registration data and unanswered questions as to why they had stores functioning across the country without valid trade certificates, which is a contravention of the Motor Vehicles Act. Now, what the government is going to do, they are going to give a chart to Ola Electric where they would say, tell us the number of stores that you have all across the country. Then you tell us the number of stores where you have valid trade certificates. Please fill in the blank, and the number of stores which are functioning but do not have valid trade certificates, number of stores which are closed, how many vehicles have been delivered or are stationed through each of these different Ola stores across the country. They're also going to be asked about the sales data, discrepancies in the vehicle registration data, which is on the Vahan portal, what they are quoting publicly as well. Why are, for example, pre-bookings being accounted in sales numbers? Why were bookings for vehicles which had not been launched in the month of February, which had not been commercially rolled out in the month of February, also included in the sales data that they had given publicly? Also, at the level of Ministry of Heavy Industries, we're told that 4 vehicle testing agencies around the country have been asked to look into discrepancies around Ola Electric. So clearly the heat growing on the company, and the government not very satisfied with the replies that have come out so far.
Okay. All right, got it, Parikshit. Thank you very much for that latest update. Let's now talk about Divi's Laboratories. Stock was up about 5%. Now, we had a note from Citi today. The brokerage is maintaining a buy rating on the stock. It's quite optimistic on the GLP-1 opportunity with respect to Divi's. Let's get more details in. Vinny, explain what is the rationale that Citi is taking here?
So absolutely, the buy rating target price has been increased 7,050 rupees for versus 6,850 rupees. Now the rationale behind this is that Eli Lilly recently had recently spoken about the GLP-1 oral drug opportunity, and obviously the efficacies that they've received in the trials that are going so far are quite positive. So now what Citi believes that Divi's is well placed to capture this GLP-1 opportunity that will turn up sometime soon. They believe this Divi's already has a lot of capacity that is there, that is lying with them for GLP-1. Plus, they have planned a lot of capex on that front as well. 18 million tons more addition plus peptide GLP-1 is what they'll be focusing on. So capacity addition plus already lying capex will give it an edge over other competition players and other players in the industry. And that is why Divi's could benefit from this. It could be an opportunity of around 800 million plus in terms of GLP-1 for Divi's Laboratories by 2030, and Divi's remains a top pick for Citi, and that's why positive move in the stock today.
All right, got it. Thanks very much, Vinny, for the details over there. Very quickly, Ruchit, let me come back to you. We discussed several stocks there in terms of fundamental news flow, Divi's. We also discussed SAMHI Hotels where the deal happened. Anything, I mean, purely from a trading perspective, do you see any prospects, any possibilities here in any of them?
I think within this basket, Divi's is looking quite positive, because if you look at last 7-8 months, the stock has consolidated within the range, has shown more of a time-wise correction. And within the pharma basket in this last 7 months, it has been a relative outperformer. So I think divis could see a significant run up from current levels towards 6,800, 67 kind of range. So this one looks quite interesting. And apart from divis, I think not one from the discussed list, but cement, as I said at the start of the show, is one space where from a near-term perspective, we could see decent upmove. So UltraTech Cement, one of the heavyweight within the cement space, is also on the verge of a breakout of last 10 months of consolidation. So I think both these names have similar structure where last 8-9 months we have seen some time-wise correction and now are showing some breakout from this consolidation.
Okay, all right. Interesting thought there. So cement also perhaps looking good on the charts. Gentlemen, thank you very much for joining in. You have a good evening and we look forward to connecting again soon. Let's move on. Another stock that was on the radar today was Persistent Systems. The company reported a good set of numbers for the fourth quarter. Persistent CEO Sandeep Kalra has said that the company is entering the year with a strong EBIT margin outlook. Take a look.
So if you look at the margin performance, we have been saying we have invested ahead of the curve in sales and marketing. So if you look at our sales and marketing headcount, even over the last 4 quarters, it's in a very narrow band. While we have delivered in excess of $225 million or thereabouts in incremental revenue over the year. So that gives us a SG&A leverage. If you look at our utilization, we started the year with 81-82% utilization. We ended the year with 88% utilization. So there's a significant amount of utilization. And that utilization, please keep in mind, there are not too many companies that are growing. A lot of companies are degrowing. They are in fact reducing headcount, whereas we are one of the few companies that are growing, adding headcount. Even in this quarter, if you look at it, we added more than 600 plus team members globally. So if you look at whether it is the revenue growth that gives you a leverage overall over many different costs, sales and marketing leverage, whether you look at the forex side of it, whether you look at utilization, every part of our business is kind of kicking in high gear.
Okay, let's move on now. Bharti Airtel has written to the government about its spectrum dues worth about 74,000 crore rupees. CNBC Awaz is reporting that Airtel has asked the government to convert its spectrum dues into equity. The government has earlier converted spectrum dues into equity for Vodafone Idea. The centre's shareholding in Vodafone Idea has increased to 49% after this conversion. And now Airtel seems to be seeking a similar treatment. Today, Airtel was down almost 2% in trade. With that, let's take a quick break, come back on the other side, and we'll tell you about the key events to watch tomorrow. Welcome back. Let's now talk about some of the key events to watch and trade tomorrow, which would also include several important earnings. Abhishek is here with the list.
Well, to begin with, watch out for RBI. They'll give out the data tomorrow with respect to the banking sector's deposit as well as advances movement. Last time around, deposit growth was 10.25%, while the advances growth was north of 11%. Also, watch out for the forex reserve data that RBI will come out with. Last time, it was around $677.8 billion. We also have one stock going ex-dividend, which is Muthoot Finance. Interim dividend of rupees 25 will be adjusted to the stock price tomorrow. Earnings season, so watch out for key results tomorrow. RIL, that is Reliance Industries, Maruti, Cholamandalam, as well as Shriram Finance. Over the weekend, we have numbers coming in from IDFC First Bank, SBFC, as well as MRPL. Back to you.
Okay. All right, Abhishek, thanks very much for that. With that, it's a wrap on this edition of Markets Forward. Many thanks for watching. We'll come back with more news and updates in just a bit.
Hello and welcome to Business 360. I'm Shriram Finance. The headlines that we're tracking for you this evening.
We will pursue them to the ends of the earth.
Prime Minister Modi vows to punish the perpetrators of the Pahalgam terror attack, which left 26 people dead. The Kashmir police say 2 of the 3 terrorists involved in the attack are Pakistani citizens. Home Minister Amit Shah and Defence Minister Rajnath Singh to brief all parties at a meeting this evening. The Indian Navy test fires missiles in the Arabian Sea as tensions with Pakistan escalate. India also suspends the Indus Water Treaty and downgrades ties with Islamabad. Pakistan's Prime Minister Shehbaz Sharif holds a meeting with top officials to discuss the response to India. The travel and tourism industry in Kashmir protests the terror attack with a rally and candlelight march in Srinagar. The Jammu and Kashmir Chief Minister Omar Abdullah requests other chief ministers to take extra care of Kashmiri students amidst reports of threats and harassment in UP, Himachal and Uttarakhand. China says there are no ongoing trade talks with the US. This a day after President Trump hinted at a potential tariff cut. Beijing calls on the US to cancel its unilateral measures. The Sensex and the Nifty snap a 7-day winning streak to end at the low point of the day. Stocks decline across large parts of Asia and Europe as the relief rally stalls worldwide. FMCG major HUL meets estimates in Q1, 2% volume growth higher than expectations. Nestle's revenue growth remains muted due to rising commodity prices, but the company exhibits operational resilience. Bharti Airtel dials the government over pending spectrum dues worth 74,000 crore rupees, seeks the conversion of the dues into equity similar to Vodafone Idea. That's a CNBC Awaaz exclusive. Tata Power's CEO Praveer Sinha sees an opportunity to supply solar modules to the US and other markets and is contemplating capacity expansion. Also expects to have a nuclear power generation unit up and running by 2030. That's an exclusive. 9 people, including children, killed in Ukraine's capital of Kyiv in a wave of Russian strikes. Ukraine's Zelensky cut short a trip to South Africa. President Trump blames Zelensky once again for the failure to strike a ceasefire deal. India has mounted its diplomatic response against Pakistan on the back of the Pahalgam terror attack. Prime Minister Modi vowing to pursue perpetrators till the ends of the earth. The spotlight continues to remain on the aftermath of what has been India's deadliest terror attack on civilians since the Mumbai 26/11 attacks. Prime Minister Modi, during a rally in Bihar, issued a warning to terrorists behind the attack that left 26 people dead and several injured. The Prime Minister said India will identify, trace and punish each terrorist and their backers in a manner that they cannot imagine. As per the Jammu and Kashmir police, 2 of the 3 terrorists involved in the attack are Pakistan citizens. Remember, the Resistance Front, an offshoot of the banned terror outfit Lashkar-e-Toiba, had claimed responsibility for the attack. India has already taken steps to downgrade ties with Pakistan by suspending the Indus Waters Treaty of 1960 and closing the Atari checkpost. Further, Pakistani nationals will not be permitted to travel to India under the SARC visa exemption scheme. Foreign Secretary Bikram Misri said that those currently in India on a visa have time until Friday to leave the country. Reports suggest that India has also summoned the Pakistani envoy and handed over a persona non grata note for its military diplomats. Pakistan's Prime Minister advisor Sartaj Aziz has referred to India's suspension of the Indus Waters Treaty as an act of war. Prime Minister Shehbaz Sharif chaired a meeting of the National Security Committee in Islamabad today. Home Minister Amit Shah and Defence Minister Rajnath Singh separately will hold a meeting this evening to brief all parties on the matter. Amidst heightened tensions between the 2 countries, massive protests have erupted outside the Pakistan High Commission in Delhi. Protesters chanted slogans against Pakistan. An army personnel has been killed in an encounter between security forces and terrorists in Udhampur. This comes less than 48 hours after the Pahalgam attack.
India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished.
Well, that's the Prime Minister. Now, the Indus Waters Treaty, a pact signed between India and Pakistan over 6 decades back, is in focus as India mounts its diplomatic response on the back of the Pahalgam terror attack. Parikshit is standing by now to take us through the significance of the treaty and what its suspension means for both nations. Parikshit.
What is the Indus Waters Treaty? The objective of this treaty is to ensure satisfactory utilization of waters of the Indus system by Pakistan and India. It was signed between India and Pakistan on 19 September 1960 after 9 years of talks and brokered by the World Bank. The treaty was signed by then Prime Minister Jawaharlal Nehru and then Pakistani President Ayub Khan. As per treaty, India shall receive water from the eastern rivers Satluj, Beas and Ravi, and Pakistan is to receive water from Indus, Jhelum and Chenab. This treaty is critical for Pakistan as it gets 80% of water under the Indus Water Treaty. Pakistan is also heavily dependent on the Indus River system for agriculture and drinking water. Let's keep in mind that Pakistan is one of the most water-stressed nations in the world. Restrictions in river flows could threaten food security, lower crop production and water shortages in Pakistan. The treaty has been termed as unusually generous to Pakistan. 80% of the water allocated to Pakistan, and India is entitled to only 20% of the Indus system water, even though the rivers originate in India. According to reports, even Mexico receives a far smaller share of water under its treaty from the US. What does India's suspension of the treaty really mean? India, for the moment, can stop sharing water flow data with Pakistan, such as flood data. India can also create storage infrastructure on the Indus, Jhelum and the Chenab rivers. India could stop visits by Pakistani officials to hydroelectric projects currently under construction in Jammu and Kashmir. But the suspension will not have an immediate impact on flow of water to Pakistan for at least 2 to 3 years. This is what experts tell us. What are the legal options under the treaty? The treaty cannot be abrogated unilaterally. The modification requires consent of both Pakistan and India. Grievances can be referred to a permanent Indus commission. Parties can approach a neutral expert or arbitrators. Experts say Pakistan cannot approach the International Court of Justice if India shuns the treaty. I spoke to P.K. Saxena, who is the former Indus commissioner for India, and this is what he had to say.
It's just like water is just not like a tap on tap of principle. It does not work like that. So once the treaty has been put on suspension, then India will definitely, our engineers are good enough. They will definitely go for certain ways and they will make changes in the design of the projects. Because no restrictions is applicable on us now. So it will take some time. But definitely the work can begin right now. And the result will be visible on ground maybe in a beginning from a week till maybe around 2 years or so.
Right. Immediately, sir, what could we do when we suspend cooperation under the Indus Water Treaty? What are some of the things that we can immediately do in terms of sharing of data, including visits of officials? What can be stopped?
Immediately what we can do is, rather we might have already done is, we will stop sharing of the data. So this data is important to Pakistan, particularly the flood data that we share with them. So this, the time of flow between India and Pakistan is quite less. So if we don't share the flood data with them, there are likelihood that flood damages will occur in Pakistan. So this is one thing that we can do immediately. And there are a host of other things like we can stop meeting them. So there are a number of issues that crop up during the meeting. So there will not be any meeting. And there will not be any kind of tour on either side.
But we can't revoke this unilaterally, sir. Will this have to go to World Bank? Because it has to be done by mutual consent. And if we revoke it or abrogate it unilaterally, what can happen?
Regarding your revoking the treaty, abrogation of the treaty, I admit that the treaty does not have such clause. Under Article 12 of the treaty, it is very clear that the treaty is perpetual. The treaty can only be replaced by another treaty. So, but there is a catch. The catch is under the Vienna Convention, Article 62 of Vienna Convention of the treaties. There is a provision that if the treaty is signed under the certain circumstances and those circumstances are not prevailing, one can revoke this treaty. So this treaty was signed during the atmosphere of goodwill, and now since goodwill does not remain and people are being killed, so definitely those kind of atmosphere is not there, and India has every right to suspend that. Obviously, they are going to challenge it, but we will fight it out.
Well, this is going to be something that we will have to watch closely. Now, former Home Minister and senior Congress leader P. Chidambaram says the terror attack in Pahalgam was intended to create a communal divide. Speaking to CNBC-TV18, Chidambaram said the Congress party supports the government in whatever measures it chooses to take.
Clearly, the government is pointing a finger at Pakistan, which is again expected and perhaps correct. So we welcome the measures, but it can't stop with these measures. Whatever option the government chooses, the Congress party will support it. The motive is to create panic among the people of India. The motive is to inflame communal passions. You know the kind of questions they asked of the tourists.
Jammu and Kashmir's Chief Minister Omar Abdullah has urged chief ministers of other states to take extra care of Kashmiri students. This appeal comes amidst reports of threats and harassment against students in UP, Himachal and Uttarakhand. In a social media post, Abdullah responded to a post saying that the government is in touch with other state governments on the situation. Many students took to social media to describe their ordeal and cited that they are scared for their lives. Tourists in the Kashmir Valley continue to flee the region after the terror attack in Pahalgam triggered panic. Reports have said that around 90% of the 20,000 hotel rooms went empty just 24 hours after the attack. More than 11,000 people have left Srinagar on 60 flights in the last 48 hours. The Kashmir Valley observed a complete shutdown after the deadly terror attack. Shops and educational institutions were closed. Locals and politicians were also seen marching down streets. Candlelight marches were held in parts of the valley. Students and staff of the Kashmir University also registered their protest against the act of grotesque violence. Meanwhile, the big international story, China has responded a day after reports suggested that the US was weighing a proposal to cut tariffs from the current 145% to between 50 and 65%. Now, China's Ministry of Commerce said, and I quote, "At present, there are absolutely no negotiations on the economy and trade between China and the US," end of quote. The statement said, and I quote again, "If the US really wants to resolve the problem, it should cancel all unilateral measures on China." Meanwhile, Treasury Secretary Scott Bessent said that there was an opportunity for a big deal here on the trade issues between the US and China. He said, and I quote, "If they want to rebalance, let's do it together." However, US President Trump, when asked about the current tariffs on China, said that it won't be that high. He added that a deal could bring substantially lower tariffs, but warned that if China didn't make a deal, the US would set the deal. Take a look.
They all want to make deals, and we're going to make deals. But they're going to be fair deals. They're not going to be rip-off deals. And by the way, if we don't have a deal with a company or a country, we're going to set the tariff. We just set the tariff. It's something that we think that will happen, I'd say, over the next couple of weeks. Wouldn't you say? I think so. Over the next 2-3 weeks. We'll be setting the number. For and China. We're going to pick, could be for China too, could be for China. We're dealing with almost all of them. Too many to fully deal with, but we're going to be fair to them. But we're dealing with a lot of countries right now, and could be with China.
There is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, and if they want to rebalance, let's do it together. This is an incredible opportunity.
Scott Bessent. And back home, the Sensex and the Nifty snapping a 7-day winning streak today as the relief rally stalled across the world. We saw a sharp sell-off in late trade on expiry day, forcing both indices to end at the low point. So that's the Nifty down 82 points. The Sensex lost about 300. The Nifty Bank giving up about 168, and the mid-cap index closing absolutely flat. That's the story for the day. But remember, we have, of course, seen a 7-day up move for our markets. Crude prices edged up higher after falling by 2% on the previous day. This after reports suggest that OPEC Plus was mulling ramping up production in June. The prices were also supported by a potential de-escalation in the US-China trade war. Gold prices, meanwhile, rebounded as investors bought the dip a day after the bullion hit a one-week low amidst optimism over the US going easy on China. The dollar index also slipped, making gold more affordable for overseas investors. And Bitcoin broke its 3-day gaining streak and fell to the $92,000 mark. Other cryptocurrencies, including Ethereum and Ripple, have also taken a little bit of a breather. FMCG major HUL met estimates in Q1, 2% volume growth coming in higher than expectations, and Nestle Revenue growth there remaining muted due to rising commodity prices. However, the company has exhibited operational resilience. Mangalam is standing by now to take us through both HUL and Nestle and what that means for India's consumption story. Mangalam.
Well, if you look at HUL, the results were largely in line with very muted expectations of 2% revenue growth, 2% EBITDA growth itself. There were a couple of bright spots and a couple of near-term concerns as well. For HUL itself, the bright spot was that volume growth came in at 2% versus expectations of 0 to 1%, even though revenue, EBITDA and net profit were all in line with expectations. The near-term concern and the reason why the stock was lower is because the company said that they will shave off gross margins to improve the value proposition to pump prime growth ahead, and as a result of which the EBITDA margin guidance for the next few quarters from 23 to 24% stands at around 22 to 23% itself. The big bright spot, however, is that they see growth returning in a lot of the categories. In fact, the first half of the next financial year, they expect growth to be better than the second half of FY25 itself. So those are a couple of factors that stood out for HUL. The stock lower, but one would have to look at growth in the next 1 year to see whether the brokerages will up their estimates despite them reducing their margin guidance as well or not. For Nestle, the top line was fairly muted, though operationally the company did report some sort of resilience. There was, that 2 to 3% top line growth that came in largely in line with expectations. Volume growth came in at 2% as well. But the gross margin compression at 62 basis points was a lot lower than what the street was factoring in, despite the sort of inflation that we saw in both cocoa as well as coffee. And the company did say they saw double-digit growth in their confectionery as well as beverages portfolio, along with the pet care portfolio as well.
The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro.
Well, some silver linings there as far as both HUL and Nestle's earnings are concerned. Cement major ACC's net profit in Q4 fell by 2% year-on-year. The profit included a one-time gain of 135 crore rupees. Revenue grew 12% compared to the same quarter last year. The cement firm declared a dividend of 7.5 rupees per share for FY25. Now, here's a CNBC Awaaz exclusive. Bharti Airtel has written to the government about its spectrum dues worth 74,000 crore rupees. CNBC Awaaz reports that Airtel is now asking the government to convert its spectrum dues into equity. The government had earlier converted spectrum dues into equity for Vodafone Idea. The centre's shareholding in Vodafone Idea increased to 49% after conversion of dues to equity. Now, Airtel is seeking a similar arrangement. We will have to wait to see how the government responds to this. Now, the Enforcement Directorate has conducted raids at 8 locations connected to coaching institute FitG as part of a money laundering investigation. The probe agency has said that the allegations include the diversion of funds taken from coaching centres towards personal gains or other entities. The raids follow FIRs filed after the abrupt shutdown of several coaching centres, which sparked outrage from parents who paid advance fee without receiving refunds or a notice. Ola Electric faces regulatory heat once again. This after the government sent the 4th letter for running showrooms without trade certificates. We learned from sources that Ministry of Road Transport, that's the central ministry, has asked the EV maker about the number of stores it has in India and whether each of these stores has a valid trade certificate. That's not all. The government has also sought more details regarding discrepancies in registrations and has asked testing agencies to examine complaints against Ola Electric. We will head to a break, but up next, 9 people, including children, killed in Ukraine's capital of Kyiv in a wave of Russian strikes. That and more when we get back. Israeli forces have continued to deepen their offensive in Gaza, killing at least 45 Palestinians and injuring more than 100 in the last 24 hours. Forces have also carried out raids in the West Bank, arresting dozens. More than 61,000 people have been killed in Gaza since the war began 18 months ago. At least 9 people have been killed and over 70 others injured after Russia launched a massive missile and drone attack on Kiev overnight. Kiev's mayor said extensive damage was caused to infrastructure and rescuers pulled survivors out of the rubble. Ukraine's President Zelensky cut short his trip to South Africa after the attack. President Trump has criticized Ukrainian President Zelensky's refusal to recognize Russian control of Crimea. In a post on Truth Social, the U.S. leader said that Zelensky's stance on the matter will harm peace negotiations. Speaking to reporters, Trump said that Russia had agreed to a peace deal with the U.S. He added that Kyiv has yet to agree to a deal, maintaining that Zelensky has been harder to deal with so far.
But we're losing soldiers, a lot of people. And if I can solve it because of a certain ability, that would be great. And if it doesn't happen, I will say that I think Russia is ready, and a lot of people said Russia wanted to go for the whole thing. And I think we have a deal with Russia. We have to get a deal with Zelensky, and I hope that Zelensky, I thought it might be easier to deal with Zelensky. So far it's been harder, but that's okay. Look, I just want to see the war end. I don't care. If they're both happy, they both sign an agreement. I have no favorites. I don't want to have any favorites. I want to have a deal done. I want to save the lives.
That's President Trump there. And back home, payment banks have now renewed their request to the government and to the Reserve Bank to ease regulatory constraints. Government sources tell CNBC-TV18 that their asks include a cut in the statutory liquidity ratio and the permission for small ticket lending. Sapna is standing by with more details. Sapna, what is on that wish list?
Absolutely, and this has been going on for quite some time. We are now given to understand some more specifics on this. So basically, what happens is that payment banks historically 75% of their deposits, and they're not allowed to take term deposits. So basically, CASA, your savings accounts and your current accounts, 75% of that is held in government securities as SLR, and the remaining 25% they're supposed to maintain with commercial banks. There is no other investment option as such that the payment banks enjoy. So a twofold demand coming in very clearly that basically reduce the SLR to more reasonable levels, quote unquote. This could be around 50-odd%, something on those lines. And second, of course, is basically to give them more investment avenues. Basically the option of investing in AAA rated bonds, just like the way the commercial banks to an extent are able to manage that. So, this is one aspect of that. Second, of course, again, in terms of the fact that they wanted deposit limits to be increased, although that has been widely reported, 2 lakhs is what they're allowed right now. It should go up to 5 lakh odd rupees because, that will basically expand the gamut of customers for them, and that is what they need to earn that interest and, kind of churn their investments and so on and so forth. It's a complex revenue model that these guys have. So that's the second aspect. What comes in, of course, is also their recurring demand to be granted a small finance bank license. Now, here it remains to be seen whether the RBI will soften its stand. We know what has happened with the Paytm Payments Bank, so that's something that we need to wait and watch and see. However, the end point here also remains that the government at some point in time may, like to have a conversation or discussion with the banking regulator in terms of a possible reassessment of the revenue model of these payment banks. It's been 10 years that they have been in business. The world has changed. So probably some of those regulations need to be tweaked. That's the sense that we have gathered. We'll have to wait and watch and see what really unfolds.
All right, Sapna, appreciate you joining us. And more from a bank's private lender, IndusInd Bank, has reportedly halted onboarding new microfinance institution customers since January. According to Money Control, the bank's board took the decision earlier this year based on the feedback received by the Reserve Bank. The bank also did not underwrite new MFI loans sourced by its microfinance unit. A fire broke out within the premises of BHEL's Bhopal unit. Visuals which surfaced on social media showed massive smoke coming out of the premises. Reports suggest the production is likely to be impacted at the plant. Firefighting operations currently underway. The cause is yet to be ascertained. The Delhi High Court has directed pharmaceutical firms to issue advisories to doctors, chemists and retailers stating that fixed-dose combination cough syrups must not, under any circumstances, be administered to children below the age of 4. Additionally, the court has ordered the manufacturers to publish clear and prominent notices in 2 national newspapers, one in English and one in Hindi, with nationwide circulation. The National Stock Exchange has revised the eligibility criteria for companies who can move from the NSE SME platform to the main board platform. The revised eligibility criteria mandates that SME companies must be listed on the SME platform of the exchange for at least 3 years. The small company should also have a paid-up capital of 10 crore rupees to qualify for the main board listing. Further, the total number of public shareholders should at least be 500 on the date of the application. And with that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC-TV18. From all of us here for now, thanks very much for watching.
Hello and welcome to Market Masters. Today we are in conversation with the top markets team at Nomura. It has been an incredible last few weeks. Massive, not exactly reciprocal tariffs, stock market selling off hard, bond markets throwing a big tantrum, a 90-day tariff pause, markets snapping back globally, with the exception of US assets, dollar US assets, which kept getting sold, and over the last few days, some repair and recovery in US assets as well. A complete roller coaster. What is the roadmap from here? Is there a roadmap to begin with? It's my pleasure to speak with the top team at Nomura. We have with us here Rob Subramanian, Head of Global Markets Macro Research at Nomura. Craig Chan is Head of Global Forex Strategy. Sonal Verma is Chief Economist, India and Asia, ex-Japan. Sayan Mukherjee is India Head of Equity Research. Sonal and gentlemen, thank you very much, all of you, for being here. It's been an absolute roller coaster ride. And, I was joking, saying that I'm getting up earlier and earlier every day and getting to office later and later. so much overnight news to digest, right?
Yeah, it feels like what's happened in the last 3 months usually takes 3 years or longer to happen.
Yeah, I mean, and you think of it, it's what, only 10%, not even 10%, 5% of Trump's term, 4-year term?
Yeah.
I mean, if you calculate the number of days. So we're just in the beginning. These trade deals now, I think, is what markets are focused on, Rob. What's your sense? Are they going to get done quickly? Because markets are swinging between optimism to despondency. What is your sense?
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%, they don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, you know, tariffs are going to have a big macro effect on the US economy and economies everywhere this year is our bottom line.
So with China, we've been hearing what we've been hearing over the last 48 hours. Should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was before election said 60%. So will we get down to 60? What I mean,
we could get down to 60, and that has been our kind of a longer term baseline around 60. But the point we'd make is that's still extremely high, and that is going to lead to a lot of, I think, particularly for the US, a lot of inflationary effects. And is going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates. We've just added another 2 cuts for the ECB this week to our forecast. Many central banks we have essentially cutting while the Fed's on hold.
Got that. And do you expect a recession in the US? Or you think we won't get it? I think your house view is that you escape it, but you get pretty close to it, but don't actually see it.
That's where we are right now. So it's very close. So if you look at our growth forecast for Q2, Q3, Q4, it's 0.1% quarter on quarter. So not much margin of error for negative growth numbers there. So very close to recession. We'd put it around a 40% chance.
What happens on the 4th of July? You said no deals. 4th of July is when the 90-day sort of tariff pause expires. So we get another extension and then these negotiations.
I mean, I think between now and then there could be some deals. But what I'm saying is I don't think all the reciprocal tariffs are gone. I think that some will be coming back.
Okay. I mean, what is Craig, welcome to the program and great speaking with you. What is your sense in terms of how, I mean, bond markets threw a tantrum and it looks like there is a bond put but no put for equities. Is that the way to look at it? Because as Rob is saying, this is a long drawn-out process, and the big deals are with EU and China, and what really matters for global growth, etc. And if they take a long time, I mean, growth may suffer and markets may swing as well. But have you seen the worst in that sense, dollar assets?
No, I don't think we have. I mean, I just say that what we have seen so far is actually just evidence of some outflow. Right? It's definitely not been broad-based. It looks like it's mainly on the bond side, where there has been some selling from the Japanese investors, from Taiwanese, to some extent Korea as well. But it hasn't been really excessive. There hasn't been much kind of equity-related selling. Overall, in terms of looking at kind of the value of assets in the US, still exceptionally high. You know, we're talking about the last numbers we have. They're quite old, but I mean, it's like 33 trillion US dollars of foreign investment value in bonds and equities. I mean, it's just surged in the past few years. I think we're starting to see some signs of that unfold.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. The data is actually
investors,
mixed. It's actually quite mixed. But you know, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of an offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind. But I just say quickly, beyond the asset unwind, there's also another element around it, and that is there's a lot of investors that put money into the US that actually haven't hedged out the FX risk. Japanese life insurance companies have low FX hedge ratios. Taiwanese life insurance companies have low FX hedge ratios. So that's another risk. They could start selling more dollars to hedge out the FX risk.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities are being. It was basically almost get out of the US.
So that phrase US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading, but at the end is still quite, I think of a push. It's a push to say that.
Because even if, Rob, everything goes back and they say, well, we've made deals, etc. I mean, it's an issue of trust, right? Suddenly you've thrown everything up in, it's kind of, isn't that is the heart of the issue here. When we say US exceptionalism, I mean, the exceptionalism was about the trust in the systems and the institutions, etc.
I think US exceptionalism means different things to different people. Yeah. I was going to ask you what you mean by that, because
to some people it just means tech exceptionalism.
It's true, right? Exactly. And then for others it means the economy. And US is facing stagflationary effects, which is bad. But then the worst case of US exceptionalism is what I think you touched on, Prashant, is foreigners losing trust in the US dollar as the global reserve currency. And as Craig said, I don't think that's clear yet. But in terms of the US economy starting to wobble and less scope for policy support for it, I think that's quite a valued concern right now.
There's been so many different angles, right? It's been from the DeepSeek fears and the impact on AI. Then it moved to tariff policies, non-tariff policies. Then there's concerns about, am I going to get taxed on, if I'm holding US Treasuries? It's just a lot of policy, as you mentioned, policy uncertainty for investors. And that is going to reduce the effective overweight that we've seen in US assets for many years. And that's what's happening now.
Fair enough. Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, relative to a number of our competitors, we do have an upper hand.
I just add that, from what we've heard from the White House as well, it's quite clear that India and Japan are way ahead of the rest. There's 185 countries which have had these reciprocal tariffs. 32 are under discussion. So India is by far ahead.
And the hit to the GDP, etc., is also, about 0.4, but of course, it's a moving number. It's a moving target, right? Does the tariff stay?
Yeah, the direct impact is 20 to 30 basis points, but usually in these scenarios, it is the indirect impact that is more important. So whether it's world growth slowing down, hit on IT services, hit on investments, confidence, uncertainty, etc. So for FY26, our view is GDP growth is likely to slow below 6%. So we're expecting a 5.8%. It is below what consensus and the Reserve Bank are looking at right now. But of course, we've made much bigger growth downgrades in rest of Asia, which are more open economies. So of course, on a relative basis, we should be better off.
Yeah, to put that in context, India, a bit below 6% growth. We're thinking China in the coming quarters is more like 3.5%. As I said, US is close to zero. So, yeah.
Europe, Germany is zero. I mean, I think many other parts of the world
That's right, yeah.
is doing much better. Sign for equities. We're again back to, I mean, equities are snapback, right?
Yes.
And FIs are coming back, about a fraction of what they've sold over the last 8 months or so.
Right.
But they're coming back.
Absolutely.
But, you know, very quickly here we tend to go back to high valuations and you're suddenly scratching your heads, now what, right? And you're waiting for earnings. I think your expectations in terms of earnings is lower than the street. That comes off the 5.8% number from Sonos.
Yes. So, yeah, Prashant, so basically, when we look at, through the pandemic, like, from fiscal 19 to 24, we had an, very strong earnings growth, north of 20%. Last year was a slowdown, fiscal 25. Now, fiscal 26 and 27, again, the expectations are around, mid-teens earnings growth. So if you look at, there's a lot of catch-up in earnings which has happened over the last 4-5 years. And if you remember the entire decade from 2010 to 20, we were struggling with corporate earnings, right? Consistent earnings cut. It was bound to happen, natural, sort of going back to a natural level of earnings and ROEs was bound to happen, and it happened over the last few years. So earnings to GDP ratio has bounced back. In fact, it's now very close to 2008, which is, just before the global financial crisis. With the kind of uncertainties, that we are currently dealing with, and if you look sector by sector, right, the profit margins are, on the higher side. And we are seeing downgrades there. So therefore, I think that, earnings to grow substantially above, let's say, a nominal GDP growth of around 10% looks challenging, at least in the near term. And that's why we think that we will continue to see earnings downgrade. And on your question on valuations, right, I guess, currently we are just shade below 20 times 1 year forward earnings. We have breached 20 times in the past, especially the last few years. But I think, it's very difficult at this point to, foresee that level of valuation. So far, if you look at, there are, certain things which are in favor, like for bond yields are falling, which is positive for valuations. And the risk premium actually hasn't really flared up. It's still behaving.
But that's a risk. That's a risk.
That's a risk.
And your view, Sign, is local, focus on local sectors, right?
Absolutely.
And consumption, etc. And we'll talk more about that. I had to take a very quick commercial break, here. So allow me to do that. So take that break back with the Nomura top team in just a bit. Welcome back. We're in conversation with the top brain trust at Nomura. So we're talking top-down, macro, economics, and of course markets as well. Thanks very much, Sonal and gentlemen, for being here on this program. I want to just talk about, Craig, if I can ask you, trade wars are also, in a way, capital and currency wars in that sense. I mean, if this were to continue, what is your sense? Can this, and the Trump administration and so many others, have said it's not about tariffs per se, it's about non-tariff barriers, with countries like Japan, etc. It's also perhaps about the currency. We don't know. Will this devolve into something sort of bigger as we go forward? Because this will take time to work itself out.
Yeah, I mean, there's been quite a bit of discussion about this kind of Mar-a-Lago Accord, but then it's not really intensified because it's really been from if you want to say the economic advisor rather than from the top level treasurer and others actually pushing it, as even Trump himself. But I would think that if we have further discussions around this, the market could really take this seriously and start thinking about who exactly would be the ones that would be kind of going along to effectively strengthen their currencies against the dollar. But for Japan, there is a lot of focus on it at this point in time, particularly with...
you think at some point in the next 2 years, we will see a revaluation with countries like Japan, even China? I don't know. Is it possible?
I mean, the US Treasury Secretary's already talked about this yesterday, saying that he doesn't have any particular levels that he's looking at for the Japanese yen. But having said that, if it's about, we don't want you manipulating, we want the market to drive the exchange rate, there's still a lot of risks around that because there is, this potential downside pressure on dollar yen, where if there's a sense that there cannot be a buying of dollar yen from the Ministry of Finance, BOJ, then actually it can be a bit of an overshoot. And then the adjustment comes naturally. So I think for dollar yen, that's definitely one that sticks out to us. The rest, not so convincing.
Okay. Rob, cost of borrowing, right? I mean, there's a lot of debt coming to be rolled over later this year. And that was one theory, that they want that cost to be lower. What is your sense? Is this success, what we've seen so far, or will we see...
I think the jury is still out on long-term cost of borrowing in the US. I think, on the one hand, there's a lot of talk about recession. We're saying it's close. If the US economy does go into a recession and expectations build of the Fed having to cut rates a lot, you could see Treasury yields come down a lot further. But on the other hand, the perverse situation we've seen in recent weeks where you've had equity markets going down, but 10-year bond yields going up, is raising concerns that maybe risk premium is building in the US. And whether that's because of the fiscal situation or because, as we talked about before, maybe loss of trust or loss of confidence in policy making in the US, that can play a role as well. So I think right now, my biggest suggestion to you is it's going to be very volatile, I think, at the long end of the US curve.
Is it really possible, Rob, that President Trump does not care about the stock market? In his first term, I think we used to see him waking up in the morning and mentioning the Dow, right? And he was proud about how high US markets were doing. Not this time, nothing. There are midterms as well. Sure. I mean, the one theory is take all the pain up front, and then, the good stuff comes later, around the time that the market... I mean, you'd want the markets to do well, right? By the time we get to the midterms. You don't
want the markets and the economy to do well by then. But yeah, I think, of course, I think everyone would like, all leaders would like their stock markets to be at all-time highs. I think the challenge right now is Trump has shown his hands a little bit with this so-called Trump put. He's come in to try to soothe markets a few times now. And I think the risk is if he really wants to achieve a lot of his longer-term goals, which are going to be disruptive for the economy, markets may test the credibility of that Trump put again and may be disappointed. If he really wants to achieve his longer-term goals, there may need to be economic pain up front.
There's been some talk, Rob, about Main Street versus Wall Street, that maybe, is that credible, you think? I mean, that maybe Main Street is the focus and, Wall Street perhaps takes a backseat.
I think that's one way to spin the narrative, right? To say Wall Street has to take some pain. We're trying to bring manufacturing back, jobs back, boost the manufacturing sector, help Main Street. Another narrative is to blame the Fed, say the Fed should be cutting rates in this environment. So there's a few things here where you can deflect the blame a little bit, I think. But I think ultimately it's going to be very interesting in the coming months. One of the concerns I have with all the tariffs is Main Street, not Wall Street so much, but the small companies that are not listed on the equity market could face a lot of cash flow problems as their costs because of the tariffs go up.
Absolutely. Sonal, what is your sense? Will this China plus one is not new, right? But it's again, I think, got one more lease of life. Is that going to happen? Manufacturing and companies, supply chains moving to India?
I think it's already happening, and the smartphone is a clear example. Even if China tariffs come down, but they stay, let's say, at 60% for the next 4 years, that automatically means that manufacturers will need to look for an alternative, because for the low and the mid-tech manufacturing segments, and I would include the entire bunch of electronics, toys, textiles, footwear in it, these are low-margin businesses. You cannot work with 50, 60%.
In 2018,
tariff.
the shift happened to Vietnam and Cambodia, especially footwear, textiles, etc., right?
That's
out of
right.
China.
That's right. But it was also a lot of the Chinese firms themselves that were investing and trading via Vietnam and Cambodia and Thailand, which is one reason why I think actually the reciprocal tariffs on these countries is fairly high. So this is different from Trump 1.0, i.e.
The main difference is substantially higher tariffs in China. I mean, even if it is not 145, but it's not 10, it's not 20, it's higher.
Exactly, which is actually the US goal of strategic decoupling from China, which is tariff on China and higher tariffs on countries that are allowing transshipment to happen, on behalf of
So basic
China.
manufacturing, essentially, right?
I think, yeah. So what we call essentially the low-tech, mid-tech manufacturing. So smartphones, but the broader electronics, you could think about personal computers, printed circuit boards, more high-end legacy kind of semiconductor chips. Toys, China has a market share of 60% in the world. We are at 0.3%. I think there's substantial scope for India to gain on this front.
Sayan, for an equity investor, what does this mean? I mean, this is all obviously, it'll take time, right, to play out. But in some sectors, maybe we will start to see...
I guess, equity investors do look at long term, right? So I think that narrative of China plus one, and as you mentioned, that, probably we haven't seen much of success. But the thing is, we are probably better prepared now. And with the differential tariffs, if it comes in, maybe we get a boost, on that. So I think that narrative can sort of, continue. So I think from a equity portfolio perspective, I think this China plus one themes, should be there. I think, though I know some of that are expensive, but they're still delivering on earnings, unlike many other spaces where we are seeing earnings cut. And if this narrative sort of sticks on or gets a little bit of more boost and people get more confident, I think that's one space, we think one should be positive on. But otherwise, I think wherever you have international demand-related concerns, right? I think whether it is IT services or anything where, you are exporting and you could see a sudden fall in demand, I think that's the space to avoid. So that means, one has to look more domestically and focus on more domestic, sectors.
Sonal, to the point of, and so Science said he likes consumption as a play as well. Do you think the RBI, of course, has done a lot to ease liquidity, but credit demand is still slow? Do you think more needs to be done? What is your feedback? Are things going to pick up a little bit in terms of domestic demand itself, or it needs help, more help?
Transmission takes time. So this turn in, policy and liquidity is just 2 months old. Usually transmission takes like up to 9 months. And now you're fighting these global headwinds. So, the effort will need to be double what we thought previously.
So double RBI plus government?
I think mainly RBI, but I think the combination of the rate cuts plus liquidity in terms of, faster transmission. And within consumption, the urban discretionary is more sensitive to global fluctuations, job market, but the rural side, can be a defensive. Of course, in this environment, low inflation is a fairly, big positive for real incomes on the consumer side. So relative to exports and investment consumption, as Shan was saying, should be, better off in the next 12 months.
Last word, Sonal, to you. How long before we see a deal? I mean, do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. COVID hit in Feb. We got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day, but the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
Yes.
All right, fair enough. Sayan, Sonal, Craig, Rob, thank you very much. I have a lot more questions, but completely out of time. So we need to do one more of these over the coming weeks, months, and I think it would be lovely to do that. Thank you very much.
Thank you.
Bye.
Loved it.
Well, that is Market Masters, the Nomura Brain Trust. Thank you very much for staying with us. More coming up in just a bit.
You're watching News Center with me, Parikshit Luthra. The ties between India and Pakistan have come under severe strain yet again. India is mounting a response to the tragedy in Pahalgam, the deadliest attack on civilians since 26/11 in Mumbai. Jammu and Kashmir police have said that 2 of the 3 terrorists involved in the attack are Pakistani citizens. The Cabinet Committee on Security, India's highest decision-making body on national security matters, has unleashed its response against Islamabad on several fronts. The Indus Waters Treaty has been suspended. All visas to Pakistani nationals have been cancelled. India has also downgraded its diplomatic ties with Islamabad by reducing its mission strength. Pakistan has been asked to do the same. Pakistan has termed the suspension of Indus Waters Treaty as an act of war and have shut down its airspace to Indian airline companies. Islamabad has also suspended all bilateral agreements with India by keeping it in abeyance. We will be discussing all the key developments in the aftermath of the Pahalgam terror attack. But first, here's Prime Minister Modi promising to identify, trace and punish each terrorist and their backers in a manner they cannot imagine.
India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished.
All right, joining us right now, former Secretary, Ministry of External Affairs, KC Singh, and Strategic Affairs expert, Brahma Chilani, with us. Brahma Chilani, if I can come to you, a very strong response there by the Prime Minister, his first statement since the Pahalgam attack. Speaking in English this time, went on to say that we will search for these terrorists everywhere and we will retaliate in a manner that no one can even imagine. Your thoughts on the Prime Minister's response?
Is responding to the national anger. The massacre in Pahalgam, the victims have included people from 14 or 15 different Indian states. So there is national outpouring of anger, and there is anger even in the Kashmir Valley. We have never seen that before. Candlelight protest marches against what happened in Pahalgam, the way these terrorists have undermined the Kashmiri economy by conducting this strike, because now the tourists are fleeing Kashmir Valley. So there's anger even in the Kashmir Valley, and the Prime Minister is reflecting the public anger by making the kind of statement that he has made today.
Right. What do you think India should be doing in these circumstances? You know, we have seen a series of attacks by Pakistan. We saw Uri, we saw Pulwama, we've seen Pathankot. Now, considering that civilians have been massacred, shot at point-blank range, what more does India need to do after taking some of these diplomatic steps? A lot of this was on expected lines. In fact, certain experts are telling us that suspending Indus Water Treaty has been on the table since the Uri attacks, because India feels we're not getting really anything out of it, and it's better to, abrogate it altogether.
You're right. After the Uri attacks, Prime Minister Modi had said publicly that blood and water cannot flow together. But 8 years have passed, and even now, India has not suspended the treaty. It has placed this treaty in abeyance. Now, placing a treaty in abeyance, it's unclear what that means in terms of international law. But international law provides India sufficient leeway to withdraw from the treaty. International law is clear. When a treaty's foundational conditions collapse, or when one party persistently breaches the terms of a treaty, then the other party has the right to suspend or withdraw from the treaty. To those questioning the legality of India's position, the answer lies in international law itself. After all, international law is not a suicide pact. The Vienna Convention on the Law of Treaties, which codifies into customary international law, allows a state to withdraw from a treaty if the other party has committed a material breach or if there has been a fundamental change in circumstances. The Indus Waters Treaty, as we all know, was founded on hope. It was founded on the hope of ushering in subcontinental peace. But this treaty has only weighted Pakistan's territorial ambitions. If 5 years after the treaty was concluded, Pakistan actually began a full-fledged war to grab J&K from India. And since then, this treaty has been used by Pakistan to argue that Pakistan should have the control of the territories from where these rivers flow into Pakistan in order to achieve water security. In other words, a treaty built on hope has become the foundation for Pakistan's territorial revisionism. And that's the paradox that India faces. And I think this step of placing in abeyance raises the question as to why India did not go full hog and withdraw from this treaty.
Right. Let me get in Ambassador KC Singh at this point. Ambassador KC Singh, as we speak, we're getting these pictures of, cars of envoys of P5 countries, G20 nations arriving at the Ministry of External Affairs. They are being briefed about the findings by investigative agencies in the Pahalgam attack. What do you think is the importance of this exercise to get foreign envoys on board?
I think it's a usual exercise. I don't think there's nothing that you can tell them which they don't know already. There's more of for optics, you convey it, those countries know it, their leaders have called the Prime Minister. So I don't know what additional, unless you have some additional information, intelligence, which you can share with them and tell them that there is a direct link to Pakistan and this is trans-border. That may be the only purpose, so that they can tell their countries that Indian indignation is fully justified in naming Pakistan. So we don't know what exactly is going to be told to them. If it is simply whatever has already been told, then it's really the normal thing you do in diplomacy. You call in the ambassadors of different countries. You're building up public opinion. But I don't think Pakistan gives a damn about that.
Right.
Public opinion, we've been built, yeah.
Right. We are also getting these pictures of Shehbaz Sharif, the National Security Council meeting that took place in Pakistan. Following that, the government of Pakistan had said that in case India restricts the flow of water under the Indus Water Treaty, it would be termed as an act of war. Any attempt against Pakistan's sovereignty would be met with very, very strongly. The airspace has been shut down for Indian airlines as well. How do you see the statements which have come from Pakistan today, or do you feel this is all on expected lines?
No, this is retaliation is expected from them. You saw the speech of their army chief. He was belligerent. He was aggressive to the point of, talking about Kashmir being their jugular vein and so on and so forth. So out of nowhere, he had come up with that. Therefore, they've been doing it for a while. There are different reasons for it. They've been, but then you see also we have to look at it from our point of view. For 5 years, we've completely ignored Pakistan. We thought this whole issue has gone away and that's it. And we can just carry on with our lives. But when you have outstanding historical disputes with neighboring countries, you can't just wish them away or simply ignore them and say, it's just gone away. Because we thought they're busy with Baluchistan, they're busy with the Taliban, they're busy with the TTP and so on and so forth. And then came this signal where the army chief was speaking aggressively. So quite clearly, he had already given the green light to the ISI. Otherwise, he won't speak. Something like this can't be done overnight. They must have had extensive planning for it. So this is, Pakistanis are bringing Kashmir back as an international issue so that it's not forgotten, because till now nobody was discussing Kashmir. You're discussing Ukraine, you're discussing Gaza, you're discussing Trump's tariffs. Kashmir had just gone off the radar. So this is Pakistan trying to bring it back. And the more you escalate it, the more they would like it, because then the escalation allows them to bluff and talk about retaliation, talk about attack. So this is along expected lines.
Right. Brahma Chelani, this is a pattern that we always see. And we spoke to Mr. P. Chidambaram, the former Home Minister, earlier today, and we'll be playing that interview out shortly. And he said that the manner in which the innocent civilians were targeted by Pakistani terrorists, this is all on expected lines. It has happened earlier. The modus operandi is known. They are trying to divide the country along communal lines, cause panic in the country. Now, how does India deal with this in a strong manner so that it is not repeated every 5 to 6 years? We have 5 to 6 years, sometimes 3 to 4 years of peace. Then all of a sudden you see a ghastly attack of this kind. How do we make sure the ability to carry out such terror attacks is eliminated?
Well, first we need a consistent Pakistan policy. Have we had a government that has pursued a consistent Pakistan policy? I can't think of any government that we've had that has a consistent approach toward Pakistan. Let's begin with Vajpayee. He went in a bus to Lahore. Then he cried publicly that his bus to Lahore got hijacked to Kargil. Then came Manmohan Singh. He made all these peace overtures to Pakistan, only to invite the horrific terror attacks in Mumbai, which went completely unpunished. Then we had Modi landing in Lahore, unannounced. And his visit to Lahore, what did it do? It triggered a series of Pakistan scripted attacks on Indian military camps, including Pathankot, Uri, so several of them, several attacks happened. So why is it that every prime minister who takes office in India, instead of learning from the experiences of his predecessors, seeks to reinvent the foreign policy wheel by believing in his own ability, the power of his personality? He believes that he can make peace with Pakistan. He believes that he can make peace with a country that is founded on hate, There's no national identity. It defines itself in terms of what it opposes, namely India. But it cannot define itself, it's unable to define itself in terms of what it stands for. That's the reason why Pakistan doesn't have a national identity. So a country founded on hate cannot be a normal state, and yet successive governments in India, at the nation's expense, have sought to make peace with Pakistan. So is it any surprise that history keeps repeating itself? After every major terror attack, we have the same debate on national channels, the same arguments, the same questions, whether there will be retribution, etc., etc.
Yeah. We've completely run out of time, but thank you very much, Ambassador K.C. Singh and Brahma Chalani, for joining us. Clearly, there are strong questions there as to what we are going to be doing next. But as we have been speaking about the Indus Waters Treaty as well, we will get you an important interview after this short break. Don't go anywhere. Lots coming up on the other side. Welcome back. You're watching News Center. Now, India has decided to put the Indus Waters Treaty in abeyance, which means that we will be suspending our obligations under the Indus Waters Treaty. And this could mean we may stop sharing of flood water data, stop visits of officials. Whether we are going to abrogate it and withdraw from it completely, that remains to be seen. But let's listen to P.K. Saxena, who is the former commissioner for India under the Indus Waters Treaty. He laid out India's options. Listen in.
It's just like water is just not like a tap on tap off principle. It does not work like that. So once the treaty has been put on suspension, then India will definitely, our engineers are good enough. They will definitely go for certain ways and they will make changes in the design of the projects. Because no restrictions is applicable on us now. So it will take some time, but definitely the work can begin right now. And the result will be visible on ground maybe in a beginning from a week till maybe around 2 years or so.
Right. Immediately, sir, what could we do when we suspend cooperation under the Indus Water Treaty? What are some of the things that we can immediately do in terms of sharing of data, including visits of officials? What can be stopped?
Immediately, what we can do is, rather we might have already done is, we will stop sharing of the data. So this data is important to Pakistan, particularly the flood data that we share with them. So this, the time of flow between India and Pakistan is quite less. So if we don't share the flood data with them, there are likelihood that flood damages will occur in Pakistan. So this is one thing that we can do immediately. And there are a host of other things like we can stop meeting them. So there are a number of issues that crop up during the meeting. So there will not be any meeting. And there will not be any kind of tour on either side.
In terms of legal options that Pakistan has, if we stop sharing data or start building structures on these water bodies to stop the flow of water or divert the flow of water towards India, what we would like to ask you, sir, is does Pakistan have a legal route available under the treaty? What are the legal options?
Legal options is, I think they have the legal options and definitely they are going to use it. They may go to UNGA first. And I believe that yesterday Pakistan Prime Minister also had a meeting. So I believe they will go for UNGA. They will raise the matter in UNGA. And then it's for us to see how we manage that. And later on, they may go to ICJ or something, but then we can cross the bridge when we'll come to it. But definitely they have some options and they will definitely explore that.
Right. But do you feel that implementing all these actions is difficult? Because even in the past, in the last 10 years, there have been terror incidents where India has stopped cooperation under the Indus Water Treaty or stopped conducting meetings that happen every year. But still this cooperation has gone on. For the last, since 1960, this treaty has survived despite hostilities and wars between India and Pakistan. So do you feel that somewhere it is difficult to stop cooperation? It is difficult to suspend it?
Look, when we say that this treaty has survived so many wars and this treaty is working on for long, so actually any water treaty, the success of any water treaty depends on the upper riparian country because it is the upper riparian country that loses, not the lower one. So the treaty has survived and treaty worked well is only because of the gracious attitude of India. We still try to, keep the cooperation afloat and all those things. But then there is an end to it. So this was the flashpoint. This thing was going on for last maybe around 2-3 years. Even when I was commissioner, this was going on. We were mulling this option, but still we thought, let the peace prevail. But now, at one point of time, we have to see that now enough is enough. And this was the flashpoint. So that's the end of it.
But we can't revoke this unilaterally, sir. Will this have to go to World Bank because it has to be done by mutual consent? And if we revoke it or abrogate it unilaterally, what can happen?
This is the wrong narrative floated by Pakistan. World Bank has no role to play in the treaty. This treaty is absolutely bilateral. Pakistan always floats this narrative that this treaty have been, multilateral and World Bank has a role to play. World Bank only has a single role. Whenever there is a dispute, they have to appoint the neutral expert and the court of arbitration, as the case may be, under the process which have been outlined in the treaty. World Bank's role is not beyond this. So they are not our custodian or like any other masters like Pakistan used to portray. So World Bank is out of question. There is no question of that. Regarding your revoking the treaty, abrogation of the treaty, I admit that the treaty does not have such clause. Under Article 12 of the treaty, it is very clear that the treaty is perpetual. The treaty can only be replaced by another treaty. So, but there is a catch. The catch is under the Vienna Convention, Article 62 of Vienna Convention of the treaties. There is a provision that if the treaty is signed under the certain circumstances and those circumstances are not prevailing, one can revoke this treaty. So this treaty was signed during the atmosphere of goodwill, and now since goodwill does not remain, and people are being killed, so definitely those kind of atmosphere is not there, and India has every right to suspend that. Obviously, they are going to challenge it, but we will fight it out.
And former Home Minister and senior Congress leader P. Chidambaram has said that the terror attack in Pahalgam was intended to create a communal divide. I caught up with him earlier and began by asking him about the action that the Indian government has taken so far. Take a look.
Clearly, the government is pointing a finger at Pakistan, which is again expected and perhaps correct. So we welcome the measures, but it can't stop with these measures.
How do you see this as an important point in our fight against terror? The government's rationale was, and yesterday the Foreign Secretary said, over the last 1 year, we've seen the successful conduct of elections in Jammu and Kashmir. There was a semblance of normalcy. The economy was coming back on track, and this has been done to derail the return to normalcy. Now, keeping this in mind, what do you think India's response should be?
No, it's not for me to say what India's response should be. It's for the government to consult us and what they intend to do and what our comments are. Because the government has all the information. Government must weigh the options and choose, as I said, the most effective and deterrent option. Whatever option the government chooses, the Congress party will support it. Well, it's for the government to tell us what options are there and what option is likely to be taken. But on the earlier statement, yes, they conducted elections in Jammu and Kashmir, but I don't think there was a return to normalcy or there is a revival of the economy. Those are debatable issues, but we won't debate them now.
Right. So as a former Home Minister, someone who's dealt with 2611 investigations and so many anti-terror investigations at the highest possible level, what do you think the intentions of these terrorists were in the manner in which they targeted civilians in a tourist hotspot?
This is not unusual. This is what they do every time. The idea, the motive is to create panic among the people of India. The motive is to inflame communal passions. You know, the kind of questions they asked of the tourists, and based on their answer and based on their response, what they did. So it's clearly to inflame passions, especially communal passions, and to divide the country and to create panic among people. The intentions have not changed, despite losing a couple of wars and despite being condemned by many, many countries of the world. The intention of the terrorists is the same. It's, in fact, the intention of terrorists of any kind are the same, to create panic and to inflame either communal or religious passions and to divide the country.
Right. So when it comes to suspending the Indus Water Treaty, currently the Indian government said we are putting the treaty in abeyance, which means you're pausing cooperation, you're not abrogating it, you're not scrapping it, you can't do it unilaterally. But what more can we do as per our international rights and obligations?
Well, I have not examined that treaty recently, But what does suspension of the Indus Water Treaty mean immediately? It's for the government to tell us. The waters, I suppose, will continue to flow. But the treaty has been suspended. What impact it will have on the ground, it's for the government to tell us. If the government tells us what is the implication, what is the effect of suspending the treaty, then we can respond.
Right. What are the kind of measures you think the government can take, sir, considering we've got a lot of support globally? A lot of condolence messages have flown from the White House, from the European Union, from the UK, and all the world past for that matter. How do you see India's position now to corner Pakistan militarily, diplomatically, and economically?
So far, the government has used strong words, maybe by implication, but they have used strong words. And they have taken the first steps, clearly implicating Pakistan. Now, what the government is capable of doing immediately or in the short run, I don't know. In fact, the defense minister said near future. So it's for the government to weigh the options. But it will be more than, I suppose, it'll be more than the singular strike in Balakot. The singular strike in Balakot had an effect, but it did not have apparently a very deterrent effect, because in the last 1 year, there have been several terrorist incidents, not of the scale that we witnessed 2 days ago. So let's see what the government contemplates. I don't want to anticipate the government.
All right, so that was former Home Minister P. Chidambaram saying that India's response must be smart and a calibrated one as well. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
I will say that I think Russia is ready, and a lot of people said Russia wanted to go for the whole thing. And I think we have a deal with Russia. We have to get a deal with Zelensky, and I hope that Zelensky, I thought it might be easier to deal with Zelensky. So far, it's been harder.
Welcome to Indonomics. The bank Nifty has moved from being a laggard of the markets last year to the leader in 2025. Watch these numbers. The Nifty rose by 8.8% in calendar 2024, whereas the bank Nifty rose only 5.5%. But in 2025, so far, in the first 100 days, the Nifty has risen only 2.7%, but the bank Nifty has rallied 8.6%. Now, the complaints last year were India's old banking model is gone. People are no longer saving via bank fixed deposits, but they're saving via mutual funds. Banks have only short tenure money now and can no longer finance India's capex. Secondly, we were told banks will have to compete very hard for deposits, and hence they won't be as profitable as they used to be. And then there were, of course, short-term problems last year in terms of very tight liquidity, euphoria in unsecured loans and in MFIs, and all that hurt their profits. But then now, has Indian banking turned the corner? Come 2025, the narrative has changed. The Reserve Bank has cut the CRR, the new governor has ensured bucket loads of liquidity that has taken the interbank market to a surplus. Risk weights on NBFC loans to NBFCs have been cut, and liquidity coverage, or the amount of money that has to be kept in low-yielding government bonds, has also been cut this week. All of which has led bank stocks to stage a smart comeback. The question we are asking today is, are banks back to the glorious days of pre-2013 or even pre-2020, when we had 20% credit growth and 4% margins? Or is the current positivity only a relief from last year's very tight position? In other words, are the best days of Indian banking well and truly over? Or is the current rally of the last 2 months signaling the start of another glorious period? For these questions, I have with me an elite panel. I have with me Dinesh Khara, the former chairman of State Bank of India, Suresh Ganpati, Managing Director and Head of Financial Services Research at Macquarie Capital. We also have with us Ashish Gupta, the Chief Investment Officer, CIO at Axis AMC, all banking experts, of course. Gentlemen, thank you very much indeed for your time. Mr. Khara, thank you in particular. Want to ask you first, as the person who has been there, done that, what is the sense you are getting? Can these loads and loads of liquidity still solve the structural problem that banks are no longer going to get easy float?
Well, I think, Lata, when it comes to the RBI step which have been taken in terms of providing liquidity, is certainly going to help in terms of ensuring that the loan rates come down, because otherwise the policy rates reduction would not have got transmitted into the loan rate reduction. Because typically speaking, the last year the banking system has seen that there was a huge challenge in terms of the liquidity. And I think as far as the structural readjustment is concerned, that has actually happened. And going forward, whether at what pace the banks can grow, to my mind, it's a function of the real economic growth. And plus, maybe, we have seen that in the real terms, the GDP growth has been around 10%, loan growth has been around 12%. And now whatever is being talked about by IMF also, they are actually talking about a little lower growth in terms of the GDP. And I think in terms of nominal terms, it would be somewhere around the same 10% or so. And if at all that being so, I think the banking system can very well grow somewhere in the range of about 12 to 15%, depending upon the capability of each of the bank to garner the deposit. The second question is that, the second aspect which I would like to highlight is that effective from 1st of April 26, this LCR reduction which has happened, it will actually release some further liquidity also. And overall, it is expected that it will further give a jump to the growth as far as the banking credit is concerned, to the extent of about 1.5 to about 2%. The third piece is relating to the co-lending. So this will also eventually help in terms of ensuring that the whole ecosystem is very well greased, and they can underwrite and pass on to those who have got the ability to absorb in their balance sheet.
Okay.
So I think these are the kind of things which will probably help in terms of pushing the growth.
Ashish, what is your sense? The question I'm asking is, the days of float seem to be over. Even government is not keeping the float. Even that is just in time spent. And so are savers like you and me. My father kept in FDs. I am not, and I will not, maybe even when I retire. So is that slack over for the banking system, and therefore the best days over?
So, Lata, if you recall, I think sometime last year on your show, we had discussed the fact that households are investing in mutual funds actually does not reduce the deposits in the system, right? It changes the nature of the deposit. So you're right, from potentially money coming as float income or savings account, money will come as a fixed deposit account, money will come rather than a retail deposit, it will come as a wholesale deposit, and the nature of deposit changes, but the aggregate deposit growth in the system does not change.
No,
right?
yeah, if I may just interrupt, you got it right. Yes. What I'm trying to say is amount of money in the banking system obviously remains the same.
Sure.
But
yeah.
I think Rajeshwar Rao, the Deputy Governor, gave some data in one of his recent speeches that total amount of term deposits have fallen from about 66% of total deposits to about 60%. So the tenure of money is clearly going down. Won't that hurt margins?
Yes, yes. And I think it was a bigger problem when the runoff rate on LCR on wholesale deposits was very high, right? So I think what has been announced last week is very, very important. When the runoff rate on the wholesale deposit has come down, and wholesale deposits therefore also become part of lendable resources of banks. So it's not just retail deposit that they have to rely on for lending. The fact that wholesale deposits can also be used for lending, given the reduction in the runoff rate in LCR, I think is a very important change. Of course, this does not do anything in terms of the cost of funds. So to the fact that the float deposits will be lower, the cost of deposits is going to be higher than maybe what banks have enjoyed historically. But that is something that potentially they can build into the pricing or will have potentially some impact on the margins. Right? But there are multiple levers on margins. What is the kind of loan mix you have? Secondly, what is happening on the deposit rate front, etc. So you have seen already several banks reducing their interest rate that they offer on savings deposit.
Suresh, to wind up this, is there a structural story in terms of banks being hit or no?
Yep. You know, the advantage of speaking after two stalwarts like Mr. Khara and Ashish is that my job becomes much more easier to answer some of your questions. But, you know, let me try to put this in two contexts, right? One, to explain why the banking stocks have done well recently and try to put it in the near-term context, and of course also try to address the structural story. So specifically taking points from Mr. Khara as well as Ashish is the fact that the monetary policy transmission has become easier because banks now have more liquidity with them, right? The fear in the market was that when we were going to go through a downward rate cycle, the repo rate linked loans will adjust downwards.
Yes.
But because there is a heavy competition for deposits and liquidity was continuously being tight, what could have happened here is that you will land up losing margins because of the fact that your loan yields are immediately reset downwards because they're linked to repo rate, but you were not in a position to cut the deposit rates. Now, what has actually changed in the last 2-3 months here is because of this tremendous change in the liquidity stance, what's happened with the LCR rules, effectively the banks have become even more confident and they've gone ahead and cut the deposit rates, right? You've already seen special deposit schemes by HDFC Bank being cut by 35-40 basis points, which is quite a substantial amount. And even savings deposit rates have been cut by 25 basis points. So what this exactly means is what you're going to lose on margins this financial year, you're going to actually gain on margins the next financial year because of lag repricing of deposits. The second part, as far as structural growth drivers and stuff is concerned, look, Lata, let's be honest, I don't think
at least for the foreseeable future, banks in India are going to grow at 20%. Now, there is a demand issue, there is a supply side issue. Demand in the sense that when we were growing at 20% in 2006-07, it was retail which is driving the growth. Then post that, it was infrastructure and corporate capex cycle which is driving the growth. Gone are those days where you're going to see a 30% growth in personal loans and unsecured loans, or for that matter, mortgage loans. And gone are those days where you're going to see 20-25% growth in infrastructure loans or capex related loans, right? So from a demand angle, there is an issue with respect to growth. So we should be happy even if the outcomes are 14 to 15%. The supply side, look, I think all said and done, for every 100 rupees of deposits that you mobilize, unfortunately, 30 gets taken away, right? I mean, though the statutory appropriations will be 22%, I mean, you have to keep a little bit excess SLR to meet the LCR requirements and stuff, right? So roughly it comes out to be 20 to 30 bucks. Structurally, for India to gain greater degree of ability to mobilize and deploy, you need the fiscal deficit to be brought down. You need the government borrowing requirements to be brought down. You need the statutory requirements to be brought down.
But I'm still striking at a smaller point, and after that, I'll go off to the other question. Mr. Khara, you have seen the days when you were having float. Now it is, I think the average tenure of deposits in banks is way lower than 1 year now. Would your sense be that, we have to reconcile ourselves to a slightly lower margin than before? Banks will never be attractive as long as the tax laws don't favor you. Long-term capital gains for equities is 10%. For, fixed income, FD, it is your income slab, probably 33% for most of the savers. As long as you have the disadvantage, the margins are not going to be what they were previously. Is that a fair assumption?
Well, Lata, I think when it comes to the cost of deposit, that is something which you have seen that it has gone up last year also. And even prior to that also, it has been on the upward trajectory. But, when it comes to the kind of action which we have seen in the recent past, is essentially, I would say that it is an effort on the part of the banks to ensure that their names are protected. That is this is a very clear message, because, when the deposit continues to be, still there's the banks are clamoring for more and more deposit, but still we have seen that there's a cut in the interest rate as far as the deposits are concerned. So that is something which we have seen. So now what you are saying is that, whether, the cost is something which is a reality, which perhaps they will try to reduce something, but how much they will have to probably wait and watch, because all said and done, deposit is a franchisee. And actually, when it comes to the savers' interest, that cannot be ignored, because unless and until there's a basic fuel, unless and until savers are taken care of, there will be a challenge in terms of mobilizing deposit.
Let me take a break on that point. Do banks now, to protect their margins, have to go aggressively after cutting their costs, for cutting their operational costs? Because interest costs, more or less, their back is to the wall in terms of the float money going away. That question after the break to my guests. Welcome back to the Special Economics, where we are discussing the fortunes of the banking sector. Are the recent improvements in liquidity and lower liquidity coverage ratio rules only a palliative, or are banks likely to return to their glorious period of nearly high teens growth, 20% growth and 4% margins? I've been speaking with Dinesh Khara, former chairman of State Bank of India, Suresh Ganapathy, the head of financial services research at Macquarie Capital, and Ashish Gupta, the CIO, Axis Mutual Fund. Gentlemen, thank you very much for waiting on. Ashish, let me restart this question about banking stocks when you analyze it as an analyst and an investor. Now, do you think banks have to aggressively cut costs, the point that Mr. Khara was making now, because the interest rate maneuverability is less?
No, definitely. I think longer term profitability, value enhancement really comes in a competitive market on basis of your cost and operating efficiencies. So I think banks will do well if they can really build on the scale and bring down costs. I think the big challenge in terms of cutting costs is going to be that a larger and larger proportion of costs is going towards technology. And the ask on technology that banks have coming on account of A, their large networks, B, the real-time payment system that are being offered free to all depositors, and of course the increasing compliance PMLA burdens means that they have to continue to invest more in technology. And of course, all of us know the advancements in technology that is happening. All banks, I'm sure, are working on various AI projects. So in this context, for them to be able to scale back on technology costs is going to be very, very challenging. Right. I think the other large component, of course, that has historically been there has been the employee costs. That probably, I think the growth rates there have already plateaued. But I think technology spend is something banks will have to keep the pedal pressed hard on. And I think what this will lead to is that there will be increasing differentiation between large bank and small banks. And clearly, scale will benefit the larger banks because what you need to spend on technology systems is agnostic to the size of your balance sheet, right? In many ways. So I think the opportunity that will be there, in my view, for the larger banks to get some benefit of scale and moderate their cost ratios are probably going to be more meaningful compared to the smaller banks. But your question is completely valid, that the driver of profitability and the differentiation in profitability will come as much as what banks are able to deliver on their OPEX ratios.
Okay. Well, until now, Suresh will bear me out as well as Ashish. When we were looking at banks, we used to look at NIMs, we used to look at NPAs, we used to look at credit cost. But Suresh, now you have a new parameter. Your last two reports are reporting on how much is the technology spend and how much are employees being, what is the employee strength, plus or minus. So do you think these will be the new parameters for you banking experts to judge banks altogether? We won't just be looking at NIMs and credit cost. We will start looking at tech spends and employee expenses.
Interestingly, if you look at the profitability of the banking system today, and we analysts, of course, give an overwhelming importance to ROA because leverage is a function of the amount of capital that you hold, and accordingly, the ROA will be different. But if you look at it on an ROA basis, the banking system today actually lands up having the best ROA at an aggregate level seen in the last 20 years or so, rather the best ever ROA.
Okay.
Of course, I understand that is more coming below the PPOP line item, right? The provisioning levels have been at rock bottom levels, and that is what has been driving the ROA, and provisioning levels can be a bit more cyclical in nature. Having said that, let me try to deliberate a little bit more on the cost ratios. Look, I think the banks so far have, of course, done a reasonably decent job. If you look at the last couple of years, the balance sheet growth of HDFC and ICICI, they have had a decent balance sheet growth, but they managed to keep the cost income ratios flat, right? Of course, we would ideally want a reduction in the cost income ratios, and HDFC Bank has had a tall target of 40% going down to 30% over the course of next 10 years. But initially, the way this would work here is that while you are having efficiency gains flowing through because of usage of technology, the technology spend itself is keeping the cost ratios, or rather not resulting in the cost ratios coming down. And that's what I wrote in today's report itself, that if you look at HDFC and ICICI on an absolute level, the cost, the technological expenses that they've incurred has gone up 4 times in the last 5 years. Right, that's the scale of technological expenses that's been done. And if you look at some of the global banks with the best technology and stuff, their total OPEX, technology expenses to OPEX is closer to about 18 to 20%, whereas in India, we are at 10%. So indeed, if we have to catch up to them, understand the business models are different, they're more into investment banking and equities, and where the cost ratios could be higher. But nevertheless, even if I were to see 10% going down or going up to 15%, at least in the near term, you are investing for the future. It would not flow into your profitability numbers. You're just preparing for the future, that eventually you do this, reach a plateau, and then you will start seeing the benefits of some of those technological investments, resulting in eventually lower OPEX ratios and eventually higher ROA.
Yeah, we are all hoping that AI is going to bring that manna, but first it will be investing in it. You know, I last spoke to KV Kamath. He said credit costs need to come down to 2/1/4. Now, that may be an extreme statement, but do you see credit costs for banks going down even to 30% that HDFC is talking about?
You're talking about OPEX, not credit costs, Lata.
Okay.
OPEX has to come down to 1/4, not credit costs. Credit costs
Sorry.
Yeah.
I meant OPEX, yeah. Sorry, I meant cost to income, actually.
Yeah, cost to income. Yeah. I mean, that's a very tall aspiration. I mean, it's good to have that, but I don't think in the near term that is something which is achievable. Remember also that banks are growing, they are setting up. You will have, of course, infrastructure costs, which will still rise and stuff, right? So, I mean, not 1/4, that's too much of an expectation, I would say. But yes, marginal reduction, maybe an annual reduction of 100 basis points over a period of 5-6 years itself would be a great outcome, I would say, Lata.
Okay, yeah, I agree, because there are so many tech spends that are looming. Just a final rapid fire from all of you. Mr. Kharat, do you think we go back to the golden days of pre-2013 or even pre-2020 in terms of credit growth and margins?
I would say that we will go forward.
Sir, rapid fire. Yes or no?
Yes, we will.
Okay.
With the economy growing, it is certainly happening. It is certainly possible.
Okay, Ashish?
So I think both in terms of credit costs and margins, we are already at a very high level. So I think the challenge in stock performance has not been that. I think challenge had been that loan growth for the banking system had been falling. And with prospects of loan growth looking better, I think that is what drives the positivity towards the banks. I think we are very happy with the margins and credit costs they are operating at.
Okay. Rapid fire is not working for me, but Suresh, last word.
No, I mean, I just cannot go against Ashish on this aspect. He's spot on. I mean, look, I think the real challenge today, Lata, here compared to what you have been comparing with respect to 2013 is not ROA, right? ROA today, as I said, is the best seen in the system at an aggregate level over the course of last 10, 15, 20 years. The real challenge is how do you go back to 20% growth? And there are several bottlenecks against that. Of course, Mr. Khara is a banker and always an optimist, but they're in taking a very practical view and the uncertain trumped world that we are living in, I think it's very difficult to argue for a growth greater than 13-14% next year.
No, I take your point, Suresh. We should not have credit growth of 20 and 25% when nominal GDP is only growing at 9 or 10%. That will lead to other problems. But my reference was not to credit growth. My reference was to profitability. Will banks have the same profit rate that they had in the past? I have my doubts on that, but thank you very much for igniting our thinking on those lines. Thank you very much for joining me in this very special edition of Indianomics.
from Madhya Pradesh to IIT Bombay. That's where your love for the capital markets personally started.
I used to watch, sometimes CNBC as well. You used to host one show there.
Yes.
Yeah. So that's how, read a lot of books and got into excited about capital markets.
Take me through that period of being at Flipkart, working in the e-commerce space, and then deciding to go the capital market route.
Flipkart was converting from retail to marketplace. And I was one of the first product managers there to kind of build that. Very lucky to meet my co-founders there.
One guy who's spontaneous, another who's a thinker and a numbers person. Which bucket or which category do you find yourself in?
I'm nowhere, I think.
Nowhere?
I think my strength lies in identifying people. So I ensured that my co-founder should be smarter than me. Then two of us came. Then we thought third one should be smarter than us.
From 0 to 14 to 15 million. What would you say has been the biggest learning so far?
One of the biggest factors in startups is timing. Why now? Less than 20 million, active investors at that time.
Yeah.
Very, very
few.
So it makes sense. So mutual fund app, and they're I think some 30, 40 apps listed on the Play Store, or Signal.
Yeah. Then how do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account. And the person did not even kind of entertain me. So I was in chappal, and as a student you go there and come to and so on. And then after conviction, after some convincing, fill the form. 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shriram Finance. My guest today has had quite an interesting journey, starting from his roots in Madhya Pradesh to IIT Bombay to his entrepreneurial start with an education startup called EduFlix. He decided to bet on India's capital markets 9 years ago along with his 3 co-founders. Let's talk to Lalit Keshre about the growth story, more importantly, where it's headed from here on. Lalit, many thanks for joining us here on the Young Turks podcast. And that's where I want to start with you. I mean, it's really been quite a journey, right? From Madhya Pradesh to IIT Bombay. That's where your love for the capital markets personally started. But it took a while for it to convert itself into a business opportunity.
No, thank you so much, first of all, Shireen. I've been following this show for many years now, and it's great to kind of be here. So I think I'm very grateful about this journey right now. So I was in a small village, my parents were in a village, and I got yeah. So and then but there were no schools there, so I studied with my Nanaji grandparents and Nanaji Naniji, and I was lucky that that year itself there was an English medium school there. It just got started, and as I progressed, that school also kind of went till 12th, and then I was lucky again that I got to know about this IITs, but nobody around me knew about them. Just lucky to kind of got in IIT Bombay. I was just there day before yesterday, and of nostalgia and so on. But I think
it's not just luck that helps you get into IIT.
No, of course. There was I got access to kind of lot of stuff also. There used to be this brilliant tutorials in Chennai at that time. They used to send you books and so on. So thanks to bunch of these folks, got in there. And then, as you said, that's where I came to know, like, the one advantage of Bombay is, like, at that time also there was a lot of entrepreneurial, like in 99, 2000, 2001, like everybody was starting startups, .coms and so on.
Yeah.
And at that time, somehow I came to know that, you can invest in stocks and, they are publicly listed companies. Primarily because one of my kind of wing mates got an internship in one listed company and so on, and that's how got into a rabbit hole of. And then I just told you, I used to watch sometimes CNBC as well. You used to host one show there.
Yes.
Yeah. So that's how read a lot of books and got into excited about capital markets.
But at that point in time, capital markets was a passion. It was something that you were personally and individually sort of taken by, but the idea of converting that into a business opportunity didn't occur to you.
No, absolutely not. No, I was doing, so in student and in IIT I did a student startup in medtech devices. Again, I've been very selfish in looking at my own problems. So I had this allergy in the campus because of some pollen. So created this device which was like allergen detector.
Okay.
And of course, when you
but isn't that the starting point of great ideas, where you actually encounter a problem yourself and then try and solve it?
Yeah, so that's my philosophy in consumer business. I think it's always better to kind of solve for you, so that you have at least one customer.
Guaranteed.
Guaranteed customer, right? And the second startup was also similar, so I was in that small town and no coaching classes and so on. So this EduFlix was about kind of education for all through internet, through videos and so on, and likewise grow as well.
Well, before we get to grow, in the middle you also went the e-commerce route and ended up at Flipkart.
Yes.
And which is where you met your co-founders. And then 2016, of course, began a whole new journey with Grow. But take me through that period of being at Flipkart, working in the e-commerce space, and then deciding to go the capital market route.
Sure. So Flipkart was so my startup didn't work out. We were not able to scale. So we shut it down. We returned money to all the investors. And then what next? So one option was to get into some MNC, do product management job, or other was to get into startups. At that time, I don't think you had too many choices to invite entrepreneurs, right? Flipkart was the largest one at that time.
Yeah.
We got in. And was again they're lucky as well. Flipkart was converting from retail to marketplace. And I was one of the first product managers there to kind of build that. So got that opportunity. There kind of realized, this people ordering things from, t-shirt from Delhi taking 5 days. We saw the NPS score across 5 days, 4 days, 3 days. As the number of days reduce, your NPS goes very, very high.
Yeah.
And we thought, okay, why not 1 hour? So started this company called Flipkart Quick within Flipkart, sponsored by founders. They were very encouraging and so on. So idea of Flipkart Quick was give everything in instant.
So you were ahead of the quick commerce curve that we're seeing today.
We were ahead, but I don't think we had so much conviction. I think timing was not probably the right at that time, because e-commerce itself was marketplace itself was kind of taking off. And I think timing was also bad, because at that time, 2015, if you remember, the ecosystem was a bit kind of shaken because of a bunch of things. But that was very crazy experience, and that's when and when that didn't go through, then kind of started thinking about something else. And then was very lucky to meet my co-founders there, and that's how we kind of got started.
But it wasn't as if you kind of met and decided that this is what you're going to do. You actually spent some time thinking this through and working with the four of you together to just ensure that you have an idea that can be executable.
Yes. So I think, so I'll tell you a story about how we kind of so Harsh. So I have 3 co-founders.
Yes.
And so I ensured that my co-founder should be smarter than me. Then 2 of us came. Then we thought third one should be smarter than us. And this is what happened actually. So Harsh, so I used to work with Itium Systems right from campus. I came to Bangalore, and he moved from IT Delhi. So we know each other since 2005. And then there was so I was interviewing for some product managers, and I see him in on Zoom call from US. And I was like, now I can't take interview because I know you so well. So, you know, then, but somehow he got through other interviews and inside. And then he joined the same team. And then when I moved to Flipkart Quick, he took over what I was doing at Flipkart Marketplace and so on. And when he came, like, his idea was to stay for like 3-4 years. Like, you know, he was excited about Indian story and so on. But then I told him, I asked him, like, you know, I'm thinking about something to start and so on. And like two of us then kind of started thinking about it. This was around 2016.
Yeah.
And then we thought, you know, it's been so long that we have coded. You need like, so the vision was to build a tech company in financial services. Now, no idea what we are going to do or what, but we thought that tech will be like basic, like, you know, the core component of it. And we need a very, very solid tech person. And Neeraj used to work with me. And I just asked him or the breakfast, and within like 5 minutes he said, yes, I am in. Like he didn't, so he is that kind of a person, like he's spontaneous, very, very spontaneous. Whatever he feels like, he just kind of does it. And right. So 3 of us then started, and then I was having lunch with Ishan. Ishan used to look at Corp Dev at Flipkart. And I asked him, you know, that I'm thinking like this and so on. What do you think? And he was like, he said that he had been thinking about this since his like college days. He is a finance guy, proper finance guy, very, very passionate about investing. He's a numbers guy among all 4 of us. And he's like, I am also kind of excited about it, but I'll have to think. So he is a thinker. He took like 2 days, checked with his wife, arranged for his personal finance and everything. And then 2 days later, he came to me and, okay, I'm in. That's how like 4 of us kind of started. We quit and then started working on it.
So one guy who's spontaneous, another who's a thinker and a numbers person. You know, which bucket or which category do you find yourself in?
So I'm nowhere, I think.
Nowhere.
I think my expertise, I feel is that my strength lies in identifying people. And like, that's like my strength. So I think the only thing that I did was like to get these folks together and the initial team and everything. And then like, you know, kind of setting up the purpose, like what we want to do and so on. But then like, everybody has like very, very crazy superpowers that kind of they come with.
Yes, well, we'll talk about those superpowers in just a second. But, you know, starting from scratch and building out, grow into what it is today. And how many active users do you have today?
So we are around 14 to 15 million customers on the platform.
Okay, so, you know, that journey from 0 to 14 to 15 million, I'm sure that there's been plenty of ups and downs along the way. There's been plenty of learnings. What would you say has been the biggest learning so far for you in the last 9 years?
The biggest learning has been that team is everything. Because in last 9 years, we have been through like so many highs and lows.
But the last few years, largely high, at least as far as the markets are concerned.
So that's what. So what you see from outside is very different from what is inside.
Yeah.
What if I told you that so in 2015, while I was at Flipkart, I was like getting term sheets from VCs, you know, just go out and start. We get out in 2016 and those, you know,
the market dries up.
Boom kind of done.
Yeah.
And there is no funder available. And, you know, and we raised some angel money from Mukesh, Ankit and so on, our Flipkart folks. But largely like till 2019, till peak 15 round, like for 3 years, which is also good, by the way. In hindsight, I think that it was very good that we kind of got a lot of time to materialize, like, you know, to figure out what we really want to build. Get very solid team bonding.
Let's also talk about the landscape that you were operating in when you decided to start in 2016. So there was already a few players in the market that had done what you were attempting to do. How much were you influenced by what was already out there?
We saw a lot of startups coming in this, and that is like a signal to me. Like, you know, when quick commerce, for example, happened, lot of companies come together at the same time. So anything, if some idea happens, then it's not just one single entrepreneur most of the time who kind of thinks about it. It's many more folks. So that was like a good indication for us.
That this was the good time to get started.
I remember when we just got out and I was thinking, okay, and we were figuring out how to start in financials. So mutual fund was some mutual fund app, and they were like, I think some 30, 40 apps listed on the Play Store, or like Signal.
Yeah. No, but that's also important, because then how do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And, you know, the person did not even kind of entertain me. So I went chappal, and, you know, as a student, you go there and like, so kala, like, you know, come to, like, and so on. And then after conviction, after some convincing, filled the form, 2 days, 3 days, like, you know, and opened my account. By the time you're like gone, like, you know, your interest is like lost.
Yeah.
So account opening process, again, the structural change that happened was like, you know, Aadhaar and like, we always say, right, we are like so crazy grateful to, like, you know, all these, the timing of DPI and Aadhaar, UPI and everything. We wouldn't have been, like, Grow wouldn't have exist, like, you know, wouldn't exist if they were not there. So the point was, like, you find one problem area at a time and then kind of figure out that you have this right to win in this market.
Recognizing the seriousness of this terrorist attack, the CCS decided upon the following measures. 1. The Indus Waters Treaty of 1960 will be held in abeyance with immediate effect until Pakistan credibly and irrevocably abjures its support for cross-border terrorism. 2. The integrated checkpost Atari will be closed with immediate effect. Those who have crossed over with valid endorsements may return through that route before 1 May 2025. 3. Pakistani nationals will not be permitted to travel to India under the SAARC visa exemption scheme visas. Any SVAS visas issued in the past to Pakistani nationals are deemed cancelled. Any Pakistani national currently in India under SVES visa has 48 hours to leave India. 4. The defense, military, naval and air advisors in the Pakistani High Commission in New Delhi are declared persona non grata. They have a week to leave India. India will be withdrawing its own defense, navy and air advisors from the Indian High Commission in Islamabad. These posts in the respective High Commissions are deemed annulled. 5 support staff of the service advisors will also be withdrawn from both High Commissions. 5. The overall strength of the High Commissions will be brought down to 30 from the present 55 through further reductions to be effected by 1st May 2025. The CCS reviewed the overall security situation and directed all forces to maintain high vigil. It resolved that the perpetrators of this attack will be brought to justice and their sponsors held to account.
I'm not going to say, oh, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice. They're going to be very nice. And if they don't make a deal, we'll set the deal. Because we're the ones that set the deal. Scott and Howard and myself and others, we're going to be setting the deal. And it'll be a fair deal for everybody. And it'll be, I think it's a process that's going to go pretty quickly. 145% is very high. And it won't be that high. It's not going to be that high. It got up to there. We were talking about fentanyl, where, various elements built it up to 145. No, it won't be anywhere near that high.
And what level do you think it'll come down to if you haven't?
It'll come down substantially, but it won't be zero. It used to be zero. We were just destroyed. China.
Let's talk about what's happening in the environment currently. I mean, as I said, we've had a bull run right through the COVID period. And again, it was unexpected because people actually thought that the world was going to shut down. And here you had the capital markets the world over delivering phenomenal returns. And you've now got a new class of investors who've been drawn into the stock markets, given what we've seen happen in the last few years, specifically younger investors, women who are investing in the stock markets. These are all sort of new trends that we've seen in the last few years. But now, with the kind of pain that we're starting to see, and it's only the starting point of the pain that we're starting to see at this point, volumes have been impacted. How are you seeing things at this point?
So we are asked this question a lot, and I think the way we look at it is that from growth strategy perspective, we think very long term. And we believe that in long term, these trends, this very long term trends that we are seeing will continue. And namely, like India's growth may be 6%, 8%. So, but this compounding over like next 10, 20 years is going to be like crazy. I don't think any other country will grow like India for next few decades and so on, right? And then penetration will continue happening. Tech will help in more and more penetration of more and more products and so on. Wealth people will continue looking for transparency. Like Bezos, like you bet on things that are not going to change. And one is that, people will not go, okay, I'll go from transparent to opaque way, or, convenience to non-convenience and so on. Right? And so these kind of trends will continue happening. And we are kind of working on those trends, democratizing wealth in the country. I think country is going to, people are going to get wealthier. They will need products to kind of make it easy, make it transparent, and so on.
What's the data telling you today on where we are as far as the addressable market is concerned, but also what the headroom for growth is likely to be?
Sure. See, today, if you look at the active investors in the market, right? Again, numbers might be here and there, but I think mutual fund would be around 50 million unique, 50, 60 million, and then stocks would be around similar number, and superset would be around 70, 80 million and so on. And participation perspective, mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Ownership, I'm talking about the ownership of the stock market.
Yeah.
Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Right? It's not like... so there's a lot of narrative, okay, retailer. But if you look at the ownership perspective, it's still mutual fund has seen higher growth in terms of ownership and so on, indirect ownership. And I think that is one way probably will grow even faster than direct ownership. From the numbers perspective, you can think, right? So Indian middle class, great Indian middle class, right? It's very large, and we are at around the 70, 80 million mark. And it's anybody's guess, where can it go to percentage wise.
So, you were talking about the fact that growth today is much beyond just equities. And that's been a sort of conscious strategy on your part to be able to address different segments of the market with different products as well. Again, what's been the learning there, and where do you believe the gaps continue to exist that you would like to plug specifically?
Yeah. No, so our biggest learning, Sheen, when we started actually, this is grow in current format was not our first product.
Yeah.
There was a pivot.
Yeah.
For first 4 years, the only product that was available
Mutual
on
fund.
Grow was mutual funds.
Yeah.
And we just kind of
Yeah.
made it just so simple and so transparent. So what happened was we built a search. You search for any mutual fund. There is a product, beautiful product page. You should check out our, like, you know, there's graph. There are like, you need to know about fund manager. You need to know about past performance, expense ratio, tax, like everything. Right?
Yeah.
What are the other funds for?
The
What is
history,
holding?
geography.
What is, yeah,
And
everything.
everything in between.
So whatever is the holding and so on. And later when you launch stocks, then holding, you can look at the stocks also.
Yeah.
Right. So that was like, and then payment, very kind of simple payment, very simple onboarding and so on. And like first month when we launched after the pivot, we thought, you know, yeah, 100 customer ho jayenge to maza, like it will be fun. Like it will be like good feeling.
Yeah.
And we got 600 customers. And at that time, getting customers was so tough. And we did not do any marketing. Even today, for example, in like more than 70% of our customers are organic customers, all word of mouth.
Two claims that literally every company makes is one, that we're a tech company, and two, that we're customer obsessed. Now, from a Grow point of view, what does that mean? Simple language, from a layperson's perspective, what does it mean to be a tech company for Grow, and what does it mean to be customer obsessed?
Yeah, tech is eating everything. Like, you know, the way we look at tech.
Breakfast, lunch, dinner, all of that.
Yeah. But tech is like, I am a techie. I've been an engineer. And my co-founders are techie. Like all are engineers. We solve today, like most of our time actually goes in building products. And I think that's what defines a tech company. Like, you know, the tech is the primary solution to like most of the problems. And not like, so we don't, for example, we don't have an army of sales folks. Nobody will call and tell you, oh, do this, do that. No, everything is tech driven. All the user experience is defined through tech and so on. But yeah, you can say that everything is tech, which is what it is going to be, right? Tech is eating everything away. So I don't know if I answered that.
No, I'm getting some clarity on you know, on how it probably creates boundaries of what you should not be doing. I think it clarifies what you should be doing, but it probably also puts boundaries on what you should not be doing.
Yeah, you're right. And there's a long list, by the way, of things that we will never do.
Like what? What are the top 3 things that you will never do?
So one is we will not. So Grow will continue to be focused on building wealth for the customers. We'll not do like e-commerce. We'll not do like anything which is like, you know, distracting. Number 2, we will mostly do regulated products. Like we will not do like unregulated products. And third is like, we will not do anything which is not good for the customer.
From your vantage point today, 9 years on, you know, what are the priorities now as you look at the opportunities that exist, as you look at the customer, where the customer has evolved? What are the opportunities that you're going to chase after? What do you prioritize today?
So the biggest one is to kind of, so our goal is to become like the default wealth platform in the country, where people think about building their wealth on Grow. And what we have seen is that a lot of our customers have got wealthy in last, like, you know, older customers, and now a lot of wealthy customers coming. And they need a lot more tools now, a lot more products. So on one side, there is simplicity and, you know, transparency for like millions of customers. And then, like, you know, for like now people are getting more and more affluent, HNIs and so on. We'll be building more products for them. And so that is one kind of direction. Other direction is now a lot of power traders on the platform. And again, they also need a lot more tools and so on. So for last 2-3 years, we've been building like, so some tools that we have built that do not exist outside and so on. So like, you know, that is another kind of direction that we'll take up and so on. And lastly, like selection, like, you know, the holistic view of wealth is very, very important. That is like, you know, you can't say, okay, I want to invest in this and you don't have that. You need to have all the products. So filling like all the gaps across multiple products, we need to have those as well. So like creating the full basket for the customer.
Yeah, well, speaking of creating the full basket for the customer, you're also operating in an environment that has seen a fair degree of regulatory change. It's also seen a fair degree of regulatory clampdown, especially when we talk about the F&O side, when we talk about True Label Circular and so on and so forth. From that perspective, how does it change the business case for a company like yours? How much does regulation decide or define your destiny today?
So, see, one good thing, so we are a regulated, all the business that
Yeah.
do are regulated businesses. One good thing, what has worked for us over last 9 years is that the philosophy of regulator is customer protection. Philosophy of grow is customer obsession, do everything for customer and so on. And they match. Now, they're short-term these things, where we have to make a lot of changes immediately and those kind of things. But apart from that, I think more or less, if you see all the regulations that have come over last many years, they have all benefited growth. Like, KYC regulations or peak margin regulations or so they increase the trust in the system. A system में trust increase होता है, so people transact online, people invest. They know that, okay, I'm buying a stock. This stock is safe. If I'm transferring money, this money is safe. So it always helps to,
in the long term
and expanding the markets, right? So overall in mutual funds, bunch of regulations came, nominee, that again more trust. Okay, now there is a nominee and something happens to me there. So I think it has always worked good.
I was looking through that F&O boom that we saw while the regulators were also kind of signaling that you need to be careful and so on and so forth. You were pretty much doing the same. I mean, I remember seeing a bunch of your tweets, etc., also sort of cautioning people to say, hey, look, the party does have an end. Again, take me back to what was the surprising aspect of what you were seeing happen on that side?
No, so see, we were always very cautious on this F&O thing, right? And as you rightly said, we around, I think when it was at peak, right? We were really scared about some of the things that were happening, and so we built a lot of responsibility features within the app. So there's this called Safe Exit where people could set in what maximum loss they can have, or Safeguard where we'll block some customers who are continuously losing money and then upload more documents to continue. We created this F&O pause. Customers can voluntarily pause their F&O and those kind of things. There are a bunch of other things as well, low liquidity. So we'll warn anti-nudges, if you're placing a trade and, it's very illiquid or risky trade, we would warn. We still do that. And then customers can still go ahead, but at least, we are shaking customer a bit, just think about it. And
but was there ever a pushback saying that, what do you care? Let me do what I want to do with my money?
So in one of the features, there was a big pushback, the Safeguard one, where we used to just block the customer. Let's say if you're losing money 5 days, 10 days, then we were okay, block, a soft block basically. First 30 days, you submit these documents, otherwise we'll block it. If customer can submit document of very high net, so let's say somebody losing 10,000 rupees and his net worth is 10 crore rupees, then it's fine, you upload.
Yeah.
But if you're losing 2 lakh rupees and your net worth is lesser, then you can't trade. And then that's when the backlash happened, because you are just a tool. So you are so we also have very few customers who are just F&O, less than 1%, right? But rest of well building and so on, right? So our numbers are slightly different.
Speaking of the future, one of the big changes that you decided to make was, of course, you're one of the companies that reverse flipped and moved your domicile to India, ostensibly, of course, with the hope and the possibility of IPOing. But what was that like? Because, it's few companies have gone down that road at this point in time, and it also comes with a pretty hefty bill. But what was the experience of reverse flipping?
Well, it was grueling experience. We in 2018. So I told, right, we started in 2016. We raised some angel, but we needed more capital because we were thinking of moving to direct mutual funds, which is zero revenue for next I don't know how many years. We needed capital. And YC was one good option for us.
Yeah.
So we applied to YC, we got in. And based on...
And for those of you watching, YC is Y Combinator. Yes.
Y Combinator, right. And but we got feedback from a lot of seniors and from YC, and that, better to incorporate in US because funding is easy, right? Raising money in the US. So us time pe you don't think about 5 years down the line, 10 years. No, I mean, you think about from your purpose perspective, but first you need to, so I say, in long term, everybody is dead, but, you know, to think long term, you need to keep doing short term.
Yeah.
So we incorporated in the US at that time. And then we paid for that, and we could afford also because a company has been profitable for so many years. And this was also right time. Typically, if you're raising capital, then it becomes tough because the process itself is very long. You go through NCLT process and those kind of things.
Yeah. Well, you know, you said you could afford to take that decision and you could afford to make that call because of the fact that the company's been sitting on profitability. What was the conversation like when you started about how important it would be to ensure that you were profitable?
So we, to be very monetization was the last question that we answered in our journey. And I don't advise to everybody, but for consumer business, sometimes, you know, so we had this framework, okay. So build a platform which is like very low CAC, low customer acquisition cost, very high retention, very high engagement, and customers should love you. Basically, you know, they should talk about it. If these four are met for consumer platform, then more or less everything is...
पैसा आ जाएगा.
पैसा बाद में आ सकता है.
आ सकता है. You know, the monetization big question mark here. At what point did you believe comfortable and ready to say that, okay, now we have clear line of sight on how we monetize this business?
As a consumer guy, the first month when we got 600 customers and when customers were kind of started talking about it, so it's like the thought process was that if you have like billions of dollars of AUM and money flowing through you, I think customers won't mind if, you know, there is some flowing to the company for sustainable. So that was the, but the real practical way, if you ask me, when we launched the second product, which was stocks, and we started charging for it. So our kharcha bahut kam tha hamari. So we raised a lot of money, but we have not spent money. Like before paying the taxes and everything, like we had all the money that we have raised in the bank. Okay? Like the net in the J curve, the net negative, maximum that negative went was like hardly anything.
Taking us for a ride and just not going to have. It's not going to happen. We're going to be very good to China, have a great relationship with President Xi, but they would make billions and billions and billions of dollars a year, and they would build their military out of the United States and what they made, so that won't happen.
If the US truly wants to resolve issues through dialogue and negotiation, it should stop making threats and resorting to coercion, and engage with China on the basis of equality, mutual respect and mutual benefit. Saying they want to reach an agreement with China while continuing to apply maximum pressure is not the right way to deal with China. And it will not work.
The Resistance Front, or TRF, a terror group linked to Pakistani terrorist Hafiz Saeed's Lashkar-e-Toiba, has claimed responsibility for the terror attack in Pahalgam. 25 tourists and one resident of Anantnag were brutally shot dead. It was one of the deadliest attacks in the region since the 2019 Pulwama bombing. The terrorists, dressed in military fatigues, fired indiscriminately and singled out non-Muslims. So who's behind this attack and what is TRF all about? Let's find out in this video. Let's first start with what the police have said so far. The Jammu and Kashmir police have released a set of sketches of the terrorists. The police said that these sketches were made based on the eyewitness accounts. The suspects have been identified as Asif Fuji, Suleiman Shah and Abu Talha. Now, TRF emerged as an online entity after the abrogation of Article 370 and revocation of J&K's special status in August 2019. It is known to target civilians, including migrant workers, Kashmiri Pandits in Jammu and Kashmir for the past 3 to 4 years. As per an Indian Express report, the TRF began as a social media-based outfit out of Karachi. It is a proxy of the banned terror group Lashkar-e-Toiba, which is the group behind 26/11 Mumbai terror attacks. Now, TRF has been linked to multiple attacks, including the October 2024 Gandarbal strike that killed a doctor and 6 migrant workers. It is also behind the twin drone attacks at the Jammu Indian Air Force Station in June 2021. This group is led by the likes of Sheikh Sajjad Gul and Basit Ahmed Dar. They recruit young men through online propaganda, coordinate weapon smuggling and orchestrate violence against civilians and security forces. Its commander Sheikh Sajjad Gul has been designated a terrorist under the UAPA and carries a bounty on his head. This outfit is involved in psychological operations on social media platforms, and it does so by inciting people of Jammu and Kashmir to join terrorist outfits against the Indian state. Its operatives keep a strong presence on platforms like Telegram, WhatsApp, Twitter and Facebook. In January 2023, India's Ministry of Home Affairs designated TRF a terrorist organization under the Unlawful Activities Prevention Act or UAPA. In its annual data in 2022, the J&K police said the maximum number of terrorists killed in the valley belonged to TRF.
What have been the big learnings from someone that you've read, someone that you've listened to, someone's career that you followed? Share some of those insights.
Sure. So mostly like, see, I also feel that nothing is original. Like all my thoughts are actually derivation of like what I read or what I heard from somebody, and and that's how you kind of build your intuition, your knowledge, and so on. Few things that I would tell you is like. So one thing, so Mukesh Bansal was our first investor, and then I am like a more product guy, and I don't like building people kind of managerial stuff and so on. And then he gave me this advice that, start looking at your organization as the product. So, org as a product. And then kind of my thought process changed. And then I started loving that, then we build like, very solid org structure, scalable org structure and so on. Nandan Nilekani is another kind of person who like directly we at that time we did not interact, but the way he kind of thought about the system thinking, right? The way he thought, and we owe a lot to Aadhaar and and the way kind of he thought about connecting so many dots together. Like you feel overwhelmed कि यार अच्छा grow इतना बड़ा company बनाना है, या you have to do something, and like sometimes you get just so overwhelmed कि ये बहुत बड़ा काम है. But then slowly, steadily connecting the dots, some things happen, and there is a probability that something will happen, and so on. So those are the kind of things. Then Satya has been kind of big, kind of such a large company is running and growing at such a fast scale, even at that scale, and thinking like some people say that he's playing like 5D chess, and he is an investor with Grow. And like we are super inspired by him as well, and like a lot of people whom we kind of look up to.
Well, speaking of looking up and looking forward, 2024 was a record year for the Indian IPO market, and specifically for new age tech companies IPOing. 2025 question mark at this point in time, given everything that's happening. But what about your plans?
We are, again, same old, like we are long-term players, and question marks will always be there in entrepreneur's life. And you need to be optimistic, and you need to play your game. Like, we'll figure out. There's no hurry. We have the luxury, we have the liberty of time. We have, the company is well kind of capitalized. We have good partners, long-term partners. So we will figure out.
But, do you believe that the IPO is a logical step as far as the company is concerned, as and when you decide to go down that route, because you've got to provide exits to current investors? Or do you believe that that is the right thing to do for the business? If you didn't have to provide exits, would you IPO?
So I would, because there are two things which are kind of very important. One is, so a lot of our investors, a lot of our kind of customers are actually investors.
Right.
And what if, just imagine, like, what if they also make money if grows and so on, right? And I think, like, what if they become like partner in our journey? Like, they are customers, but they are becoming partner in our journey.
So shareholders of the company.
Shareholders of the company, right?
What have you done differently in building out the organization in terms of the org structure?
So this is like my favorite question. And so what we did in around 6-7 years back. So when you're thinking about a product, so in product building, there is something called PRD, product requirement document. So I thought, okay, there should be like a PRD for company. So we call it Grow Code.
Okay.
Grow Code is specific way in which Grow works. We wrote down everything. Okay, what Grow stands for. What are the commandments? Or commandments is like religion. Like,
religion.
There's no black and white. This is what it is, right? There are 10 commandments. Then there are philosophies like, okay, how do you hire people? How do you take decision? Long-term decision, short-term decision, irreversible. How do you train people? How do you make yourself kind of, what is your role? So we don't have, for example, people managers. Like they are playing captains. Like, then we created set of rituals. Like, there are a bunch of rituals that go. Like
religion and rituals also.
Yes. So that is how, like, that's how PR, like, and then wherever there is a deviation, then you intervene. But most of the time it's like, this is how it is, right? So so we have Project Bezos, so, right, customer obsession. Like, everybody is supposed to go in customer support. And now, no matter how smart you are, no matter how much you know, you go and talk to customer because, empathy. Empathy is very, like, very tough. We have AIKG. We go, like, meet customers out in AC में बैठ के product नहीं बना सकते आप, right? You can't be just kind of in your bubble and building product. You have to go out and meet.
How often do you go out?
So very often, like meet, like, so I still spend like couple of hours, like 1 or 2 hours every day talking to customers, support, maybe WhatsApp or whatever, right? A lot of customers I support myself. What is the reason for success of stocks on Grow? Because it was, why did we launch direct mutual fund? Because it came from customers. Stocks came from customers. Trading, we actually, when we launched stocks, we thought trading to banana hi, matlab, investing platform hai. But then customers wanted trading. And now, like, we have so solid trading platform, like, everything charts and very, very advanced stuff, right? And so on. Like, and now this, as customers got into HNI category and so on, now they need PMS, AIF and those kind of, so most of, like, feedback comes from customers. And, like, some customers really go out of their way to just ensure, like, they will email you, like, some customers will mail, like, full documents. Yeah.
Have you tried hiring them?
Yeah, of course. But mostly, like, and sometimes, they are also very vocal कि ये आपने बनाया, ये अच्छा नहीं किया. So we have this called ritual called products. Products में हम क्या करते हैं कि आपने, let's say you build product and you have to test. So the passionate customers, they will come inside in our office and they test along with you and they will clearly say, ये अच्छा नहीं है, you do this way, that way. Very passionate kind of folks and so on. Yeah.
Okay, so that's the way that you've actually put in a feedback loop to listen to customers who are actually helping you design product at Grow. But I want to go back to Project Bezos. Why did you call it Project Bezos?
Because, so I was inspired by, so I've been reading his shareholder letter to shareholder since, like, when Amazon started, and he always talks about customer obsession. So we have some kind of, Sachin and Vinny used to work with Amazon. They carried customer obsession in Flipkart. Like, and that's what I learned at Flipkart, right? The biggest learning for me at Flipkart, two things basically: customer option and scale, thinking about scale and so on. And then we carried it inside Grow. So that's like to the original, as a respect to the original.
As respect. So you said you have 10 commandments, which is like religion, and then you of course have these rituals. What are the top 3 commandments there?
So, एक तो user को मजा आना चाहिए. Like, user should, like, really feel about your product. Like, should feel like simplicity, transparency. Second is always do right thing for the customer, right? Third is be unreasonable hospitality. Customer रात में 12 बजे आपको कॉल कर रहा है, कुछ प्रॉब्लम कर रहा है, कैन यू सॉल्व देन एंड देयर इटसेल्फ, और कैन यू गो do you worry about your P&L कि अच्छा if I serve customer in this way and then it will hurt your P&L? No, so you covered a budget out of it.
You talked about providing unreasonable hospitality to the customer. रात को 12 बजे कोई phone कर रहा है तो you will take the call and deliver. But what about the employee? How employee centric is the organization? Do you put the employee also equally at the heart of? No. Why?
Customer is number one. I mean, we are very, very open about it. Customer come first, rest everybody comes later. So we are very clear about it.
So how do you then get people to buy into this mission, vision, and also feel like the organization is treating them perhaps not with unreasonable hospitality, but with reasonable hospitality?
What we have learned is that people love working for a purpose, and we hire people who have this purpose of building like something crazy big for the customers. So the kind of people that we have are like us, who understand this very well, and I think all of us have accepted that. That it grows.
So when you see these debates rage on about 70 hours and 80 hours and 90 hours and all of that, I mean, what do you think about any of that?
I don't have any opinion on that. I don't need to have opinion on everything.
No, you don't.
There is a person who wants to work 80 hours a day, so be it. There is somebody very creative and he thinks that, out of I can work everything in 4 hours a week, so be it. What matters is your style. I am personally a hard work. Personally, my style is to kind of spend a lot more hours and so on. But then, I mean, we don't have those kind of things. But I think sabki jiski jo marzi hai, they will work according to that.
So when you talk about crazy big, let me ask you to draw up a crazy big vision, at least over the next 5 years, that the where you would like to see grow, what you would like to achieve in terms of numbers.
Numbers, I can't talk. And I'm not a numbers guy.
That job you've given to somebody else.
So I think I would be very happy if we become so we are already kind of loved by customers, the kind of love that customers expresses. I think if we kind of become a household brand, which so some of the examples that, so Apple is one example, Nike is another example where people just kind of trust you. People think you are the default platform for managing their wealth. I think there's a crazy trust that you need there and so on, which is already we are taking those steps there. That would be that would make us really happy.
So from Lepa village to IIT Bombay to running Grow at this point in time, when you look back at your journey, what are some of the most memorable moments that you believe have helped you get to where you are today?
Okay. So, I mean, this is very, very old. I was in second standard. And I was an average student till then. And somehow, pata nahi kya hua, us class mein I got first rank, somehow. And I came home and my Nanaji told me, good. That good was the biggest thing in my life, I feel, because after that, then that was something I realized, ye achhi cheez hai. Getting this, and as a kid, you don't remember and so on. So that was one of the best things that I still remember. I don't know whether it was second or third standard. I don't kind of, memory is very weak, but I think, so he has that's his company, my grandfather's company has been the best thing in my life. And then, other thing is all the people. So I've also been lucky to have people around me who are super, very caring, very high integrity. My wife, my co-founders, for example, right? And so, and I think, yeah, I mean, that's the best thing.
We hope you continue to paint the picture on a canvas of your choosing with the colors that reflect the ambition and the aspiration, not just of you, but also of your co-founders, as well as the 1,000+ people who are working at Grow. And we look forward to hearing more from you about the journey and the story as it shapes up, and eventually, perhaps as a listed entity as well at some point in the future. But thanks very much for joining us here on the Young Turks podcast. It's been an absolute pleasure speaking with you. I'll end by asking you, you know, if you're talking to entrepreneurs who are looking at getting into the financial services space today, one message, एक ज्ञान का टुकड़ा आपसे.
Regulations का ध्यान रखो.
Regulations का ध्यान रखो. Oh, that's the biggest overhang at this point.
After customer, like after solving
customer.
for the customers,
Huh.
I think in typically most of other businesses, customers का solve कर लो, business model बना लो, all good. But in financial services, it's rightly so, like you need to know regulations and so on.
Well, that's the piece of advice there from Lalit Keshre of Grow. Customer at the heart of everything that you do, but don't lose sight of the regulator or the regulations as you build a business in a regulated space like financial services. But for now, from all of us here on the Young Turks podcast, many thanks for watching. Do stay tuned. We will continue with a lot more right here on CNBC-TV18.
Welcome to this Monetary Policy Special. The Monetary Policy Committee of the Reserve Bank voted unanimously for a rate cut on April 9th and an accommodative stance, and the minutes of the policy, which are just out, indicate a strong dovish tone in the writings of practically all the members. Governor Sanjay Malhotra has summed up the arguments beautifully in his minutes by saying that with CPI inflation aligned to the MPC's target of 4% and growth moderating, it was logical for the MPC to cut rates and change the stance to accommodative. Strongly agreeing with him were the other members, including Mr. Nagesh Kumar, who has actually very strongly pointed to the hurdles to growth emanating from the global sphere thanks to the US tariffs. Joining me now to comment on the minutes and the state of the global economy and the Indian economy is Mr. Nagesh Kumar himself, external member of the MPC. In a bit, I will also be joined by Abhishek Upadhyay of ICICI Securities PD and Suvadeep Rakshit of Kotak Institutional Equities to give us the market impact and market reading of the minutes of the MPC. But first, let me welcome Mr. Nagesh Kumar to the conversation. Thank you very much, Mr. Kumar, for joining me. First, if you can parse the global environment, sir, the way you have written, it looks like a recessionary conditions are imminent. Can you tell us how bad this impact can be on Indian growth? Should we be prepared for something less than 6.5?
I mentioned in my statement that there are 2 or 3 things one should worry about, because the meeting happened during 7th to 9th, and that was just exactly 1 week after the 2nd April Liberation Day announcement of President Trump, where he slapped very high tariffs on every country. Now, some of our Indian economists and analysts are reading something positive in it because India was, sort of slapped with 26% tariffs vis-a-vis other countries, our peers, a much higher, percentage. So we were taking a bit of relief that we may be spared lightly, and we may actually be able to make more inroads in the United States market because our peers are facing higher tariffs. Now, but that is only part of the story. The second part of the story is that China, which is facing 145% or 245% kind of tariffs, and that means they will be really eased out of United States market, and the kind of excess capacity they are sitting with and the deep pockets, they will begin to dump that capacity in Indian market and in our other destinations of exports, EU, UK, and rest of the world. So we may be getting a hit in our exports and in our domestic market, domestic production as well. And the third thing I pointed out was that there is a serious risk of a world economy getting into a kind of a prolonged recession, which may impact India and the economy also like any other. So there is a compounded kind of thing, but that is all evolving situation. One has to see how the negotiations that different countries are having with the United States are able to bring them down, these tariffs. And then what else is done to support the growth and not allow it to go into recession globally. So all of these are open questions which we will find answers to in the next half a year, 5-6 months, are going to be very critical. As of now, I mean, there is some decline in the projections, like RBI projection for India for 2025 and 26 was 6.5% growth rate, but IMF has come down and has brought it down to 6.2 for 2025 and 6.3 for 2026 for India. So there is already some kind of a downward, pressure on the growth rates projected for India. But one has to see how the situation evolves.
Okay. No, Mr. Kumar, you're very strongly pointing out to instances of Chinese dumping in other countries. So do you foresee a very good possibility that inflation in our country may be actually even less than the 4% that Reserve Bank has now forecast for this year?
I think inflation-wise, we are now seeing not so much of an issue. First of all, the crude prices have come down below $75 to a barrel. And all other commodities are also heading downwards because Chinese economy will be slowing down. And that is a major source of consumption of these commodities. So that is one factor. Then the projections of our monsoon, our predictions of our monsoon are going to be that it is going to be the normal one, and that helps in keeping prices in India in check. So I think from every region or direction, you could feel very much convinced that inflation will remain range bound, so to say. And different surveys are also projecting the inflationary expectations remaining anchored.
But, the normal way in which we are made to think about monetary policy is that it should be inflation plus 1.5%, the real rate. So most people were arguing for 4% CPI forecast, add 1.5%, which is seen as the real rate, and 5.5% would be the, the end rate of this rate cutting cycle. Do you think it can be even more, like, 5/4 or 5%, considering that there are serious disinflationary pressures coming from the global environment?
This is something which one has to take a call. And, the frequency of MPC meetings is, I think, very sensible. Every other month we meet. And so we will take a call when the more up-to-date numbers are available. And it's hard to say at this stage. But all of us in MPC were very much concerned about what is happening in the world economy and how it would impact India. and if necessary, we take. We sort of take action accordingly. So right now, it would be very hard for anyone to say that it will go down to which level. But I think everyone is concerned and is watching and very cautiously. And there would be, I'm sure, no effort will be spared from either RBI or the government of India to sustain and protect or preserve growth rate.
Okay, but what is your own reading? I mean, your arguments are sounding very concerned about the global ambience in terms of a possible recession and possible Chinese dumping. So if you have to choose, do you think you are likely to see lower than forecast growth, as you say, 6.2 that the IMF has put out? What's your own reading? Do you think growth can be much lower than 6.5 and even inflation lower than 4?
At this stage, it is not wise to hazard because the actions can be taken to prevent that from happening. So it is possible that we are able to have a very good deal with the United States, which is very much possible. And it is also possible that other countries can also arrive at some kind of deal with the United States to prevent this global recession from happening in a very serious manner. So all of this is kind of something we need to watch, but not be concerned overly at this stage. So I think that's why I said next few months are going to be very sort of challenging in the sense that we need to be watchful and take action.
Oh, right.
So,
I get your point, sir. You don't want to jump into any conclusion at this juncture. But I have to jump into a commercial break. Coming back in a jiffy, and we have more questions for you. And I will be inviting my other guests, Subhadeep and Abhishek as well, back in a jiffy. Welcome back to our Monetary Policy Special. We have just got the minutes of the Reserve Bank's Monetary Policy Committee's meeting that ended on April 9th. And I have been speaking with the external member, Mr. Nagesh Kumar. Joining me now are two market experts. I have Abhishek Upadhyay, the senior economist at ICICI Securities PD, and Subhadeep Rakshi, chief economist at Kotak Institutional Equities. Subhadeep, Abhishek, welcome to the show. And Mr. Nagesh Kumar, thank you very much for staying on. Abhishek, you all have read the minutes, and you had the advantage of listening to Mr. Nagesh Kumar himself. What are your key takeaways? Are you getting any sense of even more dovishness than you expected? Just what the key takeaways are?
Well, the broad message is very clear. The committee clearly has a very strong conviction about the inflation outlook. At the same time, clearly compared to the last meeting, the downside risks to growth have increased, and that's why the committee downgraded the numbers also. With inflation expected to be a target and output gap, which is negative, likely to stay negative. Also, some of the worries on the external front, which were there, have persisted. But what has also happened is that dollar has actually weakened. There were worries that dollar may gain when if US were to impose high tariffs, but that has not happened. Also, crude prices have come down, other commodity prices have come down. So from overall, taking all these things together, it was quite clear that a rate cut was to be done. At the same time, more importantly, the committee is also guided for future easing by changing the stance to accommodative. There is some, it appears there is some difference in views, particularly in the external members, about whether immediate rate cut, is a done deal in the June meeting. One of the external members indicates that he's voting for the current stance only because rate hikes are on the table, not because immediate easing is imminent. Another member talks about upside risk to inflation, presumably from on account of currency weakness, etc.
Yes.
Our own view is there are downside risks to both inflation and growth based on information we have currently. And therefore, we pencil in at least 50 basis points or more cuts from MPC.
Okay, thanks for that. Yes, I did notice Saugata Bhattacharya saying that, giving a sense that he is not game for a cut every time. At least that's the sense one got. Suhadeep, any key takeaways that wants you to change your mind in terms of how many rate cuts and when?
So, Lata, we were at 75 to 100 bips of rate cuts even going into the policy, right? So from that perspective, we were ahead in terms of what the consensus was expecting at around 50 bips. Look, it is in some sense derived from the fact that growth is on the weaker side. And especially after the tariffs have been imposed, of course, we have seen a lot of flux after that. There is a downside in terms of the growth, and we are looking at a wide range of around 5.8 to 6.2% kind of a growth with a point estimate of around 6%. With this kind of a growth and our inflation forecast being at around 4%, the growth inflation mix, the output gap opening up, helps in our call in terms of the, let's say, 75 to 100 bips. So when we read the minutes, I think it's important to note that even Dr. Ranjan is talking about the concerns on growth now being much more than the concerns on inflation. And to that extent, the accommodative stance, as well as, if you look at the global scenario, kind of indicates that the push should be towards further rate cuts. Of course, there will be divergence of opinion in terms of whether it's consecutive or whether you wait and do the rate cuts.
Suhadeep, 1 minute. My pointed question to both you and Abhishek is the dovishness more than what the market has factored in? For instance, Suhadeep, tomorrow should we see yields lower?
Good question, because see, I think it is, for me, my read was that it is a little more dovish than what the market was expecting.
Okay, that was my reading as well. So, I mean,
yes, I think that should warrant some kind of a reaction. Whether now the OIS or the markets kind of look at a further 25 bips from the 50 bips of consensus, I think that we'll figure out. But I think
fair enough.
It is.
No, I agree. It will be more dovish because we are mentally also, we have become a little more worried about global growth. Abhishek, very quickly that question. Is it more than what the market has factored in? What may the minutes do to the markets tomorrow?
Difficult for a favorable surprise, Lata, with 10-year yield already close to 6.3 levels. End of March, we were closer to 6.6. Now we are closer to 6.3. Very difficult for, these minutes to, by itself lead to, further another, sharp leg down in yields. I don't see that happening.
Okay. Well, let me toss then, get the final word from Mr. Nagesh Kumar himself. So, there are a lot of people who share the grimness of the global environment that you have very nicely explained in your minutes. The US accounts for 4 trillion of exports, which is, almost the entire Indian GDP. That's the kind of exports they consume, and they were consuming it at 2.5% tariffs. Now you take all the average 20%, 25% on automobiles and steel and aluminium, and plus add the 10% on all goods, and plus add the extra tariffs on China. Clearly, the 2.5% has gone to 25%. Now, we are looking at a very serious situation. No matter what advantage we have over Vietnam or Bangladesh, that market is now going to come at a huge price. So do you think there will be a scope for a double cut at some point? What I mean is a 50 bips in one go.
Yeah. Well, Lata, as I said earlier, these are positioning, the tariffs which have been announced. They are kind of the starting point of a negotiation or discussion. So I do not think that at the end of the day they will hold. And so there will be in negotiations between different governments, different countries and all that. So the picture would become clear in, say, 6 months down the line. And then only you will be able to decide and, how much of a hit I'm taking in terms of my growth projections and what it means for our inflation, and then accordingly craft a response, or it is very open at this stage whether there will be further cut, whether they will, and how many of them, and whether double or single. So I think we have to keep watching and reacting as we go along.
Okay. And is your sense on inflation that we are going to be positively surprised because so many countries will not be able to push their goods to the US and will be looking for a home? See, the Asian output gap is really large. Whatever be the global output gap, there is no doubt that Asia was the production house of the world, and now that output will look for a home. So should we bet on much more serious disinflation?
Possibility, but again, it depends on what action government of India will take to prevent this dumping from coming to Indian shores, for instance. And if it is prevented, then it is not going to be that serious.
Okay.
But if it is allowed to come to our shores, then yes, it would be affecting the prices in the economy.
That's a very fair point, sir. There are people who are complaining already that the anti-dumping on non-ferrous metals is more expensive than the imported prices, and therefore it can actually be a bit inflationary. But thank you very much for giving us a many-sided insight into what is the thinking of the Monetary Policy Committee. And thank you, Abhishek and Suvadeep, for giving me an idea of how the market may interpret. As you all point out, already a lot of dovishness is baked into the yields. At 6.3%, how much more can the yields react? That's a good question. Thank you very much for joining me on this special monetary policy show.
Hello and welcome to this special show. No, you're not fine the way you are. That's how the latest book by Dutch historian Rutger Bregman urges people to think outside their comfort zone. The book, titled Moral Ambition, shows you a path to make a difference to the world rather than just watch from the sidelines. The author argues that a 40-year full-time career consists of around 80,000 hours, 10,000 work days or 2,000 work weeks. But how you spend that time is the most important moral decision of your life. What should be the main ingredients of moral ambition? Where to start in terms of identifying the world's problems, and do money and idealism go together? Those are some questions that the book addresses. Joining us right now is the author, Rutger Bregman himself. Bregman had made headlines in 2019 in Davos for calling out billionaires for tax avoidance and flying in private jets to talk about climate change.
This is my first time at Davos, and I find it quite a bewildering experience, to be honest. I mean, 1,500 private jets have flown in here to hear Sir David Attenborough speak about, how we're wrecking the planet. And I hear people talk in the language of participation and justice and equality and transparency. But then, almost no one raises the real issue of tax avoidance, right? And of the rich just not paying their fair share. It feels like I'm at a firefighters conference and no one's allowed to speak about water, right? there was only one panel, actually.
Well, we've had two. You're the second of our panelists.
There was only one panel.
Let's go there.
One panel hidden away in the media center that was actually about tax avoidance. Yeah. I was one of the 15 participants. So something needs to change here.
Rutger, thank you so much for joining us on the program today to speak about your latest book, Moral Ambition. One of the lines that the book begins with is no, you're not fine just the way you are. People may spend their whole lives climbing up the ladder of success only to find, once they reach the top, that the ladder is leaning against the wrong wall. Why did you feel it is important to shake up your readers and their thinking and their approach towards work and professional life?
Yeah, well, my reasoning is pretty simple. In the first place, we have a lot of very big global problems. So 15,000 kids die from easily preventable diseases every day. 85% of the world population is below the poverty line of the country in which I live, the Netherlands. We have the threat of the next pandemic that may be just around the corner. There's war, there's democratic backsliding. There are a lot of things we got to do something about. But then the second thing is that a lot of people are currently stuck in jobs that don't really add all that much value. And I'm not talking about teachers or nurses or care workers. No, I'm talking about people who often went to great universities, who have beautiful resumes, who may be a marketeer or a banker or a corporate lawyer or whatever. And still, at the end of the day, they have the feeling that they don't really contribute all that much. There's one big study that showed that around 25% of people in developed economies even think that their own job is socially meaningless. So there's a huge waste of talent going on. And my book is basically a call to arms. It says that if you are very talented, if you have a little bit of ambition, then you should use that to make the world a wildly better place. And I call that moral ambition. It's the combination of the activism or the idealism of an activist and the ambition of an entrepreneur. When those two things come together, something really magical starts to happen.
Right. But at what stage and at what point should people start thinking about this? Because the common line that we hear when someone talks about changing the world or launching a political party or working towards a social cause is that you can't change the world, or it's better to stick to the beaten path, have a work life balance, earn a good enough amount of money for your family, for your holidays, so that you can retire well and early. Nothing wrong with it, but perhaps, according to your book, one wouldn't be very satisfied with this way of living. But how does one come to the conclusion that you're cut out for making a difference to the world, for leaving an impact? And where do you really start off?
Well, history is littered with examples of small groups of really thoughtful, committed citizens who made a massive difference in the fight against some of the greatest problems we face as a species. In the book, I talk, for example, about the abolitionists, those who took up the fight against the slave trade and against slavery. And you got to remember that in the 18th century, in a country like the United Kingdom, for example, this was really, really unpopular. The United Kingdom was making an enormous amount of money on the slave trade and on slavery and on having this whole system of colonies. But then there was a small group of mostly entrepreneurs and businessmen who said, this is the greatest moral atrocity of our time. We should kickstart a movement against this. So it is really small groups of really committed people that can make a difference. History shows us this. And I've tried to write sort of a self-help book, a guide that people can use if they also want to follow that path. Now, I got to say, if you want to read a book that will make you more relaxed or more mindful or happy or whatever, then you should probably not read my book. There are thousands of self-help books that will teach you, how to do less. But this is a book about how you can do much more and how you can really leave your mark on history.
Right. Now, speaking about leaving your mark on history, you speak about what startup founders, young entrepreneurs can also do. Your book also argues, and you've said this, that a lot of times we are launching companies or launching solutions to the problems we never really know we had, or it's probably too simplistic. So what is the kind of mindset or moral ambition that young entrepreneurs need to have?
Yeah. So we got to realize that ambition, it's just raw energy. It can fuel a rocket that goes to Mars, but it can also fuel a bulldozer that, waltzes over a rainforest. So it's just energy. And what really matters is how you use it. What I currently see is that there are a lot of young entrepreneurs starting new companies that, create these products that are perhaps in the best scenario, okay, but in the worst scenario are actively harmful. So there's a famous quote from someone who worked at Facebook a long time and who said that the best minds of my generation are thinking about how to make people click on ads. And that is pretty sad, isn't it? That you have all these really smart people who could technically do an enormous amount of good, in a country like India in particular, if you would take up the fight against some of the greatest health problems. just imagine how many lives you could save. It's honestly extraordinary. So it's always a little bit sad to me when those very, very talented people, spend so many hours on something that doesn't actually matter all that much. Maybe you can make a lot of money with it, but in the end, what are you going to think about when you lie on your deathbed? About all the PowerPoints from colleagues that you didn't see, about all the long meetings that you didn't attend, or about the actual impact you made. That's I think what really counts in the end.
Right. How would you define moral ambition today? Of course, when you hear the term, you immediately think about doing something good for society. But according to you, what would be the 4 main ingredients of moral ambition that youngsters, that entrepreneurs, industry veterans, CEOs can keep in mind?
So I co-founded an organization called the School for Moral Ambition that helps as many talented people as possible to pivot their career and to use their resources, whether it's their talent or their capital or their network, to make the biggest possible difference. And we use a simple framework to help people focus on those biggest problems. It's called the SSS framework. So we focus on problems that are really sizable, they're very big, they're solvable. You got to have some plan of, what to do about them. And most importantly, they're also sorely neglected. If you go and work on the issues that everyone else is already working on, then you're not going to make the biggest impact. So, for example, I'm someone who grew up in a rich country, in the Netherlands, in Northern Europe. If I want to, help as many people as possible and to improve their health, then, probably focusing just on the Netherlands, where we already spend a huge amount of healthcare, is not going to make the biggest possible difference. If I would shift my focus and focus on something like malaria, for example, 600,000 people die from malaria every single year, mostly kids under 5. Well, then I can suddenly do much more good, right? Because it is so neglected. So if you're really morally ambitious, you gotta dare to go where others don't go. You gotta be able and be willing to do the unpopular or the unsexy things.
Right. And does this mean, because when we hear about working for a social cause, working for the betterment of society or world, you often hear that you need to lead an austere life. Can one have a day job where you're working as somebody in the corporate sector, have the ambition of rising up the corporate ladder, yet be an idealist? Can money-making, idealism all go hand in hand together?
Well, I think that money is pretty important if you want to make a big difference. The former UK Prime Minister, Margaret Thatcher, she once said that the Good Samaritan, from the Bible, he didn't just have good intentions, he also had money. So yeah, if you want to make a biggest possible difference, you got to find some way to attract capital. And here, I think philanthropists or brave philanthropists can make an important difference. If you study these great movements of the past, I already mentioned the abolitionists. They weren't financed by governments. Government was not giving subsidies to these people who fought the slave trade because the government was making an enormous amount of money facilitating the slave trade. The same was true for businesses. They were certainly not giving money. So there you need very brave individuals who are willing to go against what is fashionable, against what is popular. And look, I also realize that there are a lot of young people who are like, well, how am I going to buy my own house? How can I make my own career if I don't climb this corporate ladder? And I do understand that. I just think that there's more to life, probably. And for a lot of these talented, privileged people, my message is, look, you can only drive one car at a time, right? At some point, it's okay. And then other things become much more important. And it would be a shame if you lie on your deathbed and you're like, oh, as you said, I've been climbing the wrong ladder my whole life.
Right. You've spoken about how awareness is the best starting point, while for many it has become the end goal. What do you think we need to do in order to become a more satisfied individual, make a difference? And what is the problem, according to you, with the kind of activism that we see?
The reason I wanted to write this book is that, honestly, became a little bit fed up with myself. I'm a writer. I spent 10 years of my career providing my opinions from the sidelines. Indeed, as you mentioned, shouting things like taxes, taxes, taxes when I was invited to Davos. And that can be very satisfying, but it's also quite easy. Here I was, on the sidelines, watching the people who are doing the real work, who are in the arena, with the sweat on their faces. And I started experiencing this emotion that I like to describe as moral envy. I was just jealous of the people who have some skin in the game, who do the real work. And I indeed realized that awareness is vastly overrated. I had spent 10 years in the awareness industry, providing my opinions. But very often, people don't do much with what they know. To give you one simple example, most people know that billions of animals are terribly tortured in what we call factory farms. Or we can know about that at least, but most of us just choose to ignore that. So the real challenge is in bridging the gap from awareness to action, to actually do something. And so I wanted to write a book that would be a big kick in the butt for myself, that would force myself to make a difference. And hopefully it's helpful for others as well. I've, as I said, I've co-founded this organization now, completely changed my life, turned into a social entrepreneur. And that has taught me many lessons, and also, caused me to believe that it might be possible for others as well.
All right, just stay with that thought, Rutger. We have to take a short break, but don't go anywhere. When we return, this conversation with Rutger Bregman, the Dutch historian, will continue on his book, Moral Ambition. We'll get you much more after this break. Welcome back. You're watching CNBC-TV18, and we are in conversation with the Dutch historian Rutger Bregman on his latest book, Moral Ambition. I just want to go back to that Davos moment of 2019 when you called out billionaires for tax avoidance, for using, burning aviation fuel to fly down to Davos in private jets as well. How was that moment in your career as a historian, as an author? Were you invited to Davos again after that incident? And what was the kind of feedback you received?
So for some reason, they never invited me back. I guess it was something I said that they didn't particularly like. But I have been wondering, obviously, after those years, like, how can we make more progress in the fight against tax avoidance and tax evasion? Because wherever you go, whether it's the United Kingdom or India, the United States or the Netherlands, everywhere billionaires have lower effective tax rates than working class people. And that seems to me utterly unreasonable and utterly unfair. Now, you can just shout that and say that and go viral for it, but wouldn't it be much more effective to build a SWAT team, a very dedicated cohort of people who want to dedicate their career to fighting for tax avoidance and tax justice? So that's what we're doing right now. We are starting a campaign on Wall Street in New York. We are recruiting the best wealth managers, the best bankers, the best fiscal lawyers, and we are convincing them to pivot their career, basically saying, look, you're now working on the wrong side. You can leave your job and work for us. It's only going to be for the best of the best. So it's very hard to get into one of our fellowships, as we call them. But that's what we're going to do. We've already been doing it for other cause areas. So, for example, in Europe, we've recruited a bunch of marketeers and corporate lawyers who quit their job in order to fight the tobacco industry, big tobacco. And in this way, we want to make doing good more fashionable. We think that we should move towards a world where the best and brightest work on the most important global problems. It's as simple as that.
Right. You've also said that when you start off with your thinking process about what kind of change you want to bring about, you should really try and understand what does the world need right now, and whether your approach or what you're working towards can go wrong maybe 10 years down the line and cause more harm to society. Keeping that in mind, which are some of the biggest, if you had to say, top 3 world problems that entrepreneurs can start thinking of working towards right now and maybe have a cult to work around with?
Yeah. So I'm not sure how famous the Lord of the Rings trilogy is in India, but that's always the comparison I like to make. Gandalf, the wise wizard, he never asked Frodo, hey, Frodo, what's your passion? Right? He said, look, if you want to save the world, this is what you need to do. You need to throw the ring into the fiery mountain, right? And that's also how we like to work. So we work with so-called prioritization research. It's a whole branch of social science, people who spend a lot of time thinking about, indeed, the question you just asked. What are the biggest problems we face as a species right now? It's difficult to make a definitive ranking, but there are a couple of obvious examples that come to mind. Think, for example, the threat of the next pandemic. We've just gone through a pretty bad one, COVID, that cost us 20 million lives across the globe. And still we know that the next one could be much, much worse. Then you wonder how many people are currently working on preventing that next pandemic. And it's really outrageous. So currently, the whole world spends only $1 billion on researching emerging infectious diseases. That's about as much as Americans spend bleaching their teeth every year. You've got the Convention Against Bioweapons, a very important organization, and it has the budget of an average McDonald's franchise. So it's super, super neglected. We need way more smart doctors, inventors, entrepreneurs, lobbyists to fight for global health and for pandemic prevention. There are also so many innovations that need to be done here. So that's one example. Now I can go on for a long time. Another one that I think is really, really important is the fight against factory farming. I think if the historians will look back on our age and will think about, okay, what are some of the most immoral things people did back then? I think the way we treat animals is very high up on that list. We're talking about 80 billion animals slaughtered every year. And every week, scientists come in with new evidence about how sensitive and how sentient these animals are, even though we lock them up in these horrible prisons where they don't see the daylight, only if they go to the slaughterhouse, perhaps. So that, for me, is one of those examples where historians will look back on us and say, oh, my God, that is like similar to the people who practiced slavery or the people who, did all kinds of other horrible things in the past.
Right. You've spoken about the need for lowering your threshold to act. You said that at different points in history, every individual has their own threshold to act, a tipping point to taking action. How do we lower that threshold? If you were explaining that to someone in college, or maybe a young student who's finishing school and going to college, how would you explain that?
So when I was a young boy, I was fascinated by the history of the Second World War in my own country of the Netherlands. As you probably know, the Nazis invaded the Netherlands and started abducting many, many Jews. And many of them, millions of them, were murdered in concentration camps. And there was just a small percentage of the population that resisted the Nazis at the time. And already as a young boy, I was fascinated by the question, what made these people different? Why were some people so brave that they would risk their own lives to help persecuted people? And I've done a lot of research into that question for this book. And I discovered that there actually isn't such a thing as the altruistic personality type. There have been lots of studies, hundreds of interviews done, but researchers really couldn't find anything. These very brave people, they could be men or women, rich or poor, young, old. It's really a cross-section of the population. But what they did discover was that this resistance was very contagious. So there was one factor in particular that predicted very well whether people would join the resistance, yes or no. And it was the question, were you asked to join the resistance, right? In 96% of cases, when people were asked to join the resistance, people said yes. So that creates a very different perspective on how we can actually make a difference and indeed lower our threshold to act. It's by surrounding ourselves with other brave people, with other morally ambitious people, because then it can become infectious. And that's exactly what you saw during the Second World War, is that resistance wasn't evenly spread out over the country. No, there were like pockets, local pockets of resistance. where people started infecting each other, and they saw other people doing brave things, and then they were like, hey, maybe I can do that as well. And got to remember, it often starts small, right? You take a first step and then another step, and then it escalates, and you become someone who you never thought you could become. And I think that's the way we lower our threshold to act.
Okay, you've spoken about how you once saw a school which said Hogwarts for do-gooders. Would you say we need more Hogwarts for do-gooders around the world?
Absolutely. We need many, many more of them. This is an extraordinary school based in London. It's a little bit like a startup incubator, but it doesn't help people to start their own for-profit to make as much money as possible. No, it helps you to build a non-profit that helps as many people as possible. So it's incredibly hard to get into. It's only for the best of the best. If you've gone to Harvard, well, that's very nice, but it's not nearly enough. And then they incubate all these kind of non-profits. Quite a few of them work in India, by the way, because they're really looking to maximize their impact, to save as many lives as possible, for example, and help as many people as possible. And it's just a beautiful example of how we can redefine success. I think that throughout history, we've often seen that societal renewal starts with a redefinition of what it means to be successful. And currently around the world, we are sadly ruled by, the most immoral elites. I currently live in New York in the United States, and it's a pretty clear example where you have, a whole establishment that is becoming more and more immoral by the day. But we've been here before, and I think there can be a counter-revolution. We've seen that in the UK in the late 18th century. We've seen it in the United States in the 19th and the early 20th century, when people of privilege stepped forward and said, okay, now it is enough. And now we're going to make a difference, not by pointing at others, not by blaming others and using the finger. No, it is by doing better ourselves, by giving a better example ourselves. And that's what we desperately need today.
Okay, my final question would be, in the India context, how do you think individuals, citizens can raise their moral ambition? Today, there is great power competition in the world, to put it very simply. It's about who is going to lead the AI revolution, who's going to lead the economic race, who's going to be the strongest player in the manufacturing supply chain. So when you have this great power competition between India and China, China and the United States, fight for supremacy at the top, what kind of moral ambition do you feel that someone in the Indian context needs to have?
Well, at the heart of being morally ambitious, there's the recognition that we humans all have equal dignity, all have equal worth. So it is absolutely fine to care deeply about your own country. But I think that we should move towards a world where all countries can flourish, where all nations can flourish. And if anyone, in India is watching this and, maybe went to one of those top universities, I think the message of this book and my message today is use your privilege, not just check your privilege, but use your privilege to make the world a wildly better place. And obviously it makes a lot of sense to start in your own country because there are still so many big challenges to solve in India. If I only think about, the health aspects, one of the most cost-effective interventions, for example, is just to make sure a bigger percentage of the population is vaccinated. You can do an insane amount of good in that way. Just think about your life in a bigger way. Think about how you want to be remembered. I think that's the main message of the book.
All right, Rutger, thank you so much for your views on your book, Moral Ambition. That's all we had time for on this broadcast. Thank you for watching. Goodbye.
Welcome to this Monetary Policy Special. The Monetary Policy Committee of the Reserve Bank voted unanimously for a rate cut on April 9th and an accommodative stance And the minutes of the policy, which are just out, indicate a strong dovish tone in the writings of practically all the members. Governor Sanjay Malhotra has summed up the arguments beautifully in his minutes by saying that with CPI inflation aligned to the MPC's target of 4% and growth moderating, it was logical for the MPC to cut rates and change the stance to accommodative. Strongly agreeing with him were the other members, including Mr. Nagesh Kumar, who has actually very strongly pointed to the hurdles to growth emanating from the global sphere thanks to the US tariffs. Joining me now to comment on the minutes and the state of the global economy and the Indian economy is Mr. Nagesh Kumar himself, external member of the MPC. In a bit, I will also be joined by Abhishek Upadhyay of ICICI Securities PD and Suvadeep Rakshit of Kotak Institutional Equities to give us the market impact and market reading of the minutes of the MPC. But first, let me welcome Mr. Nagesh Kumar to the conversation. Thank you very much, Mr. Kumar, for joining me. First, if you can parse the global environment, sir, the way you have written, it looks like a recessionary conditions are imminent. Can you tell us how bad this impact can be on Indian growth? Should we be prepared for something less than 6.5?
I mentioned in my statement that there are 2 or 3 things one should worry about, because the meeting happened during 7th to 9th, and that was just exactly 1 week after the 2nd April Liberation Day announcement of President Trump, where he slapped very high tariffs on every country. Now, some of our Indian economists and analysts are reading something positive in it because India was, sort of slapped with 26% tariffs vis-a-vis other countries, our peers, a much higher, percentage. So we were taking a bit of relief that we may be spared lightly, and we may actually be able to make more inroads in the United States market because our peers are facing higher tariffs. Now, but that is only part of the story. The second part of the story is that China, which is facing 145% or 245% kind of tariffs, and that means they will be really eased out of United States market, and the kind of excess capacity they are sitting with and the deep pockets, they will begin to dump that capacity in Indian market and in our other destinations of exports, EU, UK, and rest of the world. So we may be getting a hit in our exports and in our domestic market, domestic production as well. And the third thing I pointed out was that there is a serious risk of a world economy getting into a kind of a prolonged recession, which may impact Indian economy also like any other. So there is a compounded kind of thing, but that is all evolving situation. One has to see how the negotiations that different countries are having with the United States are able to bring them down, these tariffs. And then what else is done to support the growth and not allow it to go into recession globally. So all of these are open questions which we will find answers to in the next half a year, 5-6 months, are going to be very critical. As of now, I mean, there is some decline in the projections, like RBI projection for India for 2025 and 26 was 6.5% growth rate, but IMF has come down and has brought it down to 6.2 for 2025 and 6.3 for 2026 for India. So there is already some kind of a downward, pressure on the the growth rates projected for India, but one has to see how the situation evolves.
Okay. No, Mr. Kumar, you're very strongly pointing out to instances of Chinese dumping in other countries. So do you foresee a very good possibility that inflation in our country may be actually even less than the 4% that Reserve Bank has now forecast for this year?
I think inflation-wise, we are now seeing not so much of an issue. First of all, the crude prices have come down below $75 to a barrel. And all other commodities are also heading downwards because Chinese economy will be slowing down. And that is a major source of consumption of these commodities. So that is one factor. Then the projections of our monsoon, our predictions of our monsoon aren't going to be that it is going to be the normal one, and that helps in keeping prices in India in check. So I think from every sort of region or direction, you could feel very much convinced that inflation will remain range bound, so to say. And different surveys are also projecting the sort of inflationary expectations remaining anchored.
But the normal way in which we are made to think about monetary policy is that it should be inflation plus 1.5%, the real rate. So most people were arguing for 4% CPI forecast, add 1.5%, which is seen as the real rate, and 5.5% would be the the end rate of this rate cutting cycle. Do you think it can be even more, like 5/4 or 5%, considering that there are serious disinflationary pressures coming from the global environment?
This is something which one has to take a call, and the frequency of MPC meetings is, I think, very sensible. Every other month we meet, and so we will take a call when the more up-to-date numbers are available. And it's hard to say at this stage, but all of us in MPC were very much concerned about what is happening in the world economy and how it would impact India. And if necessary, we we sort of take action accordingly. So right now, it would be very hard for anyone to say that it will go down to which level. But I think everyone is concerned and is watching and very cautiously. And, there would be, I'm sure, no effort will be spared from either RBI or the government of India to sustain and protect or preserve growth rate.
Okay, but what is your own reading? I mean, your arguments are sounding very concerned about the global ambience in terms of a possible recession and possible Chinese dumping. So if you have to choose, do you think you are likely to see lower than forecast growth, as you say, 6.2 that the IMF has put out? What's your own reading? Do you think growth can be much lower than 6.5 and even inflation lower than 4?
At this stage, it is not wise to hazard because the actions can be taken to prevent that from happening. So it is possible that we are able to have a very good deal with the United States, which is very much possible. And it is also possible that other countries can also arrive at some kind of deal with the United States to prevent this global recession from happening in a very serious manner. So all of this is kind of something we need to watch, but not be concerned overly at this stage. So I think that's why I said next few months are going to be very sort of challenging in the sense that we need to be watchful and take action.
Oh, right.
So, yeah.
I get your point, sir. You don't want to jump into any conclusion at this juncture. But I have to jump into a commercial break. Coming back in a jiffy, and we have more questions for you. And I will be inviting my other guests, Subhadeep and Abhishek as well, back in a jiffy. Welcome back to our Monetary Policy Special. We have just got the minutes of the Reserve Bank's Monetary Policy Committee's meeting that ended on April 9th. And I have been speaking with the external member, Mr. Nagesh Kumar. Joining me now are two market experts. I have Abhishek Upadhyay, the senior economist at ICICI Securities PD, and Subhadeep Rakshi, chief economist at Kotak Institutional Equities. Subhadeep, Abhishek, welcome to the show. And Mr. Nagesh Kumar, thank you very much for staying on. Abhishek, you all have read the minutes, and you had the advantage of listening to Mr. Nagesh Kumar himself. What are your key takeaways? Are you getting any sense of even more dovishness than you expected? Just what the key takeaways are?
Well, the broad message is very clear. The committee clearly has a very strong conviction about the inflation outlook. At the same time, clearly, compared to the last meeting, the downside risks to growth have increased, and that's why the committee downgraded the numbers also. With inflation expected to be a target and output gap, which is negative, likely to stay negative. Also, some of the worries on the external front, which were there, have persisted. But what has also happened is that dollar has actually weakened. There were worries that dollar may gain when if US were to impose high tariffs, but that has not happened. Also, crude prices have come down, other commodity prices have come down. So from overall, taking all these things together, it was quite clear that a rate cut was to be done. At the same time, more importantly, the committee is also guided for future easing by changing the stance to accommodative. There is some, it appears there is some difference in views, particularly in the external members, about whether immediate rate cut, is a done deal in the June meeting. One of the external members indicates that he's voting for the current stance only because rate hikes are on the table, not because immediate easing is imminent. Another member talks about upside risk to inflation, presumably from on account of a currency weakness, etc.
Yes.
Our own view is there are downside risks to both inflation and growth based on information we have currently, and therefore we pencil in at least 50 basis points or more cuts from MPC.
Okay, thanks for that. Yes, I did notice Saugata Bhattacharya saying that, giving a sense that he is not game for a cut every time. At least that's the sense one got. Subhadeep, any key takeaways that wants you to change your mind in terms of how many rate cuts and when?
So, Lata, we were at 75 to 100 bips of rate cuts even going into the policy, right? So from that perspective, we were ahead in terms of what the consensus was expecting at around 50 bips. Look, it is in some sense derived from the fact that growth is on the weaker side. And especially after the tariffs have been imposed, of course, we have seen a lot of flux after that. There is a downside in terms of the growth, and we are looking at a range of around 5.8 to 6.2% kind of a growth with a point estimate of around 6%. With this kind of a growth and our inflation forecast being at around 4%, the growth inflation mix, the output gap opening up, helps in our call in terms of the, let's say, 75 to 100 bips. So when we read the minutes, I think it's important to note that even Dr. Ranjan is talking about the concerns on growth now being much more than the concerns on inflation. And to that extent, the accommodative stance, as well as, if you look at the global scenario, kind of indicates that the push should be to
Hello and welcome to India Business Hour. I'm Shriram Finance. The headlines that we're tracking for you this evening.
We will pursue them to the ends of the earth.
Prime Minister Modi vows to punish the perpetrators of the Pahalgam terror attack, which left 26 people dead. The Kashmir police say 2 of the 3 terrorists involved in the attack are Pakistani citizens. Home Minister Amit Shah and Defence Minister Rajnath Singh brief all parties on the government's response to Pakistan. The Indian Navy test fires missiles in the Arabian Sea as tensions with Pakistan escalate. India also suspends all visas to Pakistani nationals from the 27th of April, suspends the Indus Water Treaty and downgrades ties with Islamabad. Pakistan terms India's suspension of the Indus Waters Treaty as an act of war, suspends all trade with India, closes Pakistan's airspace for Indian airlines. All bilateral treaties with India put in abeyance. The travel and tourism industry in Kashmir protests the terror attack with a rally and a candlelight march in Srinagar. Jammu and Kashmir's Chief Minister Omar Abdullah requests other chief ministers to take extra care of Kashmiri students amidst reports of threats and harassment in UP, Himachal and Uttarakhand. China says there are no ongoing trade talks with the US. This a day after President Trump hinted at a potential tariff cut. Beijing calls on the US to cancel its unilateral measures. Sensex and Nifty snap a 7-day winning streak to end at the low point of the day. Stocks decline across large parts of Asia and Europe as the relief rally stalls worldwide. FMCG major HUL meets estimates in Q4. 2% volume growth is a little higher than expectations. Nestlé's revenue growth remains muted due to rising commodity prices, but the company exhibits operational resilience. Axis Bank beats estimates in Q4. Net interest income increases over 5% annually. Provisions decline 36% sequentially, leading to an improvement in asset quality. Bharti Airtel dials the government over pending spectrum dues worth 74,000 crore rupees, seeks the conversion of the dues into equity similar to Vodafone Idea. That's a CNBC Awaaz exclusive. Tata Power's CEO Praveer Sinha sees an opportunity to supply solar modules to the US and other markets and is contemplating capacity expansion. Also expects to have a nuclear power generation unit up and running by 2030. That's an exclusive. 9 people, including children, killed in Ukraine's capital, Kyiv, in a wave of Russian strikes. Ukraine's Zelensky cuts short a trip to South Africa. US President Trump blames Zelensky once again for the failure to strike a ceasefire deal. Let's go straight to the top story tonight. Ties between India and Pakistan under severe strain in the aftermath of the horrific Pahalgam terror attack, which killed 26 and injured 17. Speaking at a rally in Bihar, Prime Minister Modi has vowed to punish perpetrators. He said India would identify and track every terrorist and will pursue them till the end of the earth. Jammu and Kashmir police said that 2 of the 3 terrorists involved in the attack are Pakistani citizens. The police has also announced a reward of 20 lakh rupees for anyone who can provide information about them. The government convened an all-party meeting in Delhi to brief lawmakers on the deadliest attack on civilians since Mumbai 26/11. Top union ministers, Congress President Mallikarjun Kharge, Congress MP Rahul Gandhi, NCP MP Supriya Sule and other opposition lawmakers also in attendance. The MPs observed silence for 2 minutes in the memory of the victims of the Pahalgam attack. Home Minister Amit Shah and External Affairs Minister S. Jaishankar briefed President Draupadi Murmu, who is also the Supreme Commander of the Armed Forces. Meanwhile, J&K Chief Minister Omar Abdullah convened an all-party meeting in Srinagar. National Conference Chief Farooq Abdullah, PDP's Mehbooba Beg and other senior leaders attended the meeting.
India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished.
We also support the steps taken by the Union government announced yesterday. We extend our deepest condolences to the families who have suffered loss. We share in your sorrow and stand united with you in this time of profound grief. We appreciate the spontaneous, peaceful demonstration across towns and villages across the length and the breadth of Jammu and Kashmir, which exemplify our unwavering commitment to peace, communal harmony, and the rule of law.
The Chief Minister of Jammu and Kashmir, Omar Abdullah, and the Cabinet Committee on Security, India's highest decision-making body on national security, unleashed its response against Islamabad on several fronts. Now, the Indus Waters Treaty has been suspended. All visas to Pak nationals have been cancelled. India has also downgraded its diplomatic ties with Islamabad by reducing its mission strength. Pakistan has been asked to do the same. The Atari border in Punjab, the only permitted route for Indo-Pak trade, has been sealed. Pakistan has said that any attempt to stop or divert flow of water belonging to Pakistan as per the Indus Waters Treaty will be considered an act of war. Islamabad, among a host of measures, also closed its airspace to Indian airlines. Parikshit joins us now to take us through the significance of the treaty and what its suspension could mean for both nations. Parikshit.
What is the Indus Waters Treaty? The objective of this treaty is to ensure satisfactory utilization of waters of the Indus system by Pakistan and India. It was signed between India and Pakistan on 19 September 1960 after 9 years of talks and brokered by the World Bank. The treaty was signed by then Prime Minister Jawaharlal Nehru and then Pakistani President Ayub Khan. As per treaty, India shall receive water from the eastern rivers, Satluj, Beas and Ravi, and Pakistan is to receive water from Indus, Jhelum and Chenab. This treaty is critical for Pakistan